have been getting on the labor market, the numbers are expected to deteriorate quite significantly, and hence they would be right in order to try to bring about a bit of stabilization. I think broader picture, for most of 2025, we have been trading on trade uncertainty owing to the tariff announcements. What we've seen over the second half of 2025 is as these trade deals are getting signed, it's providing a better anchor for the markets. We're also seeing, quite a strong optimistic picture emanating from the Q3 earnings season. That's also giving markets a bit more comfort in terms of the numbers and how corporates are actually navigating, the higher tariffs that companies are facing. So I think the macro picture still remains quite optimistic with, earnings being delivered by companies, with the US tracking an average earnings growth of about 14%, which is, above the expectation we had prior to entering the season. So I think, given the seasonality, given the fact that we finally are expecting to come out of the shutdown, the Fed easing cycle, gathering pace, it is an environment for a risk-on market.
Well, Anika, it's Katie in London. Thank you for your time this morning. When we're talking about the case to actually make a rate cut in December and, of course, in 2026 as well, it's coming at the same time of conversation in Washington and across the United States of more fiscal stimulus, of ideas of a $2,000 dividend payment to all Americans. And I imagine that, of course, that hasn't been backed up yet of how the math actually works on that. But you can see the sentiment is showing up. He's even talking about a 50-year mortgage to try to get affordability down. If that's the concern of the White House, are there other measures that are maybe going to be coming to the fore that would eliminate the need for a rate cut so soon?
No, that fiscal concerns of the U.S. economy remain the big overhang. This is why we have seen a much weaker dollar in 2025. And, this is why we've also seen a lot of those safe haven flows come back in. So that remains a predominant concern. And obviously, we have the big, beautiful bill coming into fruition in 2026. And that's also going to weigh on fiscal concerns emanating from the U.S. market. So I think that will broadly provide a very important anchor for safe haven flows into, precious metal markets, as we've seen in 2025.
Anika, good morning. I was looking at some analysis yesterday of earnings reports, earnings season so far, and it suggests this is an analysis of audio attached to earnings reports, and it says that CEOs have sounded their least worried about an economic slowdown since 2007. So we've got CEOs in the US not worried about a slowdown, but jobs market data suggesting that we're seeing layoffs. I wonder if that's just a mismatch in timing or whether something structurally interesting is happening here where growth continues but with fewer jobs.
Anna, we've seen quite a few concerns coming out of the earnings season. While we're seeing a broader, higher average earnings growth of about 14%, there are sectors of the economy that are providing more signs of a K-shaped economy, where the lower-end consumer is struggling. That's been quite evident in the consumer staple stocks, in the restaurant stocks that are trading at 52-week lows. And that continues to reverberate back to consumer sentiment. So it is filtering back, and it is resulting in some of those weaker retail flows that you're getting coming into Bitcoin and crypto markets. You do see that filter through. So I wouldn't say it's been an earnings season where all sectors have been performing at par. I would definitely say there is a bit of diversification and a divergence between obviously the mega cap tech stocks, which have done a lot better, with a much higher average earnings growth rate around 27%, whereas the rest of the market are grappling with, trade tariff uncertainty alongside the fact that, the low-end consumer is struggling.
All right. Anika Gupta, Director of Macroeconomic Research over at Wisdom Tree. We thank you so much. Guyana, I feel like what I learned from that conversation is that there is actually a decent case for a rate cut. And I know there's kind of consensus here, even though we're hearing perhaps different from the Fed governor, but she makes a key point. It makes it easier to service the deficit. That's what I heard out of that.
Right, and she's very focused on the weakness of the labour market, it would seem, as some of the data, the Challenger report, for example, yesterday coming through. I was interested in what she had to say about, we talk a lot about K-shaped consumption in the States, but the K-shaped earnings story out of the States, I think, is something that perhaps will gain momentum.
What you're talking about is monetary financing. I
Not me, the world.
Yeah,
Wall Street.
but basically, is that what we're ultimately we're going to end up with? David Solomon was pointing out some big concerns that he has around what is happening with the debt story in the States yesterday.
It's a temporary fix to a long-term issue. Coming up, we're going to continue the conversation around the debt conversation, how it relates to the rest of the world. This is Bloomberg.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something. Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies.
1-1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Wednesday morning, 30 minutes to the start of equity market trading here in Europe. Futures are largely positive. It'll be interesting to see how the FTSE 100 trades this morning. You could see a little bit of volatility around that market. BAE Systems is out with numbers. You've also got an oil story you want to factor in there. But the CAC's positive ahead of a key vote. Euro Stoxx 50 up by 0.5%, Chrissy.
Meantime, let's get a quick check on this bond market here. We're looking at 408 over in the States on the U.S. 10-year. When you look at the European picture, not a ton of movement, virtually unchanged. But, of course, we are barreling towards a French vote after later in today's session, so maybe that'll shake the bond market up.
Yeah, to do with pension reform, isn't it? And that's obviously a key part of whether they get the budget through. Let's pivot to what's going on in where AI meets debt markets. Big tech companies are selling corporate bonds to fuel their AI ambitions. The likes of Amazon, Alphabet, Meta, Microsoft, and Oracle have raised $93 billion this year, more than the previous 3 years combined. But as a debt-fueled AI investment boom takes off, many are worried that a tech bubble of some form is forming. Despite concerns, Bloomberg opinion columnist Julie Wren says bond traders have not lost their cool yet. She writes creditors are still demanding extra yield to fund the AI infrastructure build-out. It's a sign that we are not in a bubble yet. Joining us now with his thoughts, Mark Dowding, fixed income CIO at RBC Blue Bay Asset Management. There may be many, good morning to you, Mark, first of all. There might be many ways to define a bubble and whether we are in one or not. You could look at stocks. maybe Shuli's focused more on what's going on in debt markets and the demand for debt there for AI build-out. What are your thoughts on whether things look bubbly to you right now?
Well, I think you need to differentiate. I think in many respects we're seeing a boom, aren't we, when it comes to actually the money being deployed in the AI space. Projections next year that we're going to see $300 billion of spend. That's a huge amount of money to be throwing at an economy. It's the reason why US growth is going to accelerate next year, not slow down, what with rate cuts, tax cuts and deregulation coming down the pipe as well. So from that perspective, I'd say that we're actually in an AI boom when it comes to the spending that's taking place at the current point in time. But I think you need to differentiate between that and what's happening in financial markets. What's happening in financial markets, obviously with valuations, is a very different story. And that's where we're talking about bubbles, perhaps, when it comes to some of the valuations of some of the stocks that we're looking at in the equity market.
And let me take that thought a little further, because you make the link there between US growth and the AI boom that we're seeing, and then into continued expectation of Fed cuts, which raises some questions. I mean, do you see that the Fed will cut into this boom in AI spend?
Yeah, so look, they're likely to cut in December because in the short term, the data has been a bit soft. But into 2026, I'd contend that you could be looking at a year where you could see 3.5% real growth. On top of that, everyone who I speak to who's sensible in DC would tend to suggest that inflation's more likely to be going up rather than down. So let's put inflation at 3.5%. That's nominal growth of 7%. If you've got an economy doing that, you're not really cutting interest rates during the course of next year. And I don't believe whoever is going to succeed Chair Powell is going to come in as a Trump patsy just to deliver what Daddy wants. I think ultimately what we saw in the elections last week is that inflation affordability matters when it comes to US politics. So the last thing they can really afford in DC is runaway inflation to occur. So I actually think there'll be fewer rate cuts than a lot of people think next year.
What does fewer mean? Fewer, like, if we don't get December, how many do we get next year?
I think we may get none, to be honest, Guy.
Okay, so we're done.
I think we may be one more and done. I mean, that'll put rates at 3.5 to 3.75 compared to that to where nominal growth is. These are normal levels of interest rates.
Where's the 10-year on that?
I think more or less where it is today. I wish I had a more exciting story.
No, it's fine.
But the interesting thing is there'll be a lot of people who started their financial careers after 2008. They look at interest rates today and they say they're way too high because their point of reference was what we saw in the last decade. But those of us with no hair, with longer memories, we probably look at where interest rates are today with the economy doing what it is. We're probably saying these are pretty fair levels of interest rates and bond yields. No big cause for these to be moving in a long direction, it seems, in the months ahead.
If the Supreme Court throws out Trump's tariffs, do you think we could get the 10-year back to 5?
I don't think so. I think that there's a good chance, you look at the poly market, there's a good chance, a 70% chance, that they actually vote this down. However, what you hear, speaking to the administration as we do, is very much, if these tariffs are thrown out under IEEPA, we're just going to be replacing them with other tariffs in their place. They need that revenue in their budget.
So it's a tax?
So it's a tax. It's always been a tax. Effectively, it's a pseudo-VAT that exempts domestic production.
Effectively, it's a tax. But then is it counteracted by, again, you mentioned the affordability thing, all of the fiscal boom that you're seeing in the AI, the dividends, the subsidies, everything he's promising here, including, I mean, the obsession for me is a 50-year mortgage because I actually do care about home buying and can't seem to afford one. But I think this is crucial, though, because he's talking about that. It's not being reflected in this bond market. Why not?
So if you think about the bond market, I think the one thing that you would say is that as high as the US deficit is, you're actually in a situation that, thanks to tariffs, it's actually on a downward trajectory now. You've actually got the deficit going down from 7 to 6, still far too high. But the one thing that you can say is that when you've got 7% nominal growth, even if you have a 6% deficit, your debt to GDP ratio isn't climbing. Where you get really hurt as a debt investor is if you have that accumulation of debt and you've got no growth to go alongside it.
7% nominal growth sounds like a great story for equities, though. That is an economy that is in some ways ticking along very nicely.
I mean, one would argue that that's exactly what this rally has been about this year, and therefore there's a little bit of there's a little bit of cold water that's maybe due to be thrown on that. There's an argument in the credit market, though, that because of all these fiscal debt worries, not just in the United States, in Europe as well, and other parts of the world, you're starting to see fund flows go from the sovereign space to the credit space, one that could ultimately end up in 6 months' time as creating oversupply of issuance. Is that a risk in your minds?
So I think firstly, one thing I would say quickly is that fixed income investors today, they want carry and they want yield more than they want duration.
Yeah.
And so that has been driving a move more in a secular fashion into credit. Otherwise, the one thing that you would say is that we've seen strong demand, but we're seeing a lot of supply. Some of these big companies, as you mentioned earlier, they were big cash cows, cash generators sitting on piles of cash. They're the ones now at the vanguard of those who are splurging that cash in this AI investment. That's creating a lot of bond market supply. That becomes a bit of a barrier for yields to rally further and further credit compression. But I don't really buy the cockroach idea from Jamie Dimon. I think, bluntly, we've had a couple of instances of corporate fraud, but we're not looking at things like we were looking at the end of 2007, where you could see proper cracks developing in the credit market.
Well, that's in the private credit space. So in the public credit space, which I realize is all kind of one supply pool, I understand that. But when it comes to kind of the issuance story, whether people actually want to be buying, whether it's long duration or even treasuries, for example, is there a sentiment here that why buy the U.S. Treasury when you could get an Oracle data center bond for more yield, but perhaps more delivery? Is that thinking, or is that trade-off happening?
Well, I think bluntly that trade-off has been happening over the last several years. That's a factor that has seen
since COVID.
IG spreads effectively at a 20-year tight in terms of the index.
But is that too tight?
Well, the one interesting thing there is if you actually look at the valuation of corporate bonds relative to swaps. Sorry for getting too technical on you at this time in the morning, but if you look at the valuation relative to swaps, you're actually still about sort of 15 basis points wide of where you were in 2021. So I think what you can see there is it's less of a story about corporate bonds getting truly expensive. It's partly the fact that government collateral is cheapening up relative to everything else, and you see that in the swap spread.
Mark, we can't let you go without getting your views on gilts and the UK, because you always have lots to say on the subject. Wes Streeting, excellent reporting by our team overnight, talking about Wes Streeting plotting against the Prime Minister. He's out denying it with some extraordinary language, criticising the Prime Minister's team, saying it's just not true. I also don't know where Lord Lucan is, and I didn't shoot JFK. So JFK suggesting that this is all conspiracy theories. Would this be important to gilt markets if we saw one of the top two in the Labour Party replaced?
Well, I think the first thing you'd say in these sorts of situations, no smoke without fire, right? So, of course, you're coming out with those very robust denials. But I would say that from an investor standpoint, from a gilt market standpoint, the big concern here is if we do lose Reeves, if we do lose Starmer, it looks like the Labour Party is more likely to be lurching further to the left. We're likely to go down the path of even more spending, even more taxation.
Even if Streeting is more of a centrist, that is, well, a right of the left.
Well, that's under the assumption in a leadership election, and I think there's a good chance that you could end up with him as a stalking horse and actually a candidate more in an extreme position actually winning the day. But I think the concern here in the bond market, and the one thing that I'd say fundamentally is that Labour is pretty much committed to signing us up to 30 billion plus of tax hikes at the forthcoming budget. I think that the gilt market would be totally happy if they did nothing on tax whatsoever on this budget, if only they could demonstrate they could deliver 5 billion of spending cuts. Because as gilt investors of the bond market, we don't care what the OBR thinks. It's what we think that really matters. And what we think is that actually cutting spending is more important at this particular stage with spending on this upward trajectory than forever rising taxes. So there you go.
For heaven's sake, don't tell the Labour Party. Are you buying or selling gilts into this budget?
So I don't have a strong view on gilts. The one thing I would say, though, is I'm concerned that there's a narrative here that Reeves could end up trashing the economy, pushing the UK economy towards a recession in 26, maybe in the vain hope that actually that gives her money to spend later in the life of the Parliament, and actually voters have forgotten as you go to the polls in 2029. But that idea of trashing the economy in 26 means rate cuts. It's bad for the pound.
Okay, there we go. Set it all up nicely. Mark, nice to see you. Always a pleasure. Mark Downey, Fixed Income CIO, RBC Blue Bay Asset Management. Thank you very much indeed. Wednesday morning, coming up, chip stocks firmly in focus this morning.
2 years ago, it was 250 million revenue. Last fiscal year, more than 700. And as you said, we just raised the guidance for our AI revenue for this year from 1 billion to 1.5. So we are more than doubling in this fiscal year, and it will not end in 26.
It will not end in 26. The CFO of Infineon talking to me earlier. Infineon, very much one of our stocks to watch as we head towards the open in 18 minutes. This is Bloomberg.
Do you know what to tell people about what the tariffs are going to do on the United States economy and the investment environment, or is it not clear yet?
If you look at the impact of the tariffs, they were much more significant and broad than I think the market expected. Looks closer to 19% on balance versus 2 and change last year. So effectively, it's a 20% increase on 10% of household goods that are imported into this country.
And do you think it's going to lead to a recession?
Well, we think that it's going to impact both inflation and the economic growth scenario. So we were coming into yesterday expecting the real economy to grow at 2%. And inflation to be closer to 2.8%. If you just go through the math, it would suggest there's probably 1 to 2 points upward increase on inflation and a similar amount on economic growth. So it could put us in a position where we're teetering.
So the tariffs will likely depress the GDP growth rate and increase inflation. So what's the advantage of tariffs?
From our standpoint, we have a hard time seeing the benefits of tariffs. They do tend to be inflationary in the short term. As you're pointing out, the longer term impact on economies is probably the greater downside.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Aqua in Sintra, Portugal, and this is Bloomberg.
Minutes away from the opening trade. And you look at the futures picture, I mean, green on the screen across the board, except for the FTSE 100, virtually unchanged there. We'll get into the details as we get closer to the open. In the meantime, a focus on the tech space. On High Precision Industry has reported better than expected quarterly profit thanks to accelerated AI-related spending by major tech firms. We're here and joined now by Bloomberg's Tom McKenzie, our Bloomberg Tech Europe anchor. Leslie, he does tech. Walk us through what On High has to say on that front.
He does tech. Yes, indeed. Well, they do tech as well. Interestingly, I mean, it's not about the iPhone anymore. On High used to be all about, Foxconn City in Shenzhen and in Zhengzhou in central China and churning out iPhones and Samsungs as well. It barely gets a mention. This is all about AI. It's all about the servers. It's all about data centers. And this is another, in the bull case for AI, this is another tick in the box coming through from On High. So they came through with third quarter numbers. Profits just shy of $2 billion, $1.9 billion, comfortably above the estimates. And they're seeing huge demand for the kit that goes into those AI servers. They expect that to drive revenue growth into the double digits. And interestingly, the chairman of Hon Hai was saying that 2026, AI will be the most important growth driver for this company that, again, has traditionally and historically got most of its revenues from producing iPhones and iPads. Also saying that they are involved in the sovereign AI story in the US and Japan as well. So yeah, a tick in the box if you're a bull on AI and you're looking into 2026 from Hon Hai when it comes to what they're putting into data centers. AMD, another tick in the box. The question I have is why they've come out with an update 2 weeks after their earnings. I haven't quite gotten to the bottom of that, but the numbers are much more robust than they were on the earnings a few weeks ago in terms of the projections, 3 to 5 year projection, revenues of increasing more than 35% in terms of revenue growth projections, more than 35% over that time frame. Margins, interesting as well. They expect margins to increase by 35%, to exceed 35% over the time horizon, the same 3 to 5 year time horizon, and AI data center revenue to increase by 80%, profits per share more than $20 a share. So all these numbers coming through from the CEO of Lisa Su yesterday of AMD, underscoring optimism in terms of the outlook for a company that's getting close to having about 10% of the market share for these AI accelerators, having struck these deals with OpenAI and Oracle.
Right, but the story, essentially, that was part of the story yesterday. The other bit was the fact that SoftBank was selling NVIDIA.
Well, that was literally going to be my next question, because you have these pockets of excitement around AI, but then you look at SoftBank's take. You look at TSMC, I think, came out with a kind of a skeptical take on what the future of AI demand was. Well, so there are pockets where you are starting to see a little less enthusiasm.
So I think, SoftBank saying that this is all about freeing up liquidity that they can continue to spend on AI infrastructure, for example, the Stargate project. But certainly, it was eyebrow-raising that they've sold out not just a portion of their stake, but all of it. I mean, $5.8 billion on its own is not a small number. But obviously, in the category of a market cap company, NVIDIA of more than $4 trillion, is a drop in the ocean.
What do you make of this depreciation story? Because this kind of ripples back into all of this. The fact how quickly do you depreciate a chip? I've heard anything from 2 to 6 years.
So this is what Michael Burry has been talking about, and this is what Cameron Christ has been talking about in his opinion column today, which is well worth reading, because he's kind of done a historical analysis going back to the beginning of this century on depreciation and the spend on capex and how that has adjusted with the hyperscaler spend. Look, the depreciation is real, and so there is a real question mark: is are they marking this correctly, the hyperscalers, in terms of how quickly these AI assets, particularly the AI accelerators themselves, the chips themselves, actually depreciate in value. So you can sink $100 billion into AI accelerators 1 year, they're not going to be worth that amount 12 months later, and then you push out 3 years down the line. So for the accountants out there, that is a question worth scoring over. Are they marking it correctly? Is a question that Cameron Christ in his piece today is putting on the depreciating AI assets, and whether that's going to become more of a concern going forward.
Tom, thank you. Tom McKenzie with the Tech Beat this morning. Let's widen the conversation, talk about the markets in 3 minutes. Joining us, our Bloomberg Executive Editor for Asia Markets, Paul Dobson, who has a head start on us here in Europe. Paul, very nice to see you. Thank you for joining us. So let's talk about Treasury markets. We've got Treasuries responding, it would seem, to the weakness in the US labour market data and further expectations of rate cuts from the Fed. Anything unusual in the moves this morning?
Oh, well, absolutely, Anna. It's unusual that they move so much in our time zone, but the reason is that the time that the Treasury market is able to respond to those ADP figures showing that continuing trend of a weakening labour market and giving the market, therefore, a little bit more confidence that the Federal Reserve will go ahead with another rate cut in December. It's still very split among the Fed's speakers, right? We hear from some of them talking about the concerns about sticky inflation. We hear some of them talking about concerns about the labour market, and what we really need to know is which way is that middle ground, the middle patch, which probably includes Jerome Powell himself. Which way is it going to turn? And so I think it's going to be really interesting if we do get the US reopening, then we'll start to get some of the official data trickling through as well. We'll get probably September labour data as one of the earliest indicators, and that's going to give us some fresh signals, but it's also probably likely to give us more volatility. At the moment, though, lower yields, a little bit more hope that the Fed will cut again.
Paul, am I watching my yen screens for intervention? Is that next?
Yeah, I don't think that we're that close yet, but there definitely is that sense. The government is getting a little bit more worried about the yen, and no surprise, it's at a weakest level since February today, continuing to dribble, approaching 155. Now, the Japanese officials tend to have a couple of rules of thumb that they use to judge when they would actually need to take physical intervention, i.e. stepping into the market and buying the yen to sort of stabilize things. Either a 10 yen move over the course of about a month. We're not really at those levels, not until we get towards the 160, depending on how much you squint at the chart, or a 4% move over the course of a couple of weeks. And again, you know, we'd need to get up into the 158 levels, something around there, before they come in. Nonetheless, the rhetoric that we're getting, the pushback that we're hearing from the administration, from Katayama, the finance minister, is getting louder, and the yen is still under pressure as well. So one to watch there.
Let's circle back to a conversation we actually just had with our colleague Tom McKenzie. But Paul, there's a lot of concern about what the SoftBank's selling of NVIDIA's stake actually means. What's the take in the region?
Yeah, I am going to be completely honest with you, Critty, and don't really know. And that's why I think it's so fascinating. And I heard your debate with Tom about it all, and I think that you covered a lot of the salient points. But the fact of the matter is, in the ADR market, so in the US trading yesterday, SoftBank was up. Today, it really bombed at the open, and it has been starting to come back again. But there's all of this uncertainty about how exactly do you value these AI companies at the moment, including OpenAI, which it holds and wants to invest more in. At least it's sort of like, you know, managed to cash in on NVIDIA, but then people are saying, well, is that some sort of sign that it worried that it's at the top, or what's it going to do next with its resources? So all of those AI valuation issues still playing out in the background, even as the market continues to rally.
Lots to keep an eye on. Bloomberg Executive Editor for Asia Markets, Paul Dobson there, giving us a little bit of a world tour from FX to technology. We thank you so much. Let's do a little bit more on the corporate space, get our stocks to watch with Chloe Melly. Chloe.
Good morning, Critty. Let's start with Infineon today, after the chip maker said that it expects revenue to return to growth next year thanks to really strong momentum in AI infrastructure and AI data centers. So let's see how the stocks react to that this morning after what has been quite a lot of up and down for that stock. Interestingly, the CEO said that although there was this huge boost from AI infrastructure, there was still some weakness in some of the other key end markets like automotive, which is a really big part of the business for Infineon, but also industrial and consumer. So we'll see if investors focus more on this AI boost or the weakness elsewhere. Moving on to some M&A, and ABN AMRO in the Netherlands is buying NIBC Bank for 960 million euros. So that is in a bid to expand its footprint in the retail banking space in the Netherlands. It also has reported that this morning ABN AMRO a profit ahead of estimates. So we've got two sets of good news this morning. We'll see how much of a boost we get. We've already seen a very impressive run for that Dutch bank so far this year. And finally, SSE, the renewable energy provider over in the UK, is planning to raise £2 billion from investors to fund major investments in grid and renewable energy. This is reminiscent of the equity raise that we saw from Ørsted, another energy company in Europe earlier this year. We'll see how much that gives, how that reacts this morning. We have seen quite an impressive run for that company over the last few months. Let's see if that continues today.
Chloe, thank you very much. Our equities reporter, Chloe Melly. So there's some corporate reporting we certainly need to pay attention to, but big picture, I mean, US futures are pointing quite a bit higher, NASDAQ futures, as if they're trying to recover a little bit of that lost ground from yesterday.
Absolutely. It's going to be a bumpy day, though. It'll be interesting to see. Like, we could today get clues as to how the data is going to be delivered over the next few sessions.
There's not really much shutdown news right now, is there? No. It's just as if they were just expecting that to happen. And
a lot of anticipation, excitement in Washington. The opening trade is up next. Stick with us. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can't be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
On a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Ahmed, only on Bloomberg. From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Wednesday morning, good morning. How are you doing? Let's talk about Tuesday, and then we can talk about Wednesday and figure out what cash equities are going to look like when we open in a few minutes' time. This was the S&P session yesterday. As you can see, Europe went out kind of beginning of the session, down near the lows. We rallied after that, despite what was happening with NVIDIA and SoftBank and all the other good stuff around the AI trade. So that's the kind of setup for this morning in terms of what we've still got to price in, which probably explains a little bit as to why we are seeing most futures in Europe when it comes to the indices looking fairly positive this morning, Chrissy.
Yeah, looking fairly positive, to your point, everywhere but right here in the UK. Unchanged for the FTSE 100. So massive underperformance relative to what you're seeing, one, in Eurostoxx 50 futures, but also relative to the CAC and the DAX. DAX is higher by about 0.6% on the futures picture. The CAC is higher by 0.5%. Remember, Anna, they have, of course, a vote in the National Assembly around pension reform later today. We're going to risk positive into that, at least as things stand right now.
Yeah, let's have a look at where we are on some individual stocks and sectors in focus then, Chrissy. And energy could be in focus. We've had an interesting IEA report out. 2 scenarios being painted. They don't declare which one they think is more likely, but they've reintroduced one that has oil market demand not peaking until 2050. So that could be of interest to those in the energy markets, at least. Infineon is certainly in focus. They see 2026 revenue growth as AI outlook boosts sales. That's a headline from our story. And it does seem to be something of a turnaround from a business that was very much focused on industrials and autos into something that is more zeitgeisty now, of course, and focused much more on AI. ABN AMRO also in focus. We had numbers out from them this today. ABN AMRO's NIBC deal is not enough to offset slow growth. That is the conclusion of some of the analysts who've been poring over the details, Guy.
Okay, here we go. Time for the Wednesday session. Is this the day we see the shutdown ending in the United States? Are we waiting for that moment a little bit later on? At the moment, what we're looking at is a positive story emerging, except for the FTSE 100. It is expected to open reasonably flat this morning. BAE Systems is out with numbers. Keep an eye on what is happening with the miners and the oil stocks as well within that market. FTSE 100 flat as a pancake, as anticipated. Nothing to see here. Let's move on to some other exciting markets, which are about to open, I promise you. Looks like we're getting a slow start to the day here in Europe. Look at what's happening with Infineon in Germany. That's going to be an interesting story this morning as well. The banks are firmly in focus. The IBEX is up by 0.3%. We need the CAC to open. We need the DAX to open. I'm quite interested in what the Italian market does as well this morning. There's a few things going on that we need to focus on. I can't give you the details because they're not open yet, but I'm sure Critty's got some other factors we need to fold in.
I always do. I mean, I think what's shocking to me right out of the bat, and to your point, the CAC is not open yet, but a lot of French stocks are moving to the upside when you look at least some of the early reads on the stock 600. But overall, I'm seeing healthcare kind of in the lead right now. I mean, it's a pretty broad, you're seeing a fairly broad risk rally, but the healthcare picture certainly is key. You have Novo Nordisk, AstraZeneca. I mean, if there's a healthcare stock out there, it's up in the session today, Anna.
Yeah, it's not the clearest picture coming through this morning, is it, in terms of markets, and the CAC and the DAX, both not yet open. So we're lacking some key components. There is some basic resource upside. We have iron ore prices going higher, so we do see the miners going a bit higher. Autos and auto parts, though, is the best performing sector this morning. Mercedes-Benz is one of the better performers. In the banking space, then, we've got ABN AMRO responding to that asset sale, perhaps, up by 4.5%. So that was one that we flagged, and one that is on the move this morning. To the downside, then, it's media that seems to be the worst performing sector, and WPP is one of the fallers in that particular sector. Looking to see really whether the technology sector has much to say about it.
Finian's not open yet.
There we go.
So we'll wait and we'll watch and we'll see what happens there. SMI is down by 0.8%, so maybe the chips are going to be under pressure. We'll watch that one. BAE Systems is a fairly big drag on the FTSE 100 in terms of the points. It is down by 0.5%. Actually, the earnings look like they're pretty much in line with what expectations were going into those numbers. But there's banks, there's luxury, there's a few chip stocks that are up. Actually, SML is up this morning. But as you say, it is maybe the pharma space that is delivering the biggest kind of upside bump for these markets this morning. But I'm looking at the names that are on this board, and I am struggling to deliver a narrative off the back of it.
Well, maybe we should get to someone who maybe can give us a little bit more of a narrative. Sharon Bell, Senior European Equity Strategist over at Goldman Sachs, joins us around the table this morning. Sharon, you've just witnessed our little detective work here this morning. I think what's really interesting, and gut check me here, we're seeing a lot of positivity into healthcare stocks that were quite battered in the last couple of months over tariff risk, the Swiss story, the drug pricing, et cetera. When you see a defensive trade in the States, it seems to be followed by this massive rally in healthcare. Is healthcare in Europe the equivalent of big tech in the States? How do you think about that?
Well, healthcare is a very big sector in Europe, and even though the European markets have done well this year, you're right, healthcare has been a bit of a detraction from that, a drag from that, because of its dollar exposure, but because of concerns about pricing, etc. But it got very cheap. And I did see back in August a lot of my clients were saying, actually, this now looks quite inexpensive. So I think that some of these point rallies in the sector, I think, are driven a bit by just if you're concerned a bit about taking too much risk in tech, healthcare is a nice offset to that. Plus, it's a bit of a cheaper sector now given the underperformance this year.
Well, we've had a couple of weeks where we kind of wake up this morning and we're saying, oh, well, the stocks that were down yesterday are the ones that are up today. Going into year end, is that basically what we're looking at, a couple of weeks of the rotation trade?
Yeah, I mean, it's difficult to find a narrative this morning, isn't it? I completely agree. You've got some defensives doing well, some cyclicals doing well. It's really, really mixed. What we actually have found in the data is that correlations between stocks have been very, very low in the last 3 months, meaning that it's actually been quite a stock picker's market. So it is quite difficult, I would argue, to pick a very macro narrative in all of this. Maybe that's because one day a set is up and then the next day they're down. But I think it's also because it's been more stock-driven rather than macro-driven. And maybe that's because of the lack of data in the US as well at the moment.
Are you broadly positive, though? Like, kind of what is...
Broadly positive, yes, because we think that next year, 2026, we will see better growth in the US, better growth in China, and better growth in Europe. We think that tariffs probably have impacted growth this year in the US, not perhaps as majorly as many people worried, but there's been a negative from that. But we're also seeing the Fed cut rates, which should help growth next year as well, and probably a bit more fiscal expansion by Trump next year, all of which should be helpful for growth.
Is it going to be as good as this year?
I think that growth next year should, if anything, on our forecast, be a tiny bit better in the US than
So does the equity market do better?
I think the issue with the equity market is we're already very high valuations.
Yeah.
So it's a struggle. The equity market's kind of priced some of that positivity next year already. So I think the equity market is unlikely to do as well. We've had incredible double-digit performance this year. A lot of it in the US has been driven by earnings, not just valuation, but valuation is already high. So I don't think it'll be a bad year for the equity market, but I think that it will be a better year for economic growth next year. The market's already priced quite a lot of that.
Okay.
Sharon, good morning. Can I pivot us to the open of the gilt market this morning, and we've got gilt yields rising a little bit more than they're rising across Europe, which turns are, I mean, that's often the case, does often respond more to news. But that makes me look for drivers here in the UK, and we're thinking about a little bit of political turmoil and whether we might see some pressure on the UK government to prove it has a tight rein on spending. Anyway, whatever the driver, gilt yields are a little bit higher. And thinking about read into stocks from that, how do you, what do you watch for at moments like this when we see spikes up in yields?
So, you know, I do think the gilt market is incredibly important for stocks at the moment, probably more important than anything else. And the reason I say that is if this budget coming up is seen as gilt friendly, then I think it will be very good news for certain slices of the UK market, particularly obviously more indebted slices like utilities, but also things like real estate, home builders, UK domestic stocks, FTSE 250. They will be very vulnerable in a period where gilt yields go up. And obviously you have seen them underperform. Many of those slices underperformed this year because of concerns about the fiscal vulnerability of the UK. So I do think that having a kind of fiscally robust plan is what certain slices of the UK equity market need. But I say certain slices, and I emphasise that because FTSE 100 has had a very good year, but it's super international.
Yes, very different picture there. Of course, we're moving towards the budget. What's going to be in focus for you as we do that towards the end of this month, looking at, yes, the fiscal backdrop, but then it'll be the same sectors in focus, I suppose.
I think so, yeah. I mean, you could have a look at the budget and say, OK, there are certain measures that can impact particular companies and sectors. For example, you could see some taxes on gaming. There has been talk, although I think that may be pulled back on this, for the bank sector, the oil sector, for example, taxes on fuel, lots of other very specific things you could look at. And they could be important, but personally, I think the more important thing is the reaction of the bond market and investors, I guess, view on two things: how much the budget will impact growth. And we know that taxes are rising, but how much will it detract from growth? And then is it seen as providing that fiscal security, which means the bond market can rally on the news? If so, all those domestic slices I mentioned before, real estate, utilities, home builders, FTSE 250 can do well.
But is that tradable? I mean, come the budget's on the 26th, come the morning of the 27th, is that actually tradable? And I say this because we've had the same conversation happen in France and Italy and certainly in the United States as well. And it hasn't been something that's been reflected necessarily in the markets or in some of the heavyweight stocks of the various indexes. Is this tradable, the taxation policy?
Yeah, I think it is tradable for sure. I mean, if you start seeing a view out there that maybe with no spending cuts and not enough raising of funds, then there's concern about fiscal stability in the UK. You absolutely would see the mid-cap stocks, the UK domestic, all those related to UK rates like home builders, real estate, sell-off. That is quite clear. If, on the other hand, you get a budget which is delivered and the market's confidence improves, then I think these types of names will outperform and do well. So I do think they turn on this particular factor.
If she raises taxes and growth slows down and the bank has to cut rates, is that, I'm trying to kind of wonder, how does that play out in terms of some of these stocks?
I don't think that, so it depends on your rate sensitivity. It's probably less good for the banks, for example. But it would be good.
Better for housing.
Better for housing, better for real estate.
But it's a slowing economy because taxes are going. If the gilt market reacts positively because she's giving herself a greater fiscal buffer, but the economic consequence of that is slower growth, is that good for UK domestic stocks?
Yeah, at the margin, I think it is. I know what you mean. There's offsetting things here. Utilities ought to benefit either way because they're a more defensive sector, less vulnerable to economic growth slowdown, and they would benefit if gilt yields go down. But most of the ones I mentioned before, FTSE 250, the mid-cap stocks in the UK, are also vulnerable to UK economic growth. Yeah. So I think on balance, I would like to see, for those types of slices of the market, I think you would like to see a budget that delivers fiscal stability, even if it does mean some drag on UK growth. I think that's well priced anyway, and expectation taxes are going to rise. It's going to be a drag on growth. We reckon a drag worth about 0.3% of GDP. So considering kind of trend growth in the UK is maybe one.
That doesn't sound like a lot, but if you...
Actually, it's a reasonable
It's a really
amount,
big chunk.
Yeah. And thinking about what influences the growth story in some of these European economies, Sharon, takes us to maybe a more global conversation. I noticed that you've recently upgraded your European stocks view, but a lot of that is driven by US growth, maybe China turning a corner. Is it, or is that the wrong narrative?
I think it is certainly helped by that. European growth hasn't collapsed in the way that some people worried with tariffs earlier this year. So European growth has been okay, hasn't been stunning, and we've had lots of risk factors like French political risk, for example. But you've also got some news that next year you're likely to see more fiscal spend by Germany. China, definitely growth has again been less battered by the tariffs than many feared. US growth has been a little bit better as well. All of those things, in our view, mean that earnings can be a little bit better next year. We're probably going to see zero earnings growth this year for the biggest European companies. Next year, we think it'll be about 5%. Not stunning, but enough for us to slightly upgrade our forecast.
Sharon, great to see you.
Thank you.
Thank you very much for stopping by to see us. Sharon Bell, Goldman Sachs, Senior European Equity Strategist. Course X looks a little bit like this morning. Let's take a look at where the centre of gravity is here in Europe. And as you can see, there's a lot of positivity on the screen. Luxury is trading higher. Defence stocks are bouncing back. Chip stocks are doing relatively well. Infineon has been in negative territory and up by over 2.5% at some point in the last 11 minutes. So it's a choppy session, maybe for some of the chip stocks. Let's deal with the details of what we're watching. SSE is another name that really stands out for Chloe Mellet.
Good morning, guys. SSE is up quite impressively this morning after saying that it plans to raise £2 billion from investors to fund some key projects. So projects like wind farms in the renewable assets and also electricity grids. So that is an equity raise that is being received really well by the market this morning. And we have got SSE up 10.5% this morning. Moving on to ABN AMRO, the Dutch bank is also up on the back of really positive earnings and also M&A. So it reported profit ahead of estimates this morning, and also said it is buying NIBC Bank from Blackstone for €960 million. So that will help ABN expand its footprint in the retail banking space in the Netherlands, and that is being received quite well by the market. We are up 2% for ABN AMRO this morning. Moving on to a sector that is struggling a little bit more, and that is the UK house building sector. So Taylor Wimpey reported this morning and said that the uncertainty around the UK budget and potential tax raises there was really hurting that housing market, and so that is dragging down the rest of that sector this morning, and we have got red across the screen for those house builders this morning. Moving on to RWE, and the energy company said that the trading division was recovering after being hurt by a lot of geopolitical uncertainty earlier in the year. So, if we put that back into context, that trading division is still struggling, but it seems to be doing a little bit better, maybe back on the road to recovery, and that really reassured investors this morning. And finally, we have got Hiscox, which was also down this morning after being double downgraded by Jefferies with the analyst saying that it was lagging in performance behind some of its peers, Lancashire and Beazley, which are also UK-listed insurers. This is the only sell rating on the stock so far, so it's not doing it that badly, but we are down 1.6% on the back of that double downgrade.
Chloe, thank you. Chloe Melly from our equities team. Coming up on the programme, we'll check in on one of the moves in this morning's session, making some modest gains. The German chip maker Infineon raising its revenue outlook for next year. We spoke to the company, Guy spoke to the company's CFO just earlier this morning. We'll hear from that conversation shortly. That's next. This is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Versace in Tehran, and this is Bloomberg.
What is going to be the consequence for U.S. markets? We are being
basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
Welcome back. You're watching the opening trade. There's a bunch of stocks out there that we're focusing on. We've dealt with a few of them. SSE was a real standout story a few minutes ago for Chloe Melly. Let's turn our attention to what is happening with the chip space right now. Infineon, really choppy this morning in terms of the market performance that we're seeing. It's been actually in negative territory briefly and up over 2.5%. What is really fascinating here is that we're seeing basically one of Europe's big chip giants in transition. This is a company that has traditionally very much focused on the automotive sector, which has been a struggle for it recently. This morning, though, despite talking about kind of moderate growth elsewhere, they significantly at Infineon upgraded their expectations when it comes to the AI story. Now, they build chips that help with the data center build out, and that is where they see significant growth coming from here. The company's CFO spoke to me a little bit earlier on, just as the numbers were coming out. This is what he had to say about that AI story.
If you look into the revenue development for AI, and for us, AI is powering AI from grid to core, has developed in a very steep way. 2 years ago, it was 250 million revenue. Last fiscal year, more than 700. And as you said, we just raised the guidance for our AI revenue for this year from 1 billion to 1.5. So we are more than doubling in this fiscal year, and it will not end in 26. We expect the addressable market for Infineon for powering the AI data centers in the magnitude of 8 to 12 billion. So it's a significant idiosyncratic growth driver for the company going ahead.
How much precision do you have at the moment in terms of the outlook on that space, and in terms of being able to guide investors to what you are going to see next? How much precision do you have there?
Yeah, so first of all, the 8 to 12 is the addressable market. So it would assume 100% market share, which is probably not the most realistic assumption. 1.5 is the revenue we are generating this year. How much visibility is there? Of course, we have a very broad coverage of all major customers, be it cloud providers, be it processor makers, which gives us a great visibility into the business. You're also maybe aware that we entered into an agreement with NVIDIA to cooperate on the development of a total new architecture, which is 800-volt DC-DC. So there's a lot of visibility in what's happening, but of course it is and remains a very dynamic market.
Let's talk about what else we're seeing in 2026. You have, over the last few years, been, let's call it conservative in your guidance for what the further year is going to look like. Are you being conservative when you talk about broadly moderate revenue growth, broadly moderate growth in 2026? Are you doing the same thing again? Can I call this conservative?
Yeah, first of all, I would point out to the fact that under German corporate governance, we are not only guiding for a fiscal quarter, but for the full fiscal year. Secondly, if we look back into the way we have guided last fiscal year, we called it a qualitative comparable guidance. We managed well. So the guidance we gave in November, exactly 1 year ago, matched the real numbers pretty well, despite the fact that we have to digest a significant negative currency development. And from a philosophy, how we guide, we are not changing that for that fiscal year. But it is, if you go one layer deeper, there is a story of two tales. There is the idiosyncratic growth, the boom in AI power. On the other hand, as you asked in your question, Guy, there is on the automotive, the industrial, the consumer, there is some modest growth. And why is that only modest? Yeah, it is driven by this geopolitical uncertainty, by all the tariff discussions, which lead our customers to a very cautious behavior. They are ordering on very short notice. Therefore, we have baked all that into our guidance for that fiscal year.
Infineon CFO Sven Schneider speaking to me earlier this morning. As you can see, the stock is chopping around all over the place at the moment. As I say, we've been up over 2%. We've been negative. We're now only up by 0.2% on Infineon. Do I take the kind of the moderate guidance on the broad part of the business as the main story, or do I take this kind of pickup that we're seeing in terms of the AI narrative and the upgrade that we're seeing there and the expectation for future revenue growth coming out of that space as the way I want to be looking at this story? Charles Schum, who covers semiconductors and electronics for Bloomberg Intelligence, joining us around the table. What do you make of the number? Where should I be looking this morning with Infineon?
I think the number actually quite match what we expected. As the CEO said, he's actually giving a very conservative guidance. I think that's because there's still some uncertainties on the future automotive and also industrial chip demand. Like he mentioned earlier this morning, there's actually still some destocking movement in the coming quarters, because there's still uncertainty that bring by the U.S. tariff. So that's something we have to consider. And also, if we look at the third quarter results, we see that actually, although the AI power demand actually is quite strong, but if you look at the breakdown, you look at the operating margin, actually it missed the consensus. That's actually could be a warning signal that maybe it's not that easy to turn the top line growth into the bottom line growth. That's the problem we should watch. Yes.
Very quickly, talk to us about OnHigh as well, which is also reported. Some of the earnings also use that AI tag word.
Yes.
Thoughts?
Yes. OnHigh also report a very good result for the third quarter this morning. Actually, it's operating profit actually beat the consensus by more than 17%, if I remember correctly. I think this is actually all contributed to the strong AI server demand, and also particularly it also give a guidance on that it's a component business actually is growing very robust, because actually we should look into this. I think this is partly contribute to the consensus because it has a high profit margin on the component business.
Yeah.
And HonHai is actually also best known for being a OEM for the Apple's iPhone.
Yeah.
I think, yes.
Yeah. Charles, thank you very much. Thanks for the update. Charles Schum from Bloomberg Intelligence with the latest on some of those tech names. Let's pivot to what's going on in the defence space. Modest gains also the story over at BAE Systems this morning, up by 0.4%. The company maintaining its full-year sales forecast in its trading update. So far, so simple. But there are some interesting things to talk about with the defence sector, of course, right now. Jerry Doyle joins us, Bloomberg's global defence editor. Jerry, good morning. Talk to us about order intake. That seems to be an area that they're quite pleased with, the order intakes at BAE.
Yes, they reported 27 billion pounds in orders so far this year. That includes 20 Eurofighter Typhoon fighter jets for Turkey. It includes Type 26 anti-submarine frigates for Norway. Those are big orders. that dovetail nicely with this broader European defense spending we're seeing. So I think they're pleased with that and see some momentum with it going forward.
Is there another catalyst coming? We can't know about. There's been this big defense sort of build out. You've talked about some of the Norwegian stuff and the orders that are coming through. Are there bigger catalysts coming? The Germans are about to start spending money. The UK looks like it's going to be excluded maybe from some of the defense spending that's coming out of Europe for political reasons, economic reasons as well. What's the next catalyst for BAE, or is it all in the price now?
It could be any number of things, like their involvement in MBDA, for instance.
Right, the missile.
Yes, yep. Exactly. The missile business, they make a lot of air defense missiles, they make a lot of air-to-air missiles. Those are areas that Europe is expected to spend quite a bit on. So those could be areas that could help BAE going forward.
Is there a problem with the UK being excluded from this big fund that Europe, the EU, is putting together? At the moment, that's kind of, there's a lot of political debate about whether or not we should be playing a part in that.
It could be a political stumbling block for BAE. I'm sure as a business, they're just going to put their best foot forward. They're going to say, we have the good stuff and we're going to sell it, and they'll see what they can do.
Yep. Well, what's the political kind of story around that one? They're saying the price tag is too high at the moment. Jerry, great stuff. Thank you very much indeed. Jerry Doyle, Bloomberg's global defense editor. What are we going to talk about next? The oil market. The IEA has tempered its stance on imminent peak oil demand, reinstating a scenario where consumption actually keeps growing until the middle of the century. We're going to be talking about that next. Amrita Sen, founder and director of market intelligence at Energy Aspects, will be joining us next. Energy, next on the show. This is Bloomberg.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you're good at your job, bro. Like, this is actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. Mm-hmm. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Welcome back to the opening trade. 30 minutes into today's session, green on the screen across the board. You started to see the FTSE 100 pick up a little bit of momentum as well. We started the session virtually unchanged. Now shares higher by 0.2%, but it pales in comparison to some of the moves that you were seeing in the DAX and the CAC. And the CAC is really interesting here. Of course, we do have that French vote later on today, but risk on going into it. The DAX, there's some earnings stories there. There's a tech bump that you're seeing. Guy, really interesting to see green on the screen yet again.
Defense stocks are also up, as are pharma stocks. 2-to-1 in terms of the ratio, up to down. You've got a volume story, though, that remains quite weak, and I think you want to keep paying attention to that. This is an unconvinced market at the moment, judging by the volume that we are seeing on a day-by-day basis at the moment. So we are on the front foot, so let's talk about some of the leaders at least. Let's start there and figure out with what is happening in terms of the leaders. Alcon is up by 6-7% in the eye care space. It is SSE that really stands out. Scottish and Southern up by over 10%. So this utility this morning is putting out a $2 billion investment program. Remember that the bottleneck in terms of the AI story, the bottleneck in terms of economic growth, you could argue, is getting electrons from A to B to C. And this is basically what they're going to try and solve. You've also got the renewable space that you need to fold into all of this as well. Grid connection, grids are really important. That stock is responding positively. SAP is up by 1% today. So the tech space is actually getting a little bit of a lift as well. Where are the laggards? It's in some of the more defensive names, actually. That is where we're seeing some of the disappointment today. Unilever is down. Shell is also giving back some ground. We're going to talk about what is happening in the energy space in just a moment with Amrita said, and Swiss Life is down by 2.34%. But there's some interesting trades out there this morning, but quite a lot of dispersion in terms of what we are seeing. So that's a kind of interesting narrative as we come towards the end of this reporting season. Anna, what else do we need to know?
Yeah, let's get an update then, Guy, on some of the other political stories and other news flow that we need to keep on our radar. Allies of Keir Starmer have sought to ward off any leadership challenge by arguing that an attempt to oust the UK Prime Minister would risk a market shock and undermine the government's finances. Centrist Cabinet member Wes Streeting said this morning that there was no leadership bid from him and that he supports the Prime Minister. Starmer is likely to address the issue at the weekly question session in the House of Commons today, that is Prime Minister's questions. Debates over France's 2026 budget are dragging on in Parliament. Lawmakers will spend the day discussing the Social Security financing bill with a vote on suspending the 2023 pension reform by the end of the session. The vote is seen as decisive for the survival of Sébastien Lecornu's government. And Bloomberg has learned that President Trump is to host financial industry executives for dinner later today at the White House. It's the latest effort by the administration to get the country's business elite behind the president's policies. We're told JP Morgan's Jamie Dimon, David Solomon from Goldman Sachs, and BlackRock's Larry Fink are among the invitees. Chrissy.
Lots to go on when it comes to what we might actually hear from that dinner. I'm really curious. We were kind of debating this around the table earlier today. We were talking about deregulation. We were talking about sanctions relief, maybe even just his thoughts on tariffs, et cetera. Does the oil market show up in that?
I don't know. Maybe it's a fact. It's going to be interesting. So one of the things that I think that the Republicans, Trump will take away from the recent kind of political story is that they need to get back on the front foot, and lower gas prices in America could be certainly part of the political narrative. You get gas prices down, that's going to put more money into people's pockets. That gives them a better feeling about what is happening, particularly at the bottom end of the economic spectrum. So I just wonder whether gasoline prices could be a part of the story in terms of the politics.
I mean, affordability is the key message, and we've heard that time and time again this morning, but of course in the last couple of months as well. I think it's really crucial as well is that does any of this matter? Does any of the tariff stories, any of the trade matter? At the end of the day, this market, as consensus suggests, is oversupplied. Let's get a bit of a market perspective from here. Amrita Sen, founder and director of market intelligence over Energy Aspects, joins the program. Amrita, pleasure to have you. Thank you so much for joining us this morning. The consensus is that this is a market that's oversupplied. We talk about Russian infrastructure attacks, tariffs, a decline in growth, gas prices, as Guy just mentioned, among a series of other factors, and this market doesn't move. I want to start off by just asking, what's the range for oil? What's the floor? What's the ceiling?
Yeah, thanks for having me. I think oil's been really stark. I mean, you can see that over the last few months, really, not just the last few weeks. It's weathered a huge number of headlines on kind of U.S. sanctions on Russia, but at the same time, it hasn't collapsed either, despite all the kind of narrative around a really big supply surplus coming up in, not just in Q4, but really coming up in 2026. Given that kind of really varied risks on both sides, because you have the very bullish possibility of quite a bit of Russian supplies getting lost versus the bearish risk that, we are in an oversupplied market or getting into an even oversupplied market with the OPEC plus unwinds still ongoing. I think that's why prices will remain stuck as well around this kind of $64, $65 mark for Brent, and a couple of dollars really. I'd say 60 to 65 is your newish range, unless the market kind of sees or starts to see more material disruption to Russian supplies.
Rita, let me ask you about some of the news flow we've had surrounding oil. There's been lots of bits and pieces to keep an eye on, even if some of the underlying US government data has been absent, of course. We've got an IEA report today. They're reinstating one of the scenarios that they're considering, and that is that oil demand continues to climb out to 2050. What's your thinking about when oil demand peaks? Because IEA has this scenario, but it also has another where it peaks around 2030. BP has been pushing, playing with its estimates, though, of when we get this peak, also suggesting it could be later. What's your thinking?
Well, look, great question, because I know we all tend to focus so much on the short term, but some of these longer term trends are changing, and I think it's kind of becoming a lot more aligned with what we've been saying. As an industry, if I may say so, we are really bad at calling oil demand. We continue to call for peak oil demand and then just push it further and further back every year. And I think our view has always been that, yes, even if total liquids demand kind of peaks, say, late 2030s, even early 2040s, the reality is it's not going to collapse. Even by 2050, we have oil demand at around 100 million barrels per day. And I think that's the crucial thing. A lot of the scenarios with kind of some of the names you've mentioned had oil demand falling to 60, 70 million barrels per day. Even at the peak of COVID, we consumed over 80 million barrels per day and the whole world was shut in. So to just assume that we would go down to 60 or 70 million barrels per day by 2050, I think that caused a lot of damage to the industry with the lack of investment. And I think we're going to see the effects of that in the coming years. And I do think we'll see higher prices as a result of that. But it's really good to see a lot of these agencies now coming out, like the IEA's latest report just abandons all different scenarios, and it's got that one scenario that says at our current policies, oil demand continues to grow. That's a significant shift.
Yeah, we'll continue to get the details on that then. Let me go back to the short-term picture, Amrita, having put some focus on the longer term, and go back to what Kriti was talking about this balance between the oversupply narrative and the sanctions narrative. And on sanctions, I'm really interested that there's been a sort of a scramble to deal with Lukoil's international assets. Who's going to own them? What will happen to prices if the West is not allowed to deal with Lukoil in any form? I mean, this is a business that has a footprint in the US, Italy, Netherlands, Bulgaria, Romania, Iraq. I mean, maybe not a big footprint, but it does have a global impact. Is it inevitable that if the West can't trade with Lukoil, that prices should feel some upward push?
I mean, look, this is unprecedented, right, in terms of both, not just Lukoil, Rosneft as well. We are talking about, at least on our calculations, at least 1.4 or around 1.5 million barrels per day of Russian crude exports that are at risk of being backed out, because we have seen, I was in India myself a couple of weeks ago, the refiners we've spoken with, they've kind of said, yeah, certain ones are completely backing out, others are reducing. China, we've seen the state-owned companies have also stopped purchasing from these companies. We already had Surgutneftegas and Gazprom Neft under sanctions from earlier in the year. So you only have 3.1 million barrels per day of Russian production currently that is not sanctioned. And then, of course, you've, like you mentioned, in terms of Lukoil's international assets, we saw what happened with Gunvor and then the Treasury kind of statement around that. There are a couple of other buyers who are looking into it, but it is going to be extremely difficult to kind of get to a scenario where all flows continue uninterrupted. Like, of course, the total volume lost could be a lot more. We're not assuming the full 2.6 or 3 million barrels per day of Lukoil plus Rosneft volumes getting out of the market, but at least 1.5 can be at risk in the short term.
Amrita, good morning, it's Guy. If you were Donald Trump and you wanted to get WTI from 60 to 50, how would you do it?
Well, it was heading there, right, Guy? I mean, we had even Brent was sub 60, WTI was closing in on 55, and that was even on our kind of price forecast. That is the kind of path of least resistance for next year, Q1, early Q2, given the oversupply that we're looking at, the Chinese SPR bid, which has really kept the market fairly tight this year. That should also seize up a little bit in the short term because the next mandate is in March. So all of those factors were actually driving prices lower into the kind of 50s, which is probably where some U.S. officials, or at least Trump, wants prices to be. But these Russia sanctions are material. I know they've kind of named companies instead of saying blanket Russian oil, but having just come back from the East, I think the market might be underestimating that.
Okay, so do you think 60 is a more realistic prospect for next year than 50?
I think if these Russian sanctions are enforced, and that's the million-dollar question, right? Because we've seen this before. The U.S. announces a bunch of stuff, and then they don't follow through with it. So short term, absolutely, like I was saying, 60 to 65. If they do enforce it, I think prices go higher. But even otherwise, I'd say with these Russia sanctions, even in like a moderate form, 60 is probably a better flow.
Well, speaking of flows from around the world and, of course, the Russia equation as well, Amrita, a final question to you on Venezuela. There's a lot of questions here about what Donald Trump's strategy is towards Latin America broadly, but specifically towards Venezuela and the oil supply and the partnerships that happen between Venezuela and Russia. How seriously is that threat being taken in the people you speak to?
Not much, in the sense that I think it's gone the other way, where a lot of people are asking us, we'll have a lot of Venezuelan oil following regime change. Firstly, I don't think the U.S. is kind of going in directly. Yes, they probably do want some regime change, but they're not kind of putting boots on the ground. More importantly, the Venezuelan upstream industry is completely damaged. It's going to take hundreds of billions of dollars and years to resurrect that. And the debt that PDVSA has is the biggest crippling factor. So we're not looking into swathes of Venezuelan oil coming to the market in the next few years. So I think this is a long-term story, if it were to even happen.
Amrita, great to catch up. Thank you very much indeed for your views. Amrita Sen, founder and director of Market Intelligence, joining us from Energy Aspects. Coming up, the big story, the U.S. House of Representatives returning to work today, a vote on the bill to end the longest ever U.S. shutdown on the docket. We'll talk about that next. This is Bloomberg.
NYK sustainability efforts have produced a breakthrough. The tugboat Sakigake is the world's first ammonia-powered vessel in commercial use.
LNG can decrease emission of the carbon dioxide compared with the heavy fuel oil, the 25% more or less. But ammonia, 95% decrease can be achieved.
According to Bloomberg NEF, ships powered by LNG and other alternative fuels make up nearly 40% of the global shipping order book.
This is funded by the NEDO, so-called Japanese agency. And also the NEDO has the kind of the GI funds and the Green Innovation Funds. And also the Japanese government is supporting the usage of the ammonia as the petroleum fuel.
It's more expensive than normal standard fuels.
Yes, it is. And at this moment, the supply of the ammonia volume is very much limited compared with the LNG and also the heavy fuel oil. But in order to promote ammonia as a marine fuel, together with the other industry players, and we can have the kind of the mass production then the cost will be decreased. Then the next 10 years, we try to increase the number of the vessels powered by the ammonia.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. 26th, Chancellor of the Exchequer, Rachel Reeves, delivers the UK's autumn budget. Can she boost growth and productivity by unlocking investment? How will the Treasury raise revenue without breaking tax promises? And will the budget prove that a fairer economy can reward working people? Bloomberg Television brings you special coverage starting with the Chancellor's Statement to Parliament at 12:30 p.m. UK time. And tune in Thursday for the opening trade budget special at 7 a.m. Bloomberg, context changes everything.
Welcome back to the opening trade. 46 minutes into our European session, and it is looking increasingly positive. We've had earnings stories to deal with. US futures also increasingly positive. NASDAQ futures up by 0.6% right now. Let us turn to matters European, though, and to the French budget story, which continues to rumble on. The French Parliament is scheduled to vote today on suspending the 2023 pension reform as part of the Social Security financing bill. The vote is considered crucial for the stability and survival of Sébastien Lecornu's government. Let's talk to Bloomberg's Caroline Conan, of course, who is in Paris for us. What's being debated then today? Help us look ahead, Caroline, and why does it matter to the overall budget story?
You know, the suspension of the pension reform that brought the retirement age in France from 62 to 64 years old back in 2023, well, that suspension was a key request from the socialists last month in order to avoid another vote of no confidence against the current Prime Minister, Sébastien Lecornu. So unless there's a big surprise, this reform should be suspended today until 2027, which is the next presidential elections. Sébastien Lecornu has claimed he had no choice in order to keep the socialists on board. So this has been included in the social security part of the budget, which is being debated this afternoon. Remember that same social security part of the budget that made the government of Michel Barnier collapse pretty much 1 year ago. Of course, this comes at a cost. This will cost about 400 million euros in the next budget, 1.8 billion euros the following year, and as much as 15 billion euros by 2030. There was, though, one first ray of hope with a vote on Saturday on the revenue part of the social security budget, which passed in a very tight vote, 176 against 161. That made one MP from Macron's camp say that we may see the emergence of a bloc of reason within the National Assembly.
Reason in the National Assembly. Taxes in the National Assembly as well. More taxes.
Yeah. That's right. We're still really far away from a final vote on an overall budget in France, but in the first discussions, the amendments created as much as 40 billion euros of extra new taxes compared to 15 billion euros in the initial copy of the French government of Sébastien Lecornu. These new taxes are mainly targeting wealthy individuals, capital, and big companies. The so-called Zuckman tax was rejected. However, we are seeing the return of the exit tax for those who decide to leave France, for example. There's also a new tax on so-called unproductive wealth, which is luxury yachts, private jets, or what they call non-productive real estate. On capital, Parliament approved a tax on super dividends and increased the tax rate on share buybacks from 8 to 33% in order to bring in 8 billion euros. And of course, remember, this exceptional tax on big companies that was supposed to last only 1 year in 2025. Of course, this has been expanded for another year in order to bring in another 6 billion euros. So a lot of new taxes there. Of course, this tax is not approved at the moment. It will then go to the Senate by tonight, by midnight. And of course, it could be amended by the Senate, which has a center-right majority.
Well, looking forward to seeing how this all plays out. Yet another twist and turn in the French political saga. Caroline Conan, of course, joining us from our Paris bureau. We thank you so much. It's a similar story in Washington, where the U.S. House of Representatives will be back at work today for the first time in nearly 8 weeks to vote on a bill that would end the longest government shutdown in American history. For now, we're joined by Bloomberg Managing Editor for the U.S. Economy and Government, Mario Parker, hot-footed it over here from Washington to join us this morning. Just walk me through the likelihood that come Friday, the government's open.
Well, at the risk of handicapping this Congress and this chaotic political landscape in the U.S., the likelihood is quite high at this point. There's a lot of optimism that the shutdown is going to finally be ending. The fact that Congress, the House of Representatives, is in and of itself coming back after almost 8 weeks of quote-unquote vacation is a positive sign.
In terms of what happens when it reopens, just walk us through the kind of, like, how do you reopen a government? Talk me through the kind of what people are talking about in DC. What happens first? What kind of clues are we going to get about when the data arrives? Kind of just give us a sense of the next few days if it happens.
Yes. Well, one of the things, the main thing that people in DC are talking about right now are just the federal workers getting back to work.
Yeah.
One of the pain points that we saw with this, and the reason that Democrats essentially caved, even as they had a winning hand, was these images of bread lines with federal workers, the backups with airlines, the hit to the hospitality and airline industry as well. So the main question as we approach Thanksgiving is how quickly can airlines get back to normal, first of all. The data, the resumption of the data, the economic data that our traders, our readers depend on so heavily as well. It's unclear right now how quickly that will resume, but that's a main question as well. And then again, as I mentioned, just the fact of federal workers getting back to work. Do they report back on Monday, next week? How does that look?
Mario, does the way that this was handled and the way it eventually ends, does it tell us anything about how close we're getting to the midterms, about how attention is increasingly focused on the midterms?
Yes, absolutely. I think one of the things, if there's anything, a moral victory that the Democrats scored, again, last week they had a very good tangible victory in some of the key elections. This week, even as there's some consternation among parts of the base, the moral victory is that you've got the argument settled on affordability. You've got the White House a little bit on its back foot with the economy as well, and then you've made yourself as the party of taking care of health care costs.
Mario, thank you very much. Thanks for joining us. Good to see you in London.
Thank you.
What a treat, helping us get to grips with the shutdown story right here in London. Let's bring in Bloomberg's Valerie Titel, who's been watching this, of course, from a market's perspective. Val, developments in Washington, we haven't had a lot of data, so maybe we're a little in the dark about the data and therefore the Fed's path from here.
Yeah.
So the shutdown really matters from a data perspective.
Yeah, no, it does. It does. I think the market is really keen to hear from the Bureau of Labor Statistics as soon as they're back in the office, the kind of schedule that they want to put together in terms of data releases. We're getting this backlog, this fog lifted in order for the Fed to have a better decision-making track for that December meeting. We have 4 weeks today in between now and that December 10th decision from the Federal Reserve. And the question is whether that backlog will be cleared in a meaningful way or will they'll still be struggling to get the data releases out the door. The other thing that is very topical with this is just the resumption of liquidity. We know that the equity market really struggled last week. We did see some front-end basis widening out, and a lot of that can be tagged to the fact that there's a liquidity problem right now because the Treasury isn't necessarily paying out these payments. There has been a cash balance rise in the Treasury General Account, the TGA. A rapid unwind of that could be something that could help the equity market, help the price of gold, help these front-end interest rates that businesses rely on for day-to-day funding come back to more normal levels, and that'll be something that would probably risk positive moving forward.
Do you think it'll come up at the dinner with Jamie Dimon and his Wall Street peers?
So this is a really interesting timing, I think, for the White House to invite most of the major executives. We have JP Morgan, BlackRock, Morgan Stanley, all the CEOs will be convening for a dinner with President Trump. Just what will he be trying to ask them? One thing on my mind is whether there will be some more political pressure on the Federal Reserve coming out of this dinner. Will he want to get Wall Street on his side in terms of calling for more reductions in interest rates that Jerome Powell seemed really hesitant to give the market guidance for at the decision
Do you think they would bite
last
on that?
week?
Do you think they would take the bait on that?
Jamie
Dimon's been pretty clear on his concerns. So is David Solomon. He's talking about concerns around what is happening in terms of the debt track. There's lots of things going on here. Do you think is putting pressure on the Fed via these guys? Are they going to be the intermediary?
Well, in some way, you can say that Jamie Dimon is more powerful than Jerome Powell in his position at the helm of the world's biggest bank. But the other thing that Trump could possibly do is really try to push them to help this debt financing of the AI boom. We know that that's something that moving forward, Trump has been very successful at getting these AI pledges. He invited the tech leaders for dinner back in September.
But now you got to pay for it.
But now it's step 2. It's the debt financing. It's how are these companies going to handle this debt build out that we heard from tech executives in the last 24 hours is still going really strong.
I mean, private credit seems to have stepped up to fund it, so maybe. But I guess there's still something for Wall Street to do for these particular names on Wall Street.
But Trump's biggest fear must be that actually the politics is moving against him. So you talked about the midterms. The midterms are a year away now. How does he use these guys to help him politically? How do you put money back in people's pockets? How do you convince people that the cost of living crisis is not real? Is this the right...
That's what Trump's asking the execs. I imagine the execs are also asking Trump about some of the antitrust pieces and the regulation because all their IB revenues are coming from the FTC basically not being on their back.
Yeah, so perhaps, the Wall Street executives will be asking the Trump administration to move a lot more quickly when it comes to deregulation that they want to see in the banking sector. There's a lot of things that are still overhanging some of these regulators that the Wall Street executives want to see done quickly, and that obviously will help them boost their bottom
shutdown
line.
would have delayed a lot of this stuff as well, especially the boom in M&A that some of them had been looking ahead to. That would have been delayed.
Lots to discuss. Valerie Titel will be back with the full briefing of how that dinner went.
I wonder what they're having to eat.
That's what I was going to say. Is it like gold-tipped?
Who's going to be sitting on the left and who's going to be sitting on the right?
That's all that matters. That does it for the opening trade. The Pulse is up next. These markets are in the green. Lots of interesting conversations. Don't go anywhere. This is Bloomberg.
Coming to you live from Kuala Lumpur, the whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Stocks and treasuries gain as signs of a cooling labour market in the US prompt bets that the Fed will cut rates next month. The UK Health Secretary, meanwhile, denies plotting to oust Prime Minister Keir Starmer, accusing Downing Street of self-destructive behaviour. Plus, Hon Hai reports better than expected profit, and Infineon says that it will return to growth thanks to the global boom in AI spending. Well, a very good morning. Checking in on these markets an hour into the European cash trade, and we are extending the gains that we've seen on the benchmark stock 600. Euro dollar pretty steady at a 115 handle, and we're looking at futures pointing higher stateside. It is day 43 of the US government shutdown, but it appears we are inching towards its end. Meanwhile, we've got to keep an eye on UK gilt yields, the 10-year yield higher this morning, because, of course, we've got all that speculation swirling around Downing Street. But do keep in mind that investors were buying gilts yesterday. We'll dive into that in just a moment. But flip the board over, because I want to look at what's happening under the hood here in European stocks. Outperformance for the DAX in Frankfurt this morning, underperformance for the FTSE. But broadly, it is a green picture across this screen. Now let's also check in on the US pre-market. We've got an eye on AMD shares, the company having said that its sales growth over the next 5 years will accelerate, driven by strong demand for its data center products. So you are seeing, as you would expect, AMD shares up 5.8% in the pre-market. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse.
Good morning and welcome to The Pulse. I'm Lizzie Burden in London. Now this morning we've got stocks and US Treasuries gaining after softer US jobs data strengthened bets on a Federal Reserve rate cut. And with the US government shutdown on track to end soon, investors are bracing for a flood of delayed data once those agencies reopen. To dive deeper into the economic outlook, Rajiv Sibal, Senior Global Economist at Morgan Stanley, I'm pleased to say, joins me now. Great to have you back, Rajiv. So we've got these bets on after the ADP numbers that the Fed is going to cut. If it doesn't cut next month, would it be behind the curve?
I think that it's going to be a tense debate whether or not the Fed cuts. You have a lot of data that's coming out over the next few weeks. Historical precedent from the 2013 shutdown suggests that we will get a lot of the September data in the next week or so. But I think there's a big question whether or not we get the October payrolls data ahead of the FOMC. Our baseline is that it should come out based on the precedent of 2013. But last time, the government was not shut down for an entire month. And so there's a lot of question marks about what data was and was not collected. We'll be looking for the BLS, the Bureau of Labor Statistics, to give a little bit of indication on timing after the government reopens. But this is very important for that Fed meeting because ultimately the ADP data is a little bit of a new data series. We've not been tracking ADP data on a weekly basis. And the monthly data from the ADP is not as correlated to the non-farm payrolls as we would expect.
Exactly. I mean, we've had the Wall Street Journal reporting on how split the FOMC is. Of course, the labour market is so much in focus. From the private survey data that you've seen so far, what is your read on the labour market?
So our read is actually that we don't have a change in our NFP forecast. You've seen two different stories come through. The Challenger job cuts was something that caught headlines recently. But
are we overweighting them?
We're not. And if you read the data, a lot of it was talking about the Doge cuts that were coming from government cuts earlier in the year. And so the result of that is that that was kind of anticipated, and that was always going to be a drag on the October payroll. The initial claims data looks okay. So we're seeing signals in both directions. And because of the lack of correlation I was talking about with ADP, we've retained kind of our expectation that 50,000 level for the September NFP is going to be what we expect.
Now, we're in November. I have to kind of congratulate you because you were one of the few that didn't see a recession this year. So now we're looking to next year. We're looking for when productivity is really going to take off. And I suppose the big question is when we're going to see the fruits of all this AI capex.
So this is the big debate, I think, in markets. And if we think about AI CapEx, the challenge is if we, again, look at historical precedent to the 2000 internet introduction in the economy, it took 3 or 4 years for that data to really show up in the economic sphere, if you will. We think this time will be faster, but it's a big debate if we're going to see it in 2026 or 2027. And one of the things we've been writing about is exactly this delay and how investors need to be thinking about it. Because the challenge we think we're going to face over the next 1 or 2 quarters is a lot of the weakness in consumption that was perhaps expected maybe in Q3, perhaps was pushed to Q4 and Q1 because the tariffs didn't really come into effect until August and September.
So how much of a rebound would you be expecting in the US early next year?
So we actually don't really have the rebound until Q2, Q3.
Okay.
We see that you probably have 3 to 4 months of a drag ahead of us. You can see that in our inflation forecasts, a little bit deceleration in consumption. And this is going to be, I think, a little bit of a rude awakening for markets. And then you have the added complication of the government shutdown, which is going to be a drag on GDP data. So over the next few weeks, I think the data that we get is going to be hugely critical in setting expectations for the beginning of the new year. You have markets that are, I think, expecting an acceleration in consumption, but the timing of that acceleration may be delayed for 1, 2 quarters, and that becomes a big challenge, I think.
Okay, really interesting. I also want to turn to Europe because we saw German investor confidence dipping. Does that mean that Germany's fortunes are starting to turn or not yet?
We remain supportive on the German economy. We recently upgraded our German GDP growth by about 10 basis points to 1%. I think the debate on the confidence is really about the timing of the stimulus. We see that a lot of the stimulus early is going to be more on the social side, and the infrastructure projects, which is natural, take longer to implement. And so some of that benefit may not be immediately visible in the next few quarters or the next few months. And so as a result of that, confidence is probably going to be moving back and forth. But we do think the German economy is well supported into next year and thereafter because of the stimulus.
So then when's the ECB going to cut again?
So we have the ECB cut in March. We do think that Euro area as a whole, while Germany is strong, does have drags from French fiscal risk, Italian fiscal risk. And also, as I mentioned, in the U.S., if you have a little bit of a slowing of consumption over the next couple of quarters, that could knock on to export data in the Euro area. So we do expect that PMIs, even though they've been resilient, could have a little bit of downside risk in the next few months. And if that were to happen, we think that the balance on the ECB would push more towards a cut.
Okay. Rajiv, don't go anywhere because I want to get your view on the UK as well. That's Rajiv Sibal, Senior Global Economist at Morgan Stanley, of course. But let's bring in our Bloomberg Opinion columnist, Rosa Prince, on the latest in the UK. The Health Secretary, Wes Streeting, denying plotting to oust Prime Minister Keir Starmer. This is after Bloomberg learned that allies of Starmer privately accused Streeting of planning to challenge for the Labour leadership. So let's get Rosa Prince's take on all of this. Rosa, why do you think that Starmer's office slapped down this leadership challenge that our political editor Alex Wickham reported so hard right now? Do you think that he wanted to see this gilt market reaction, show it to Wes Streeting and say, I told you, don't come for me?
I don't think they wanted it to be quite this big. I think Downing Street will be quite unhappy about the headlines this morning. Now, the truth is that whenever you talk to a Labour MP, sooner or later, usually sooner, they will start talking about the Prime Minister, how badly he's doing, what they could do to get rid of him. So I think this kind of bubbled up, it reached a peak, and as you say, Bloomberg overnight reporting that the Health Secretary had as many as 50 signatures of the 80 you need to mount a challenge and was therefore ready to go. And Downing Street went very hard on slapping that down. Wes Streeting, however, has come out this morning and denied it. He says, in the terms of that reality TV programme everyone's been watching, The Traitors, he says, I'm a faithful, I would do nothing. It all amounts to a lot of chaos, and I think that's really problematic for the ruling Labour Party, because they came to office promising to end the drama that was really the hallmark of the previous government.
Yeah, he did deny it, but he's also criticising the Prime Minister here. Do you believe Wes Streeting at this point, or do you think the challenges are just going to keep coming?
Yeah, well, look, we have to take him at his word. I think it's certainly true, and I think even Wes Streeting would say that if a vacancy became available, he would want to be in the front line in the job. He would run for it. He's ambitious, he's keen, he doesn't think there's anything wrong with that. what he would deny is overtly plotting to topple the Prime Minister. And I think it's almost a kind of combination of things, which is, one, his own backbenchers are very unhappy. They see those opinion polls and know that they're probably, a lot of them, going to be out of a job if it keeps going like this. And we're streeting there saying, hiya, if it falls vacant, I'm available. So do the two come together? That's what Downing Street fears.
Well, yeah, because of that polling and Starmer really languishing behind Nigel Farage, the Reform UK leader, a lot of people, young people on the left of the party, have been looking across the pond at Zoran Mamdani and asking, who's the Mamdani of Britain? Do we actually need to pay more attention to the Greens and Zach Polanski?
Yeah, this is a big criticism of this Downing Street, that they're so worried about Nigel Farage and Reform UK on the right that they've kind of forgotten about the left. Now, Zach Polanski was elected leader of the Greens in September, wildly popular, particularly, as you say, with young people. And I think they're starting to sort of recalibrate and realise that perhaps they've made a mistake in ignoring that threat. I don't think the Greens will make a massive difference to Labour. I don't think that they are going to form the next government, but they could really damage some Labour MPs and deliver seats actually to Reform, which is the reverse of what the Labour Party wants to happen.
OK, Rosa, thank you so much for all that analysis. And Rosa's latest print is, of course, on the terminal. Just go to OPIN Go for her latest. Our Bloomberg opinion columnist, Rosa Prince. Now let's see how that Labour leadership challenge could impact the markets. Rajiv Sibal is still with us. I mean, this political instability isn't good for gilts. We're already seeing it today. What do you take on it?
So I think, in general, the budget becomes the focus here. And if they can deliver on the budget, the gilt market will be happy. If there's challenges to the delivery, then the gilt market is going to be raising questions.
Well, that's interesting, because our economists this morning say that the Chancellor, Rachel Reeves, if she can make a bigger fiscal buffer at this budget, even if that's through unpopular tax rises, even if it means that she has to break her manifesto, she could make the 10-year gilt yield fall 50 basis points. That's £6 billion less in terms of debt interest payments that the UK is going to have to pay. Do you agree with that?
So the level is really hard to speculate at this point, but I do think that if you get a big surplus and either through stronger economic growth or through tax policy that enables you to have a nice surplus, it does change the trajectory and the outlook. Because the challenge I think that the UK has had over the past couple of years is that we're in a constant battle of trying to maintain that surplus. And every time the UK thought it had a surplus, it kind of got whittled away. And so I think this is the thing that the markets are focused on, is if you have a structural surplus, which could be designed through tax policy, then there will be more calm in the market and you could see yields coming in.
Well, we're looking at the 10-year gilt yield up 4 basis points at 4.42 this morning, because of that political instability in part, although investors were buying gilts yesterday, we should note. But, of course, what would help the Chancellor is if the Bank of England were to cut rates. And we got the labour market data in yesterday, unemployment at 5%, traders up in their bets for a December rate cut. Do you believe that labour market data? Because the Bank of England's Megan Green says take it with a wheelbarrow full of salt.
Yes, the labour market data in the UK has had revisions and volatility in recent months and quarters. I do think, though, however, our baseline view, we have been a little bit more concerned about the labour market in the UK. So we do see the headline as appropriately from a direction standpoint. We know that PMIs have been actually resilient in the UK, but the labour market has been one area why we at Morgan Stanley have been expecting cuts from the Bank of England. And so this really reaffirms our position.
So you think they're going to cut in December? OK, that's really interesting, because we've seen the likes of JP Morgan bringing forward their calls from February to December, but you're already there. Do you expect that the budget is going to weigh on growth? Because a lot of people have been talking about a doom loop where growth is down because of the last budget. Are we going to see more of that if the Chancellor raises taxes again?
I think if we have a policy that brings finality to the situation and you can move on, I think the economy can continue to perform. I believe that the global economy is actually doing very well, and it's supporting both the UK and the euro area. And so if the UK can move past the budget crisis, if you will, and think about what is economic output going to be from different types of economic policies rather than just thinking about spending and revenue generation, that it will be more positive for the economy.
And is AI the silver bullet there? Because we started by talking about that CapEx turning into productivity stateside. Do we see a similar picture here in the UK?
So I think, and this is not just the UK story, this is Europe, this is the world in total. we need to see it first in the US because that's where most of the investment has been in AI. And then the adoption can be more rapid in other parts of the world. And so this is why I think not only for the US, but for the global economy, what happens in Q1 and Q2 becomes very important from the AI perspective.
Okay, really interesting. Definitely a theme for 2026. Rajiv Sibal, Senior Global Economist at Morgan Stanley, we thank you so much for your insights this morning. Coming up, we're going to check in on the pound after those rumblings of a leadership challenge for the UK Prime Minister Keir Starmer. I'll be speaking to Barclays Global Head of FX Strategy next. This is Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life.
I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. November 26th, Chancellor of the Exchequer, Rachel Reeves, delivers the UK's autumn budget. Can she boost growth and productivity by unlocking investment? How will the Treasury raise revenue without breaking tax promises? And will the budget prove that a fairer economy can reward working people? Bloomberg Television brings you special coverage starting with the Chancellor's statement to Parliament at 12:30 p.m. UK time. And tune in Thursday for the opening trade budget special at 7 a.m. Bloomberg, context changes everything.
There's so much disruption in politics, in trade, in blockchain, in AI. How do you think we'll reflect on this period?
I have to tell you that in my 30-plus years in this business, I have never felt the intense pressure of change like we do right now. From an investment person, staying on top of all these things has always been core to what they do.
All right.
Okay.
Gosh, it's like Hogwarts.
Yeah, it's like Hogwarts.
Thank you so much.
Wow.
It's quite impressive being in such a big hall.
I know.
I feel
Very
like the weight
important.
of history.
Yes.
Jenny, thank you so much for doing Leaders with us.
I am honored to be here.
So let's start from the beginning. How would you describe your family?
Wow, that's just diving right in.
Let's go in.
How would I describe my family? Look, I think bunch of achievers. You know, you look at my dad, he really built Franklin Templeton. People always say my grandfather started it, but my dad took it over when it was $2.5 million in assets and $10,000 in revenue.
So Jen, what was the interview process like to becoming chief executive?
So it was not a fait accompli.
Okay.
So the board, you know, look,
that's tough if you're like part of a family.
Oh, trust me. They put me through a Spencer Stuart CEO survey, and they said, we're going to give you a scenario, and you need to answer it. And the only reason I remember this one, I don't remember any other, is because my mind went completely blank with fear.
So that was Francine speaking to the Franklin Templeton CEO, Jenny Johnson. And you can catch more of their conversation in the next episode of Leaders with Francine Lacqua. That premieres at 5:30 p.m. London time on Friday, right here on Bloomberg Television. Now, getting back to these markets, we're looking at the pound weaker 0.2% at $1.31. It's recovered some ground after falling on the back of the worrying UK jobs data. Also factoring in, of course, that UK political instability that we have just been discussing. But we yesterday, of course, had that official data showing that unemployment reached the highest rate since COVID. In a possible bit of relief for the government, economists, though, are raising concerns about the accuracy of that data, including Bank of England's Megan Green. Now, joining me to discuss is Temos Theotakis, Global Head of FX Strategy and EM Macro Strategy over at Barclays. Good to see you.
Good to see you too.
Let's start on the pound then. So we've had Keir Starmer saying that markets wouldn't be very happy if he were replaced as Prime Minister. What sort of a market reaction do you think we'd see if he were replaced by Wes Streeting, even if Streeting is denying it?
I do think that obviously the market has been quite sensitive to any kind of political noise. What the market wants to see is a reasonable budget that leads you to some kind of path that is credible. And any distraction away from that would weigh either on bonds or on the currency to some degree. And on top of that, you have economic pressures that need addressing. So political noise is not what the market wants to see right now.
What's reasonable? What does reasonable mean? Because I think it's one thing to politics and another thing to the bond market.
Yes, so if you look at it from an economics perspective, the primary deficit is not enormous. It's middle of the pack, and if you compare it to other developed economies, the amount of budget consolidation that needs to be done, a little bit more than 10 billion, is something which is manageable. I think what the market wants to see is that whatever measure is put forward is an efficient measure. So ideally, the market would have liked to have seen some kind of spending cut, but it's not going to see that. At the very least, if tax hikes are being brought forward, credible set of measures that will last, will stick, will have a high yield in terms of budget returns would be welcome from the market.
I mean, is it a blessing for Rachel Reeves that the budget almost coincides with Thanksgiving? Are we going to see less liquidity and that meaning that there could be more extreme moves, or does it mean there'll be fewer cross currents?
You know, to me, I think everything is so well signaled right now that I don't particularly, I think that something would need to be enormously surprising to see enormous moves. I would be tempted to see the other way around. The pound is now cheap. There is a risk premium to what is going on. I would wait to see what goes right to start unwinding some of this madness, let's just say, in terms of pound at least.
Okay, but what about the Bank of England? Are you expecting a cut in December? Because it didn't sound to me like the Governor, Andrew Bailey, was all that convinced that inflation had peaked.
Yes, I mean, we do have a slightly more dovish kind of approach to the Bank of England. I do think, though, that the pound in itself, when you look at euro sterling, it's at 88. It has been at 89 or 90 during events like Liz Truss or the Boris Johnson negotiation on the post-Brexit future of the UK. So I do think that the market is factoring, and has been factoring this for a while, the economic weakness. I do think that if we go past the budget without enormous surprises, we might see tensions in the markets calm down.
Okay, well, I want to stay with the politics, but flip to Japan, because we've seen the yen at a 9-month low against the dollar. 154 per dollar is where we trade right now. We've had the Japanese finance minister coming out and saying that he's keeping an eye on it, but I wonder how weak the yen has to be for you to expect a proper intervention from Tokyo.
I think substantially weaker. The reason here is that, first of all, they're looking, when it comes to their reaction function, they're looking at volatility, at size, speed, violence of moves, not particular levels. So we would need to see a fast move to something like 160 or well above 155 for all intents and purposes. But beyond what they would do, I think what is important to keep in mind is that we have gone through a very bearish dollar environment since April, since Liberation Day. We have gone through a period of time where rates in the US have been repriced lower relative to the rest of the world, where the euro has traded at some point 118 and now still at 116 almost. And the yen has not just failed to capitalize, but it's actually trading quite soft and quite weak. which speaks to a weak underlying story, which speaks to a market's lack of confidence for policy normalization in rates, and for a fiscal and political direction which is moving the opposite end in terms of what would need it to happen to get a stronger yen.
Well, Thomas, you mentioned the dollar, and that takes me to the political chaos that we're seeing in the US. Potentially an end to the US government shutdown. We were talking before we came on air about how quiet things have been in FX actually recently. Do you think the volatility will come back when and if that shutdown ends?
Good question. I do think we will get some moves because we're going to get less pressure on the economy from the shutdown itself. We're going to get a bunch of data. There will be contradictions. There will be some data that's going to be softer. Some data is going to be stronger. The market is going to try to move. To me, I think all of that is a little bit of a distraction, to be honest. We're focused a lot of when the government will reopen, how long it will stay shut, whether the next couple of payrolls numbers are going to be soft. But when you look ahead, you have an economy that has already benefited a lot from AI spend. And massive companies, enormous companies, the major sort of like tech companies, are promising $3+ trillion of AI capex for the next 5 years, which is an enormous amount of money for any economy, even for the US. And I think that is something we will start seeing already by the end of this year, beginning of next year, and it will support the dollar.
Okay, because I had to chuckle at your note. You wrote, sometimes the macro world observes developments in the corporate space as if they take place in some parallel universe. So how much of a tailwind is AI capex going to give the dollar?
Well, let me first justify my point. When you speak to the macro world, they'll address what's going on in AI space as some kind of science fiction movie and some kind of equity bubble, which is not. You're talking about companies with proven business models, with enormous free cash flow, with amazing capacity to take loans, telling you that they're going to be absorbing resources globally.
Yeah,
basically.
But you cover EM as well.
Yeah.
So let's say the AI bubble bursts. Which EM currencies are most vulnerable?
I think that, obviously, I don't think that currencies in EM have actually moved because of AI, to be honest. You could see natural resource currencies get hit because of some expectation for demand. But I do think that we haven't seen that theme priced into FX markets here.
Okay, it's interesting. Bank of America pointing to the Thai baht and the Colombian peso, but let's keep an eye when and if that bubble bursts. Temos Fiotakis, thank you so much for joining us, Global Head of FX Strategy and EM Macro Strategy at Barclays. Well, coming up on the programme, is London still the place to be for the global elite? We're going to discuss with Raja Mekhuar, Senior Advisor at the Family Office, Capnor. That conversation next. This is Bloomberg.
The key issue right now for us in the diamond space is the declared divestment of Anglo from GBS. And as you know, Anglo holds 85% stake in GBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in GBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties. We have the Oman Sovereign Wealth Fund. We have others who are willing and ready.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the centre of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
Insight with Haslinda Amin, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacqua in Sintra, Portugal, and this is Bloomberg.
Good morning and welcome to The Pulse. I'm Lizzie Burden in London and these are your top stories. Stocks and treasuries gain as signs of a cooling labour market in the US prompt more bets that the Fed will cut rates next month. Here in the UK, the Health Secretary denies plotting to oust Prime Minister Keir Starmer, accusing Downing Street of self-destructive behaviour. Plus, Hon Hai reports better than expected profit and Infineon says it'll return to growth thanks to the global boom in AI spending. Well, those are our top stories this morning. We're also watching the moves in the oil market after that latest report from the International Energy Agency further tempered its stance on an imminent peak in oil demand, reinstating a scenario in which global consumption keeps growing to the middle of the century. Let's get analysis now. Bloomberg's EMEA News Director Will Kennedy joins me for more. Will, just talk us through this report. We're looking at Brent weaker 0.7% at $64 a barrel. How is it likely to be received globally longer term?
Yes, this is their annual long-term report that's produced by the International Energy Agency, and it's been quite controversial over the years. They had done away with what they call their current policy scenario, i.e. if nothing changes, what happens to demand, and gone for scenarios that assumed we would take more drastic action against climate change. The IEA denies this as a response to the Trump administration to reinstate this forecast, but I think clearly it's acknowledgement of the shifting political winds around climate change. And what it says is right now, if current trends continue, far from having a peak in oil and gas consumption that many people had predicted, oil consumption will rise by 13% to the middle of the century, which is not good news for our prospects of tempering carbon emissions.
Well, yeah, just take us through the supply side, because OPEC's been upping its production recently. That's the demand side, but what about supply?
Yep, there's plenty of supply in the world, and I think one of the reasons that oil demand is still rising in the short and medium term is that it's relatively plentiful and relatively cheap. And that means that the shift to electric vehicles, and the IEA was explicit about this, may not be quite as quick as people expected some years ago. Of course, electricity prices are rising in many parts of the world because of the boom in demand from electricity and electrification and artificial intelligence and electric cars. Meanwhile, we have an oversupplied oil market, as you say, and that's keeping the price of gasoline and the diesel that people put in their cars relatively low by historical standards.
All right, Will, thank you so much. Will Kennedy, Bloomberg's EMEA News Director, with that crucial context. Now, London, as a destination for investors and the wealthy, has very much been in the spotlight of late after the Labour government introduced tougher tax rules on the non-dom population last year. The country's once vibrant stock market also in a rut, with a flow of negative headlines weighing on the city's reputation, including this morning, ahead of that UK budget later this month. But my next guest says that London still retains huge appeal. That is Raja Mekua, Senior Advisor at the Family Office, Capnor. Good morning to you, Raja. I want to get the case for London from you, because we started the show painting a pretty chaotic picture of London, especially when it comes to politics. Why are you so confident in its appeal?
Well, I mean, we should always, nuance things. I think London has a great legacy reputation. It has, used to have great infrastructure. There's a huge pool of capital still in London, and it's the natural, stopover for American investors altogether. But I think slowly but surely, this legacy position is being eroded because of recent political uncertainty. And, even if I look at it from the capital and the wealth standpoint, while this kind of money doesn't move, with a knee-jerk reaction, it also watches where clarity comes from and will follow that. So I don't think it's a blanket approach that we should have, and we should watch the news very carefully. The upcoming budget is super important, and unfortunately, we've had some negative signals that worry the investor community. But if you take Brexit, then you add to it the end of the non-dom, the IHT starts to accumulate in a worrying way, and we're just still hoping that the next decisions will be a little bit more favorable to preserving London's role.
Well, yeah. Do you see Rachel Reeves, the UK Chancellor, as a friend to the rich? What sort of measures in the upcoming budget would drive Americans away?
Well, Americans are looking at wider options because of the recent mayoral election. But, again, it's not like you can just bail out of New York overnight. And I think what worries people the most here in London is the mansion tax. It's this new exit tax that has been rumored to be being discussed. And anything that prevents capital from working hard and being optimized, I think, will not please people in our community.
I mean, you mentioned Brexit. Arguably, Brexit's given Britain the freedom to negotiate its own trade deals, free of the shackles of Brussels. We were front of the queue for that trade deal with Washington. I only say this partly in jest, the following. Is the political chaos here in the UK actually something of an attraction for Americans? It seems to have attracted the likes of J.D. Vance and Elon Musk.
Well, no, I don't think so, because I think capital follows clarity, and anything that is not, looking like with good visibility will not help. But at the same time, Europe is seen as a more benign territory now from the US, because it's on a relative basis, it's cheaper. So you see big firms in private equity expanding operations in London. They can buy companies that have, success and issues. They can also hire good talent at a relatively lower cost than in New York. But for a New York business, the alternative is not only London or Europe. If they want to move, ranks of staff, they also have other alternatives in other US states. And I think I was just reading the stat that nowadays JP Morgan has more staff in Texas than they do in New York, just because of the cost of living and the salaries, etc., that are become really, really expensive. So, Europe is seen from America as a good turf for better pricing in general.
Well, yeah, what about other European capitals other than London? I think of Milan and all of the active efforts that the Italian government is doing to draw those non-doms away from London and to Milan.
Yes, I mean, the Italians have been great at introducing a flat tax, which wealth loves. At the same time, I think it's too early to call the shots, because if you look at the wider economy, it's not like Italy is growing very fast. Miss Meloni has been good at cleaning up, the deficit, but I think right now debt to GDP is still 130% in Italy, and all these measures eventually are taken into account. At the same time, if I look at capital and if I look at talent, which are the two notions that I like to oppose, people who have made their money or have money are very easily moving to Milan, but talent that still works and need a career, I don't think have that much prospect in Milan, and London remains an attraction for the younger generation. And I think that's an important nuance to keep in mind.
Yeah, why specifically is London so attractive to the younger generation?
Well, it's the critical mass of infrastructure, opportunities, at least in our industry, private equity in particular. It remains unbeaten. It's very international. It's the natural stopover for Americans. And from that standpoint, the opportunities are still better and bigger in London. But of course, down the line, the cost of living, the ease of living, the quality of schools and the infrastructure around it will also be taken into account. So let's say in financial services, London still remains number one, but it shouldn't rest too much on its laurels and count only on its legacy image to attract talent, because one thing is to attract talent, another one is to retain it over time.
So overall, is it more a London pull or a Trump-Mamdani push, Raja?
Yes, I think, again, people are watching. In New York, people are nervous, but so are they in London. The political, chaos right now doesn't help anyone. But I would say that for New Yorkers, London remains a playground that's natural, and they don't have to live here to enjoy the benefits of London. And for people in London, the playground is much wider. In Europe, you have now Dubai emerging as a clear hub for lifestyle. And again, I would keep the separation between those who have to work to make money and those who have money and don't need to work anymore.
Okay, really great to have you on. Raja Mekua, Senior Advisor at CapNor. We'll see where those non-doms land in the future. But speaking of big moves across the world when it comes to hiring, major US investment banks are speeding up their hiring of finance specialists in India. The flurry of job postings underscoring Wall Street's growing reliance on Indian hubs. And that reliance is set to grow as President Donald Trump moves to tighten immigration by driving up visa costs. For more, we're joined by Bloomberg's Janyapon Janjaroen out of Mumbai. Good to have you. Just talk us through why India's global capability centres have become so important for Wall Street banks.
Hi, good morning, Lizzie. Thanks for having me. Global capability centers are what multinational companies are establishing overseas to provide worldwide support for their operations. It used to be a simple stuff like call center or something back offices. But over the years, the involvement of India's global capability centers have evolved. Now, people in India are doing more sophisticated jobs, from artificial intelligence to quant analysis program and auditing and multi-functions. We are seeing banks hiring senior levels, like including managing directors level in India. So India is now the world's largest hub for global capability centers and very significant to US banks.
And so how are President Trump's visa curbs likely to impact these expansion plans by banks in India?
Good question. Even before September, when President Trump announced the visa fee, we already saw hiring spree in India, and that hasn't stopped at all after the announcement. Actually, our sources were telling us that some of the jobs being posted for US are now being diverted or considered for alternative roles in India. Cost is quite significant, and the big pool of talents in India is actually crucial to US operations. So we may see more jobs and coming here.
Okay, well, we'll look forward to that. The big take is already on the terminal. It's a fantastic read. I highly recommend it. Bloomberg's Janyapon Janjaroen. We thank you so much for bringing it to us. Now, coming up on the programme, the UK wellness drinks brand Trip says that it's now valued at $300 million, boosted by a star-studded funding round. And we're going to be speaking to the fund founder and CEO, Olivia Fairdy. That conversation next. This is Bloomberg.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something. Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Welcome back. Now, Infineon shares are rallying after the firm posted quarterly revenue in line with estimates this morning and said that it sees revenue growth next year due to the boom in AI centers. As you can see, the shares up more than 5% this morning. The German chipmaker's CFO spoke to Bloomberg earlier.
If you look into the revenue development for AI, and for us, AI is powering AI from grid to core, has developed in a very steep way. 2 years ago, it was 250 million revenue. Last fiscal year, more than 700. And as you said, we just raised the guidance for our AI revenue for this year from 1 billion to 1.5. So we are more than doubling in this fiscal year, and it will not end in 26. We expect the addressable market for Infineon for powering the AI data centers in the magnitude of 8 to 12 billion. So it's a significant idiosyncratic growth driver for the company going ahead.
How much precision do you have at the moment in terms of the outlook on that space, and in terms of being able to guide investors to what you are going to see next? How much precision do you have there?
Yeah, so first of all, the 8 to 12 is the addressable market. So it would assume 100% market share, which is probably not the most realistic assumption. 1.5 is the revenue we are generating this year. How much visibility is there? Of course, we have a very broad coverage of all major customers, be it cloud providers, be it processor makers, which gives us a great visibility into the business. You're also maybe aware that we entered into an agreement with NVIDIA to cooperate on the development of a total new architecture, which is 800-volt DC-DC. So there's a lot of visibility in what's happening, but of course it is and remains a very dynamic market.
So that's the CFO. Let's get some analysis now with Charles Schump, technology analyst at Bloomberg Intelligence. Charles, you heard Sven Schneider there. What did you make of these earnings from Infineon?
I think the company's guidance is that we expect, given a very prudent guidance, because there's a lot of headwinds that are visible in the short term. For example, the high inventory in the supply chain, and also the slower growth in the EV market. But the thing we have to look into is actually the term prudent, because we are seeing that there's also some silver lining in the longer term. For example, the AI power supply market is actually growing strong. Actually, the company just raised the guidance on this front actually by 750 million euro dollars for next year. And also we are seeing that they are also still building a very large capacity for the coming demands. So that shows that they have a confidence that there's more growth in this area. So that's one thing. And the other thing is actually is that it's a MCU, the volume shipment. Just in the earnings call that finished a few minutes ago, the management mentioned that they still are confident that the volume can go in a mid-teen. So that's actually also another signal that the confidence that there will be more growth than the guidance hint in the coming quarters.
Yeah, I mean, we're also trying to gauge the AI demand story from the Honhai results, and they, of course, have posted better than expected quarterly profit. What do you read into that?
Yes, actually, there's also another signal that the AI server demand is very strong. In the past, we worry that when in the transition period, when NVIDIA launched the new AI server, there will be some slowdown. But this year, we are expecting something different. So that's why the Hong Hai is still actually accelerating the shipment for the AI server. And also, this is reflecting on their component sales growth is very strong. And that's actually good positive factor because it's a component business actually is one of its highest margin business. So that actually supports its gross margin and also operating margin increase in the coming quarters.
Okay, Charles, thanks so much for digging into those numbers for us, watching all the earning calls for us as well. Charles Shum, technology analyst at Bloomberg Intelligence. And you don't want to miss our latest edition of Bloomberg Tech Europe, focusing this time on the defense space and how AI is reshaping that industry. It all starts this Friday at 6:30 a.m. London time, right here on Bloomberg Television. Now, Tom Mackenzie, of course, will be speaking to lots of exciting founders, and we've got one of those right here for you. The drinks brand Trip, having raised $40 million in a funding round, which included investments from lots of celebrities. The company says that the fundraise gives it a $300 million valuation, and I'm pleased to say we're joined now by Olivia Fairdy, co-founder and CEO of Trip. Welcome to the show, Olivia.
Hi.
It's good to have you with us. I wonder, I've had a Trip drink.
Yes.
I don't know if viewers have, so maybe you could explain to them the difference between a CBD drink and an alcoholic beverage.
Definitely. Well, these have no alcohol, no added sugar. They're positioned as a what we call better-for-you beverage. So you might see these drinks in the front of store in a meal deal. You might find them on a menu listed as an alcohol alternative. As we mentioned, a lot of people reach for these instead of alcohol because the fact there's no sugar as well as no alcohol means you're able to have a healthier option instead of those traditional, slightly sweeter options, which can be a bit limiting if you're actually looking for something to drink all evening or all day.
So am I meant to drink it before yoga in the morning or at night before I go out?
Both.
Okay.
Yeah, we call it an all day, every day. So like I mentioned, there are people grabbing them. I had one on my way here. You could find one in the coffee shop next door.
You offered me one before we came on, but I think we'll have to save it for after.
Yeah, you can have them any time of day because these ingredients, so functional is quite a new and exciting area of soft drinks more generally. It's driving a lot of the growth in soft drinks, and it's things like magnesium, lion's mane, natural extracts from botanicals which help your mind and body adapt to stress. That stress could be physical in a yoga experience. It could be at the office desk, but it's really flexible. That's why they're having such an incredible popularity because of the breadth of those moments. It's really not restrictive.
But I know that the ASA banned an ad of yours on that claim that the drink reduces stress, right? Have you had any external advice on that? Can you update us on how you're going to navigate future ad
We
claims?
have a range of ingredients, all of which allow claims about finding moments of calm. It was a single advert on the website, so a single complaint, and actually we're incredibly confident about our ability internationally to continue using these claims in relation to our brilliant profiles and formulas, which are helping tens of millions of people around the world. The mission is to create 1 billion moments of calm, and having sold hundreds of millions of cans already, we're well on our way to achieving that, which is great.
Well, let's talk about it as an alternative to alcohol, because we've been writing a lot about Gen Z giving up booze. I wonder if it is a long-term shift. Are you seeing evidence of that?
Oh, yeah, definitely. You don't hit $100 million in revenue from something niche that's not got tailwinds behind it. We're talking about these macro trends of people reaching for a better-for-you option. That is a healthier choice versus traditional soda. And then when you're thinking about alcohol alternatives, again, people aren't looking to consume necessarily alcohol-free versions of wine or beer or spirits. Gen Z didn't grow up on those sorts of beverages, so they're looking to enjoy taste and experience, and social media has been a huge driving element in those choices, particularly when about a third of Gen Z are completely teetotal, and all other demographics have reduced their alcohol consumption.
Well, look, Olivia, I'm teetotal. Let me ask you something that I asked the Carlsberg CEO.
Okay.
There is a drink that has no calories, no hangover, no cost. It's got morning, noon and night. It's water. Why not drink water?
Well, I think for our hospitality establishments, that's tons of billions of pounds left on the table, and we really need to come together to support that industry because experience is a big part of why people choose to relax and socialize as well as celebrate. People reach for alcohol to relax. That's not just a solitary moment at home, but allowing the options and the benefits. The alternative to water here is you've got added benefits in these functional drinks. So beyond water, magnesium to help replenish the balance in your mind and body. Lion's mane, chamomile, L-theanine. These added ingredients are giving your body supplementation which supports the best balance and health of your mind and body. That is kind of the counter specifically to water, as well as the broader trend about those venues and how we want to support. We don't want to tell teetotalers, just have water, there's nothing for you, you're not included, you know? We want to join them in the celebration, and actually the teetotal person in a social group is typically the one that chooses the venue. I don't know if you would agree, and knowing that there's more than just water, knowing that there's more than just water, I think is important, not to exclude these people from what is an important part of experience.
True, well, you've certainly convinced lots of celebrities, the likes of Alessandra Ambrosio, Sophie Habu, Joe Jonas.
Yes.
How important is that group of celebrity investors, the combination of fame and money to your strategy?
I think all of these incredible ambassadors came on as customers. You know, they loved the brand, they were consumers of the brand, and we kind of connected over that, and they were so excited about the growth journey and, you know, the raise and how fast we're growing, how fast we're impacting cultural change. They wanted to get involved in a more meaningful way, and to have them as experts speaking to their audience in a very authentic way about something that helps them. They're each experts in their own right, whether it's a pop star looking to de-stress backstage or decompress after a long tour. Joe Jonas is on tour at the moment. You know, alternatives to alcohol as well as healthier options that they can recommend. Some of those are mothers, they are business women, they are performers. High performance is such a broad term, but to be able to speak authentically to their audience about things that have helped them find balance and that are healthy, you know, how incredible to be able to talk about something that's actually great for you. There's an incredible amplification that we see typically globally on social, because all of these international experts are part of the journey in a meaningful way.
Well, congratulations are in order, because after that funding round, Trip's now the highest value drinks business led by a woman. How are you going to spend that money?
Oh, we're going to be getting closer and closer to the people that are looking for Trip. That in particular is the US. So all of this funding is to amplify existing growth in the US and the opportunity there. It's an enormous market. Our community and the demand we're seeing from that market is something we want to get close to as quickly as possible, because at the moment simply supply isn't meeting demand. So for us it's about producing more beverage. You know, we're doing millions of cans of production a week. It will be millions of cans per day pretty imminently. You know, the working capital for that is important, as well as the logistics and international marketing efforts.
So when and if you do list, will it be New York or London?
We shall see. I'll keep it open-ended for now. For us, we are running the business. It's a family-owned business, and, you know, we built this, my husband and I, after a personal experience, and we're incredibly passionate about getting this to as many people and helping so many on their journey of everyday health and well-being. The future, you know, there's a lot of different ways we can look at it. I think what's exciting from the data that we're all seeing, and a lot of strategics are seeing as well, this is so beyond a niche, this is so beyond a trend. This is something much more macro, which people need to pay attention and cater for. You know, you don't want to be that person in the bar or the restaurant that's being told, sorry, tap water's all we have on offer.
Don't you? Okay. Olivia, we can crack a Trip after this.
Yes.
Olivia Ferdy, co-founder and CEO of Trip. So good to have you with me this morning. Thank you so much. Well, Bloomberg's David Rubenstein is going to be having another big conversation for us later. That's with Kevin Hassett, Director of the National Economic Council. Don't miss that at 5:30 p.m. London time. But that does it for The Pulse. Coming up next is Bloomberg Brief. We're going to head to New York. This is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, you know, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can't be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
It's 5 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. Reopening trade. Stock futures rally as a likely end to the government shutdown lifts investor moods. Treasuries also climbing as the cash market returns from the holiday. Wall Street at the White House. President Trump plans to host a dinner tonight with financial CEOs, including Jamie Dimon, David Solomon, and more. And in AI we trust. AMD, Infineon, and Honhai all out with positive growth outlooks, boosted by demand in artificial intelligence. So it was a rocky session yesterday. We did end up 0.2% for the S&P 500, down though for the Nasdaq. Today it's a different story. The prospect of an end to the government shutdown really infusing some enthusiasm into this market. After all, the last 4 government shutdowns have seen the S&P rally afterwards. Same for Russell 2000, and we have also the betting odds now at 90% that that shutdown will end today, day 43. Can you believe it? Let's take a look at bonds because, of course, we're reopening after Veterans Day. We are seeing the 2-year yield down about 2 basis points, 3 basis points across the 10-year part of the curve, and then just under 2 basis points at the 30-year yield. So a little bit of movement here, but essentially the story is perhaps the soft ADP data causing some demand for treasuries, and also, of course, Fed rate cuts and the betting on that for December. That's now at about 70% of a chance for a Fed rate cut. So all that is being priced in today. We'll see how things go. We're 4.5 hours from the open. So let's get a look at some individual movers now in the pre-market. Over to London and Valerie Teitel. Good morning, Valerie.
Good morning, Vonnie. Let's start with a check on AMD. It is soaring in the pre-market, up more than 5%. This is NVIDIA's main competitor when it comes to that advanced AI chip market. Now, AMD, their CEO, was out with a prediction that over the next 3 to 5 years, they're going to see on average a 35% growth when it comes to revenue, and specifically their AI data center revenue she's predicting could run at near 80% growth over the next 3 to 5 years. She also had some bullish comments when it came to investment in data centers. She said that the largest owners of data centers have been telling her that they are continuing strong investment into that space, saying that there has been no leveling off when it comes to data center investment. Next, let's move on to the space industry. Rocket Labs out with a beat in revenue last night after the bell. The shares are higher by 2.5%. The company is on track to beat its launch record for the year annually in the fourth quarter. They did announce, though, a pullback when it comes to the timeline of their larger rocket launcher to launch larger satellites into space. Vonnie, this is key because this is a component where they wanted to compete directly with SpaceX. So kind of a positive and a negative for Rocket Labs. Lastly, I want to touch on the payments industry. Bill Holdings, there has been sources telling Bloomberg they have solicited both private equity and industry leaders for a bid for the company. The shares are rising 13% in pre-market. Now, the business payments industry, Vonnie, has seen a lot of consolidation over the recent years. So this is just another sign of a trend. But Bill Holdings has been suffering from intense competition in that space.
Yeah. Yeah, and an activist investor as well with Starboard there, Valerie. Thank you so much, Valerie Titel there in London. And later this hour, we'll speak to Frank Monkham of Buffalo Bayou on the year ahead investment plan. But first, our top story, the U.S. House of Representatives will be back at work today for the first time in nearly 8 weeks to vote on a bill that would end the longest government shutdown ever. For more, we're joined by Bloomberg Managing Editor for the U.S. Economy and Government, Mario Parker. So, Mario, take us through the steps. What has to happen?
Well, next, as you mentioned, the House of Representatives is back after an 8-week sabbatical away from D.C., if you will. Some procedural votes have moved forward, both in the Senate and then in the House. And the House, presumably, optimistically, the House will vote on the shutdown deal later on this afternoon during the U.S. Day. Hopefully it reaches President Trump's desk, and then things start to happen to restart the government from there.
Now, is there anything that could provide an obstacle or a blockage to this, or can we expect that at some point today we will have an open government once again?
Oh, no, there's always an opportunity or a challenge there for this Congress, this current political landscape that we find ourselves in Washington. Nothing is done until it is done. There's high likelihood right now. There's optimism, more optimism than there's been in the previous 8 weeks or so. But until it reaches the president's desk, until he signs it into law, there's nothing. There's always some room for something to go awry. One of the reasons, I mean, there's political pressure on both sides. Both the Democrats and the Republicans are feeling some pressure here. A lot of the backroom dealing, willing and dealing. Again, the optimism is high. The likelihood is the highest it's been. I would probably handicap it well above 90%. But until it's a done deal, it's not a done deal.
Yeah, exactly. Now, we know as well that President Trump is planning a dinner tonight, if you don't mind, for Wall Street's top executives, David Solomon, Adina Friedman, Jamie Dimon. What will they discuss, do you think, Mario?
I think a few things will be on the table. You have to imagine that tariffs will be front and center. H-1B visas should be on the docket as well. And then the broader state of the U.S. economy. One of the things that did come out of the shutdown talks, one of the things that did come out of some of the U.S. elections last week was the president finds himself a bit on his back foot in terms of economic messaging. Whether or not the Wall Street titans that you mentioned are able to give him some modicum of advice that he heeds, we'll see. That'll be one of the things we want to see coming out of that dinner.
All right, we'll be keeping a close eye. Mario Parker, thank you so much for joining. Well, in the UK, cabinet feuds spilling into the open. UK Health Secretary Wes Streeting has denied plotting to oust Prime Minister Keir Starmer. Bloomberg has learned that allies of the Prime Minister privately accused Streeting of planning to challenge for the Labour Party leadership. This comes just weeks before the government is due to unveil a contentious budget. For more on this, I'm joined now by Bloomberg's Lizzie Burden. So, Lizzie, what exactly do we know about any kind of potential leadership challenge that might be waiting Keir Starmer in the wings?
Well, Vonnie, Starmer's team told us that the market wouldn't like it, and indeed we are seeing gilt yields up on the 10-year. We saw investors buying gilts yesterday, so perhaps we can look through that. And we've had Wes Streeting, the Health Secretary, denying that he is making this challenge just this morning on the airwaves. But it wouldn't be the first time that his name has been swirling around, because he is 42, so younger than Starmer. He is charismatic. He is from a council estate in London. He's gay. He'd be seen as a fresh face of the party when Starmer has a personal rating that's been languishing behind Nigel Farage's, the Reform UK party leader, of course. And it's previous that we had Wes Streeting's name floated because he was so openly criticising President Donald Trump when he came for that second state visit earlier in the year. So Wes Streeting breaking with Starmer's softly approach to the US president. But what's interesting about Streeting is that he only won his seat by a razor-thin margin at the last election. So he might not even be in the parliament at the time of after the next election. But the timing, as you say, of this, Vonnie, is notable because we are just weeks away from that budget. It looks like the Chancellor could break her manifesto and raise income tax, which would be hugely unpopular. That could create a window of opportunity for a leadership challenge. But look, this political instability, if we lose Starmer, smacks of the Conservatives when we had Boris Johnson followed by Truss, followed by Rishi Sunak as well. And that is exactly the sort of instability that Keir Starmer promised to end.
Yeah, I mean, UK business chiefs are urging the Chancellor, as you were pointing out there, Lizzie, to ease energy costs, avoid raising the tax burden on corporate Britain. That would be to the detriment, obviously, of, you know, British citizens, right? So she's in between a rock and a hard place. Will she be becoming under more pressure now if this leadership challenge is underway?
Well, the Chancellor feels that she's got the bond market behind her. Remember when there was that gilt sell-off when the Chancellor cried and there was speculation she was going to be fired? Well, actually, just this morning, Bloomberg Economics put out some really interesting research saying that if she is able, even if it's politically unpopular, to boost her fiscal buffer, that could mean that gilt yields fall on the 10-year by as much as 50 basis points, so winning her £6 billion in terms of reduction in the debt interest payments that she needs to pay. Perhaps if she can just get through this budget and get through that, it would give some political strength to the Labour Party. But she also got criticised yesterday by the opposition parties for that 5% unemployment figure. You've had the Bank of England's Megan Green pouring cold water on it yesterday, saying, look, we can't trust these labour market figures completely because of data collection issues, and actually the hit to the employment figures that we've seen because of the Chancellor's tax rises at the last budget may be already in the rear-view mirror. So we look ahead to what she's going to do in terms of the tax picture at this budget.
All right, and we'll be listening out for PMQs at 7 a.m. Eastern Time. Lizzie, thank you so much. That is Bloomberg's Lizzie Burden. Now to other top stories trending on the terminal this morning. Two Sigma's assets under management in China are now more than $1.4 billion for the first time. It's now the second global asset manager behind Bridgewater to grab a top spot in the country, which has been dominated by Chinese firms. Two Sigma declined to comment. JP Morgan has started rolling out a deposit token to institutional clients. The JPM coin allows users to send and receive money through a Coinbase-affiliated public blockchain. The launch marks a significant expansion of JP Morgan's blockchain efforts and comes as global banks experiment with digital assets. And Honhai sees more AI-driven growth in 2026. Net income for the company surged 17% in the latest quarter. Its rosy outlook offered some relief to investors who've been concerned about an AI bubble. Coming up, world leaders gathering in Brazil for the COP30 climate summit. We'll discuss what to expect next. This is Bloomberg.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacqua in Sintra, Portugal, and this is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
As an industry, if I may say so, we are really bad at calling oil demand. We continue to call for peak oil demand and then just push it further and further back every year. And I think our view has always been that, yes, even if total liquids demand kind of peaks, say, late 2030s, even early 2040s, the reality is it's not going to collapse. Even by 2050, we have oil demand at around 100 million barrels per day. And I think that's the crucial thing.
The IEA reinstating a scenario where oil demand continues to climb out to 2050. This as COP30 is underway in Brazil with little expectation for big declarations. Plenty of smaller pledges, though, potentially on the cards. Let's bring in Shaheen Contractor, Bloomberg Intelligence Senior ESG Analyst for more. Shaheen, just on the IEA prognostication there, right? And we've heard Dan Yergin and people like that talk about this too. We're nowhere near peak oil demand. It's going to continue. How does this impact the decarbonization story?
So, Vani, I think this, it does put a damper on the COP conversations that are going on as we speak. I think what it does is it brings into focus the topic of adaptation, and COP has been dubbed the Implementation and Adaptation COP. So it brings this growing recognition that it's not just about mitigating emissions, but also adapting to, the physical impacts of climate change.
And this is every single company and every single country. It's everybody adapting. And explain to us what adaptation means.
Sure.
It's to do with cleanup, right?
So it's, let's just call it preparing for your next storm and cleaning up after your last one. So I'll give you a number. So the US, for example, we estimate it spent about $1 trillion on climate damages. So again, cleaning up after previous storms and preparing for the next. So it's learning to live in a world where the physical impacts of climate change are being felt.
And it's a vicious cycle because you wouldn't have to do so much cleanup if potentially we got to our goals faster. And are they even goals anymore? There's so many questions. But I did want to ask you about the green trade, because we're seeing, according to your research, ESG funds with withdrawals, right? People are just pulling out of them left, right, and center. It could be a political issue because obviously climate and climate change, not the most popular thing right now, especially in the United States. But it could also be that we've seen huge run-ups in some of these green stocks.
Sure. So I think climate funds in particular are seeing outflows. And I think that's really driven by this negative political environment. It's uncertainty in policy that is driving this. And I'll give you a disconnect. I don't know if this surprises you, but clean energy is one of the best performing themes of the year. So there's this very big disconnect where the funds are outperforming, but they are seeing outflows. And that's just uncertainty.
Literally, the S&P Global Clean Energy Transition Index just hit a 52-week high last week. It's up 53% this year.
30% outperformance.
Yeah, it's incredible. So, I mean, companies can make the economic claim to decarbonize and to do better, right? It may not be politically very popular. So what's happening on a company level? Are they continuing with their policies because it makes economic sense, or are they pulling back just to please certain administrations?
So it's really both. So on one hand, companies are continuing to do what they do, not shouting it from the rooftops, but others like Wells Fargo earlier this year, they are abandoning climate goals. And I think an unintended consequence that people don't realize is divestment risk from your, let's just call it ESG or climate investor base. And some companies like EDP, Simrise, these are the ones I'm watching. Over 5% of their market caps are in ESG and climate funds. And any rollback can really spark a divestment from this investor base. Not many people realize that.
It's true. Now, the AI revolution is going to demand phenomenal energy. And a lot of that is going to come from renewables, right? So is the trade coming to be played out, or is there a lot more to run?
Well, that is what's fueling this clean energy outperformance. So we estimate that renewables is going to, it's faster deployed, it's going to fill the gap, and power demand is going to increase about twofold. Whether it's played out or not, I don't know. I mean, the needs for AI and power demand are something that, it's ever increasing.
Now, we're at COP30. There have been 30 COPs, right? So there's been a lot of COPs where perhaps not that much has been achieved.
Sure.
But what do you expect, if anything, that will be the high point of this COP? And maybe you could just throw in a comment about biodiversity funds, because they're also growing.
Sure. So I think, we have a few days to go to see what the outputs are. I think what I'm particularly interested in is the fossil fuel story. So last year, countries agreed to phase down fossil fuels for the first time. None of this has been reflected in action plans. The IEA story that you mentioned is completely contradictory to this. So that's what I'm really watching for. And the second is adaptation. And COP is in Brazil this year, so biodiversity is a big topic, and it's, like you mentioned, a bright spot in the, let's just call it environmental funds, where those specific funds are seeing inflows, contrary to the broader environmental fund space that is seeing outflows.
All right, Shaheen, fascinating research. Thank you so much for joining us this morning, and we'll keep an eye on what happens at COP30. That is Shaheen, contractor of Bloomberg Intelligence. Coming up, the Supreme Court extends an order that allows limits on food stamp payments. And a look at what else is making headlines in your front page news. That's next. This is Bloomberg.
Climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch
Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Shares of Infineon climbing as the German chipmaker anticipates 2026 revenue to return to growth as the global boom in AI data centers raises its sales outlook. Infineon CFO Sven Schneider spoke with Bloomberg's Guy Johnson.
If you look into the revenue development for AI, and for us, AI is powering AI from grid to core, has developed in a very steep way. 2 years ago, it was 250 million revenue. Last fiscal year, more than 700. And as you said, we just raised the guidance for our AI revenue for this year from 1 billion to 1.5. So we are more than doubling in this fiscal year, and it will not end in 26. We expect the addressable market for Infineon for powering the AI data centers in the magnitude of 8 to 12 billion. So it's a significant idiosyncratic growth driver for the company going ahead.
How much precision do you have at the moment in terms of the outlook on that space, and in terms of being able to guide investors to what you are going to see next? How much precision do you have there?
Yeah, so first of all, the 8 to 12 is the addressable market. So it would assume 100% market share, which is probably not the most realistic assumption. 1.5 is the revenue we are generating this year. How much visibility is there? Of course, we have a very broad coverage of all major customers, be it cloud providers, be it processor makers, which gives us a great visibility into the business. You're also maybe aware that we entered into an agreement with NVIDIA to cooperate on the development of a total new architecture, which is 800-volt DC-DC. So there's a lot of visibility in what's happening, but of course it is and remains a very dynamic market.
That was Infineon CFO Sven Schneider speaking with Bloomberg opening trade anchor Guy Johnson. Time now for your front page news. First up on the New York Times, the Supreme Court deciding to allow the Trump administration to withhold food stamp payments for roughly 42 million Americans for 2 more days. The new order neither gave a vote count nor did it include the court's reasoning. Next, the Washington Post is reporting Venezuela has ordered massive mobilization of its military arsenal. This as a U.S. aircraft carrier and 3 warships enter waters in the region. Venezuela's defense minister said President Maduro had ordered almost 200,000 soldiers deployed as part of the special operation. And finally, the Wall Street Journal leading with the White House exploring new measures to curb the influence of proxy advisors such as Glass Lewis and ISS. The firms are under fire from CEOs such as Elon Musk, who calls them corporate terrorists. Jamie Dimon also says they have conflicts of interest. The administration is said to be discussing at least one executive order that could include a broad ban on shareholder recommendations. Coming up, just 34 trading days left in the year, would you believe? We'll discuss what your year-end investment plan should be with Frank Moncomb of Buffalo Bayou. That's next. This is Bloomberg.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
It's 5:30 a.m. in New York City. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. Reopening trade. Stock futures rally as a likely end to the government shutdown lifts investor mood. Treasuries also climbing today as the cash market returns from the holiday. Wall Street at the White House. President Trump plans to host a dinner tonight with financial CEOs, including Jamie Dimon, David Solomon, and more. And apparently in AI, we trust again. AMD, Infineon, and Honhai all out with positive growth outlooks boosted by demand for artificial intelligence. So look at those futures, pointed higher, not a huge move, but don't forget we did finish up 0.2% on the S&P yesterday, even though it was a really rocky session. For the Nasdaq, we were down 0.3%. Today, again, those futures pointed higher. And Russell 2000 futures pointed higher as well. We did have that soft ADP data yesterday, so that might be potentially why we're seeing a little bit into treasuries. A little bit of movement across the curve, down 3 basis points at the front end, not down as much at the longer end. But of course, there is the idea that we'll have the government reopen. A 90% probability, in fact, according to the betting markets, that will happen today. And that's infusing this market with enthusiasm. And then, of course, we're looking ahead to the Fed and the potential for a December rate cut. 70% chance or so now, according to markets. So not a done deal, but nevertheless, the probability is in the cut's favor, let's put it that way. Let's get to some individual stocks to watch now. Here's Valerie Titel. Valerie.
Good morning, Vonnie. Let's start with a check in the tech space. We're seeing shares of AMD rising in the pre-market just shy of 5%. And this comes after some pretty bullish comments from the CEO at a company event yesterday, talking about revenue growth over the next 3 to 5 years being around the 35% range. She also had some bullish things to say when it comes to AI data center revenue, that being 80% over that same time horizon. She also said that she sees from her clients, from these data center owners, that they are not slowing down their pace of investment. So these bullish comments, seeing the likes of AMD and other chip makers rise in the pre-market this morning. Next, let's move on to some possible M&A activity. Bill Holdings, this is a company that operates in the business payment space, is under some pressure by an activist investor, Starboard Value, in order to solicit some bids for the company. Now, sources have told Bloomberg that they are looking at private equity offers as well as offers from other industry leaders. Now, the payment industry has been under intense competition. We have seen a lot of consolidation in this sector, so perhaps we're due for some more, with Bill Holdings up 13% on the back of this news. Lastly, let's end in the apparel space on sneakers. This is the sneaker company owned by Roger Federer. It is based in Switzerland but listed in the U.S. Shares are climbing in the pre-market, up over 9%, as they saw their sales in Asia and Europe soared in the previous quarter. They have been posting some pretty interesting competition to those more dominant sneaker players such as Nike and Puma of late. Now, I should note, though, that they are bucking the recent trend with this rise. On Holdings has been down around 35% this year on the back of tariff worries, especially the tariff discussions between the U.S. and Switzerland have weighed on the shares, but they're rising in pre-market this morning, up 9%.
That is a nice gain this morning. Valerie, thank you so much. Valerie Titel there in London. Frank Monkham of Buffalo Bayou says Get yourself a 30-day closing plan. It's hard to believe, but there's just 34 trading sessions left in the year. Well, with the S&P up 16% so far and the Nasdaq 100 up more than 21% and lots of uncertainty out there, what should that game plan be? I'm pleased to say Frank joins us now. He's head of macro trading at Buffalo Bayou. So, Mac, if we haven't had a plan up to now, what are we supposed to do for the last few days of the year, given that we only have fewer days than the government has been shut down, would you believe?
Hey, Bonnie, pleasure to be here. Well, like I said, this is the time of the year typically where, we try to figure out how to close in the year, right? I mean, there's, people think about tax harvesting, those kind of things, and center rally. But this year, it's been a little bit different with this government shutdown that we've had. And I called it 30-day closing plan, meaning there's literally 33 to 34 days left in the year. And you basically have two major macro sub-themes really to trade around to the end of the year. And the first theme is basically that, going to the end of the year, right, you've got to figure out what the DC reopening trade looks like. And obviously, bodes really bullish for risk asset. But the problem with this reopening trade is that it also comes with the end of the data blackout. And that's going to introduce a lot of choppiness to markets because, markets participants are going to try to, retroactively think about how to reprice data that is perhaps stale and also poorly collected. Because we saw, data collection and survey windows being truncated during the shutdown, and that's going to create some volatility once we start returning to full data
And we might have got a sneak peek of that yesterday with the ADP data, which was slightly softer than we were expecting. Typically, shutdown reopens are good for markets, but are you saying maybe just wait a little on this one?
Yeah, just wait a little on this one. I think, even though when you think about the equities market, I think, positioning has kind of come off, the extreme highs here. So we're not saying positioning is super bullish, but it's probably at a place where, is less of a headwind. I mean, we're looking at discretionary positioning around, the 75th percentile. No, it's a 35th percentile rather, and a systematic positioning being around the 75th percentile, which isn't too bad. But what I'm saying here is that, this center rally is really set up, every year from a seasonality standpoint, especially when you have buybacks coming back to kind of offset some of the deleveraging that we've seen from the retail community, over the last couple of weeks. But again, like I said, with the data coming in and being very hard to read and being very, very nebulous, I think we're not going to have a straight, a smooth line sort of center rally towards the end of the year. I think we might have some choppiness, along the way. And volatility is yet to reflect that. I'm not calling here for a major pullback, but I think it's just not going to be a typical smooth sailing sort of center rally.
Yeah, because every time we get some kind of an answer to a question, we're back below 18 on the VIX. I mean, the same again today, we're down again on the VIX. So talk to us a little bit about the AI trade. I mean, it seems like we're getting different headlines every day, capacity constraints, build-out constraints for data centers, but yet growth, will be fantastic next year. What are you supposed to do with all of that?
Yeah, I think the AI trade really, whenever you have a theme that's really central to everyone, right, it's there's going to be capital flying into the space. Obviously, when valuations are stretched, it just makes us vulnerable to these kinds of worries. But I don't think that trade is by any stretch of the imagination being derailed. I just think there are going to be patches throughout the cycle where we kind of question the trade and question the valuation. But at the end of the day, it's a story of liquidity, right? We have a Fed that's still leaning very, very dovish here. I mean, we talked about the probability of the next cut here in December having ticked down since the Fed's sort of, quasi hawkish pivot during the last meeting. Not pivot, but, rhetoric. But I think, we're still pricing in a Fed that's going to be cutting in December and probably 2 to 3 times next year. So that's pretty liquidity positive. And I think at the end of the day, that's what's going to continue to support risk assets. In my opinion, what really stands as a headwind to risk assets potentially is the job market completely unraveling or having a rate tantrum.
And in terms of the bond market, you're looking for the curve to twist, steepen.
Yes.
So that would be the answer to that. Now, would you still be 60-40 in a portfolio, or would you be, skewing a different way?
Yeah, well, the bond market is really looking at two major dynamics, right? The front end is really being anchored by Fed cutting. I mean, I think there's clearly, the path they're going to be leaning towards. But the back end still is very vulnerable to fiscal dominance concern and also inflation concerns. So that's my reason for having high conviction on the curve steepening here in the medium term. The 60-40 portfolio, obviously, it's something that has come to light here recently and has been exposed in terms of, lacking the ability of really providing investors with, the full range of risk parameters that they need to make sure that the portfolios are balanced properly. So I think gold has been the one asset class that's slowly but surely being introduced to investors' portfolio here. Some people have talked about a 60-20-20. Perhaps that's a bit excessive given how big the treasuries market is. Having to shift allocations from treasuries to gold in that level of magnitude is going to be very disruptive for markets. But I think gold definitely has its place in investors' portfolio here.
And despite everything that's going on, is there still time in this last 34 days for a Santa Claus rally?
I mean, yes, there is. I just think it's going to be a little choppier than we used to, which is fine. It's just a matter of being able to navigate that and understand that the data that we're going to be seeing is going to be very, very nebulous to read. I think one thing, though, the investors that need to take into account going forward is that the importance of these private data providers is going to be paramount going forward. Because I think we've all learned that there's been a credibility issue, perhaps some issues around independence around some of these institutions. So having gone through this stretch with the data blackout is just kind of raising investors' attention to the fact that they have to rely more on private sector data going forward.
We have to get through these next few weeks and get things back to quote unquote normal. Frank, thank you so much. That is Frank Moncombe of Buffalo Bayou. Coming up, House lawmakers set to vote to end an historic government shutdown. More next. This is Bloomberg.
Coming to you live from Kuala Lumpur, the whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can't be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
Not a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. I'm not here to say what I would and wouldn't do in the future. But the theatrical experience is one that means a great deal to me. It means a great deal to us. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. But that's where I'm at today.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
This is Bloomberg Brief. I'm Vonnie Quinn in New York. End in sight for the longest U.S. government shutdown ever. The House of Representatives will be back at work today for the first time in nearly 8 weeks to vote on a bill which would relieve the sharpest pain points, including delayed SNAP benefits, air travel chaos, and government worker furloughs. Joining us with the latest is Bloomberg's John Harney from Washington, D.C. So, John, what time is that vote? We're very, very impatient.
The vote will be, well, the votes will begin today. Now, it'll take several hours because there'll be debate, there'll be, meetings, whether we won't actually see on camera, as Speaker Mike Johnson makes absolutely sure that he has the votes to get this through. But it could be signed, perhaps be signed by President Trump as early as tonight.
That would be a relief to a lot of people around this country. Now, it seems as well on a separate story that Trump aides are reviewing funds for New York City. This, of course, after the Mamdani win. Can you give us a little more detail into this?
Well, as my colleague Skylar Woodhouse reports, yes, several people in the Trump administration, some people in the Trump administration are considering perhaps scrutinizing or even withholding money that's been earmarked for New York. Now, this is a skirmish, if you will, perhaps a much larger battle between Mr. Mamdani, the Democratic Socialist mayor-elect of New York, and President Trump, a New York native, after all, who tried very hard to get to convince enough New York voters to not elect Mr. Mamdani. That, of course, failed. Now, so we'll have to see what the next moves are. Mr. Mamdani has pledged to work with the Trump administration, but has vowed also not to be bullied.
Yeah, exactly. Well, tonight in D.C., 7:30 p.m., people are going to be in their best gear because Trump is having a dinner with Wall Street executives, Jamie Dimon and Dina Friedman, David Solomon, and so on. What do we anticipate they'll be speaking about, the top priorities for that conversation, John?
Well, I mean, President Trump has allies on Wall Street and has always tried to perhaps, he enjoys their favor, the good relations with them. So, but some of them, Mr. Dimon among them, have not been particularly keen on some of his policies. I imagine tariffs will come up. The state of the economy, the labor market, and perhaps also the shutdown, the effects of that. We're starting to recover from it. The country was beginning to, or will be beginning to recover, but it'll take some time for the effects, flight delays, et cetera. So, I mean, all those, it'll be the economy, it'll be tariffs, trade,
all the hot button issues. Yep.
Agenda.
About 14 hours from now, they'll all be sitting around a table. John, thank you so much. John Harney there in Washington, D.C. Well, as the president plans to host Wall Street executives at the White House, JP Morgan has started rolling out a deposit token called JPM Coin to institutional clients. Bloomberg finance reporter Jenny Serrain joins us now. So, Jenny, how much is the Trump administration's embrace of digital assets driving how JP Morgan and other Wall Street banks interact with the industry?
I think it's really been a sea change for these banks. So they've spent years, kind of playing on the outskirts and expressing, some mild curiosity. And now you really see lots of the big banks going after this space in really interesting and new ways. And a lot of that is driven by the fact that all of a sudden they have regulators and watchdogs overseeing them that say, we're okay with the experimentation here. We have an administration that is kind of full force ahead and passing legislation and trying to really entice investor interest, make the U.S. kind of the global hub for crypto. And so you kind of see these banks following suit and trying to fully embrace it in much the same way that their regulators and the broader Trump administration really has.
And they're able to do it fast when they decide to do it. Now, on a separate story about AI, MUFG saying it needs to hire more bankers that specialize in AI as part of its recent tie-up with OpenAI. We've been reading so much about AI taking jobs away. Are we going to hear more examples like this where AI is actually bringing jobs to finance?
Yeah, I think that will be the really interesting kind of trend to watch, because I think so many of the bankers and traders and everybody that we talk to obviously are concerned that, oh my goodness, could the robots come take my job? Could AI, replace me one day? But right now, what we hear from a lot of these banks is actually, we don't have enough. Like, we need more AI specialists. We need more folks who are really steeped in this technology to kind of come in and show us the ropes and bring this technology and really embed it throughout the bank. And so right now we're hearing a lot more that we need to be training people, we need to be retraining people. And so right now, at least the narrative has not been one of job cuts, but really been one of investment and kind of seeking out more talent. But at the end of the day, I think they are all hoping that these investments one day, you know, produce a good return and cut the costs of the way they expect it to. And so I think that's still in the offing, but right now, when we're still in these early innings, a lot more of it is about job growth and retraining employees rather than getting rid of, you know, thousands and thousands of jobs.
Yeah, positive spin, at least for now. Jenny, thank you so much. Jenny Serene there. And staying in the AI space, AMD, Infineon and Honhai all out with positive growth outlooks boosted by the AI boom. Bloomberg's Tom McKenzie joins us now for more. So Tom, what were the interesting points to take away from all of these earnings reports?
I mean, Vonnie, the key thing that stands out to me of all those three companies is, my goodness, their earnings would look soggy if it wasn't for AI and the data center build out, because it's all those things and the fact that there is this build out and they're exposed to it that has lifted the prospects for all of those companies. I'll start with Infineon. It's the German listed company, of course. It makes the silicon that helps in terms of power efficiency that goes into data centers. But typically, and still more than 50% of its sales come from things like autos and the industrial space. That part of the business remains pretty weak. In fact, the CFO telling Guy Johnson of Bloomberg TV he doesn't see a significant turnaround on that space. Certainly not even next year, that the headwinds will remain when it comes to that part of the business. But they are benefiting from their exposure to AI data centers, to the point where they've actually lifted their forecast on sales for the data center part of the business by 50% just from the previous quarter. So it's that part of the business that's really driving the prospects into 2026. Across that business, the Infineon business, they're projecting pretty modest return to growth. But again, it would be a much bleaker picture if they didn't have that data center exposure.
Yeah, for sure. You know, speaking of bleaker picture today, can we go back to the NVIDIA story from yesterday? So we saw SoftBank ADRs rising yesterday, right? And now they're falling in Tokyo today, the stock falling in Tokyo today, as much as 10% at one point, although it didn't close out that far down. Is this because investors were spooked that SoftBank was getting out of NVIDIA? I mean, you have to point out, I think, in this conversation that the stock is up 138% year to date, and it did announce that stock split, and perhaps investors were waiting for that, and they're just taking some chips off the table.
I think those are all valid points, Vonnie. Absolutely. The stock split was important. Of course, they want retail investors to get more exposure. The stock has run up very high this year, to your point as well. So maybe some profit taking. But there are some, and the Bloomberg team have been talking to some analysts who've been looking at this, who are concerned about what signal this sends. I mean, there was a lot of chatter yesterday about whether or not it signals SoftBank and Masayoshi Son's concerns about the data center build out. Others are saying, look, you're taking money out of a very, very profitable business, NVIDIA, your investments in NVIDIA, $5.8 billion US. You've sold off that entire stake. And guess what? You're putting it into OpenAI, which is not making a profit. So what's the rationale there? Masayoshi Son is taking a long-term bet on OpenAI, on infrastructure, and on the deals that he wants to secure around Ampere, which is the chip design company. He wants to get that across the line. ABB's robotics business. That is the focus for him right now, that future bet for Masayoshi Son, releasing that liquidity. But some investors taking a bit of a cautionary note on that action yesterday from SoftBank.
And it'll be interesting to see how it trades throughout the week, obviously. And there are other things going on in SoftBank too. But, you know, will all of its AI investments be related in some way to OpenAI? Or, you know, does it have the liberty to sort of go elsewhere and maybe fund AI investments from other countries?
Well, certainly SoftBank is looking at exposure beyond OpenAI. They have within their portfolio companies like Runway. They have companies like Perplexity, both of those startups performing very well and seeing incredible growth as well. They're building, of course, out in Japan in terms of the infrastructure story around AI. But the big focus is, of course, for SoftBank on the infrastructure story is on the Stargate project in the US. It was interesting to get an update when you think about the infrastructure story in the data centers from AMD, who just a few weeks ago came out with results and forecasts that didn't really inspire investors. But the update yesterday from AMD, that the competitor, of course, to NVIDIA, was much more bullish. So over a 3 to 5 year period, They see revenue growth topping 35%, more than 35%. They see margins of more than 35% over that same 3 to 5 year time frame, and profits of more than $20 per share, again, on that time frame. And they're seeing no slowdown in demand for the chips that go into those data centers. They're looking to get they're closing in on about 10% in the market share for those AI accelerators versus 85 to 90% for NVIDIA. But they made a mark. They've got the partnerships with OpenAI and Oracle and painting a brighter picture, at least for their prospects, over that time horizon.
Tom, thank you so much. That is Bloomberg Tech Europe host Tom McKenzie. Can't wait to tune into the next Tech Europe. Coming up, we're going to get you set up for your trading day. There's a host of FedSpeak on deck. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Caroline Connon in Paris, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Now, look at what's ahead today. So we get FedSpeak galore. We're going to hear from Williams, Paulson, Myron, and lots more all throughout the day. National Economic Council Director Kevin Hassett speaks with Carlyle co-chairman David Rubenstein. That's at 12:30 p.m. Eastern. Plus, the Treasury will auction $42 billion of 10-year notes this afternoon. And then tonight, of course, President Trump set to host financial CEOs, including Jamie Dimon, Adina Friedman, and David Solomon at the White House. Here's how your market is set up for the trading day. Surveillance is next. This is Bloomberg.
Do you know what to tell people about what the tariffs are going to do on the United States economy and the investment environment, or is it not clear yet?
If you look at the impact of the tariffs, they were much more significant and broad than I think the market expected. Looks closer to 19% on balance versus 2 and change last year. So effectively, it's a 20% increase on 10% of household goods that are imported into this country.
And do you think it's going to lead to a recession?
Well, we think that it's going to impact both inflation and the economic growth scenario. So we were coming into yesterday expecting the real economy to grow at 2%. And inflation to be closer to 2.8%. If you just go through the math, it would suggest there's probably 1 to 2 points upward increase on inflation and a similar amount on economic growth. So it could put us in a position where we're teetering.
So the tariffs will likely depress the GDP growth rate and increase inflation. So what's the advantage of tariffs?
From our standpoint, we have a hard time seeing the benefits of tariffs. They do tend to be inflationary in the short term. As you're pointing out, the longer term impact on economies is probably the greater downside.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
We have been experiencing one of the biggest and largest momentum markets that we have had since the late 90s.
I think we are in a little bit of a wait-and-see moment. The volatility and the rotation that we're seeing among single names is healthy.
There's a chance we get a significant 5 to 10% pullback.
Looking into next year, we are more optimistic.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, adding to 3 days of gains, equity markets advancing as the end of the government shutdown nears. The bond market reopening with yields falling on weaker than expected economic data. And President Trump preparing to host a dinner with Wall Street executives, including JP Morgan's Jamie Dimon.
It's sort of an interesting mix of bedfellows, considering that President Trump has a love-hate relationship with Wall Street, with New York City, and particularly with Jamie Dimon. It comes after a series of different dinners that he's held with other executives. Think about the tech executives he held a dinner with back in September. A question of what role business plays in this administration and whether this is potentially President Trump's effort to get a channel check on the consumer and on credit extension.
Do you think we start a conversation about a 50-year mortgage with a bank executive later on this evening?
I can imagine that might come up, and if not President Trump, probably some of these bank executives.
Got to talk about a state of the U.S. economy as well. Some mixed data in the last 24 hours. ADP out with a weekly number, not great. Small business confidence, not fantastic either. Bond markets reopening, picking up on the temperature of that. Bond yields lower across the board.
What's fascinating is bond yields are lower, and yet stocks are higher. So you might say, well, on one hand, the bond market is looking at the weakness. On the other hand, stock markets are looking past that to the boom that they're expecting in the first quarter of next year. Pick your poison. Right now, it seems like a lovely, beneficial mix, given the fact that the government's reopening and people are embracing the idea the Fed will have the confidence to cut rates, but hard to get a clear read on exactly what the implication is for risk assets and for markets more broadly.
Well, let's go through what we're hearing from corporate America and corporations around the world. AMD talking up data center revenue. Hon Hai out with a solid outlook as well. That's what's supporting this equity market story.
What's fascinating is a week ago yesterday, we got AMD earnings, and they came out and they were better than expected. The forecasts were better than expected, and the shares dropped. It highlights that after a dinner last night, the shares are up in pre-market trading because they could talk about their rosy forecasts. How much does this really speak to the fundamentals, and how much does it speak to a shift in tone, in vibes, that doesn't necessarily have a connection to anything in what these executives are talking about?
The vibes are better this morning, at least. The stock is up by 5% in the pre-market. The broader equity market higher by 0.3%. Coming up this hour, Matt Miskin of John Hancock as stocks look for a fourth day of gains. John Lieber of Eurasia Group with the House to vote on the reopening of the government. And Hugh Van Steenis of Oliver Wyman on rising investor angst over AI spending. We begin this hour with stocks rising as investors await the end of the government shutdown and the release of a lot of delayed data. Matt Miskin of John Hancock writing, bad news is bad news, especially when it comes to the jobs market and a Fed being hawkish. Regardless, markets have a trade the headlines mentality that is far from fundamental. Matt joins us now for more. Matt, that last slide, what did you mean by that?
Well, I was just talking about you guys mentioning vibes here. It's a vibe market, and it's all driven from sentiment for the most part. And really what we're seeing is this jaws kind of presenting itself from the weaker economic data and the markets continuing to advance. You know, at the end of the day, sentiment is a very powerful short-term market force. And we are seeing momentum investors around the world really allocate towards stocks because they're rallying. Even in these mornings now, you're not even getting necessarily a narrative of why things are up other than it was up yesterday. And so we really see it even at the beginning of the week on Sundays. It used to be Sunday Fun Day, and now it's Sundays are a time where markets open, and there's usually some sort of headline that hits the markets first thing. So Monday morning we open stronger, and that sets the vibe or the tone for the week. In our view, this is a time where you want to think about more defensive or conservative options for portfolios and not to really overweight risk and over your skis in terms of risk at these kind of levels. But it's been a very strong year for markets, and we'll take it.
So, Matt, let's unpack some of this, and let's start with the data, the jobs data. How relevant is the jobs data to a market that's been driven by technology that is arguably holding back jobs data?
Yeah, John, I mean, this is the circular feedback loop that everyone's really highlighting is, you know, it doesn't matter about the jobs because these companies are running more efficient. The AI is helping them increase earnings. And as long as those earnings are going up, that helps the stock market. Makes sense, right? Well, the missing linchpin of this argument is that you need the U.S. consumer to spend. There is no more powerful economic force globally than the U.S. consumer. And if the U.S. consumer doesn't have a job, they can't spend. And that's where we struggle to find this feedback loop and why we think that the weaker jobs data really is going to present weaker consumer spending. You're already having weak consumer confidence. Now, to us, this means the Fed will end up cutting more than the market thinks. Right now, the Fed is actually, in our view, overcompensating a bit because they think they're going to be more dovish into 2026. So they're being a bit more hawkish now. It is really fascinating to see stocks really kind of just float through that with minimal impact. But in our view, the weaker jobs data is very material for this economy and markets in time.
Matt, why do you reject the argument that in the beginning of next year, we're going to get tax rebates and all sorts of other stimulative measures that will really cause a boost to consumption?
Yeah, at the end of the day, the jobs market, like I said, is so important. And when you look at these, whether it's the Challenger layoff announcements or the ADP data, and you look at prior periods when it rose or when it caused the initial jobless claims to rise or the unemployment rates to rise, it's usually about a month and a half lag time between the initial layoff announcements and when it hits the data. And really, if you kind of time that out here, it's the beginning of 2026 when initial jobless claims start to rise, the unemployment rate starts to rise. And you think about this, the unemployment rate, the last data point we had was 4.3% in August. At 5%, usually that's a recession. And we're already likely ticking up. I mean, yesterday, Goldman Sachs said that more likely than not, we had a 50,000 job decline here in October. If that was actually the release of that national non-farm payroll report, in our view, that would have been a shock to the system. And so that's what I struggle with is if you're telling me that there's all these, kind of good things coming in the pipeline, the other side of this is we're still going to be catching up on weaker data that really hasn't been released here in the last month or so.
Matt, that R word was kind of jarring for me because I haven't heard it in so long, and no one's talking about recession. I mean, that seems to be nowhere on any of the earnings calls from corporate executives across the spectrum. We're not hearing mentions of an economic slowdown or anything like that. It really has come in at the slowest pace in terms of mentions of that going back to 2007. What does conservative mean in terms of investing? Does it mean just hide out in the 10-year, or does it mean actually high value companies that are also facing pretty elevated valuations, in addition to, yes, very steady cash streams?
Yeah, so at the end of the day, there are companies that are growing earnings. We do like higher quality companies. Quality has not been in favor this year. It's been more of a low quality rally. But in our view, we would position higher quality in the equity space. We are looking at infrastructure-related equities. You know, across Europe right now, you're seeing Europe rally. Some of that is infrastructure-related utility-type businesses that are throwing off dividends. They've got great earnings. So infrastructure-related equities is one way to do it. We are looking at, in the bond market, like you said, I mean, we're still getting nearly a 5% yield here. And yields have come down this year, but if the 10-year did drop below 4%, which is support, we think there's more return potential there. So there's still a lot of income and return potential out of the bond market. In our view, though, on the equity side, we're more neutral on U.S. large cap. We're overweight mid cap to get more diversified exposure, better valuations, and we're underweight small cap because, frankly, there's just so much non-profitable businesses there. So it's a modestly below one beta.
Talk about vibes. The ultimate vibes trade of the year is Europe, dressing up 1% GDP as if it's the next best big thing. Matt, you really want to stay in European equities into 26?
So we would look to trim into strength here. And it's been, this year is probably years worth of returns. If you look back over time, I mean, whether it's Italy or Spain, I mean, Spanish stocks, who would have thought? I mean, the economy is doing great. So congratulations on that front. But really, the stock market there is trading almost like it's another entity. And a lot of these, markets are trading almost like they're just ticker symbols versus a company or a country. And we want to be mindful of that we're not really just day traders here. We're not just trading these for momentum. And we want to look at the underlying fundamentals. But yeah, Europe is on fire this year. European financials breaking out here. And again, that is a sentiment indicator. There's positive vibes globally right now.
Amazing rally. Matt, thank you, sir. Matt Miskin of John Hancock there. Spain up by 1% today. The IBEX on the year to date, higher by more than 40%.
The vibes are good in the stock market. When you take a look at the economic indicators coming out of Europe, not so much. Did you see the ZEW feelings indicator from Germany yesterday? It was terrible, right? So you start wondering, can the vibes feel really good in the stock market and really bad everywhere else globally?
The estimate for growth in Europe, according to the ECB for next year, 1%. For 2027, 1.3. There's some work to do. Let's get you an update on stories worldwide. Let's get to your Bloomberg brief. Let's cross over to Yahara Anand. Hey, Yahara.
Hi, John. The House of Representatives is set to vote on reopening the government after the longest shutdown in U.S. history. The short-term funding bill was reached after senators agreed to compromise on a plan that will fund the government through the end of January. The measure would reinstate federal workers fired during the shutdown and guarantee back pay for furloughed employees. Meanwhile, aides to President Donald Trump are considering cuts to New York City's federal funding after Zohran Mamdani's victory in the mayoral race. The White House is waiting on Trump to greenlight any funding freeze. It's not yet clear what programs could be impacted. Mamdani, for his part, says he is ready to work with the White House. And AMD shares are jumping in the pre-market, up 5.3% after the chip maker released a bold forecast for sales growth over the coming year. CEO Lisa Su predicts revenue growth to average more than 35% over the next 3 to 5 years, with data center revenue on track to rise by an average of 80% over the same period. Su went on to say the total AI chip market will reach $1 trillion by 2030. That's your Bloomberg Brief. John.
Yahara, thank you. More from Yahara later this hour. Up next on the program, fighting for an extension.
Democrats will continue to press the case to say to our Republican colleagues, you have another opportunity to extend the Affordable Care Act tax credits.
That conversation up next with John Lieber of Eurasia Group, live from New York City this morning. Good morning.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Three-day winning streak on the S&P 500, looking to make it day 4. Futures higher by 0.3%, outperformance on the Nasdaq. The Nasdaq 100 higher by 0.6. In the bond market yesterday, Treasury futures rallied on weaker than expected economic data. The cash market reopens with yields lower, down by 4 basis points at the front end, 2s at 355, 10s at 4.08%. Under surveillance this morning, fighting for an extension.
House Republicans, you now have an opportunity to actually take some action in an area of this healthcare crisis. Democrats will continue to press the case to say to our Republican colleagues, you have another opportunity to extend the Affordable Care Act tax credits.
So here's the latest this morning. House Democrats looking to hold the party line ahead of an expected vote to end the longest U.S. government shutdown in history. House Speaker Mike Johnson signaling a vote could come as soon as this afternoon. Bloomberg's Jack Fitzpatrick joins us now for more. Jack, do you see some smooth sailing later this afternoon or some wrinkles, some rough seas ahead?
I don't see smooth sailing, but it looks like the end of the shutdown is just about here. We've got one more critical vote in the House. It's probably going to be a very close vote. The conventional wisdom that if you can get 60 votes in the Senate, you're probably fine getting a majority in the House, I think holds here. But you've heard some hard opposition from House Democratic leadership, despite the fact that this is kind of supposed to be a bipartisan deal on funding bills to end the shutdown. We'll look to the centrist Democrats to see if the Republicans can pick up a couple. Your Jared Golden from Maine, your Marie Gluesenkamp Perez from Washington, perhaps. But this is going to be close to the party line, and that puts even more pressure on Speaker Mike Johnson after being gone for almost 2 months to come up with a good solid whip count and make sure his members are in line, because they will need almost all of the Republican votes to be there to end this, send it to the president's desk, and finally be able to move on from the longest shutdown ever.
42 days. And maybe 43, and possibly this goes on a little bit longer. Let's hope it doesn't. But Jack, let's run with 42. The Democratic leadership has had a 42-day commercial on their health care effort. How's it resonating in the court of public opinion?
You know, a lot of people were surprised because the polling generally looked pretty good for Democrats. There were a series of polls saying, who do you blame more for the shutdown happening? It leaned towards Republicans and favored politically Democrats. They put a spotlight on the issue that they wanted to spotlight with rising health care premiums. The Democrats definitely established they were the ones who wanted to extend the existing subsidies that are set to expire at the end of this year. That said, they couldn't hold everybody together, and now they're riding on a promise of a vote in the Senate, not in the House, in December for something that hasn't yet come together. So there's going to be frustration from the base on the Democratic side with Democratic leadership and the moderates for allowing this to happen and not actually getting anything out of this, though you at least have to give them some credit for establishing where they stand. This is going to be a big issue in the midterms, and Democrats at least have some positive polling on their side, though they, again, have some frustration from the base that expected more out of this.
Jack, thank you, sir. Jack Fitzpatrick down in Washington, D.C. We'll catch up with Jack a little bit later. So, big question for all of us tracking the markets. When do we get the economic data? The National Economic Council Director, Kevin Hassett, had this to say in the last 24 hours. I've been told that some of the surveys were never actually completed, so we'll never, perhaps, even know what happened in that month. What does that tell you about the October data?
That we're not getting CPI. Period, full stop. I mean, or if we do, it's going to be so muddy that people are going to really struggle to understand what exactly it looks like. We are going to get September jobs report. That probably will be number one, possibly early next week. After that, kind of a pot shot, whether it's retail sales, whether it's other peripheral data points that indicate inflation. But right now, it seems like we're kind of going to be in that fog for maybe forever when it comes to that 1 month period.
It's not going to be fun for the next few months. John Lieber of Eurasia Group joins us now for more. John, welcome to the program. What's your understanding of the data we will get and won't get in the coming weeks?
Well, the BLS and the BEA are still shut down, so we don't know exactly what their plans are. I'd expect they'd probably announce something by the end of this week, or maybe Monday of next week, a timeline for when they will get these reports out. Some of them, they can collect the data. November's looking dicey right now because this is the reference week for payrolls. They could always push that back a week and collect the data next week, and then they release the November data a week later in December. That's what they've done in previous shutdowns, but we really have no precedent for anything like what we've seen here in the 2018 shutdown. The government was partially funded, so data releases weren't disrupted. And in 2013, which is the closest analog, you had a 2-week delay, and then you had some delay in other some of these reports coming out. I do think it's right. We'll just never know some of the things from October. The employer survey, we probably can get some pieces of that from October, but the household survey, I think they probably just won't release anything, and we'll be flying blind on that month.
John, give us a reality check. I'm in New York. We cover financial markets. Obviously, there's a home bias. We think this is really, really important. Is it even on the radar of people down in Washington, D.C.?
No, this is not an issue that's come up, I think, in any of the shutdown discussions. It's a distraction. You know, this is about Democrats wanting to rein in the Trump administration. It's about healthcare costs. It's about a whole bunch of other things except data. I mean, these are kind of would be in Washington would be considered extremely wonky issues, and nobody on Capitol Hill is wonking out about this stuff.
Yeah, but there is a larger takeaway here, John. And I was looking at the history of government shutdowns. There have been 6 since 1990. They're getting progressively longer. They were 2 to 3 days under Ronald Reagan and George W. Bush. Under President Clinton, it was as much as 21 days. Under President Obama, 16 days. Under President Trump, 1.0, 35 days. And now here we are at 42 plus days. I'm just wondering what this means about Congress's ability to get anything done, and whether January 30th is the next D-Day where we're going to get another government shutdown.
Yeah, I mean, I think you hit the nail on the head here. The federal budget process is fundamentally broken. It's been broken for probably a decade now. And as it kind of creaks and cracks and Washington becomes more partisan and things become harder to do, I think the brokenness of the federal budget system becomes more obvious and starts having real world consequences. Congress hasn't completed the appropriation cycle on time in years. The idea of even doing a budget for reasons other than doing a reconciliation bill is basically laughable. And I think what you're going to see is increased likelihood of shutdowns. Now, in the past, what we've seen is that nobody really wins from a shutdown. Members come out of that saying, gosh, I don't want to do that again. I'm not sure that's what you're going to see this time around, given how long everything functioned just fine under the shutdown government. I mean, a huge portion of federal workers were considered essential, meaning they could do their jobs but not get paid. And it wasn't until flight delays really started kicking in and you had this issue with SNAP benefits that people started to really feel the real world pain. But I think that one of the lessons of this shutdown is that a week or two or longer of shutting down the government really isn't that big of a deal. President Trump can fly around the globe making peace deals, tearing down the East Wing, and it doesn't affect people's lives until you get much deeper into the shutdown.
Yeah, but John, to John's point earlier, when he was talking about the fact that we may not get this data ever in terms of data that was not collected during the reference period, Greg Dako over at EY Parthenon said that about 20% of the economic hit from the government shutdown probably will be permanent, just simply because there is sort of this lost economic activity. I'm just wondering, does this change the landscape for investors, for corporations trying to maneuver in a world that is affected by a government shutdown, even if most people don't feel it?
I think that if you're thinking about the future and thinking about possibilities of what the future is going to look like, you've got to have a much wider range of outcomes on your radar and prepare for those outcomes. You could have an even longer government shutdown in January. There could be no government shutdown in January. You could have the Democrats take back the House next year, and then you get an even longer shutdown coming in 2027. So I think there's a lot of different possibilities here. You can't rule anything out. And I think that the fact is that the policymakers just aren't going to respond until their constituents are feeling pain. And right now, I mean, and it's possible that this government shutdown, everyone walks out of this and says, boy, that was more painful than we thought. And to your point, the data is that the economic pain is permanent, but I don't get the sense that's happening right now, but we'll see how people feel in a few weeks.
John, things are changing down in Washington. And can we just wrap things up by leaning on your experience? You know the Capitol well. Nancy Pelosi is stepping aside. She's retiring. Senator Schumer is under immense pressure. You worked alongside the former leader, Mitch McConnell, longtime leader of the Republican Party. What's left of Washington, D.C. that you knew so well?
Very little. I mean, I think you look at the committees on Capitol Hill, they don't do much anymore. They're not producing legislation. Lawmakers are no longer kind of growing. The senior lawmakers that are going to be running the show in the next 5 to 10 years aren't ones that grew up in this era of bipartisan compromise where they came to Washington to do legislation and get bills done. They're people that came up in an age of Donald Trump and social media. And I think that creates a different set of incentives for lawmakers. It makes lawmaking harder. Congress has abdicated a lot of its responsibilities, and the public doesn't take it very seriously. So I think on Capitol Hill, at least, you're going to get a much weaker generation of leaders, and no disrespect to the people who are there now. This is just a broader trend. And I think it means that Congress takes itself out of the governing game and puts itself into a full-time campaign mode that's going to define more and more of the noise and policymaking you're hearing out of Washington.
John Lieber. Put well. Thank you, sir. John Lieber of Eurasia Group on the latest down in Washington, D.C. I'd throw in the fact that we've just torn at the fabric of coherent ideologies over the last several years on both sides of the aisle.
Yeah, there's a real question around what government intervention should be in the business cycle, in corporations. I love how Punchbowl put it. We want to welcome back members of the House of Representatives to Capitol Hill. Remember, the big white building with the giant dome is the Capitol. That's where the House floor is. We know it's been a while because there is this feeling that there just is an actual abdication of responsibility, if not, just a virtual one.
You talked about the likes of vibes, right? Let's talk about the vibes in Washington, D.C. When you see politicians that think they're influencers and not policymakers, we got a problem. And I hope that's not how things play out here in New York City.
Well, that's going to be an interesting point of discussion, I'm sure, at tonight's dinner with the Wall Street executives at the White House. How much can you imagine that Mamdani is going to come up in those conversations, given the fact that there's been a real tit for tat between President Trump and incoming Mayor Zoran Mamdani, and a lot of the executives in that room, if not most of them, all live in New York City.
One to watch later this evening. Coming up next, Hugh Van Steenis of Oliver Wyman saying AI investors need to pick up the slack. Plus, Danny has some of the morning movers this morning. AMD predicting a boost in earnings on AI demand. Growth ahead is looking good for that company. According to that company, that stock is up by more than 5% from New York City. You're watching Bloomberg TV.
Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzone.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're the 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
3 days of gains on the S&P 500. Here's day 4. We're higher by 0.25% on the S&P, up by 0.5 on the Nasdaq 100. A lift on the small caps, the Russell, up by 0.1. The bond market reopens with bond yields lower, trading off the back of the data out yesterday. Weaker than expected economic data almost across the board in the last 24 hours, driving yields lower by 3 basis points at the front end of the curve to 355.76. The big debate at the front end of the curve, what does the Fed do next? A range of views coming up later. Check this out for the Fed speak today, Lisa. Williams, Paulson, Waller Bostic, Myron, Collins, and a whole lot more to come for the rest of the week.
And that will offer approximately no clarity on exactly what they'll do next month because there's a lot of division and it's unclear whether they'll have any new information or, frankly, any new consensus heading into December. A real question here around a battle between what we are in. Are we on some sort of reacceleration? Are we on a technologically imposed regime change kind of moment where suddenly we have new productivity? Or are we heading into a stagflationary type of environment where you're starting to see the data reflect that?
Some officials are worried about the labour market. Others are more concerned that inflation is closer to 3 than it is to 2. And in the next month or so, ahead of their meeting of December 10th, we will get some payrolls data, but we probably won't get some inflation data. So to convince those hawks that they need to cut interest rates, that jobs data we will see needs to be a whole lot worse than expected to convert them to cut interest rates.
And then overlay on top of this question on what's behind the labor market data that has shown a reduction in the number of jobs actually created in any given month. Is it immigration? Is it a supply side issue? Or is this truly a demand waning? And if it is demand waning, is that truly signaling some sort of recession? Or is that signaling that we're all going to be replaced by robots? I mean, I'm being sort of tongue-in-cheek here, but there is this element of what are we looking at? And everyone has a different opinion.
Are you having that recurring nightmare? I'm having it too.
Yeah, I mean,
wake up, sweating.
Yeah, it's a robot being like, hello, I am Lisa Bromowitz on television.
It's telling people about financial markets, switch out the boards and get to the bond market. No.
To be honest, sometimes when I wake up and the alarm goes off at 3:15, I'm like, you know what? The robot can fill in today.
You can have it. On your way, son. Speaking of worries about inflation, the UK getting a record £69 billion in bids for inflation-linked debt in that sale. That number, that headline just crossed in moments ago. As we count you down to the opening bell, 3 hours away, let's get you an update on some single names, some morning movers. Here's Danny Berger with more. Hey, Danny.
Hey, John. A rebound tech-wide this morning for the chip stocks. Helping with that is what we heard from AMD, giving a new outlook, a renewed outlook, an update from Lisa Su, the CEO there, saying that revenue expectations are going to be higher, 35% gain for the next 5 years. When it comes to AI data centers, that will look more like 80%. So trying to assuage some of the fears that we've had in recent days about the sustainability of AI-driven revenue, those shares up 5%. Elsewhere, a great scoop from Ryan Gold and the deals team that the payments firm Bill Holdings is exploring a sale, according to people familiar. We don't know with who exactly. It could be another large payments provider or a private equity fund. They've been under pressure from activist investor Starboard, hence the exploration of the sale, and those shares up 12%. Finally, we got some earnings early this morning from On, the running shoe company, and it was a beat and a raise. Even though this company has the most expensive running shoes on the market, They raised prices in July. They kept them higher. There are fears about tariffs. People are still buying them. There's lots of demand. They especially saw bright spots in Asia and in Europe. So those shares up 8.7%, John.
Danny, thank you. Good news for them, because the shares of Deckers have had a terrible year so far this year.
Yeah, Deckers tried to get into the running game, and frankly, On Holding has been winning it. Nike is battling to try to keep up. It's really competitive. It is highly difficult. I'm looking right now at Cloud Surfer Max for $180, flying off the shelves, and people can't get enough of them. It's not a price game anymore. It's something else. And so this, to me, is get into the running clubs and start giving out freebies.
You're a runner. I don't like those thick heels, those thick soles. I don't like them at all.
You know, it depends which ones. Some of them are very effective, some of them aren't. It depends how bad your knees are or how good your knees are. It depends the distance that you run.
I feel like I'm on stilts, you know? I like to be low to the ground.
I like to have
Agile.
the springs, and I can just sort of spring up.
Oh, you like
spring up,
those? No, I don't like those at all.
Up.
I like to be low to the ground.
I can imagine that. Stealth.
You know, move in and out, you know, of people in New York City. Anyway, on our radar this morning, I don't run. President Donald Trump hosting Wall Street's elite for dinner this evening, including JP Morgan CEO Jamie Dimon. People familiar with the matter telling Bloomberg the president is looking to bring business leaders on board with his policies. Elsewhere, the record-breaking government shutdown is finally nearing its end on day 43. House Speaker Mike Johnson ordering lawmakers back to Washington for a possible vote later on today. And finally, AMD rising after predicting accelerating sales growth over the next 3 to 5 years, driven by surging demand for AI products. The CEO, Lisa Su, expecting data center revenue to increase by 80% and seeing the total chip market reaching $1 trillion by 2030.
Lisa Su saying at this dinner that the rate and pace of change in AI is certainly beyond anything that I've seen, talking about how profit margins are going to get to 35% as they meet both what's going on at Intel as well as compete more directly with NVIDIA. It raises a question about the vibes market, because a week before she gave this talk, there was around kind of disapproval of the earnings that came out better than expected and the shares fell. Now she comes out giving the same kinds of projections, the same kind of vibes, and the reaction is so much different. It points to just how different and fickle the market can be on one day to the next.
Some pushback in the last week, but some relief this morning off the back of that particular forecast. Lisa Su, it's not going to level off. That's the outlook for demand. Let's turn to AI infrastructure. Investor concerns rising as big tech issues record debt to finance the AI build-out. Hugh Van Steenis of Oliver Wyman writing, financing the trillions needed for digital and energy infrastructure demands long-term capital. As the boundary of what banks can provide got moved, investors need to pick up the slack. Hugh joins us now for more. Hugh, good morning, sir.
Morning, John.
Let's just talk about that. The boundary for what the banks can provide. What does that mean? Just unpack that line for us.
So with the change in regulation, banks struggle to lend much more than 5 years. And with a lot of these data centers, they want to do 8-year money, 10-year money and lock it in. And so that provides an opportunity for both the investment grade bond markets, but the quantity needed to fund is good. Let's say JP Morgan's forecasting $700 billion for next year. For data centers in the US alone, probably doubling by 2030. That's more than the IG market alone can hold. And one of the sources of flexible capital is private credit. And I think what's been really interesting to me, and we spoke about before, is the complexion of private credit has changed. I mean, finance has evolved in an enormous amount. Something like 2/3 of all the new money in private credit in the last 3 years have come from insurers. They want a slightly lower but more dependable return, and that's structurally lowering the cost of capital of what private credit can do, hence why data centers is right in their ballpark.
And they'd obviously want long duration investment grade debt. Now, we saw some of that come to market. We saw Alphabet come to market with an 8-part offering, including a 50-year maturity. That demand came out and sucked up all that supply. Week before it was Meta. Exactly. Do you think that demand's ready to go? Can it meet this moment? Or do we need to build this market out more?
Oh, well, I think it's both. I mean, I think you've already seen a flurry of very large deals, but it's probably in the hands of only 4 or 5 players at the moment. So actually, 4 players can't take all of it. And so even they are actually arranging the deals and maybe syndicating half of it away to elsewhere in the bond market. But no, I think it's ramping really, really fast. And certainly, I was with one manager yesterday who said they think this private investment grade market will actually be larger than the rest of their private credit business next year in terms of growth. So it really is the key focus for 26.
How concerned are you that fundraising has been at a record pace for private asset managers in credit? They have a lot of money they need to deploy. They're looking for opportunities, and it seems like there's almost more cash chasing potential opportunities than there are the potential opportunities to get financed. That's usually a recipe for accidents. How concerned are you about that?
Lisa, I think it's a great question. I think, look, the space is now large and varied enough that it depends which piece. So I think you're right, that in the leveraged finance market, as you speak about daily, the M&A market has not picked up that much, nor has IPOs. So there it's loans are heavily picked over. And actually with the financial deregulation simplification, the banks are becoming much more relevant. So LevFin, acquisition finance, is very tightly bid. But actually in terms of this new infrastructure build-out, the demand exceeds the supply. And so actually it's interesting, even with the deals that John just mentioned, you can get, if it's an off-balance sheet structure, you can get about 1% more than the investment grade index. That, for an insurer, is pretty appealing if it's a 10-year duration.
This is really largely asset-based finance, though, with the data centers in particular. And I just wonder how much we're evaluating whether we need data centers in Tennessee and the Southwest Desert if this actually does get more efficient and start to build out. I mean, at what point are we talking about assets that are going to become obsolete in short order?
Oh, look, this is, again, if I think about the big debates that people are doing their year ahead and thinking about 26, this is one of them. I think the way it's been put to me is like, for the next 3 years, the demand is so strong, actually, you're being underwritten by very, very high-quality borrowers. I mean, let's make a comparison here. If we were sitting here in 98, 99, and there's a little bit of that, a field that you speak about, you had Global Crossing, you had some of these large non-investment grade firms making investments. Today, these hyperscalers they're a better credit rating than France. I mean, for the moment, and so you're seeing much higher quality borrowers. So I think there'll be some differentiation. I suspect that the hyperscalers and the really good credits who are really good tenants will get a slightly cheaper cost of capital, and then you'll need to be paying up for that little bit of, will the tail still be there in 5 or 10 years? And of course, these are different. You need to replace the chips every 3 to 4 years. So there's some real constant refresh CapEx. So look, there's nothing in finance that's simple. There's never money left on the table. This is going to be, something where you need to be smart. And I think it's that challenge between the people who are smart credit risk takers and those who are not.
There are some weak spots. Can we explore some major question marks in the ecosystem? So I'm with you. The hyperscalers, really strong balance sheets, got all that. They're the ones making these massive investments. Let's talk about OpenAI. Yeah. So they've got huge spend commitments over the next several years, which are a multiple of the revenue they're currently generating. And that really feels like it's the foundation for everything that's happening around us. Is that the big bet? Lisa's asked us a few times. Are we betting on one company?
Well, look, I probably don't speak to one particular company, but let's say our good friend Torsten Stock had a good chart showing how the scaling of OpenAI is something like 3 to 4 years faster than NVIDIA and Facebook and so others were. If that were to hold, then hopefully that's the case. If they then slip back to the same trajectory as the others, then of course the financing needs start to become much more challenging. But look, it's a great question. I think that there's a lot of thoughtful credit work being done to try and think through what are the vendor financing and what's the control place here.
Do you think we're at this point already where we're starting to test investor tolerance, where they need to demonstrate exponential revenue growth from here to justify some of the spend commitments we've seen?
Certainly, the way it's being put to me is that the investor conversation we have is that they need to maintain this extraordinary fast scaling, otherwise things will slip.
Right now, I'm just wondering, going forward, whether you think that energy constraints are going to become an issue in the near term. I mean, how much some of the data center build-out is really going to be contingent on how quickly the grid can keep up?
Oh, completely. So this is interesting. So Lisa, this is why I think also in the conversations we're having, we're now starting to say, like, the difference between is the data center next to existing grid connections or existing, maybe it's an old coal-fired power plant which needs to be repurposed. That's getting a cheaper cost of capital, the ones which are off. So no, these energy, the interconnections and the energy demand is becoming not only a political issue, but also one which is really at the heart of economics. Now, look, I'm not saying every deal is correctly priced, because there's such a frenzy here to do the build out, but I think there's much more focus in the due diligence now around where's the energy coming from. And the other piece is, given the demand, there's probably going to be huge inflation in actually putting these together. So I'm also hearing people underwriting saying, you know what, let's assume not only the price, but a bit like in the pandemic, plus some. And obviously there's a debate about what that plus sum should be.
Hugh, given the constraints, to Lisa's point, could come from energy, is there more comfort in the investor world to support that build-out than maybe there is elsewhere in the broader story of AI and the data center effort?
I'm not sure I've got a strong view on that, John. I mean, I think that, I can see what the spreads are tight enough to suggest the demand is definitely there. But I think it's, look, these are tough questions going to 26.
The worry is overcapacity, right? Yeah. Overcapacity in one thing, but the story seems to be that we don't have the capacity and energy. And I would have thought that people would develop more comfort in that story, at least allocating capital to it, because that's what we need to develop. So maybe some of the questions that remain elsewhere about the other things.
But isn't that why some of the biggest deals we've seen in the last few months are not just data centers, they're actually LNG, pipes, grids, it's also the utilities. And I think that's interesting. Some of our private credit clients are spending as much time around utilities and energy as they are on pure data centers for exactly your reason.
Well, data centers are more satisfying, John. I mean, right now, the idea of investing in something that's going to take 10 years to build out, not something a lot of people want to get around to.
Yeah, data centers are also very controversial.
That's
of course,
true,
because
100%.
of the energy costs that come with that to the community that they put those massive things in. And they are huge. They are some ugly things, right?
How much do you expect a lot of the big tech giants to become utilities? In 10 years, they're going to be the ones that have to build this. They're going to be the ones that regulate this. They're going to be the one that's financed this. Because ultimately, you're right, it is a political issue. And at a certain point, after they get the exponential growth, if we all rely on them to that degree, how much does their profit line look more like a Verizon than it does, say, you know, the Metas and OpenAIs of today?
This is how I think about things. I'll use my hands. Profit growth's up here. Employment growth is right here. And in between is a lot of space for societal pushback and political tension. All of that right there is where the game's going to be played over the next 18 months.
Yeah, watch the space. So given the fact that Congress seems to be on the ball and very much ready to legislate compared to the conversation that we just had with John Lieber, you know, I'm looking forward to their propositions for exactly how to narrow the space in a productive way.
Hugh, it's good to see you.
Thanks very much.
Bye. Thanks for being here. Thank you, sir. Hugh Van Steen is there of Oliver Wyman. Let's give you an update on stories worldwide with your Bloomberg Brief. Here's Yahira Arnott. Hey, Yahira.
Hi, John. Speaking of the AI build-out, CoreWeave shares are staging a modest rebound, up about 1% after a 16% drop in yesterday's session. In its latest earnings results, it announced it expects a delay in fulfilling a customer contract caused by a third-party data center developer being behind schedule. That caused it to trim its outlook. Shares had more than doubled this year after its initial public offering back in March. Meanwhile, leaders of major U.S. airlines pressed for more information on the safety data that justified the flight cuts mandated by the government due to the shutdown. People familiar say executives asked the FAA if the agency identified risks that the carriers might not have been aware of. The FAA shot down concerns and went ahead with its plan to cut 10% of flights across 40 major airports. And JP Morgan is broadening its push into the digital asset space. The world's largest bank has started rolling out a deposit token called JPM Coin to institutional clients after a months-long trial. The coin allows users to send and receive money via the Coinbase-affiliated public blockchain base, allowing payments to process in seconds and 24/7 rather than in days and just during working hours. That's your Bloomberg Brief. John.
Yahira, thank you. More from Yahira in the next hour. Up next, getting the data back on track.
We hope that with the government reopening, we can get very quickly October and November employment data. Right now, we just have to go ahead and interpret this data because this is all that we have.
Up next, we'll catch up with Jane Foley of Rabobank, live from New York City this morning. Good morning to you all. You're watching Bloomberg TV.
The key issue right now for us in the diamond space is the declared divestment of Anglo from GPS. And as you know, Anglo holds 85% stake in DBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in DBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
Asia is at the forefront of some of the world's biggest stories. I'm Sherian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the centre of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Bonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
Your favourite 24 hours full of Fed speak coming right up. John Williams of the New York Fed, Philadelphia Fed President Anna Paulson, Chris Waller, Fed Governor, Stephen Myron, Fed Governor, Boston Fed President Susan Collins, and more over the next 48 hours into the weekend.
What clarity can we glean from this, John? What do you think we're going to learn? How much can you really get a sense of what they're going to do in December and beyond? What's your view?
Very little.
All right, but
I will say I think we can stress test their positions and say to them, if we don't have inflation and you don't get a CPI report by the December meeting, does it make the call to cut interest rates or hold? Harder? Easier? You tell me.
Yeah, what data are they looking at? What's actually going to be the tell for them, especially given the fact that it's unclear which government data we're going to be getting? And that, I think, is a really key question for a lot of them out there.
Under surveillance this morning, getting the data back on track.
The October data is going to be very noisy, and it's going to be affected by the government shutdown. This coming month is going to be pretty tough. We hope that with the government reopening, we can get very quickly October and November employment data. Right now, we just have to go ahead and interpret this data because this is all that we have.
So here's the latest this morning. Investors are waiting signs government data will resume, with alternative data sending mixed signals on the economy. Jane Foley of Rabobank writing the dollar will be more sensitive to poor data releases in the coming weeks than to good. Either way, it's time to reassess the outlook for the greenback. Jane joins us now for more. Jane, welcome to the program. What data are you focused on?
You know what, any data, I think at this point, but particularly, of course, the labour data and the CPI data, if and when we get it. But, you know, we all know that that's going to be pretty confusing, perhaps, and in October it will be affected by those shutdowns. But I think we learned something, particularly yesterday, about positioning for the US dollar, and that is probably going to tell us how the dollar is going to react. Because when that ADP data came out yesterday, the dollar sold off perhaps more aggressively than I thought it would on that data. And that, I think, tells us that the market isn't quite so short of the dollar anymore. And we've got to remember that whilst the dollar remains the worst performing G10 currency in the year to date, actually it's done pretty well in the second half of the year to date. And yesterday, after that data, you know, it was the Norwegian krone that was the best performer. But, you know, last week it was the dollar that was the best performing G10 currency in the year in the second half of the year to date. And now I think we're in this more balanced position for the dollar. And that, I think, is going to be crucial going into these data numbers.
In your words, it's time to reassess the outlook for the greenback. Jane, against what? Is it against the single currency, the euro, or the story of the moment, the Japanese yen?
You know, I think all of these, but I think the yen has got its perhaps bigger fundamentals. We saw what seemed to be a little bit more verbal intervention by the new finance minister in the Japanese parliament this morning, a little bit more pushback. She appears to be becoming more uncomfortable with the yen. And actually, we had some indications out earlier in the week from the Bank of Japan with respect to their previous policy meeting. You know, we can't write off the risk of a December interest rate hike from the Bank of Japan. That is still going to be, very much so a live meeting. So, there is the possibility that we do get maybe an interest rate hike, that we may even get intervention. I think the market is going to be wary about 155 on dollar yen. So there is very much a yen story going on there. As very much there is a cable story, a sterling story going on. But, the common denominator here is the dollar, and it doesn't seem to have an awful lot of strong direction right now.
There is a strong direction possibly later this month when we get NVIDIA earnings. How much does the AI trade really favor the strength of the dollar and kind of buoy it from losing too much value versus its peers?
I think this is really important because, for instance, if we look longer term, if we look at the amount of portfolio flows that came into the U.S. Assets, into the stock market, but also bonds, also the dollar, say from the global financial crisis up until, last year, what was driving this? And what was driving it was the outperformance of the US on growth and productivity. And of course, crucial to that outperformance of productivity has been the US tech companies. The fact that, the most of the world's biggest 100 tech companies are US based, that they're from the US, they are American companies. They're still there. And yeah, we had the dollar selling off at the start of the year, but I think that was more like a really big, heavy lump of profit taking after years of the Buy America trade. And if we look at US fundamentals now, maybe we're not going to be, so focused on the US trade. Maybe there is room for diversification, but those fundamentals are still very much there, and they are linked to productivity gains. They are linked, therefore, to tech. And I think they are going to, protect the outlook for the US economy, and therefore for the outlook for US assets and the outlook for the US dollar going forward. I don't think we have moved into this era where the dollar's going to be on the back foot, like many commentators were fearing at the start of the year.
Part of it is what they're up against. And I just want to conclude by asking you about the pound, because we've heard a lot of the discussion around what the budget has looked like. Is there anything that can get the pound stronger at this point without maybe regime change at the top?
Well, even if we were to get regime change, there's an awful lot of uncertainty that would have to come first. It's not that easy to oust the leader of the Labour Party. And actually, what would that do for investors? It would just add to the confusion. It would add to the uncertainty and probably be a drag on investment growth and the possibility of an uptick in productivity. So even that, at this point, I think could be a weight on the pound. So, the cable has been, quite resilient in the last couple of weeks or so, but I do think we are going to see a little bit more downside on cable. I think that's got to come, and I don't really think the budget's going to bring an awful lot of good news. We just know we're going to have an awful lot of tax hikes and downgrades to growth and productivity forecasts.
I'm not sure the bar could get any lower for that budget, Jane. It's good to see you, as always. Jane Foley of Rabobank. It feels like we've had months and months of leaks about this tax hike, that tax hike. I'd be surprised if they announced a tax hike we haven't already heard of.
Yeah, and if they have, congratulations. Gita Gopinath had a great column in the Financial Times talking about how fiscal instability and uncertainty is causing a lot of the problems.
Game of Thrones over at Westminster today. We'll avoid some of that. Coming up on the programme, we'll catch up with Rick Reeder of BlackRock, David Tinsley of the Bank of America Institute, and Amy Gower of Morgan Stanley. The second hour of Bloomberg Surveillance up next.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Now, Wissam, would you say, when you look at your career, that the pivotal moment was actually that meeting with Robert De Niro? It took him 4 years to convince you to open a restaurant near him. You eventually did, and that started a partnership that has lasted through the decade.
I met him 1988 after my first restaurant opened. He asked me to come to open the restaurant in New York. And beginning, I didn't know what he did.
You didn't know he was an actor?
No, I don't know. What he doing? Because I never watched the movies. I was traveling the business. But of course, after people, hey, Nobu, so you must know him. And then I understand.
How is he as a partner?
He's, for me, and a great partner. He understands to my concept. He supports me 100%. But he's a very smart people. Sometimes, so strange idea, but it's good idea. So, example, Nobu Hotels, idea come from him. He said, hey, Nobu, so we have a lot of new restaurants coming in somebody's hotel. For him, doesn't make any sense. Then we start Nobu Hotel in Las Vegas 11 years ago. Now it's a big success. So next step is the residence.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Both businesses and consumers are wary about the economy.
Without data, it's kind of hard to get a gut check.
The October data is going to be very noisy, and it's going to be affected by the government shutdown.
Further inflationary pressures may be coming down the pipeline.
It's a K-shaped market economy. It's a K-shaped socioeconomic recovery post-COVID. Everything is diverging.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures adding some weight to the rally. 3 days of gains on the S&P 500. Hello, day 4. Higher by 0.2% on the S&P. On the Nasdaq, up by 0.3. In the bond market, a rally this morning. The Treasury market reopens after some weak data yesterday. Yields are lower by 3 basis points at the front end of the curve on twos, 355.76. Today, we can debate the front end of the curve, a big debate at the Federal Reserve, and a ton of Fed speak through the next 24 hours.
A real lack of clarity around what the Fed's response mechanism really is at a time where people can't understand whether we're heading into a reacceleration or whether we're heading into a downturn, whether we're heading into a surge in productivity or whether we're heading into something that feels stagflationary and unsustainable with the division between the wealthy and the poor. And right now, the lack of understanding is clouding the fact that we're not even getting data, right? So we can't even get any concrete bona fide data from the government to really parse over. So people are just using the data points that are conflicting within different sectors of companies that are trying to get an upper hand. It is a stew, and Fed officials are just mired in it.
We've been leaning on third-tier and fourth-tier economic data. Challenger job cuts have been in focus over the last week or so. We never talk about Challenger job cuts, and you're unlikely to get the CPI data in the next month as well, according to this line from Kevin Hassett, the NEC director, saying, I've been told that some of the surveys were never actually completed, so we'll never perhaps even know what happened in that month.
So CPI is probably the casualty that a lot of people are expecting. When you take a step back, even if we were to get the data, unclear how much of a signal we actually could get. Because right now you have the Challenger job cut announcements that largely were tied to Amazon and UPS, which were announced, and Amazon linked it to artificial intelligence and the idea that they are doing more with less, fewer people. But there is this larger question about the fact that companies sound pretty good. They're not talking about recession. They're not talking about downturn, but they're not hiring. So how do you solve that puzzle? Is this a puzzle that is solvable with more layoffs, or is this a puzzle that is solved with more productivity, greater economic activity, and then eventually more hiring?
We'll get into that puzzle in just a moment. Coming up this hour, we'll catch up with Rick Reeder of BlackRock. With equities looking to stage a comeback, David Tinsley of the Bank of America Institute as consumer spending continues to climb, and Amy Gower of Morgan Stanley as the AI build-out pushes copper even higher. We begin this hour with stocks hovering near record highs. Rick Reeder is BlackRock's CIO of Global Fixed Income and is widely considered to be one of 5 contenders to replace Fed Chair Jay Powell. He writes the following: moving interest rates lower is very much in line with what we do know today, which is that the labour market is clearly slowing to the point of potential stall speed. Rick joins us now for more. Rick, good morning.
Thanks for having me.
It's good to see you, my friend. It's been too long.
Thank you.
Welcome to the studio. Have we got a labour market problem?
I do. I don't. And by the way, I don't think it's a cyclical phenomenon. I think there is, or the way Lisa was, I think we have a productivity revolution that is pretty extraordinary. And people point to AI as an exclusive driver of that. If you look across what companies are doing, including second quarter earnings, third quarter earnings, if you look at dynamic around how you think about logistics, freight management, predictive maintenance, customer procurement, companies are doing more with less, and I think that is a secular dynamic that's going to be with us for a couple of years now. I mean, we can talk about there's a bit of elevated inflation because of tariffs, but I think we're going to be dealing with some. By the way, you also put robotics, automation. You know, this to me is a structural dynamic. I think full employment will be the challenge for the next couple of years.
So we mentioned the spread between earnings growth, fantastic, employment growth, terrible. How are we closing that gap, if ever?
So I think, by the way, I actually think that's not a coincidence. Those aren't coincident factors. What's happening is companies literally, the top line revenue is pretty good generally, but what's happening is they're cutting costs of goods sold, they're cutting their SG&A costs, they're reducing their cost infrastructure. By the way, AI is a technology. There's historically been this dynamic of when you have new technology, it moves people into other higher value jobs. This technology, by the way, I put robotics and automation on top of it, autonomous driving, et cetera, is literally designed to replace human input. You have a dynamic that is pretty extraordinary that I think, if, as a central banker or whatever, as you think about being anticipatory of where the world is going, that is where the world is going, and I think that is a challenge. The economy's doing fine, divergent, and quite frankly, only operating on a couple of cylinders. Huge CapEx, which we talk about from cloud, from infrastructure, from power, and you've got higher income, wealthy savers that are doing great and supporting consumption in the economy. And then you have the part of the economy that's interest rate sensitive, that's really struggling. And that's part of why the interest rate tool needs to address low income, small business, housing. And that's where I think you square the circle.
So we've got to talk about this from two perspectives, one as a policymaker, the other as an investor, and one, of course, informs the other. Let's just sit on policy for a moment. You're talking about maybe the need to cut interest rates, but also the fact that some of the pullback we've seen in hiring is not cyclical. How can we address one with lower interest rates? Just explore that for us a little bit more.
Yeah, so first of all, if you came down from Mars and said, okay, so I've got 5-year inflation break-evens, a trade in the market, you buy as many as you want at 2.35%. And you said, okay, now set the price. And you said, okay, 2.35% inflation, and I clearly have a slowing labor market. You would say, gosh, I don't know if I set the rate at 3, and then I thought about, okay, so now what's equilibrium on the mortgage rate to create velocity in housing? And it directly related to what you said. Housing today is 3/4 of the wealth by people in the country is in housing. We have a housing market that, you look at the earnings from D.R. Horton, you look at Lennar. By the way, I just saw an ISI home builder survey that showed the softness. If you actually get the mortgage rate down a bit, then what happens is all of a sudden you get housing velocity. Why is housing velocity important? Because you get labor mobility. Today you can't move. You lose your job, you got to go somewhere else, you can't move. Secondly, and I've said it before, for every home built in this country, we hire 3.1 people. It's pretty hard to AI building a house. So if you can get some real estate velocity, and by the way, it's why young people who are struggling today, young people who aren't savers, who are borrowers, that's the way they build wealth. That's the way you put people to work. And so I think it is all a related concept. Point being is, and by the way, I mean, if we had to raise interest rates to where they were, but if you said to me today, what's equilibrium? I don't think it's where we sit today in the funds rate.
So how willing are you to allow, or how willing would you be to allow inflation to run above that 2% target in order to run the economy hot to allow for more job creation?
Listen, that's a great question. And I think every time you think about these things, and I think about the same thing, we take risk. You sort of think about what are the quadrants of risk, what are you willing to underwrite? So today, when I think about those quadrants, if you were willing to take some labor and some overall inflation, then you think about, okay, what are the sticky drivers of inflation today? Healthcare, education, insurance. It's pretty hard to use the interest rate tool to get insurance costs down. It's pretty hard to get a healthcare. So the tool is not that robust. And health shelter is a sticky part of inflation. That, if I actually get the rate down, I'll actually mitigate some of that elevated. I'll mitigate the rental inflation. So, you know, I'll throw one other thing. 5-year inflation expectations are 2.35%. If you were at 2 3/4, and by the way, core PCE, the 6-month moving average core PCE is 2.5. Let's say we're probably closer to 3 if you take the whole full construct of inflation. 3 is not an infectious, you clearly don't see it in terms of where people anticipate inflation. If you're running 4 or 5, then I'd say, gosh. Or if the 3 was trending higher on things that the interest rate tool impacted, then I think you'd have to address that.
Just to sort of build on that, and this idea that 3 is okay, but above that, maybe not so much. There's a feeler that there is an asymmetry in the time frame of AI. That right now the build out is going to be inflationary because of the inflationary inputs of commodity costs, of just how much lending and money this is generating on a broad scale. The productivity gains that will cause disinflation will take a lot longer to come into play. So how, if you were the head of the Fed, would you handle that?
So I take a couple things. So think about historically the way the interest rate tool worked is it was a modulator of CapEx. So you think about, go back 60s and 70s, the big spenders in manufacturing. Today, my guess is OpenAI, NVIDIA, Google, et cetera, it's not the interest rate tool that is affecting CapEx. They are going to put that CapEx in because there is a long run benefit for doing it, meaning the interest rate tool doesn't really do a lot. So I think at the end of the day, does that create a little bit of inflation in the areas you described? I think so. But I think you have to say, where are we going? And I will say, being an investor for a long time, the concept of data dependence, if you were constantly in the rearview mirror trying to figure out how would you invest, it's probably the wrong way to do it. We are going through something that's very different. We now are in a CapEx cycle. And then if you break down the economy and say, okay, what is driving GDP today? That's what's driving this CapEx and some consumption from higher income people.
The key piece of the inflation story is shelter. You touched on it. And you said something interesting. Interest rates down, shelter costs down. Just explain that for us.
Yeah, so we have an inventory problem in the country. And by the way, you look at every piece of data, it shows the same thing. And so, by the way, when the mortgage rate has come down a bit post this recent Fed drop in interest rates, all of a sudden you're seeing existing home sales pick up. We just saw the prepayment report for mortgages, and all of a sudden you're seeing some acceleration. Meaning you don't have to get the interest rate tool down that much. If you got the mortgage rate into the 5s, I'd say mid to high 5s, you would see some velocity of housing. If you saw velocity of housing today, I saw on D.R. Horton's numbers, they talked about they're doing 1% first-year mortgage, and then I think it's 4.9 because they've got to subsidize the mortgage. Well, what if D.R. Horton didn't have to do that? And what if the actual, organically, the rate was lower? They'd build more houses, you'd create more inventory. You create more inventory, you take the pressure off of rental rates, and you start to bring inflation down. Plus the labor mobility, that is not an insignificant part of that.
Do you think the Fed needs to think outside of the box beyond just interest rates? Is there something else we can do here?
Yeah, listen, I think the Fed has a series of tools. The interest rate tool, by the way, today, nobody really borrows off the overnight funding rate. The interest rate tool, it used to be, you think about how banks borrowed short, they lent long, we had a very different dynamic. Today, the way we tranche the debt in the economy, think about how we finance resi, commercial, asset backs, credit cards, auto loans, it's tranched. The front end of the yield curve doesn't really do a lot. How you think about, where is the 10-year point? How do you think about your balance sheet? How do you think about all the other tools that are at your disposal? I think are really important. Plus, you got to think about what is the effect of the currency, et cetera, relative to that. So anyway, I think the construct is much more complex and much more, quite frankly, you have a lot of tools that create much more effectiveness, and we're just going to move the overnight funds rate every 6 weeks.
Like the balance sheet. How much would you be open to see the Fed use the balance sheet a little bit more?
So I think the construct of the balance sheet is important. So I think people don't realize there's a notional dynamic and there's a DV01, there's a duration dynamic further out the yield curve. I am sympathetic to, should we keep the balance sheet around the same level? But you could be really effective. So today, the U.S. Treasury, 89% of what the U.S. Treasury finances is at the 0 to 2 year point. 89, think about if you're a company, would you ever finance in the 1 year? Like it's crazy, but that's where we are today and it is what it is. So there's not that much float actually longer on the curve. There's a reason why people put on steepeners and they get squeezed out of steepeners because there's not that much float. you don't have to use that much balance sheet. But if you thought about, gosh, the construct of the balance sheet, if we used more of it further out the curve, we let runoff happen on the front. If you can keep the stability of the back end, so if you can keep the 10-year, you know, we got to the 10-year was 390. If the 10-year was 3.5 to 4, stable, and rate volatility came down, all of a sudden you'd see mortgage spreads could come in, then you'd get, and by the way, deregulation of the banking system, then you get mortgage velocity moving. So, by the way, I don't think we're that far away. And by the way, you know, this concept of, you know, we have to get the rate down hundreds of basis points, I just think we're not that far away. Just get it there, keep volatility of the rate market at a stable level, and then you'll see a system that'll operate pretty well.
Rick Reeder of BlackRock is going to be sticking with us to talk about the market implications of some of this and the opportunities out there at the moment. Before we get there, let's get you an update on stories worldwide with your Bloomberg Brief. Let's cross over to Yahara Arnott. Hey, Yahara.
Hi, John. The House of Representatives is set to vote on reopening the government after the longest shutdown in U.S. history. The short-term funding bill was reached after senators agreed to compromise on a plan that will fund the government through the end of January. The measure would reinstate federal workers fired during the shutdown and guarantee back pay for furloughed employees. Meanwhile, the U.S. military may build a temporary base near the Gaza Strip. Sources telling us here at Bloomberg, the base would be capable of housing 10,000 international troops for 1 year to monitor a fragile truce between Israel and Hamas. This as the U.S. has been seeking international support to send troops to the region to support the ceasefire. And the grandson of President John F. Kennedy is running for Congress. Jack Schlossberg says he'll make a bid for the New York seat being vacated by Jerry Nadler, joining a crowded Democratic primary. Schlossberg is an author known for his political commentary on social media. He told the New York Times that the Democratic Party needs more voices to push back on President Trump's policies. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next, Calling Wall Street.
The stock market has hit many record highs during the last 9 months, many. And it will again. This is just the beginning. We've never had anything like this as a boom.
Very close to all-time highs this morning. That conversation continues with Rick Reeder of BlackRock, live from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Stocks are positive this morning, up by a third of 1% on the S&P, up by 0.5 on the Nasdaq 100. Under surveillance this morning, Calling Wall Street.
We must get the government back open soon and really immediately. We have to get it up. We have the hottest economy we've ever had, and it's affecting the stock market now a little bit. But the stock market has hit many record highs during the last 9 months, many. And it will again. This is just the beginning, because when these plants that are being built right now start opening up, we've never had anything like this as a boom.
So here's the latest this morning. President Donald Trump is hosting Wall Street's top leaders for dinner at the White House. Sources telling us here at Bloomberg that JP Morgan's Jamie Dimon and Goldman's David Solomon are expected to attend. Bloomberg's Jack Fitzpatrick is tracking the story. Jack, what's the objective of tonight's dinner?
So there's no listed objective, but there's a broader context to consider here that the president hinted at in those remarks. This is a president who put a huge amount of political capital into getting his signature tax bill extended, and yet he sees major concerns among the electorate on affordability, on jobs. There was some pressure on him to the degree that he focused on foreign policy, taking his trip to Asia during the government shutdown. This is a president who clearly feels some pressure to refocus on the economy as much as possible and sell voters on the economy, on the tax cuts they've gotten, and on any success he can. So there's not an official agenda for what he's trying to accomplish, but he's certainly brought forth some high-profile names as you see him shift his focus a little bit away from the recent attention on foreign policy and back to the economy as his bread and butter as we get closer to the midterms next year, especially.
We'll see if we can get the cameras in there as well, Jack, a little bit later this evening. Jack Fitzpatrick there of Bloomberg down in Washington, D.C. Still with us, BlackRock CIO of Global Fixed Income, Rick Reeder, also the head of the BlackRock Global Allocation Team. Rick, you've seen a lot going back to the late 80s. How much fun are you having right now?
I've said before, this is the best investment environment I've ever seen. I mean, not because stocks are going to go straight up. I mean, you have divergence that is great for investing. You have technology that's changing, and so the ability to look at tech stocks, healthcare tech, to look at, where some of the financials, how you create velocity in the system. And then, the earlier conversation, we were talking about the break. Like now, the income levels, as long as this interest rate stays here, which, what's ironic is commercially, I prefer the interest rate to stay here because this is pretty good. We can create portfolios. We run this ETF called Bink. And, creating 6.25, we're running almost 6.30 now. You don't have to take a lot of risk. You don't have to go out the yield curve. That's pretty good. So anyway, I think, and by the way, the options market, I think the best opportunities are in the options market. Rate options, equity options, and you can manage your convexity. So you can be long equities and then buy a lot of, you can overwrite your single name stocks. You can buy downside. It's a fun environment.
Well, let's lean into Bink. You mentioned it, the iShares Flexible Active Income ETF. What kind of things have you been doing over the past 6 months?
We've been, the cool thing about being active is you can move around because the regime shifts. And while, I was describing earlier, like, where do you think the interest rate should be? The truth is the interest rate isn't going to move very far. So, we're keeping our interest rate duration, in and around 4 years. We've moved a little bit out of the very front end because it's pricing a lot now in terms of where this Fed is going to go. Then we've shifted some of our credit into mortgages. Quite frankly, if you believe rate volatility is going to be down, mortgages have become interesting, and credit spreads have gotten pretty tight, particularly U.S. investment grade has gotten pretty tight. So we've rotated out of that. We've bought a little bit of EM recently. I would say recently over the last 6 months. We haven't bought EM in a long time. If you believe the dollar is contained, EM becomes pretty interesting. And the yields, relative to high yield, the yields in EM are attractive. So we've cut a little bit of high yield. We've got a good amount of investment grade credit, and we've rotated. So today, I think our average rating is A-, which is pretty good. So it gives us a little bit of room to do some things like EM.
You said something that was interesting there, which is you don't have to go very far out the risk curve in order to get income now because yields are high. If the Fed were to cut rates, does that make you more inclined to take more risk?
Yeah, I have to say, for two decades, part of why I'm so excited about where we are today, for 2 decades, it was like, I got to buy high yield at 3.5 and 4, and it doesn't feel natural. But now, if you have the risk-free rate, particularly in the front end here, gosh, I put a little bit of spread on it. Now I get what is ample yield with default rates that are not that elevated. You are seeing some bubbling defaults in a couple of places. So, I think the thing that we would do is, I know what we would do is if rates come down, I'm not a believer, and this is what blows you up. I'm not a believer is, gosh, I got to keep that yield. I got to get my risk up. You just have to absorb it and say, you know what, I'm going to run. I can't run 6.25 or so. I'm going to run 5 3/4 to 6. But you know what will happen is the cash rate will come down, and people say, gosh, you know what, cash is only getting me 2.5 to 3. And you know, inflation, even if inflation's 3, like it's still pretty good.
Okay. Very few people on Wall Street, though, are saying, you know what, I can just live with less income. It's okay, I won't stretch too far. I'll be disciplined, and maybe I'll just take less cash and I'll commit to the economy. At what point can you imagine that things start to get a bit excessive, especially given the fact that there is a lot of cash right now looking for a home?
So, by the way, you know, it's a funny thing as you say that. You know, we live in a competitive environment. We can't just sit back. I mean, it is a tough business, and we have competitors and people that are out there say, gosh, I can get you more yield. Listen, I think one of the things you have to do is you got to keep your volatility. As long as you always think about what's your yield per unit of volatility. Today, equities, I think equities are still going up 15 to 20% from where they are over the next year. So I'm just trying to keep our volatility at a reasonable place. What is excessive? You know, there's some things that are bubbling in the markets that are mostly in privates that are, gosh, I don't get any cash flow for 2 or 3 years. What's the multiple you put on that? Like, that stuff is hard. There are some really good business models. You say, I see it, and it's almost definitional. You know, you see some parts of it where people have stretched, and in some of the credit markets where some of the levels get aggressive, part of why we've rotated some of the investment grade. It doesn't do that much for us anymore at those spread levels. But I don't see, like, you know, saw before the financial crisis, excessive low covenant or easy covenants, high LTV financing. I don't see that yet today. Around the edges a little bit, but not really.
15 to 20% on stocks.
Yeah.
Another double-digit year.
You know, Jonathan, I think we're living through history because, what you asked about before, because productivity and ROE is so spectacular. And by the way, I don't think it's 500 stocks. I think it's, by the way, we heard a stat yesterday, if you take the S&P 1500, is this right that I heard it was 22% off the highs? I thought that number, Russ Costridge, who worked with Doug, I thought that was extraordinary. If you take the highest ROE businesses, you know, let's say it's 30 stocks, 50 stocks, tech, healthcare tech, some of the financials, they're doing really well. They throw off a lot of earnings. Their ROE is high, and they buy back huge amounts of stock. You know, small cap, don't really know. But there's enough stocks with enough market cap that I think will get you that sort of return.
Stay with market weight on the S&P 500.
No, we're long.
Embrace the concentration.
I mean, we're long. I mean, we've reduced a little bit of beta. When equity volatility picks up, I have to bring my beta down a little bit, but I'm still running long. And, you know, days like yesterday, you know, and, single name, you know, we get these earnings reports, and single name vol is high because, you know, if company doesn't hit these excessive numbers, they hit the stock.
Yeah.
So you can still do some things to protect some downside. And by the way, interest rates, if you believe the Fed is moving, albeit deliberately, interest rates actually act as a reasonable hedge again. So there's some correlation to rate that's allowed us to run a moderate long.
Rick, it's good to see you.
Thanks for having me on.
Come back soon. We appreciate it, sir, and best of luck with the process. I've known you a long time. BlackRock wins either way.
Oh, thank you, sir.
The country wins either way. Thank you, sir. BlackRock's Rick Reeder. Coming up on the program, David Tinsley of the Bank of America Institute with a consumer spending surge. Plus, Danny has your morning movers. AMD shares soaring on the back of promising comments from the CEO. Lisa Su, their stock is higher by almost 6%.
technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Rick Reeder of BlackRock with the program just moments ago, talking up the potential for another double-digit year on the S&P 500 and U.S. equities over the next 12 months. Equity futures this morning higher by 0.4% on the S&P, on the Nasdaq up by 0.6% in the bond market. The bond market reopens, bond yields are lower, anticipated off the back of some weaker data yesterday. We're down by 4 basis points to the front end of the curve, 355 on 10s, just north of 4%. Rick also talking up the prospect of maybe the Fed using balance sheet to address some of the issues at the longer end of the curve.
Talking about a sweet spot between 350 and 4 for 10-year yields, that if you could kind of create that kind of level and low volatility, you could get the housing market back in force. A real question here, what is monetary policy's role if you do believe that we are living through history with respect to a technological shift that could potentially be inflationary up front, but disinflationary long term and leave a lot of people out of work? It is a quagmire, and frankly, that's what a lot of people are wrestling with.
We've talked about this a million times, the spread between earnings growth and employment growth and the tension it's generating in between. It's a problem, not for the future. It's a problem right now.
And so if the Fed tries to cap rates to keep the economy hot, to allow people to get more work, what does that mean for the dollar? What does that mean for the credibility of Fed policy with respect to inflation? These are going to be the 2026 issues that are going to really create the contours for a lot of market activity.
Conclusion, another double-digit year on the S&P 500
and probably lower rates.
In that direction. Yeah. Equity futures this morning up by 0.4% with some morning movers this morning. Let's cross over to Danny for more. Hey, Danny.
Hey, John. The big mover of the morning is AMD, with Lisa Su, the CEO, giving an update on where she sees the revenue trajectory, and it's 35% growth over the next 3 to 5 years. For the entirety of the business, for data centers, it's an 80% growth. That confidence helping to lift shares 5.6% this morning. Elsewhere, we also have a little bit of earnings. This coming from the stablecoin issuer Circle. It was better than expected, and the amount of their stablecoin in circulation doubled. The issue is for this company that has had a huge run-up, prices doubling since their IPO in the summer, is that the rate of return was lower. And again, given that big ramp up, we're seeing the reaction in shares, those shares falling by about 5.6%. Finally, some sell-side action for you. Kava and Sweetgreen getting put on Citi's 90-day watch list. Their earnings in recent weeks flagged some real weakness, especially with the younger consumer, but Citi pointing out that they get a good chunk of their sales from the D.C. area. The DMV area, D.C., Maryland, Virginia, sees about 16% of sales for Kava, 11% of Sweetgreen. So they say the government reopening could give a boost to both those companies, John.
A reopening trade. Danny, thank you. Appreciate it. More from Danny in about an hour from now. On our radar this morning, aides to President Donald Trump considering cuts to New York City's federal funding after Zohran Mamdani's victory in the mayoral race. It's not yet clear what programs could be impacted. Mamdani saying he's ready to work with the White House. Elsewhere, President Trump hosting financial executives for dinner at the White House tonight. Attendees including JP Morgan's CEO, Jamie Dimon, NASDAQ's Adena Friedman, and David Solomon of Goldman Sachs. The president is looking to shore up support for his economic policies. And finally, aviation leaders saying flight schedules won't immediately bounce back after the government reopens, adding residual effects will be felt for days. The Transportation Secretary, Sean Duffy, offering no timeline for when flight restrictions might end.
You know, Sean Duffy has been the poster child of this entire shutdown over the past couple of weeks, at least trying to, articulate some of the concern and, frankly, some of the frustration that people feel. There was something like 10% of flights on Saturday that were canceled, and it really is isolated to a lot of the biggest airports. So you start to wonder, at what point are we looking at a disruption that can go into Thanksgiving? Right now, even if we were going to get a reopening today, it will take time. Think about the logistics. Think about pilots that have to get from one place to another. This is a logistical nightmare. Nonetheless, at some point, you can imagine things might get back to some speed.
I'll be watching a conversation you're having a little bit later. Ed Bastian of Delta catching up with Bramo around noon. About noon, 12:10?
Yeah, it'll be aired around noon.
Looking forward to that. What's going to be the focus of that conversation?
Well, I want to understand how big the parameters are for their fourth quarter and what the track rate really is, how much people are delaying some of the reservations for Thanksgiving, for the holiday period because of these disruptions, and whether this is truly an economic disruption that will lead them with a lower projection for the fourth quarter. But going forward, it also really is the perfect example of the bifurcation in the economy that we have seen. And what we have seen is that the wealthier, well-heeled travelers are doing just fine and are supporting the growth and the profitability of the likes of Delta. Is it a sustainable model, or does something have to give?
I've called it the Delta Airlines economy. It truly is. The man of the moment coming up a little bit later at noon Eastern time, catching up with Lisa. Look out for this. Ed Bastian, the Delta CEO. Let's turn to the consumer. Bank of America Institute's latest consumer checkpoint report showing a fifth consecutive month of spending increases, but noting consumers are spending more on retail but getting less, while possibly trading down in services. David Tinsley of the Bank of America Institute joins us now for more. David, welcome back to the programme. Always good to catch up. So we've seen this tension and stress with the lower income consumer for a while. Is it migrating up to other income groups?
Actually, there's not too many signs of that, to be honest. So we've got the kind of K-shape, if you like, in our data. Consumer spending, top third of the population by income, growing at 2.7% year on year in October. Bottom third down at 0.7% year on year. So we've got that, but the middle is in the middle. So if anything, slightly closer to the top. So that would be a concern, because obviously you can kind of run the economy with weakness at the low end, just because the kind of contribution to the overall consumption picture isn't great. Not talking obviously about all the socioeconomic implications of that. But if the middle went, that would be more concerning.
David, you track this, I know. What percentage of this country does live paycheck to paycheck across income groups? What does that look like at the moment?
Well, you know, we've just published on that this week, and we found around a quarter, give or take, of people live paycheck to paycheck. So literally, you know, in our definition, they have a very small margin of money left over at the end of the month after just spending on necessities. Now, the good news is that has risen a little bit between 25 and 24, but the increase is slowed down relative to the previous years. So it's not getting worse at an accelerating pace, but at the lower end, household income end, it's higher. It's about 27, 28% from memory.
David, one of the big mysteries going into the next month is really what holiday spending is going to look like, and how much the upper part of the income sphere can continue to support more broad economic activity that most retailers depend on for the entire year. I'm just wondering what the early signs are from your studies.
Well, the early signs are quite encouraging in the sense that our holiday spend tracker that, you know, just focuses in on categories that are particularly kind of seasonal, if you like. That's got a run rate of 5.7% year on year. I mean, the note of caution in that is that across this year, we see very little growth, if at all, in retail transactions, but we see an uptick in the money spent. So in other words, price increases, most obviously from tariffs, are, as John said in the intro, leading to people paying more but getting less.
I'm looking right now at this equation. So we're looking at spending growth at 5.7% year over year. Wage growth, however, for higher income is 3.7% year over year, 1% for lower income, the widest gap, tied with the lowest gap going back to 2016. Does this seem unsustainable in terms of how much the consumer is willing to absorb the higher prices? Or are you seeing a willingness to spend it and maybe just expand the credit balance that a lot of these households have, given the fact that they're coming from actually pretty well-adjusted levels?
Yeah, well, I guess there'll be some convergence. These Ks don't go on forever. There will be some convergence. So the big question is it, you know, in the middle, or is it towards the lower end? I guess if you're, you know, listening to Rick earlier and talking about the optimism around productivity, you know, if you're relatively bullish on things like productivity, then there's no reason to assume, in a sense, the economy should go where the labour market has gone, if you like, and sort of towards the lower end. Credit, pretty solid, really. You know, people have money in the bank relative to pre-pandemic still. There's a slight rise in people only making the minimum payment on their credit card. But again, that's not accelerating that rise. If anything, it's decelerating. So by and large, you know, there's sort of dry powder for holiday spending. And in aggregate, the K is concerning, but in aggregate, the pitch is quite solid.
David, how much are credit card owners still the representative sample that they used to be, based on the fact that an increasing proportion of people are using buy now, pay later, are using alternative sources of financing, and are kind of out of that credit card world?
You know, that is a great question. So certainly now, when we've looked at buy now, pay later, and we can look at people paying those debts off, I think last time we looked, the share of our households doing that was about 10%, certainly rising, but by no means everybody. And most people are quite light users of that, making only like 1 to 5 transactions a month. So I think it is something to watch, I think. And one of the reasons we exist at the Institute is to not just concentrate on credit card debt. We look at ACH, wires, all the other ways, P2P, all the other ways you could pay for spending. But it's a fair point. But I think right now, the card data still gives you a pretty decent steer.
David, always good to catch up. Thank you, sir. David Tinsley there of the Bank of America Institute. My takeaway from that is the K is concerning. The aggregate is okay. The aggregate is the Fed's position, right? That's where consensus kind of is, if there is one right now, which is that on aggregate, things are okay. The risks around it are problematic, but things are just about okay. The K is concerning, sure. The K is the problem for Washington, for the White House and for Congress, and that's what they've got to wrestle with into the midterms next year.
And the K will become a problem for markets because, as David Tinsley was just saying, the K will break at some point, and it's not just something that can go on forever. And the question is, which side is going to break to? The Fed's grappling with that right now. Washington, D.C. is grappling with the fallout of a lot of social issues that are hinging on this.
Given the sequence and arc of earnings season, the attention is going to turn to the consumer again next week. Next week, we'll hear from Walmart, we'll hear from Target. Big spotlight on what's happening with consumption in this country, in the absence, of course, of retail sales at the moment. Equity futures on the S&P positive by 1/3 of 1%. With an update on stories worldwide, let's cross over to Yahira for your morning brief. Hey, Yahira.
Hi, John. Federal Reserve Governor Michael Barr is calling for guardrails as the financial sector looks to adopt AI. Speaking in Singapore earlier, he warned that loosening those standards opens us up to too much risk, from market manipulation to collusion. Plus, he worries AI could be trained on skewed data that could introduce new biases into the financial system. Meanwhile, banks in China are asking clients to take out loans and then immediately repay them, with the bank covering the interest. The practice is spreading as banks come under pressure to hit government-set targets that can't be met by real demand. Regulators have vowed to prevent funds from circulating within the banking system instead of flowing to the real economy. And shares of On Holdings are jumping 8.6% after the Swiss sneaker maker boosted its sales and earnings forecasts for the year. The company also posting a better-than-expected third quarter in which consumers in Europe and Asia bought on high-priced footwear despite trade tariffs weighing on the sneaker industry. That's your Bloomberg Brief. John?
Yahira, thank you. I just want to pick up on that story again. That right there is the problem with central planning. Banks in China asking clients to take out loans and then immediately repay them, with the bank covering the interest. The practice spreading as banks come under pressure to hit government-set targets that can't be met by real demand. What a story from the team this morning.
This really goes to the heart of a question: how much can China transform its economy versus pay lip service to it and create sort of metrics that seem like that's the case, but still really relying on the consumption side of, not on the consumption side, on the production side of things and the overcapacity that they have.
Just to take a step back, I think it's just spot on. This White House, and I'd say this Treasury Secretary, wanted this country and this economy to rebalance away from exports. What have we seen over the last year? even with the tariffs, may be a record trade surplus for the year for China. Exports are going everywhere else. What did we want to see? We wanted to see China boost consumption. What are we seeing based on that example? Can't even make the loans. No one wants them. That's a problem.
You can't change the structure of an economy by mandating it from the top. This has to go to a lot of incentives, and China has been reluctant to give some of the checks to average citizens in the same kind of way that the United States and Europe did during the pandemic. It was maligned in terms of the inflationary boost, but it did create activity and it did create consumption, and that is part of the problem right now for China.
That's the latest on China. Up next on the program, powering the AI build-out.
Where is the real bottleneck in this whole, AI process? It's really at the gas turbines in the grid. The grid is copper, and gas turbines are steel.
Jeff Curry of Carlisle, fantastic yesterday. Full conversation up on YouTube and, of course, on Bloomberg.com. We'll continue that conversation. Up next, we'll catch up with Amy Gower of Morgan Stanley from New York City. You're watching Bloomberg TV.
Climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance. Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacqua in Sintra, Portugal, and this is Bloomberg.
Looking for a fourth day of gains on the S&P 500. The S&P this morning up by a third. Outperformance for big tech, and the Nasdaq up by 0.5. The tone of things out of the technology world is pretty good this morning. AMD talking up growth in the future. Hon Hai doing the same thing. We're up across the board here. Small caps higher by 0.4%. Under surveillance this morning, powering the AI build-out.
Where is the real bottleneck in this whole, AI process? It's really at the gas turbines in the grid. The grid is copper, and gas turbines are steel. So we have a lot of investment that needs to take place at that point in the supply chain before you can really begin to grow it. A lot of that CapEx spend that we're seeing, these $300-400 billion CapEx spends, a lot of that's going to go into the copper price and the commodity prices. That broader super cycle, we're witnessing it in metals.
So here's the latest this morning. The AI build-out fueling strong demand for industrial metals, adding to gains for the year. Amy Garrett of Morgan Stanley writing, elsewhere the battle for power is heating up. Electricity-intensive aluminum smelting is competing with rising AI power needs. Amy joins us now for more. Amy, welcome to the program. There was a hope that maybe these constraints wouldn't hit so soon. Are we already hitting them right now?
I think at the moment we are definitely seeing that particularly the electricity-intensive commodities are running into some supply issues. So at the moment in the US, for example, there's a 50% tariff to import aluminium, but this is still not really driving the restart of idled capacity. And I think part of the reason for that is that the companies are just struggling to get the power, either because of power availability or because of the price that they're being expected to pay. So the US Aluminium Association has said, ideally smelters want $30 to $40 per megawatt hour, but some of the AI and tech companies are paying $100 per megawatt hour. So it's just very, very difficult for these kind of industrial metals to compete with the price for electricity that is playing out right now. And so that's driving the aluminium price higher. We have what looks like very, very strong margins for smelters at the moment. And so far, that's not really showing any signs of abating.
Amy, you track some of these metals, other metals too, that are needed for this build-out and for this transition, including the likes of copper. Which commodities of the ones that you track have proven to have the lowest supply elasticity? How much longer will we have to grapple with maybe supply deficits into next year and beyond?
Yeah, look, I think a lot of the metals that we cover have quite low supply elasticity, particularly on a short-term time frame. Because if we think about investing in a mine, these investment cycles are just getting longer and longer. So it's not necessarily the time needed to construct a mine. That arguably hasn't changed very much. But the time needed for the permitting, the environmental approvals, the licenses, getting the local community on board, all of that is just stretching longer and longer. And so that's what processes like the Fast 41 program in the US are aiming to address, but this is not an overnight fix. So it's very, very difficult in the short term to bring supply on. Arguably, recycling is one that can adjust a little bit more quickly, so often prices go up, recycled supply comes to market. But there's challenges there too, particularly I would say you want free trade for recycling to work well. You need the places where there is excess scrap metal, you need that to be able to transport to where there's the processing capacity. And at the moment, with all these trade barriers and high cost of moving things around the world, that's also struggling. So it looks like both copper and aluminium, which are your key electricity conducting metals, it's actually quite difficult for supply to respond, at least on a sort of 12 to 24 month view.
Amy, I'm glad that you talked about the trade imbalances and some of what's going on geopolitically. I just wonder how much of a choke point China is over a lot of these metals, given the fact that not only do they produce a lot of them domestically, but they have their tentacles in different places, whether it's in South America or if it's in Africa, that are a lot of the suppliers of a lot of the raw materials.
Yeah, look, I think the growth that we've had in China's metals output over the last 10, 15 years has been extraordinary, and to the point where China is, I guess, increasingly self-sufficient, particularly if we look at something like aluminium. In copper, they are still a small net importer of refined copper, so arguably they're not quite there yet, but we are seeing the focus on securing that access to that upstream resource. So particularly in copper, you can build a smelter, anyone can build a smelter, but it's really getting access to that mined copper, and that's where China is focusing at the moment. And so I think that's where the West as well needs to be looking and making sure that projects are getting approved and we are moving forward to develop the resources that we have, which have so far been held up by long lead times, long environmental approval processes, etc.
To John's point about the elasticity and how quickly things can be brought online, and I'm wondering more domestically or nearshoring from that perspective, how much progress has there been made in terms of bringing some of the refining and other production capacities to the West over the past, say, year? Has it been a pretty exponential growth?
I would say actually so far we haven't seen a huge amount, and part of the challenge there is, if you take copper for example, to process a ton of copper concentrate into refined metal, smelters are actually having a negative margin for the most part. So what they get paid to process that copper is a negative number, and that's partly because of this overbuild of processing capacity around the world. So it's not that there isn't enough processing capacity, it's just it's all concentrated in a few places. So actually for then somebody to make that investment is quite tricky if the margin is negative to then say we're going to deploy capital here. So I think we haven't actually seen all that much progress yet. And then going back to aluminium smelters, you know, arguably there is quite a lot of idled capacity in Europe and in North America. In Europe, we are making some progress with some restarts in Germany and Spain, but we're not. There's still a lot that's idled, and the challenge is just getting that 5 or 10-year power contract at a reasonable price that companies can then use to run, you know, to make that restart decision for the next sort of 10, 15 years of their business planning.
Amy, for capital allocators right now, what's the best way of playing this story? Expressing this as a trade?
At the moment, we like aluminium. We think the combination of the China capacity cap, where China is no longer adding to supply, which has been a key challenge for the market for the last 15 years, is China over-adding capacity, combined with some supply outages, and then also probably a lower likelihood of restarts outside of China, is keeping the supply side very constrained. Against that, we've got a good demand backdrop. You know, the aluminium is the key substitute for copper, and so where there's price incentives, sometimes you can get switching. And we think as well the growth in Indonesia, which many are looking at as something that could derail the rally, we think that's not a problem for next year or probably even for the year after. That's something that's going to take a bit longer to build out.
Amy, thoughtful stuff, as always. Let's do it again soon. Amy Gower there of Morgan Stanley on aluminium.
Yeah.
I've been converted.
Oh, yeah?
Aluminum, you know, but it's nice to hear aluminium. Just every now and again.
I actually think it's pretty poetic. Aluminum. Actually, no, it's not. I just absolutely butchered it. I can't do it. It's aluminum. I mean, if you're growing up with something, it sort of sticks. You know, the point here about what China is doing is so crucial to these trades. I was thinking, okay, so much more is going to hinge on batteries, right? And even if the U.S. is really pushing back against some of the EVs, electric vehicle production, you still can imagine lithium would be a good spot. Lithium prices have absolutely cratered. Why? Because of overproduction in China. So it's such a complicated story, even if the overall theme seems pretty obvious of we need to build the infrastructure.
China seems to be at the epicenter of all of it.
100%.
Yeah, and that's the problem for this administration as they try and work out how to become less dependent on the China story. Coming up on the program, we'll catch up with Judy Beale of Kane Addison Rudnick, Jay Goldberg of Seaport Global, Sarah House of Wells Fargo, Ivy Zalman of Zalman Associates. We'll be having a conversation in the next hour on a 50-year mortgage and what it could mean for this housing market.
Will it lower prices? Will it actually juice some sort of housing market activity? Honestly, this has been the strangest area of the economy, and frankly, the most politically charged one, as so many people get locked out of the homeownership market.
If you're just joining us, welcome to the program. We're positive by a third of 1% on the S&P and looking for a fourth consecutive day of gains. The bond market reopens with lower bond yields. We're down by almost 5 basis points now across the belly of the curve. From New York City, the third hour of Bloomberg Surveillance, up next.
We are in such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety, and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. Mm-hmm. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
We have been experiencing one of the biggest and largest momentum markets that we have had since the late 90s.
I think we are in a little bit of a wait-and-see moment.
The volatility in the rotation that we're seeing among single names is healthy.
There's a chance we get a significant 5 to 10% pullback.
Looking into next year, we are more optimistic.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
So the gains continue, not a million miles away from all-time highs on the S&P 500. Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. And we add some weight to the rally with futures up by 1/3% on the S&P, up by 0.6 on the NASDAQ. In the bond market, we reopen with lower bond yields across the curve. 2's down by 4, 10's down by close to 5. We're down to 4.07%, going into a week full of Fed speak. Coming up later on today, Governor Waller, Governor Myron, New York Fed President John Williams as well. And look out for this at 10:45 a.m. Eastern Time. We'll hear from the Treasury Secretary, Scott Bessent.
Yeah, trying to understand exactly how to frame an economy that's in flux. We caught up with Rick Reeder just a bit ago here on Surveillance, and he was talking about the same thing that Mary Daly of the San Francisco Federal Reserve is talking about, a transformational change that's creating a real tension right now where you could get a productivity boom without the accompanying jobs. It creates a real quagmire both for the monetary policymakers as well as for the Treasury Department.
They've got a problem in the labor market, a problem that we need to address, a problem that we need to address fast. The question I would have is that the responsibility of monetary policy, the Federal Reserve, or the responsibility of Congress, the government, Washington, D.C.?
Yeah, and this ultimately will come down to probably both to some degree. Even if people say this isn't a monetary policy problem to fix, increasingly what you're hearing from potential policymakers and existing ones is you need to kind of run the economy a little hot in order to keep people employed at a time when they're becoming less relevant in a technological shift. And right now, the rates they control are more of the rates that actually are things that feed into consumption in the lower end of the economy rather than the overall stock market. Although a lot of concerns here, too, is stocks at pretty high valuations.
The jobs data is super relevant to the politics, without a doubt, and for the broader economy. There is no doubt about that. How relevant is it to the broader stock market when the forces that are driving the stock market right now are the very forces that are undermining the labor market, to some extent at least, over the last year?
If you look at what companies have said when a company announces layoffs, efficiencies, their stock rallies, because right now they can do more with less. And that's what we saw from Paramount Skydance, and that's what we saw from Amazon, and that's what we saw for UPS. And when you take a look at all of these efficiencies, you start wondering, is this a feature or a bug of the stock market rally that hinges on new technology and greater efficiency?
Can this decoupling persist? Or is that tension going to snap back things one way or the other? That's the story of the moment. That's where the tension is. Equity futures on the S&P up by 1/3%. Coming up this hour, we'll catch up with Judy Beal of Kane Addison Rudnick as stocks are edging higher. Jay Goldberg of Seaport Global on AMD's accelerating sales growth, and Ivy Zalman of Zalman & Associates as President Donald Trump's 50-year mortgage plan is losing steam. We begin this hour with stocks rising, the S&P 500 pushing for its 4th straight day of gains. Judy Beal of Kane Addison Rudnick writing, the setup for the first half of the year should be positive. I'm encouraged this earnings season to see estimates holding steady for year-end versus typical softening, and estimates look solid in 2026. Judy joins us now for more. Judy, welcome to the program. Let's talk about that earnings growth and your projection for the next 12 months or so. Where's that growth coming from and how broad-based is it?
I think you're seeing a broadening beyond the kind of core AI names. For sure, they'll be part of the story. We expect that, and that should continue. But I'd love to see more of a broadening in terms of industrial names that are seeing better productivity. And, you know, what we would love to see is healthcare really start to participate more. And I think I'm hopeful and optimistic that it's not broader just in terms of sectors, but market cap as well.
We'd love to see it too. Hopeful, optimistic, right there with you. Are there reasons to be hopeful and optimistic?
Yeah, I do think that a lot of what's happening in small cap is more favorable financing conditions, and that's enabling a lot more earnings growth. If they don't have the same level of interest burden that large cap has had, that helps them for sure. It also kind of helps loosen the conditions in terms of their businesses in the industrial sector, for example. Healthcare, to me, is more a function of what's going to happen with the FDA and the government, and can we clarify a little bit of, you know, where the CMS cuts are going to be. Looking forward, for me, what's in the Russell that's the most important is just seeing that the consumer can still hang on and hold in there. If we have a deterioration in the labor market, I don't think that's good for anyone, but I think that could particularly be problematic for the Russell.
Which really raises the issue, Julie, of the action that we're seeing today in markets. And I understand that one day is just one day, but we're seeing bonds rally on the heels of some less positive news coming out yesterday, less positive data, at the same time that you're seeing futures rally, in particular the Russell 2000. Does this work for you? Does this seem like a coherent picture, or is something amiss?
It's not a great picture, right? You know, for the most part, I try to be in the good news is good news camp because I think that's the more important factor. It's not great when what's driving, you know, what's happening in the Russell is just a function that interest rates are lower, and so non-earners, you know, can have a better valuation. What you want is that the fundamental growth, the earnings picture to be improving, not just interest rates are coming down, and so, you know, biotech businesses look better valuation-wise.
Heading into year-end, though, at this point, you just want to ride the rally, go into the most popular names, because it feels like the Santa Claus rally is gaining some steam and people are getting excited, sentiment following sentiment?
I think it's more important to make sure that as you come to year-end that you feel very good about the underlying quality of your business, because there are enough headwinds and heartaches that are in front of us. I don't think that it makes sense to just bandwagon on things that you don't have a lot of confidence in. So, you know, there are parts of the AI trade that are lower quality, and they're really, really dependent on AI continuing at this feverish pace. Those are the names that I would avoid, the kind of tangential, connected names. The ones that are the core winners, you know, look, if AI goes away tomorrow, Google still has a monopoly on search. They're still fine. That's what I think is important, is that your business model really matters.
Judy, next week we'll talk about the business model of the retailers. So Target a week today, a week tomorrow, we'll hear from Walmart. What are you expecting to hear from these retailers?
I think Target, for the most important thing for Target is kind of the level of execution that they've had has been pretty poor. And so any indication on have they got their act together a little more is helpful. Walmart, I'm really curious about this lower income consumer. Part of what I'm worried about is that we've seen this immigration outflow that's pretty meaningful. And so is it a function of their low income consumers stressed and spending less, or are there just fewer of them walking in the door? That's a really important component in terms of understanding what's happening in the labor market, because immigration has both boosted and hurt us in the most recent 3 or 4 or 5 years. So I'm really curious about that. And then what is going to be the setup for holiday? How are people thinking about pricing? Because of tariffs, I have this sensation that maybe we're going to see less discounting. And how does that impact pricing and feels about that?
So, Julie, what we've seen from the restaurant business and what we've heard from fast casual is they're struggling to put up prices. They're getting pushback from the consumer. Is a retailing world a different world, or do they have to experience the same themes?
I think it completely depends on the merchandise that you have. If you are differentiated and your consumer is doing pretty well, then you're fine. But I think what the real question is going to be is, now that we have inventory that has been tariffed, right? We had been benefiting from people buying ahead earlier in the year, but now most of the inventory that's going to be in the stores is going to have tariffs on it. It's a question now to the retailers and to the manufacturers themselves is, what is your acceptable level of profitability? Are you going to try to pass on price maybe early on in the holiday season? And then if there is a weakness in demand, do you start to discount aggressively?
Julie, how much can you extrapolate a macro trend from these specific company reports? The idea that if some of these companies are able to pass along price increases, that makes you think, okay, maybe inflation can run a little bit hotter and I should do something with my overweight duration.
I think it's a function of mosaicing in terms of all of the information, right? What you're trying to do is put together a really cohesive picture. And often what ends up happening is that the idiosyncratic things of a certain retailer will actually kind of throw you off. It's not that, Target is the customer that Target is serving is actually doing that badly. It's just that their execution is poor, for example. Or it's not that certain retailers like, say, a Lululemon are really struggling to get product that people care about means that their consumer is weak. So it's not that you want to be overly dependent on a single comment, but just like we were talking about with the restaurants, they're having trouble being able to push price. You're able to draw certain conclusions about certain segments of the income population and then make a decision about where you think the health really is.
Based on the fact that some of these specific companies can be noise in terms of the overall macro signal, how much of a liability is it for you that we haven't gotten the government data that a lot of people rely on, that we might never get some of the data points?
Yeah, I think that is probably the hardest point right now, is that the quality of the data was already not excellent, right? We can kind of all agree about that. But not having it at all makes it really, really difficult. And some of the newer data series that we're getting, like Challenger, they haven't really been tested in terms of getting a strong sense that there's a lot of signal to be gained. And so not having the economic data and the jobs data in particular most recently, to me, that makes me pretty uncomfortable because I don't think we're going to really have it. I think we're just going to be looking forward with data, and hopefully that gives us some indication. But we basically have this air pocket where we don't really know what's happening in the economy, and we have fears in terms of all of these layoff notices that we've been getting.
Julie Bill of Kane Anderson Rudnick. Julie, thank you. Referring, of course, to the Challenger job cuts of the last week, which I might have described as Tier 3 or T4 data. And I got this message from a Bloomberg subscriber who said NFP was revised down by something like 1 million jobs in the last year or so. Which data is Tier 4? Exactly.
This is the point that a lot of people have been talking about, which is non-farm payrolls is highly imperfect and often is revised in a significant way. And yet, without it, life is so lonely. It doesn't have the cadence.
What, Fridays? I'm with you. The rhythm and the cadence of financial markets, that first Friday of the month, you get payrolls data. It just sets the foundation for the conversation for the month ahead, and then in about 12 months' time, everything gets revised, and those conversations were maybe misplaced.
Look, the data...
That's the cadence, right?
That's the cadence, and at least we can play into the cadence, and right now, without it, people are getting sort of whizzed around when it comes to Challenger job cuts or ADP weekly data that doesn't have a long historical series that really it relies upon. So you start looking at these data points, and you start wondering, is this introducing more volatility than it's worth into the market?
Certainly putting more emphasis on things that we wouldn't traditionally put emphasis on. Equities this morning positive by, let's call it 0.3% on the S&P 500, higher by 0.37. Let's give an update on news worldwide with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. The U.S. House of Representatives is gearing up for a vote to end the longest shutdown in U.S. history. The short-term funding bill was reached after senators agreed to compromise on a plan that will fund the government through the end of January. The measure would reinstate federal workers fired during the shutdown and guarantee back pay for furloughed employees. Meanwhile, supporters for UK's Prime Minister Keir Starmer have privately accused Health Secretary Wes Streeting of plotting a leadership challenge against Starmer. Streeting has dismissed the allegations as not true and repeatedly reaffirmed his support for the Prime Minister in an interview. The reports come just weeks before the government is due to unveil a contentious budget. And aviation leaders saying flight schedules won't immediately bounce back after the government reopens, adding that residual effects will be felt for days. And Transportation Secretary Sean Duffy is offering no timeline of when flight restrictions might end. Tune in later at 12:10 p.m. Eastern for Lisa's interview with Delta Airlines CEO Ed Bastian here on Bloomberg TV. That's your Bloomberg Brief. John?
Yahara, thank you. Looking forward to it. Ed Bastian of Delta coming up on the program later on this afternoon. I asked this question yesterday. Outside of Delta and maybe United Airlines, what is left of this industry right now? They are in a world of pain.
And when you take a look at the likes of Delta, how much of their revenue and profits come from the premium cabin, as well as loyalty, it is an increasing proportion of their overall profitability. How far can we push that? How far can we see that go where suddenly the bulk of the plane is premium and the capacity in the back is smaller and really all the profitability comes from there? Is this the model or is this going to hit some sort of stopping point?
Don't miss that conversation at about 12:10 Eastern Time later on this afternoon. Lisa catching up with Ed Bastian of Delta Airlines. Up next on the program, the morning calls plus AMD rising on expected sales growth. That stock is higher by more than 6% this morning. Live from New York City, good morning.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
In terms of this new infrastructure build-out, the demand exceeds the supply. For the next 3 years, the demand is so strong, actually, you're being underwritten by very, very high-quality borrowers. Today, these hyperscalers they're a better credit rating than France.
That was Hugh Van Steenis of Oliver Wyman. The capital needs for the AI build-out are absolutely massive, and they're growing day by day. Equity futures on the S&P 500 this morning, positive by 0.4%, up by 0.6 on the NASDAQ. Thank you, AMD. Let's get you some morning calls with that one stock in focus. First up, Wells Fargo raising its price target on the stock to $345, citing its stronger than expected financial framework. Next up, Mizuho raising its price target on AMD to $285, forecasting sales growth through 2030. And finally, Evercore raising its price target on the stock to $283, citing optimism around its ramp and share gain. That stock, Lisa, up by 6%.
Again, I can't get over the dissonance between today and a week ago after they reported earnings and people came out and said, it was good, but not good enough. And, you know, this could be a bubble, the B word, right? And so there's this question of what's changed from then to now? This has been a stock that's been absolutely outperforming so far this year. It also has shown that it is outperforming on the underlying fundamental backdrop. Last week, it wasn't good enough. This week, it looks pretty good.
This morning, it's driving this stock higher. The CEO, Lisa Su, expecting accelerating sales growth on strong demand for data centers. Joining us now is Mandeep Singh of Bloomberg Intelligence. Mandeep, good morning, sir. Big move for that name. What's behind it?
Well, I think what they did yesterday was to give specific targets in terms of what the growth trajectory may look like through 2030. That wasn't the case when they reported their quarter. And look, I think the thesis here is a lot of the existing systems are going to be rewritten with a GPU or an accelerator framework in mind. And, you know, you can talk about the new AI applications that will come to the scene, and some of them have, you know, including ChatGPT and Cursor and whatnot. But rewriting existing systems with GPUs or accelerators, that is the type of driver that will take this market to $1 trillion by 2030. And AMD's prior forecast was $500 billion. So clearly they see something on the horizon in terms of what's going to carry the demand, you know, through 2030.
Mandeep, can we talk about the source of that demand? How much of this hinges on the spending commitments of one company, say OpenAI, going forward from here?
Well, so look, I think there are a lot of questions to AMD around that 6 gigawatt, you know, contract with OpenAI. Doesn't have a strong balance sheet like the other hyperscalers. But in the end, if compute is needed for all the existing applications that we run, then, you know, you can finance it, whether the hyperscalers raise debt or, you know, there are other entities that come to, you know, support this build out. So it goes back to the sustainability of demand. And, you know, you don't want to risk it to training the next version of ChatGPT's model. But you are willing to, you know, invest if you know it's going to be used in existing applications. And I think that's the big difference, is you're not pinning your hopes on these models constantly improving by, you know, scaling laws or something like that. And I think that is what has changed in the past 6 months.
Mandeep, AMD is pretty interesting because it sits somewhere between NVIDIA and Intel. This idea of the hyperscaler GPUs versus what we use in our computers and some of our day-to-day electronics that people have known. Is AMD eating Intel's lunch with the profits that it's getting from the GPU land?
So clearly, they talked about how this GPU wave and the accelerator demand is also going to drive the traditional CPU compute. I mean, think about, you know, an existing workload right now uses a certain level of compute resources. It's going to 5x or 10x in the age of AI, and that applies across any type of workload. So from that perspective, what they're saying is they have the best CPU right now, better than Intel, and they will gain share when it comes to both the CPU market as well as taking some share from an NVIDIA or some of the accelerators that are out there. But their value proposition is offering all types of compute for workloads that are being deployed at enterprises.
I guess another way to frame this, Mandeep, is are there going to be winner-take-all types of dynamics in the chip space, just based on what kind of scale you need to really execute and compete in this space right now? Is it going to be AMD and NVIDIA at the top and everyone else a two-bit player?
I mean, I wouldn't take out Google TPUs. So one of the things we have seen this year is, yes, NVIDIA has done very well, but also Google is looking to commercialize their TPUs outside of their own workloads. And so from that perspective, the hyperscale threat is always there for, you know, NVIDIA, AMD, and Broadcom, because these guys are doing a lot of things in-house. But with that being said, you know, what NVIDIA has shown is they have a clear path to $500 billion in data center revenue, and that's not changing anytime soon, even though competition is there. And like I said, Google TPUs is doing well, but this market is large enough that, you know, all these companies can still do well.
Mandeep, did you see some of the conversation with Brad Gerstner of Altimeter, with Sam Altman and Satya Nadella? You're nodding along, so I assume you did. Mandeep,
yeah, I did.
There was a moment in that was kind of uncomfortable. Brad asked a really straightforward question and a very fair question. He talked about the level of revenue right now, and compared it to the spending commitments they had several years out and asked for an explanation. And Sam Altman became really defensive about it and essentially turned around to Brad and said, if you want to sell the stock, there'll be someone else that can buy it. Mandeep, I didn't think that was a very good response at all. What was your impression from Sam Altman's reaction to a very straightforward question?
I think no doubt there is an acknowledgement that 1.4 trillion spend is a big number, especially when you are at a run rate of $13 billion in ARR. Yes, you talk about, $100 billion in ARR over the next 2 years, and you're the fastest growing company. But still, there's no doubt that, it all hinges on execution. And for the private market to underwrite a lot of debt related to that. I mean, there is a lot of execution-driven hope that, you're pinning on OpenAI being the leader and the hyperscalers not being able to catch up. I mean, what Google has shown this year is not only has Gemini gotten better, but they have a play with the vertical integration with the chips that they have, the TPUs. And from that perspective, you can't just be assured that OpenAI will be the leader throughout this 5 years. And so from that perspective, I think it's a fair question to ask. And look, I think Sam Altman is confident that the model will remain the leader when it comes to the frontier models. I mean, Chinese models are open source. So from that perspective, you could question the unit economics. And that's where the biggest question mark is around OpenAI, is the unit economics. Will it be a profitable endeavor when it turns to be a $100 billion run rate company? And I think right now it's all upfront spending. So that's why I think it's a fair question to be asked.
Mandy, what are the cash needs of that company at the moment? I've seen estimates that it's close to like $500 billion valuations in the private market. Do you anticipate they will be going public soon?
Well, they are changing that nonprofit structure, and I think with the revised structure, there is a chance that they will go to the public markets as well. With that being said, there's no doubt that this is not, an 80% gross margin business. This is more of a 40 to 50% gross margin business, even at, scale that they are talking about. So the fact that you need a lot more compute for running your software just goes to show that, software gross margins are not the same as they used to be. And so from that perspective, you have to account for the lower gross margins of companies and higher spend on the chip makers, which is what we are seeing in the valuations of NVIDIA, Broadcom, and all the other peer group.
Mandeep Singh of Bloomberg Intelligence. Mandeep, thank you, sir. Enjoyed this. Appreciate it. Thank you very much. If you haven't seen that conversation with Brad and Satya and Sam, not my friends, I should use their full names, you should watch it. It's actually a really, really interesting, revealing conversation.
Two ways to interpret it. On one hand, he's got something to hide, and he's frustrated, and he's pushing back. Another way is he gets so much pushback about the spending plans and the profitability questions around OpenAI that he's exhausted, and that he's just frustrated with it, and he's just saying, if you don't believe in my story, then short my shares once they go public or try to, get out. And that's, I guess, the real story of the market right now.
It just felt a bit awkward. Let's put it that way. Equity futures on the S&P 500, positive by 1/3%. The opening bell about an hour away, and tech is doing better than good so far this morning, driven by the latest news out of AMD. Up next, we'll catch up with Sarah House of Wells Fargo, with Wall Street hoping for official data to get back to work, and Danny has some morning movers for you. On holdings, up by 8%.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Caroline Connon in Paris, and this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
So first come the tax refunds and then comes the tariff relief. The Treasury Secretary, Scott Bessent, speaking right now and saying that we'll be talking about substantial tax refunds coming in early 2026 and saying this on tariff relief. We're going to unveil tariff relief on coffee and other items. Bananas and other fruits also set for tariff relief. Affordability is the dominant word down in Washington, D.C. right now, and it looks like based on those comments, the Treasury Secretary is responding to them.
If people see their coffee prices go back down, how much does that affect their feeling about cost of living and just how much prices are going up? Talking about how they are going to respond to a spotlight that has been shown on the fact that people are worried about inflation, that they're worried about the absolute cost of everyday goods. Can you selectively take tariffs off certain items? Say coffee in the morning, say your eggs that you have for breakfast, while still keeping them on in certain areas.
You can't hide from that. People experience those goods every single day. It's what UBS has talked about. The frequency bias. You have a coffee every single morning. You see the price of that go up, that's going to shape your view on the economy and on inflation, regardless of what inflation is elsewhere. And this is the problem with the gaslighting of the previous administration when they were telling people there wasn't a problem and they could experience a problem. That is the issue right here. Don't fall into that trap. That's the mistake of the Biden administration. Don't fall into that trap. Listen to what people are saying. They're saying they're struggling. They're saying there's an affordability problem. You've got to respond to it. Otherwise, you will get crushed.
Yeah, well, President Trump has been saying that actually prices will go back down, and how much is this sort of a push to do that, and saying things are actually pretty good. How do you have things are pretty good and you get a $2,000 rebate? I mean, there are a lot of questions that you have in terms of coherency of message right now, but nonetheless, what really is the main driver right now is cost of living is going to cause policies to shift, and that is what we're seeing in Washington, D.C.
On that $2,000 rebate, this headline just crossing, the president talking about a $2,000 rebate for families earning under $100,000. The president alluded to that over the weekend. It feels like this is moving forward, like this might actually turn into real policy.
I'd like to see exactly how that factors into the tax policy that's already planned and what that does in terms of the budgeting around some of what has already been proposed and what exists, because that is going to be the focus of the bond market.
We'll come back to some of these comments in just a moment. Just to take the temperature of the equity market, doing okay, up by 1/3 of 1% on the S&P, on the NASDAQ up by 0.6, with some single names, some morning movers. Let's cross over to Danny for more. Hey, Danny.
Hey, John. Can't keep some of these cloud and AI names down for too long. CoreWeave on the back of a very bad day yesterday, where it fell 16%, is up 3% in the pre-market, so not making up for the entirety of losses. But still, we are seeing dip buying. It comes after CoreWeave gave earnings, where their revenue outlook disappointed, and it's lost 1/3 of its value this month, so a very tough run for CoreWeave. Octo, the nuclear energy company, reporting earnings this morning, a boost to their cash and cash equivalents. That's seen as a positive, alongside the fact that they are focusing more on Department of Energy contracts. Dan Ives of Wedbush saying that they are powering the nuclear revolution in the U.S., so those shares up just under 3% this morning. Finally, on one of the other earnings we had this morning, a huge rally this morning, up 11%, a beat and a raise on their behalf. The strongest regions were Asia and Europe, but you did see some growth in North America, a little bit less than expected. But they pointed out, despite the fact that they raised prices in July, the tariffs were a big concern. People are still willing to buy what is the most expensive running sneaker on the market, John.
Stock is up by almost 12%. Danny, thank you. Looking forward to the program. Danny Berger, Matt Miller, taking over in about 27 minutes' time to guide you into the opening bout. Let's turn to the economy. U.S. Secretary, Treasury Scott Bessent, set to speak at the New York Fed later on today. Bloomberg's Mike McKee joins us now for more. Mike, good morning, sir. Some comments already from the Treasury Secretary just moments ago.
Yeah, there are two Scott Bessents. There's the Scott Bessent who has the Treasury Department responsibilities, and then there's the one who has to defend the Trump administration on all sorts of weird topics like coffee and banana tariffs. Remember, the tariffs were supposed to be put on things that we make in America that are being brought in, so we'd make more, but we don't make any coffee or bananas. So I'm not sure how great a job that means the administration is doing. But the nerd version of Scott Bessent will be at the Treasury Department today. It's an annual conference that the New York Fed puts on talking about the plumbing, the functions of the Treasury market. And they'll be looking at things like the resiliency of the market, what's going to happen now that the Fed is ending QE and asking banks to use the standing open market, the repo facility on a regular basis, that sort of thing. I don't think we're going to get a political speech from Bessent at this meeting, although he might talk some about the president's fiscal policies and what they might mean for debt for the U.S. And there are other issues that the Treasury Department has, including what they're going to do about buybacks. Are they going to buy more debt back than they have? And where are they going to issue along the Treasury curve going forward now that the Fed is not the buyer of last resort?
Mike, are we seeing some acknowledgement, though, this morning from the Treasury Secretary that people are struggling and they need to adjust? We're talking about tariff relief, tax rebates. That's something new in the last few weeks.
Yeah, it is new because the Democrats did very well running on those issues in the off-year election, call it. And the administration seems to have pivoted very quickly to try to grab that issue back. And you're going to hear a lot from all of the members of the administration who are talking about this. And Bessent is one of those who is on television a lot. So he's going to be pushing those issues. But of course, he doesn't have anything to do with tariffs. And the idea of the dividends, we don't exactly know what that means. So I suppose he'll get asked about that a lot as well.
Mike, thank you, sir. Looking forward to your coverage. Mike McKee of Bloomberg. This is what Jared Seaberg of TD Cowen said last week, and I keep going back to this quote, and I keep giving Jared a shout-out. We expect Democrats will make the economy the key message heading into the midterm election. The president may respond by embracing populist policies, including some he raised during the campaign. There's a slow turn emerging here down in Washington.
Yeah, including checks, $2,000 checks to people who earn under $100,000. This is going to raise a question around the economic profile of the first quarter. If people do get checks, these are people who are predisposed to spend more of that money, which will find its way more quickly into the economy. And it also raises questions longer term, what kind of policies are actually going to get through?
Here's the view of Sarah House of Wells Fargo, writing, the absence of broad-based layoffs suggests the jobs market is holding together, even if the risk of a more meaningful slowdown cannot be ruled out. Sarah joins us now for more. Sarah, welcome to the show. Just to pick up on those headlines from the Treasury Secretary, if we start seeing $2,000 tax rebates, if we see significant relief early next year, how would that change your outlook?
Yeah, so I think already we're looking for a pickup next year just because you have some pretty favorable tax policy coming out where consumers are going to get pretty big refunds come the early part of the year. And so if you add $2,000 rebate checks on top of that, I think you would get a meaningful pickup in spending through the first few months of the year that could help, I think, balance out, I think, more of the components of GDP that we're seeing, where maybe it's at least temporarily a broader based increase increase in overall consumption rather than one that's being driven more by your asset owning higher income households.
Sarah, we saw a taste of this, and I know it's not the same thing, but during the pandemic era checks that people got, and a lot of people attribute the inflation that we saw in the pandemic era to some of those particular checks. Do you think that there'll be a similar dynamic, or do you think these are too small and not regular enough to have that kind of transmission mechanism?
Well, I think there are a couple important differences there. So yes, if you're injecting cash directly into households, especially your lower income households, they're going to go and turn around and spend that. But there's other sides of this that are different. So you don't have the same degree of supply constraints. You don't have, I think, the labor supply issues that we had at that time, where it wasn't just the increase in demand that I think led to the pandemic era inflation, but it was some pretty unique supply factors. So I think overall, rebate checks, even the larger tax refunds that we're expecting, I think that's going to make it harder for inflation to continue to grind lower. But I don't think that it would be something that would necessarily respark a sustained pickup in inflation again. I think it would just more derail the path, or at least slow the path of disinflation that's set for the second half of next year.
Sarah, the implication here is faster growth and potentially an expanded fiscal deficit in order to finance a lot of the programs that are being proposed, likely will be proposed heading into the midterms, not just by one party, frankly, both parties talking about similar types of responses. How are you factoring that into your economic outlook at a time where there already have been some concerns raised about the U.S. fiscal trajectory?
Right. So I think, again, if we're talking about one-off checks, this is only a temporary boost. So this is not something that's going to be fundamentally sustaining the outlook for the consumer. And to the extent that it does increase the deficit, then you're going to be seeing some of that feedback into yields, which is also going to flow through to other things, so potentially mortgage rates. And so it's not a panacea for, I think, really reviving the sluggish pace of growth that we think we're hitting here in the fourth quarter, maybe in some of the early parts of the first quarter, given that there are going to be some feedback sides of this in terms of what happens with borrowing costs.
Sarah, what should anchor our view of the labour market right now? I think that's the question of the year for the labour market. Employment growth is super low. But the unemployment rate is also low as well. Do you think the employment growth maybe overstates the weakness, or does the unemployment rate overstate the strength?
Yeah, so I think the hiring rate, I think it does overstate the weakness, given that some of this is supply. But I think we can't chalk it all up to the immigration story, for example, or just the ongoing population aging, where we are seeing demand continue to weaken. So look at Indeed postings, look at the PMIs, whether it's the ISMs or the Fed, still showing employment in contraction territory. And so I think there still is a demand problem here. And I think even if that break-even rate is lower, that still portends something for what's happening with household income and therefore spending power. But when we step back and I think at that main point that we need to keep in mind, it is where we are in terms of that overall balance. That's what the Fed is looking at. And I think there we are seeing some softening, but not in a material or quick way. So it's just this gradual ongoing softening that's keeping the Fed on edge, but not definitive in terms of the labor market really being in trouble here.
Sarah, what is your best guess for the Federal Reserve on December 10th?
So we still have that they'll cut another 25 basis points. So obviously that's a close call where it doesn't look like we're going to get even the November data that we usually would have had with the shutdown ending. I think the CPI, we're not going to have that for November. It's going to be a close call of whether you get November employment. But I think the overall position of, look, we need to move closer to neutral. Inflation, yes, it's being temporarily held up by tariffs, but you're not seeing that spill over into services. Path there is still low. I think that still supports the argument of moving towards neutral. And I think when you look at the voter composition too, that some of the more outspoken hawks are the people who have come out and said, look, I'm having trouble supporting another cut. They're not voters. So I think when push comes to shove, we'll get that additional 25 basis point cuts in December.
A few of them will be voters next year, so we'll see what happens for next year. Sarah, thank you. Sarah House of Wells Fargo setting up December. So we probably won't have CPI, and it'll be a close call if we get November payrolls. That's what Sarah just said just then.
Yeah, and frankly, we just got a note from Andrew Hollenhorst over at Citigroup saying that we could get the September jobs report maybe in the next few days. The October jobs report might be delayed until early December. So then, you know, imagine that you're not going to get the November report on time either. Think about people getting back to work, being asked to work overtime and there are 30% fewer people in those offices, it's going to be kind of messy down there.
Yeah, we go from flying blind to driving with the rearview mirror.
Exactly.
It's going to be fun, isn't it?
Well, it's, foggy driving. This sounds like a nightmare. God.
Yeah, December 10th is going to be an interesting one. Plus, they've got to put out some projections as well, some guesses about the future. So that'll be fun for them and everyone on the FOMC. Let's get you an update on stories worldwide with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, John. Treasury Secretary Scott Bessent saying just moments ago to expect substantial news on President Trump's sweeping tariffs in the coming days. He said the administration is planning tariff relief on coffee, bananas, and other fruits. He also said the president is considering a $2,000 tariff rebate for American families making less than $100,000. Meanwhile, Citi is selling its banking operations inside Russia to investment bank Renaissance Capital after an order from President Vladimir Putin. Citigroup announced back in 2022 that it would wind down its consumer and commercial banking operations in Russia following the invasion of Ukraine. The Russian government confirmed the sale, but offered no other details. And Wall Street's elite are heading to the White House for a dinner with President Trump later this evening. JP Morgan's Jamie Dimon, NASDAQ's Adina Friedman, and Goldman Sachs' David Solomon will be among those attending. The dinner comes as Trump faces rising pressure on the economy and affordability, testing his relationship with business leaders. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Thanks for this morning. Up next on the program, we'll set you up for the day ahead. Plus, we'll catch up with Ivy Zalman of Zalman and Associates as President Donald Trump's 50-year mortgage plan is losing steam.
Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal. With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzone.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
housing today is 3/4 of the wealth. If you actually get the mortgage rate down a bit, then what happens is all of a sudden you get housing velocity. Why is housing velocity important? Because you get labor mobility. For every home built in this country, we hire 3.1 people. It's pretty hard to AI building a house. So if you can get some real estate velocity, and by the way, it's why young people who are struggling today, young people who aren't savers, who are borrowers, that's the way they build wealth. That's the way you put people to work.
Rick Reeder of BlackRock weighing in on the housing market a little bit earlier on this morning on Bloomberg Surveillance. Sticking with housing, the president has got a 50-year mortgage plan and is struggling to gain traction in the industry. Ivy Zalman of Zalman, a Walker and Dunlop company, writing, while pushing for better affordability is a good fight to fight, the likelihood of a policy moving the needle on home buyer affordability in a tangible way is quite low in our view. Ivy joins us now for more. Ivy, welcome to the program. You've experienced it all in housing. What was your reaction to the prospect of a 50-year mortgage?
Well, it's good to see the administration is trying to help, today's prospective buyers by improving affordability. But I think we have a lot of impediments with a 50-year mortgage. To begin with, while the monthly payment, if you just took the same mortgage rate, same home price, would actually go down, the problem is by adding 2 more decades, investors that would have to purchase those loans would require a higher rate. Our mortgage contacts that we survey think that rate would probably be close to 35 to 50 basis points higher than the 30-year fixed mortgage rate, therefore sort of wiping out the benefit, but not entirely, but most of that benefit. But even more importantly, right now, because of Dodd-Frank that was passed in 2014, Fannie and Freddie, who purchase more than half of the loans that are originated in this country, cannot purchase a loan that has a duration longer than 30 years. So we would need congressional approval to have that to come to fruition. And lastly, I think that today's consumer, while entry-level buyers think about monthly payment, so any reduction is helpful, it is the long-term how to build wealth, because people really don't save. So by owning a home and long-term equity appreciation is a way to create wealth. By having a 50-year mortgage, you're definitely going to create a lot less equity over time or have equity appreciation. So I think those are some of the concerns that we have. And I think that right now the industry has poo-pooed it enough that it's losing steam with the administration.
Ivy, what do you think the solution is? I'm sure there's not a magic wand, but what would you implement? What would the remedy be?
Well, I think housing, it's rather complex than just looking at one variable to assume that that would help ignite more activity. I think the builders are doing everything they can to provide more affordable housing, predominantly using mortgage rate buydowns, which has been a very successful strategy to keep velocity or growth growing, despite rates and affordability being at the worst levels in 40 years. But really the impediments for more housing, mortgage rates have to come down, or incomes have to rise more, or you have to have home prices come down. So it's really not a magic one variable solution. We do think most of the impediments for building more at more affordable prices come at the local market level.
Ivy, do you think that if interest rates were to go lower and mortgage rates were to follow suit, that it would cause housing prices to go up or go down because it would allow people to move who have been locked in their homes?
I think mortgage rates going down would actually help. I don't know about how much a home price appreciation we would get. I do think that right now consumers are locked in at much lower rates than prevailing rates. We looked at really what would affordability, where would we get back to trend line? And mortgage rates would have to fall to roughly 4.5%. So quite a ways from where we are today to just get back to sort of a median level of affordability.
Ivy, have you done any studies that show how many people own homes who want to move but can't or don't want to because simply mortgage rates are too high and they don't have other options?
We haven't done a study to that, but I can point out that more than 70% of homeowners have a mortgage rate that is lower than 5% that hold a mortgage, and roughly half have a mortgage rate below 4.5%. So there's quite a bit of stickiness. And in many markets in the country, inventory has risen in the southern part of the country, mostly Texas, Florida. So there's more choices. But then the challenge is that consumers are worried that they're buying at the top. Whereas in some markets like in the Midwest and Northeast, inventories are still very tight. So when people are trying to move, they're like, where am I supposed to go? There's not product on the market. So we have a bit of a tale of two geographies, as well as a tale of two price points, where the high end is doing pretty well and the entry level is still really challenged.
Ivy, this is really a conundrum because at the same time that everyone's saying we need more supply, when you hear from home builders, their sentiment is terrible. They can't seem to feel motivated to go out there and build. So what will motivate them to want to build given the fact that there seems to be plenty of demand to buy homes and it seems like there's insufficient supply?
Well, I might beg to differ there because overall today for the new construction market that accounts for about 15% of transactions, there is a very high level of speculative inventory on the market. In fact, it's near 2009 peak levels. So I think there's plenty of inventory and builders are very motivated to sell homes. They do not want to sit on finished lots given very high carry cost, overall cost of sitting on lots. So they want to go vertical. The challenges are they have impediments from local governments that require many, many factors that keep them from being able to go vertical. So I can go through those, but the reality is that we need governors to pressure local markets to reduce those impediments, and then builders will be able to go vertical. So just one example is just getting a permit. Getting a permit or getting entitlements could take weeks or months in some markets. So it's really not the builders. The onus is on the local markets.
Ivy, well said. A great framing. It's good to see you. Thanks for being here. Ivy Zalman there of Zalman and Associates. Affordability is the center of every single debate right now in this economy, and we'll have that conversation later on today. Delta Airlines CEO Ed Bastian catching up with Bloomberg TV and our very own Bramo at 12:10 Eastern Time. Don't miss that conversation. I've said this is the Delta Airlines economy. Half the country thinks it's Group 1. The other half is struggling to afford to pay the ticket to get in the main cabin.
Yeah, there are two parts of this conversation. On one hand, the government shutdown, just how quickly will it take for everything to get back to normal? Will we have our Thanksgiving holidays with our families? But then there is this question around the K-shaped economy and the fact that 60% of their revenue comes from the premium and loyalty aspects of their job. This highlights why they have been so successful, why they are the preeminent airline. And it goes to the question, how far can this go? Is this something that just structurally is the new reality that a lot of different companies are facing?
Are you Diamond Medallion? That's all anyone wants to know, Bramo.
I'm actually not.
Diamond Medallion.
I'm here. How can I be Diamond? Where am I flying to?
Got to do a lot of flying to make it Diamond Medallion. Right?
I think that you'd have to do a lot of flying. I think I'd rather spend time with my family.
That's the highest status at Delta.
Yeah, there's Diamond, and then there's sort of like the mystery categories.
Oh, okay, there's one above that.
I'm sure that you don't even know how you can get it, where it comes from, but things happen to you. I do get a handwritten note, though.
Oh, do you? They write something for you?
The flight attendant will say, thank you for flying, et cetera. There is this feeling that, loyalty really is the way to capture people and lock them in.
Looking forward to the conversation later on today. Logged in, 12:10 Eastern Time with Ed Bastian of Delta Airlines. Tomorrow, here's the lineup for you. Keith Lerner of Truist, Eric Johnson of Cantor Fitzgerald, Kevin Gordon of Charles Schwab, plus Tiffany Wilding of PIMCO. From New York City this morning, good morning to you all. Have a wonderful day ahead. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Day 3 at the NITO ATP Finals. Carlos Alcaraz remains unbeaten after a thrilling 3-set win over Taylor Fritz. The top seed fought back from a set down against the American, closing it out 6-3 in the third. Later, Lorenzo Musetti wowed the home fans in Turin with his first win of the tournament. The Italian closing out a dramatic victory, 7-5 in the decider over Alex de Minaur.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
The key issue right now for us in the diamond space is the declared divestment of Anglo from GBS. And as you know, Anglo holds 85% stake in GBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in GBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
More optimism to kick off the session 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Danny Berger. Bloomberg Open Interest starts right now.
AI front and center with AMD predicting accelerating sales growth driven by strong data center demand.
President Trump prepares to host a dinner with Wall Street executive heavyweights, including Jamie Dimon, David Solomon, and Larry Fink.
Plus, as the shutdown nears, economic warning signs emerge. More Americans are falling behind on car payments than ever before. Growing anxiety about jobs doesn't help.
Yeah, we'll have more about that story at the end of the hour. For now, Matt, though, the everything rallying but tech trend yesterday is reversing this morning. Some of the tech names doing well, AMD among them, up 6.2%. The CEO, Lisa Su, said that revenue growth will surge over the next 3 to 5 years. AI data center revenue, that alone will increase to an average of 80% each year. So one day it's, we're terrified about AI and its energy and capacity constraints. The next day it's, yay, everything's wonderful.
Yeah, Anthropic going to spend $50 billion this next year on data centers. Roger Federer backed sneaker brand On Holding raised its outlook as sales soar in Europe and Asia. The company is poised to surpass sales goals for the second year in a row. And as a result, the company gains another 5th in market cap, Danny.
Let's get back to that story on AMD. With expected revenue growth of at least 35% over the next 3 years, let's bring in Bloomberg Tech co-host Caroline Hyde on this. And Caroline, it is a vast different sentiment than we saw yesterday. How big are these numbers? 35%, 80%? I thought it was supposed to be like 200, 300. Is that a good figure?
It's a lot better than the market had been anticipating. Look, to give that sort of breadth from 3 to 5 years in full outlook, we are starting to see ultimately that this is better than the market had thought, maybe a 20% growth rate. So we're seeing 35% committed to until that sort of full range. We're also seeing a total addressable market of $1 trillion. I'm becoming numb to the $1 trillion figures. But more broadly, we are seeing Lisa Su getting specific about the CPU offering that they can get into the AI data centers, but more broadly into GPU, real AI accelerated competition with NVIDIA. This is no longer an also-ran kind of a company. This is a company that can gain market share when it comes to AI data centers, continue to win when it comes to AI PCs, and really sort of eat Intel's lunch more broadly when it comes to the overall offering that we use with our everyday handheld devices.
So how how concerning is the lack of energy for these data centers? I mean, I know AMD is going to sell the chips regardless, I guess, in the short term of whether we can get the power, but over the longer run, it's going to be a real problem.
Well, she faced some real questions about ultimately the question of AI bubble, whether or not there's a lot of circular financing, and she managed to breeze through that, just saying she doesn't want to bet against OpenAI, for example. She's also, though, still saying that government support is where it's necessary. She talked more about the fabrication of chips in the United States rather than perhaps what we've heard from CoreWeave yesterday. Michael and Trader came on the show saying, look, the US government can play a role here when it comes to getting infrastructure up and ready a little bit faster, when it comes to ultimately the sign-offs that you're going to get from a state and city perspective. But AMD is really going to have to say they are there to provide with the scale of chips that are necessary. But look, we're all wondering how quickly these data centers can come online, and that's sort of the narrative that we've been fighting for the last week.
Well, then you have the earnings, the like of Oklo, who said that they're getting more cash and cash equivalents, and that the government, they're focusing on Department of Energy build-outs too. How much is the government playing a role here in some of this?
Well, DOE is actually a real fosterer of driving force for AMD because, in particular, that is where the MI AI accelerator demand is coming from. It's from the Energy Department. It's also from what they've signed up with the likes of OpenAI. They've already been signing it with Oracle. And you've got to remember, these are players that have been alongside President Trump. At the very beginning of his administration, we saw Sam Altman alongside Larry Ellison talking about the AI infrastructure build-out. The government has an eye on this. Department of Energy has an eye on this. And this is where Lisa Su is trying to say AMD can offer you the power efficiency that's necessary going forward. We've got the innovation in place, and we're going to be able to get you on our MI accelerator bandwidth going forward that will ultimately drive that innovation that's necessary, so we don't have to have quite so much power. But ultimately, that is going to be where some of the holdouts are at the moment.
All right, Caroline, thanks very much. Bloomberg text Caroline Hyde there talking about the AMD news that's really driving these markets. Now, strategists at Goldman Sachs expect U.S. equities to continue lagging global peers for the next decade. Peter Oppenheimer and his team recommend that investors increase diversification beyond the U.S. And you can see from this chart, the white line being the U.S. valuation just starting to soar away from the rest of world valuation in blue, the delta there in purple, so you can see that growth. Peter Oppenheimer and his team see the S&P returning an average of 6.5% over the next 10 years, but everyone else, especially emerging markets, doing even better. Bloomberg macro strategist Michael Ball joins us. So is this the end of that trend that we see from the chart?
Yeah, it's what they're thinking. And it's not just on the valuations, which obviously have been talked about a lot in the last couple of weeks, as we're all worried about the concentration in leadership and how far the AI trade has gone. But also they see structural reform and they see better nominal GDP growth. And with that, it's not just better growth because of inflation also going up, but more contained inflation, creating a better backdrop for financial conditions to loosen and allow equities to kind of outperform. And this is obviously going to be different between every EM. They're all their own unique butterflies. But overall, if you lump them together, there are structural reforms in place, and there's a better growth dynamic that should boost earnings and margins on the kind of, margins will also be better defended, I suppose. They're not expected to necessarily blow out, but they're not expected to contract on pressures from idiosyncratic stories.
But people love to make this prediction. It usually doesn't come true. Last year when people said it, it did. This year we have seen those markets outperform. Who's to say that that's really going to last? Because if you were to have traded on valuations in the past decade, you probably would have missed out on a lot of American equity gains.
Right. I think it's a little bit, you have to be careful. Like, obviously, there's ways for investors to buy the basket of EM. But overall, like I said, there's going to be these individual stories. There's going to be outperformances. They also did highlight, basically, Asia, ex-China, and Japan is looking pretty strong. But you are going to have to pick your countries. You are going to have to be very clear on what your target is, because there are always these shocks, and they come out of nowhere often. And to your point, we get these good narratives going, and then something unforeseen comes and knocks everything off.
Right. The way I read it, it's not just about valuations, right? It's also the idea that, at least in terms of the emerging markets call, which I think he said is going to see 10% average annual growth, the idea is that AI is going to provide more productivity to those economies than it will to our more developed economies.
Yeah, and super interesting, because we were just talking about that whole power part. If EM starts to look at sort of the open source algorithmic advancements that the Chinese AIs are pushing, That's less power, it's less infrastructure potentially for data warehousing. Now, I'm not an expert on this, and we can bring others on to speak to it.
Power hungry is what
But
we've been
exactly,
hearing.
and this is always a constraint. As the demographics grow in some of these countries, there's going to be more of a jostle for who gets that power. Whereas in America and the West, some of that's already set with our demographics being more stable.
And by the way, we're going to have the CEO of Seminova on too, who presumably, or they say, builds a chip and a GPU that uses less energy. So it'll be interesting to get his take. Michael, thank you so much. Bloomberg's Michael Ball. Elsewhere in D.C., House lawmakers are set to vote on a measure to end the 43-day government shutdown. It will reinstate fired workers, guarantees back pay for furloughed employees, and prevents further layoffs through the end of January. Here's House Democrat leader Hakeem Jeffries.
House Republicans, welcome back from your taxpayer-funded 7-week vacation. You now have an opportunity to actually take some action in an area of this healthcare crisis by working with Democrats before the Rules Committee this evening to extend the Affordable Care Act tax credits.
Bloomberg senior editor Mike Shepard joins us now. Mike, day 43 and the last day of the government shutdown?
It's looking to be that way. The House is on track to vote sometime this evening. We're expecting it to take place about 7 p.m., and the president is expected to sign the measure as soon as it hits his desk. We don't know if that'll be tonight or first thing tomorrow morning, but they're looking to move quickly to end this. Now, Danny, one thing that's important to note is that even with the shutdown ending, there will be some lingering effects. The disruption that we have seen, for instance, with air travel, that will go on for a couple of more days, and it could take even longer to restore some of the food aid and other government services that were disrupted along with air travel as a result of the shutdown. And Danny, another thing that we're going to see linger through all of this, as you just heard from House Democratic leader Hakeem Jeffries, is recrimination within his own party. There is a lot of frustration among Democrats with the decision by 8 Democratic moderates in the Senate to side with Republicans to pass this spending measure without gaining the key concession that they wanted. And that was namely the extension of those subsidies under the Affordable Care Act that are set to expire at the end of this year. Democrats are now looking at a couple of options. One, some have talked about ousting Senate Democratic leader Chuck Schumer. Others have also said, look, we have to take this now to the midterm elections and wage our health care fight then.
By the way, there's been a lot of talk about the power that companies like BlackRock and Vanguard yield because they vote on proxies for their clients, essentially. Also Glass Lewis and these kind of shareholder activist groups. President Trump is going to have I guess, lunch or dinner with a number of Wall Street executives, including Jamie Dimon and Adena Friedman. What do you think we're going to hear from that?
Well, you know, for now, Matt, it is a dinner. It's scheduled for 7:30 p.m. on the official White House calendar. And publicly, the White House is not saying who will be in attendance. But we have confirmed that some leading lights from Wall Street will be there, including Jamie Dimon. And we also know that David Solomon from Goldman Sachs and Larry Fink from BlackRock have been invited. Now, on the agenda, they will have a lot to talk about. Naturally, the shutdown and whatever concerns Wall Street may have surrounding federal spending will certainly be a topic of discussion, as it usually is. But the executives may also get into other areas that are sensitive, and that includes financial regulation, the proxy rules that you just mentioned. They may also talk about the immigration crackdown, especially the higher fees on H-1B visas that many Wall Street firms use to add to their ranks in the U.S. They may also talk about what's happening with tariffs, the sweeping levies imposed on U.S. trading partners around the world, and what the economic fallout may be and how Wall Street is taking that on. And then, of course, there is the question of artificial intelligence and whether there may be too much punch in the bowl these days when it comes to spending on AI, and whether these executives have any concerns surrounding all of that and surrounding the returns. We've heard Jamie Dimon talk about how J.P. Morgan Chase is using AI. So this may be a topic that the president will want to talk about as well. Remember, he has grown very close to Silicon Valley, and he had a high-profile dinner in September that he actually brought the press in with a number of key tech leaders.
All right, Mike, thanks so much for joining us. Bloomberg's Mike Shepard there in Washington. Let's get a quick check on what's going on in the markets with futures rising. S&P 500 futures up 0.33%. NASDAQ futures up 0.6% as investors continue to be optimistic about the AI CapEx.
I was worried you were going to say, like, because the shutdown is ending. Like, are we still trading on that? There's no way, right?
I couldn't imagine that we are, but there are some stocks, right? Like Kava.
And Sweetgreen.
Yes.
Citi basically said, watch out, they might outperform because they get a lot of their revenue from the D.C., Maryland, Virginia area. All right, some other movers.
Delmarva.
Delmarva?
Yeah. Delaware, Maryland, and Virginia.
Oh, well, I was thinking it was the DMV, which is where I'm from.
Okay.
D.C., Maryland, Virginia. All right, some other stocks moving on our radar. Nuclear energy company Oklo is rising on a plan to launch a commercial plant and focus more on energy department authorization.
Oh, here we go. Let's take a look at Kava and Sweetgreen shares added to Citi's 90-day positive catalyst watch list, with analysts expecting sales to improve once the government shutdown ends.
And stablecoin giant Circle, they beat expectations on their earnings, but the return rate is concerning investors, and it controls 29% of the stablecoin market. Coming up, Intel reportedly has its eyes on a chip startup. Samba Nova CEO Rodrigo Leong joins us next to share his outlook for AI and their company. You're watching Bloomberg TV.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1-1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzone.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Ahmed, only on Bloomberg.
Now to high interest, look at what's making headlines around the world. House Democrats released newly obtained emails from Jeffrey Epstein, alleging that President Trump, quote, spent hours at his home with one of Epstein's victims and also, quote, knew about the girls. The messages sent years after Epstein's 2008 conviction were written to Ghislaine Maxwell and author Michael Wolff. Democrats say the emails raised new questions about Trump's ties to Epstein and accused the White House of withholding the related files. The president denies all wrongdoing, calling the claims a political hoax. More Americans are missing car payments. Fitch says subprime delinquencies hit 6.65% in October. That's the highest since 1994. Inflation, student loan bills, and high rates are straining wallets, forcing some lenders into bankruptcy and leaving many drivers underwater on loans with interest, in some cases at 30% or more. Mercedes Formula One chief Toto Wolff is in talks to sell about 5% of his stake to CrowdStrike CEO George Kurtz in a deal that could value the entire team at $6 billion, a record for an F1 team. The deal isn't final, but would mark the highest ever F1 valuation, underscoring booming investor interest. Fueled, is it still fueled by Netflix's Drive to Survive?
Maybe not still. I don't know if it's as popular as it once was, but it certainly helps. I mean, they wouldn't be worth $6 billion if it weren't for Drive to Survive.
It just continues to climb, right? McLaren is worth $4 billion, now $6 billion for Mercedes. It's pretty incredible, and I think Drive to Survive has kind of worn off.
Yeah, I think you're right. I think it's just normal fans, Netflix or not. All right, turning back to the chip story this morning, Matt, as AMD predicted its annual revenue growth will average more than 35% over the next 3 to 5 years. Intel is said to be in early talks to acquire chip startup Samba Nova. Joining us now for a Bloomberg exclusive is Rodrigo Leong, Samba Nova co-founder and CEO. Rodrigo, thank you so much for joining us this morning. How are you thinking about this? Is Samba Nova as a standalone company versus part of a big chip legacy brand?
Well, look, I think what's exciting about it is that we've been getting a lot of interest over the last few months around investing in the company. But look, every scenario we consider is about growing our footprint, accelerating our roadmap, driving our product into the market faster. AI inference is exploding, right? And as you just talked about with AMD, and we're seeing the same thing. We see quarter-over-quarter doubling of our business, multiple quarters in a row now, and so we're excited about that. And so we're just really excited about figuring out how to actually accelerate that into the market and growing faster.
I mean, your chips, reportedly the SN40L RDU chip, see how much I know about this, apparently use less power than competitors' products, right? And we've been hearing about Chinese AI using less power than American AI products. Can you give us the scoop there? I mean, how much of that is true and how much can that be improved?
Yeah, I think what you're seeing today is basically this interconnection between AI and scaling it and power and energy supply, right? And so the simple way to describe it is basically energy in and tokens out. That's really what you're thinking about and trying to figure out what is that conversion rate. And so there's actually a really interesting report that's coming out today from the Stanford Research Group that talks about Samba Nova's technology, the SM40, being 4x more efficient than Blackwell's. And so if you think about this industry now, which I think McKinsey's estimating that the entirety of actually building out, scaling out this infrastructure, data centers and power and racks is 5 to 8 trillion to meet the demands. Imagine what it would look like if we could deliver something that's 4x more efficient.
Now, is the SM40, though, used mainly for inference, whereas Blackwell's used for training, or does the Samba Nova chip deliver both capabilities?
We do, but most of the time, what people are using Samba Nova's SM40 is really for inferencing. As you know, inferencing is going to be 80–90% of the market going forward, right? And so we're really focused in on how do we deliver inferencing at a much lower power footprint, much lower cost. And this is really important because in the world of sovereign AI, every country is trying to figure out how to deploy their own data centers for AI models. Not everybody has gigawatt data centers available. And so being able to go with really energy efficient technology allows you to accelerate deploying these technology into the market.
We were talking about in the break how quickly these things are developing. Already, if you have a more efficient chip, presumably as the technology gets better, the efficiency only increases. What does it mean for this world that started all of these new energy products, that started reviving nuclear energy outputs, that's opening up places in Texas without leases being signed yet?
Yeah.
Is there a real risk we are going too far right now?
16 gigawatt campus in Texas.
Exactly. I mean, is that a real risk that, you know, in 5 years from now, these are going to be obsolete because of the efficiencies that are being delivered?
Well, I don't know if it's going to be obsolete. Look, in every scenario we model, energy requirement is going to be increasing over the next 5 years. You know, this is an insatiable demand for AI. But that said, if you look at the race, all these different companies trying to get to scale of AI, energy is going to cap it, And so what you need to do is actually not just find supply of energy, but using the energy more efficiently. And this is where our technology, being 4x more efficient than the Blackwells, allows you to actually smooth out that curve. While energy is being delivered, how do I deliver more tokens to the market with the energy I have today?
I look at your company and see that Lip-Bu Tan is the chairman and, of course, also CEO of Intel. And there's reports that Intel may be interested in just buying SambaNova. Would that work out, you think? Would that be a good strategy for them, for you?
Look, I think, if you think about kind of what the industry's looking for, NVIDIA is so dominant. NVIDIA is so dominant in the AI space. Their chips are, continue to be the most popular chip out there. And yet you have all these other players, whether that's an Intel, or Qualcomm, AMD, all these different large players looking for solutions that compete. And companies like ours, SambaNova, where we've got a technology that's competing very well with NVIDIA, what we're looking for is scale. Right, what we're looking for is how do we accelerate, how do we get capital, how do we drive that into the market faster? And so we're looking at various different options, including large investments into the company, including all these other partnerships that allow us to actually take that capital and translate our technology into something that competes against the largest company in the world.
So sometimes when you have dinner with Lip-Bu Tan, do you talk about selling the company to him?
Well, look, Lip-Bu is an incredible chairman since day one. And so, look, this company is on a track to be, very, very competitive going forward. And so we do look at his leadership as the chairman in order to help us figure out kind of where to attack.
Rodrigo, thank you so much for joining us. You have to come back. We could do this all day. Rodrigo Leong of SambaNova, and you're watching Bloomberg TV.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacqua in Sintra, Portugal, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
On a visual.
And the analysis you need.
China's not going anywhere, nor are we.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Let's suppose you hire people in this business and they start losing money.
Yeah.
How long before you say, this isn't for you?
When we bring people on, we're looking for a previous record of success. So we don't train people, particularly on the investing side, right out of college. They would have come with already experience. Then there's also the why are they wrong or why are they right? Are they right for the right reasons or are they wrong for the wrong reasons? And then there's also collegiality. How do you work in a team? But I would say that within a 2 to 3 year period, we, usually you get a sense whether, someone's talented.
Do you ever hire English majors or history majors, or you only hire STEM majors?
I encourage my boys to go to liberal arts and to be in whether it was poli-sci, economics, and be fluent in other areas. So I think having a broad perspective can be very helpful.
If somebody is very good at what they do you say to them, you're very good, but go to business school, or you say, don't go to business school because you're very good at what you do?
So I didn't go to business school, and I think that the markets are a great business school. So it's we don't encourage people to go to business school. We encourage them to take the CFA. That's a good way to get more technical trading. If it was something that they feel they wouldn't be complete without going to business school, there have been people who've done nicely with us who've wanted to go, but that's been more the exception.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Moments away from the start of trading, and optimism looks to drive a fresh rally on this Wednesday. Actually, we rallied into the end of yesterday's session, even with NVIDIA down 3%. That likely won't be the case today with NVIDIA because we got great news about chips. S&P futures up 0.3%. NASDAQ futures up 0.5%. Even the small caps are rallying. And by the way, we have two big CEOs ringing the bells. Down the New York Stock Exchange, Ed Bastian celebrating 100 years of Delta and the stock. I always run a comp function before I come over here. Up 72% over the last 5 years, so better than a stick in the eye, not as good as being invested in the S&P. And the AMD CEO, Lisa Su, ringing the bell down at the NASDAQ. Obviously, her company is really driving markets today. I think Danny's just about to talk about the stock up another 7%, and it's already tripled over the last 5 years, so they've done very well.
They've done very well. Thank you for setting me up so wonderfully, Matt.
My pleasure.
I appreciate that.
Take it away.
So we do have AMD just here at the opening bell, up 7.5%. Lisa Su, who we were just seeing yesterday, said that revenue growth will surge over the next 3 to 5 years. She sees AI data center revenue alone increasing by an average 80% last year. She also said that the AI chip market will top $1 trillion by 2030. So how's that for some optimism? Shares rally, Matt.
Yeah, pushing us even higher. By the way, Roger Federer-backed sneaker brand, if you care about these things, or care about companies that gain 27% of their market cap in one day, raised its outlook as sales soar in Europe and Asia. The company poised to surpass sales goals for the second year in a row, and On, which is the ticker, is now a company worth $15 billion.
And Roger Federer is that much more wealthy.
Good for him.
Yeah.
He's earned it.
He's earned it. I don't really like his shoes, though. The On tennis shoes. Not that big of a fan.
I just don't really wear tennis shoes unless I'm playing tennis.
Right.
But I know a lot of the kids wear them all day long. JP Morgan's Mira Pandit says stocks might be expensive, but not too expensive. She argues that weaker tailwinds from policy and the consumer cycle, robust profits, growth exceptionalism, and structural factors justify these high valuations. Weaker economic tailwinds. Weaker economic tailwinds. Did we get that wrong, Mira?
No, you got that right.
Why does weaker economic tailwinds justify these valuations?
Well, essentially, we've been so resilient against not that much of a pressure coming from some of these cyclical benefits. Like, for example, if you compare to where we were during the aftermath of the pandemic, you had valuations almost as high as they are today, and you also had rates at 0, where we've had rates at 4% essentially or above, except for the last couple of weeks, for 3 years. We are not coming out of a recession, so we don't have this cyclical boost from earnings, from the economic cycle, from valuations overall. We don't have this big fiscal impulse, not 25% of GDP plowed into the economy. And yet valuations are basically the same as they were a couple of years ago when we had all of this momentum pushing stocks higher. Now it's like the beach ball that you kind of can't keep down. You're trying to push down on these valuations, and yet all that pressure against them, and they're still continuing to rise because we see so much momentum behind profits. So people want to get what they're paying for, essentially. And you've seen 4 quarters in a row now of double-digit profit growth, a double-digit year last year, potentially a double-digit year this year, maybe even a double-digit profit growth year next year against typically mid to high single profit growth. So you have that incredible earnings, and even across the world, where it's no longer a TINA trade. You can buy bonds and get income. You can buy international stocks and get double-digit outperformance. If you look at the component of earnings that's driving the U.S. return relative to international returns, it's a lot higher in the U.S., so you still have that earnings exceptionalism. And then there are a number of structural factors. Entrance into the markets, whether it's passive flows, 401k, you have such a uptick in retail trading relative to prior to the pandemic, where that's a big pillar of the market as well. And all of those people are entering the market. And by the way, it's really hard to exit the market right now because of some of those embedded capital gains. So a lot of different factors here. Throw on one more, which is index composition, a growthier index relative to value of the 20 years ago.
Even with all that, though, you have seen international markets outperform the U.S. And Matt and I were talking about Goldman Sachs' Peter Oppenheimer, who said not only is that going to continue next year, it's going to continue for the next decade. And part of that is what we've all been talking about, is valuations are starting from a higher place. Do you think that, yes, U.S. has some room to outperform, but it's international, it's EM that outperforms the U.S.?
It's less about geography for me and more about AI. You have AI driving U.S. markets higher, whether it's within tech or industrials or utilities. But then you look abroad and you see Korea up almost 95% year to date. You have staggering double-digit returns in areas like Taiwan as well, China, of course, and particularly the areas of China that are linked to technology. So not so much the domestic A shares, which is a little bit less tech-heavy, but the H shares, Chinese ADRs, which are doing particularly well. So you're seeing that AI story permeate the world as we remind ourselves that many supply chains exist abroad, and the competing technologies that you're seeing coming out of China are pretty staggering, especially when you look at areas like robotics. So the EM trade, I certainly think that can continue, particularly in EM Asia, very much linked to that tech story that we're seeing here in the U.S.
We have a great chart on U.S. valuations versus MSCI World ex-U.S., right? And you can see that U.S. in white here, the rest of the world in blue. U.S. valuations have just pulled away over the last couple of decades, and the purple's just the delta there. Do you see this trend coming to an end now because of, I mean, Jensen Huang, for example, says China's going to win the AI race?
I think it's not just about who's innovating from a technology perspective, because certainly when we think about technology, they are doing some really advanced things overseas, again, particularly in areas like robotics. I think the question around AI is, do they choose to go the commoditization route and make it mass and scalable in a way that some of the advanced producers here in the U.S. are trying to continue to innovate in more advanced ways, or do they really compete head on? But the other piece of this, when we think about it from an investor standpoint, is not just who's the best innovator, but who's the best capital allocator. And one of the things that U.S. companies have proved time and time again is that they know how to produce shareholder value by being smart capital allocators. I don't know that that exists everywhere in EM, which is why we're hyper selective about companies overseas.
What do you think of the Michael Burry argument then? Essentially that these companies are about to be hit by a huge depreciation cost because of their assets and all the capital expenditures they're doing. And if they don't show up in a real way with real meaningful AI revenue, it won't be enough to offset that, and then they'll have to pull back on CapEx pretty meaningfully.
I think there's a spectrum to that argument where even if you do see the useful life of some of these chips shorter than people anticipated, you're still seeing chips today that have a reasonably long useful life, even though there's more advanced options out there in the market. So not everything needs the absolute most advanced technology underpinning it. So I think that's an important thing to remember, that still the broader chip world is useful and reliable. I'd also say that it remains to be seen whether we see mass obsolescence when we think about the accounting factor here, or even just the innovation that maybe things even move beyond the table stakes of today. So it's definitely a valid criticism and one that we see as a key risk, but does that mean wholesale everything becomes obsolete and useless, or can we still continue to find uses for some of these things as we still scale up on some of the more advanced products as well?
Yeah, really thoughtful as always.
This is a great chart, by the way, that the macro man put together, showing CapEx. Now we're looking at $100 billion for S&P.
Which, by the way, OpenAI, I mean, that's just S&P. OpenAI itself has committed $1 trillion
Right,
for
but
that's over a long period of time.
$1.4 trillion over the foreseeable future,
right.
Although, when asked about it, Sam Altman said, like, sell your shares if you don't believe we can fund this. Because they only have $13 billion in revenue. Did you see that little back and forth?
It's wild.
The demand is there. I mean, you're still seeing that cloud growth, 27% growth year over year when you think about cloud revenues. So when you hear from the hyperscalers, when you hear from a lot of these AI companies, yes, some areas are really scaling up on revenues and not quite yet on profits, but that takes a little bit of time, and when you have an innovation and a technological revolution taking place, it does occur in phases. We're probably still in the early to mid phases of that whole transformation.
Mira, thank you so much for joining us this morning. Always great to have you on. JP Morgan Global Market Strategist Mira Pandit. All right, let's get a check on your equity market now, about 10 minutes into your trade. The Dow, by the way, has hit an all-time high. That's because financials are doing particularly well today. I'll show you that in a moment when we look at the sectors. But now here's the overall picture of this equity market. The breadth is pretty good. It's AMD that's the biggest contributor to the gains this morning. It's driving the S&P up by 3.5 points. Similar to NVIDIA, even though it's not even up 0.5%, but that's just because of how dominant the thing is. As I mentioned, some of these banks are doing well. JP Morgan's up. Jamie Dimon's going to be meeting with the president at the White House for a dinner. On the downside, it's also tech that's leading us down. Apple, Alphabet, Palantir, Meta, all in the top losers so far this morning. If you look at some of the sectors, again, financials are doing really well. Goldman Sachs is up, which means the Dow is up because it's a very differently composed index, so that's helping things out. That's followed by materials and healthcare. On the downside, energy is doing worse, down 0.6%, but it's actually the best performing sector over the past month. Not tech, but at least you're getting a rebound from the wider tech index, Matt.
All right, we are going to talk about all the Wall Street CEOs heading to the White House tonight when we come back. Will they vote in favor of stripping power from proxy voters like Glass Lewis and BlackRock? All the details for you when we come back. This is Open Interest.
The key issue right now for us in the diamond space is the declared divestment of Anglo from GBS. And as you know, Anglo holds 85% stake in GBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in GBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders. We have parties. We have the Oman Sovereign Wealth Fund. We have others who are willing and ready.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Let's look at some of the top calls this morning, the analyst action that we are watching. First up, AT&T, that gets an upgrade at KeyBank. The analysts there are calling the recent weakness overblown. They say the company's focus on integrating its wireless and home internet unit is pulling ahead of its peers. Those shares up 1.4%. Next up, Bath & Body Works, that gets cut to Raymond James thanks to what it says are near-term challenges. The analysts point out that digital and product improvements will take time. They also say recent innovations have underwhelmed. The stock is down 43% this year, ahead of its earnings next week. They're up about 0.75% this year. And finally, Citi adding Kava and Sweetgreen to its 90-day positive catalyst watch list. They expect sales to bounce back as the government shutdown ends in the coming weeks. Both of the fast casual restaurants saw softness as federal paychecks were halted. So it's back to salad days, I guess. I believe Sweetgreen gets 11% of the revenue from the DMV, and for Kava, Matt, it's almost 20%.
Salad days.
I know.
I like that. You know, actually, I think that's a great Minor Threat record, if you ever listen to the DC punk rock band. Turning now to Wall Street, President Trump is set to host a big, beautiful dinner at the White House with bank CEOs, including J.P. Morgan CEO Jamie Dimon, and others that you can see here. Joining us now is Jenny Serrain, Bloomberg Finance editor. And actually, Jenny, really cool to see Larry Fink there because it sets up maybe a little bit of a conflict, right? The president wants to take away, perhaps, some of the voting rights that a company like BlackRock has on behalf of its investors.
Yeah, I think it'll be really interesting because, you know, you've got so many different dynamics that these guys could, you know, use this opportunity to discuss with the president. Obviously, the ongoing debate over ending the shutdown, I think, will be one of many topics that they might try to discuss. How consumers are kind of faring and how they're seeing this play out in terms of, you know, the loans that they make and the consumers that they serve might be another one. And then we have kind of the broader, you know, regulatory rollback and the massive amount of deal making we're seeing, the kind of roaring capital markets. You know, Trump might be wanting to pick their brains on what he could do to kind of keep all of that going, which I think would be music to a lot of these CEOs' ears. So there's lots of different ways that we could see this go. Obviously, with executives like this and a politician like this, it's hard to know exactly what will be discussed, but there's plenty of grist in the mill, if you will.
By the way, just having Larry Fink and Jamie Dimon in the room together will be interesting, considering Dimon once called those proxy groups a cancer, reportedly, so he's not a fan either. Jenny, how important...
What are you talking about? That's
right?
the drama.
Right? No, there could be some serious drama just between the men themselves. But Jenny, how important is it that these men and maybe one woman have a good relationship with President Trump? I mean, I don't see Brian Moynihan of Bank of America on this list, and it's a company that President Trump has railed against for debanking. How important is it for these executives to foster a relationship with the president?
I think it's a very delicate dance that a lot of these executives play kind of day in and day out. I think we've seen with this administration a willingness to kind of go after any number of companies, any number of industries. And so it's a very, sensitive time. And I think they all try to kind of avoid the limelight where they can, while still taking this opportunity to kind of make their case and for, whatever the topic may be. So I think for a lot of these guys, just the general environment like we've been talking about, the capital markets coming back, the deal making finally seeing a way through, the regulatory rollback, those are probably all of the kind of lanes that they'll want to stay in, because that's where they're already getting a lot of what they want, but they might see opportunities to push for even more.
Yeah, I mean, I wonder if they had a wish list, what would be on there? What can they get from the president, these Wall Street CEOs, or what is chief among their desires?
I think the big thing that they've all talked about is just this willingness to greenlight deals and be more open to M&A and merger activity. I think they've all really appreciated that. They like to see kind of the wheels of capital markets moving. The fact that the president has been so open to digital assets and kind of wanting the U.S. to be this hub for crypto activity, that's something that a lot of these banks are finally starting to experiment in. We just had the news yesterday that JPM is finally debuting its tokenized deposit JPM coin for its institutional clients. So you see a lot of these banks now, after years of experimenting, after years of trials and small focus groups, you really see them embracing a lot of these new areas. And a lot of that's just driven by the fact that they're getting the green light from their regulators to go out and play with some of this stuff. So I think you'll hear a lot of just keep doing what you're doing. And then, on the margins where the government shutdown might have impacted consumer spending or the health of consumers generally, there might be some discussion and back and forth about, how can we ensure that consumers are still staying afloat and the U.S. economy is still growing, because that's obviously things that are all supportive for these big banks' bottom lines.
I really can't wait for what I assume will be some good reporting to come out of this dinner, what's actually said. Jenny, thank you so much for joining us. Bloomberg's Jenny Serene. Coming up, Eli Lilly drops CVS's drug benefit plan for its own employees. We explain what's costing workers. That's coming up next. You're watching Bloomberg Open Interest.
up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on with stocks. Right now we see gains on the S&P, the NASDAQ falling, so a little bit of a divide here. And the reason is likely that we have NVIDIA shares down. This doesn't necessarily bode poorly for gains today on the S&P. Yesterday, the NVIDIA shares were down 3%, and the S&P still closed with a gain. But it doesn't help, obviously very heavily weighted. AMD, a big boost to the index right now, up 5.5%. On holding right now, up 25% after earnings and sales growth, especially overseas, that really boosted that brand. Circle, the stable coin out with earnings down 8%. Eli Lilly and Novo Nordisk still kind of locked in this battle. And we're going to talk about that in a second with regards to CVS. You know, CVS is no longer insuring and giving you Zepbound. Instead, they're going to try and move you to Wegovy. And Danny, we have more on the retaliation that Eli Lilly may be taking for that move.
That's right, because Eli Lilly now dropping CVS's health drug benefit plan for its employees. For more on that, we're joined by Bloomberg health reporter Madison Muller. Madison, it feels quite vindictive. And I guess my initial question was like, can they do this? But I guess they can because they are doing it.
Yeah, it's sort of the latest tick for tack in this ongoing war between Lilly and Novo that has involved CVS as well. And it is normal for employers to switch who they're using to manage their employees' drug benefit plans. Usually those contracts last around 3 years or so. But the timing is interesting given that CVS made this decision earlier this year in May to prefer Wegovy, which is Novo Nordisk's drug, over Eli Lilly's Zepbound, a rival weight loss drug. And so the timing is obviously interesting and makes sense if one of their biggest drugs sort of wasn't able to reach a lot of patients as a result of that decision.
Why did CVS drop coverage for patients using Zepbound? Because it's not the same drug as Wegovy, and so a lot of patients were actually benefiting from the use of Zepbound who don't deal well with the use of Wegovy.
Yeah, I mean, CVS actually openly says because of the competition and the popularity of these drugs, they were able to sort of, they said, do what PBMs do best and, you know, pit these two companies against each other to negotiate the best prices for their members. So they said that this decision has actually saved a lot of money for their members, which is an important piece of this because a lot of employers have said that costs are rising as a result of covering these
Many
drugs.
of their members have such adverse effects to the Novo drug that they can't take it, whereas with Zepbound, they were actually losing weight, reducing their risk of heart attack and diabetes.
Yeah, when you think about it from the patient perspective, this was really frustrating, really hard for a lot of patients. We did a story on this earlier this year. I talked to a lot of patients who were, you know, seeing really great success on Zepbound and sort of had their whole weight loss journey, medical care upended by this decision. And so even
what PBMs do best.
Yeah, exactly. I mean, that's what CVS said.
But isn't the total addressable market for these medications so huge? Why does it feel like every corner it is so vicious, be it these two companies or Pfizer, the battle over Metsera? It feels particularly intense even when the pie is gigantic for this medication.
Right, but it's right now two companies. I mean, Pfizer is still a few years away from reaching this market, and so for Novo and Lilly, like, they are really for so long they were neck and neck, and like Lilly was coming a bit from behind. I mean, Novo had their drugs on the market first, and so Lilly had to be pretty aggressive to catch up, but they also had a drug, Zepbound, which is more effective than Wegovy, and so they had that advantage. Now Novo is trying to sort of claw back market share in a market that they really lost out on to Lilly, and so the competition is just increasing, and then add in all these other drug makers that are trying to get in on it, and it just is sort of never ending.
All right, it's a pretty exciting space, Madison. Madison Miller covers weight loss drugs and pharmacy for us at Bloomberg News. Coming up in the next hour, Katrina Dudley will join us and talk about the, I guess, increasingly K-shaped economy and earnings expectations versus consumer sentiment. Plus, Apollo's Akila Gruel joins us on the rise of credit, which was the strongest earnings driver for alternative asset managers last quarter. And Ducati's North America CEO Jason Chinook talks about dirt bikes driving growth.
cidade estava sitiada.
Isso é o começo, eu tremia, não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Vonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
This is breaking news from Bloomberg.
All right, Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. This is a Bloomberg Intelligence program for a Wednesday. Got some breaking news coming across the Bloomberg terminal, Scarlett. Atlanta Fed President Bostic to retire when his term ends February 28th. Interesting.
It is interesting, given that we know we'll probably have a new Federal Reserve chair next year as well when Jay Powell's term ends, and President Trump has been on a crusade to change the makeup of the Fed Board of Governors because he wants to push forward with lower interest rates. So Bostic, which is part of the previous administration, you could argue, is going to step down. So the question is, who's going to replace him, and is the person who replaces him, will that person be more tilting towards interest rate cuts?
Exactly right. And Mr. Bostic is only 59, so we'll see what the next term is for him. Let's bring in Enda Curran. He is global economy reporter for Bloomberg News. He's down there in Washington, D.C. And some pretty big news here for the Federal Reserve. Pretty high-profile president and high-profile region of the United States being in Atlanta. What do you make of this news?
It's surprising news. He, as you say, he's been running the Atlanta Fed since 2017. He was the first African-American and openly gay person to lead a regional Fed bank. So he was quite a figure on the policymaking scene. He was also, as you mentioned earlier, among those who was, more concerned about inflation, perhaps, and maybe was seen as something of an interest rate on the more hawkish side of things. He wasn't a voter this year, but obviously he was a key voice out there. That's what we know so far. These details have just come out. He's just announced his retirement when his term ends. He does speak today. He's delivering a speech later, so perhaps he might be asking questions after that where he will deliver some comments. We don't know more than that for now, but obviously we do know the backdrop is that there is ongoing political pressure on the Fed to lower interest rates. So we'll have to see if that's part of that story or not.
And of course, Bostic is one of 12 regional Fed presidents. All of the 12 regional Fed presidents have 5-year terms that end on February 28th, which means that they could be reappointed or something else could happen. So, Enda, we could see a completely different FOMC next year.
Well, we could. This is a talking point, and it's more than an academic talking point because of the political pressure on the Fed, explicit and public. President Trump and other officials in the White House want interest rates lower and much lower. And of course, we've seen the unique nature of the appointment of Governor Myron to the board, to the committee, given that he's merely taken leave of absence from his White House job. He hasn't left his White House role. So the political pressure is clearly there. And then that feeds into the idea that, wait a second, could this reappointment process of the regional Fed presidents be also pulled into this political mix in an effort to kind of get more policymakers who share the White House worldview, which is obviously one of lower interest rates? We're not there yet. We'll know more, and that will become clearer in the months ahead. But right here, right now, what we do know is policymakers are certainly divided over whether the bigger concern is the employment market weakening or whether it's sticky inflation.
And what is the process for appointing a new regional Fed president?
The regional Fed president is appointed by the regional Fed. They've got their own board of management. They've got their own process. It's not a congressional approved position. If you're appointed to the board here in DC, you have to go before Congress and get approval. The Fed is different. Their stakeholders include banks and the like. So they have their own process. The release announcing Mr. Bostic's retirement did say that they do have a first vice president, chief operating officer, who will step in as interim president if they haven't got a new leader appointed by the end of February. And given that we're now mid to late November, it's probably a tight timetable to see whether or not they can get someone new in there before that deadline is up.
Enda, thanks so much for your reporting. Really appreciate it. Enda Curran, global economy reporter, Bloomberg News, joining us from Washington, D.C. again. Federal Reserve Bank of Atlanta President Raphael Bostic announced that he plans to retire from the U.S. Central Bank when his term ends in February. All right, so let's get a reset of this market here. We go to Lisa Mateo for a Bloomberg Business Flash. Lisa.
And this Bloomberg Business Flash brought to you by IBKR. Will the average global temperature in 2025 be greater than 2.45 degrees Fahrenheit, above the 20th century average? At IBKR Forecast Trader, the yes recently at 6%. Start predicting today at ibkr.com/forecast. The last trading day for this contract, January 9th, 2026. Well, we have the Mag 7 in the red. Alphabet, Meta leading the losses, down more than 1.5%. We'll go to the NASDAQ right now, down about 0.1%, 42 points. The S&P 500, though, up about 0.1%, 10 points. The Dow rising nearly 1%, 447 points. The 2-year yield's 3.56%. That's down 2 basis points. The yield on the 10-year, 4.07%, and that's down 3 basis points. To tech right now, Advanced Micro Devices, their shares up more than 7%. That's after forecasting faster sales growth. And after taking a hit yesterday when tech investor SoftBank sold all its shares in the company, NVIDIA shares, well, they are little changed right now. And SoftBank shares, they're taking a turn. They're down more than 3% in Tokyo. That's after sparking concerns about climbing valuations. And finally, NVIDIA partner Foxconn gave an upbeat outlook. Its shares are up nearly 2% in Taiwan. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That is a Bloomberg Business Flash. Scarlett and Paul.
All right, Lisa Mateo, thank you so much. We appreciate that. As Lisa was just mentioning, we got mixed on the screen, red and green on the screen. Let's take a look at some of the stocks on the move today. I'm Paul Sweeney alongside Scarlett Fu, and we're joined by Bloomberg's Christine Aquino. Christine, what are you looking at?
Well, let's start with AMD, shall we, Paul? Because that stock is still doing well today, even after the update that we got yesterday. So still going. Ticker AMD shares currently up more than 7%, so extending their opening gains after the announcement yesterday regarding their long-term outlook. As we know, of course, CEO Lisa Su saying that annual revenue growth will average more than 35% over the next 3 to 5 years. And I think the headline headline grabber was really their projection for the total addressable AI chip market, which they're projecting to reach $1 trillion by 2030. So the takeaway from that, at least according to Bloomberg Intelligence, is that, that outlook really shows that AMD's share within the AI space is widening. They're engaging with multiple customers at a comparable scale, and they're really looking at, AMD's capacity to expand into the space with a full stack sort of approach, right? So they're expanding beyond inferencing into full model training, and AMD's products, their GPUs and CPUs, are gaining broader validation across hyperscalers and enterprises.
You're also well,
absolutely
not quite so big. It once was big.
Yeah, exactly. Shall we say it's an old school tech name in given the context of today's AI moves. And this is Cisco, and we're looking at shares. The ticker for that is SCO, and shares up slightly, like about 0.5%, and we're looking ahead to their earnings after the bell, Scarlett. So, the expectation is that first quarter EPS will rise 5.8%, and revenue is projected to climb 5.3% for fiscal 2026, and then decelerate modestly over the next few years. So the thing with Cisco is that it's one of these, as we know, kind of more old school companies, right? That perhaps is a little late to the game when it comes to capitalizing on AI capabilities, but we know that they're starting to ramp that up, right? They've partnered with NVIDIA to speed up the deployment of their AI systems, and results from their last quarter did show that their projects in that space are picking up. And so that is the big question for shareholders, right? Like, can they finally evolve to really capitalize on that? Because even though their shares are up more than 20% this year, their prices are still below the peak in a dot-com era, and there's this perception that they are a little late to the game compared with their competitors. So we'll look forward to those earnings after the bell today.
All right, one more. What do you got?
Let's look at JP Morgan.
Because they're good.
Yeah.
So the big CEOs, they have a dinner tonight, right?
That's
Down in DC.
right.
Okay.
Yeah.
That's an off-the-record dinner because it's not on the public schedule.
Right. I saw that.
Bloomberg is reporting it, but if you look at the president's public schedule, just says private event.
Oh, interesting.
Yeah. So this is a Bloomberg exclusive that they are going to be having dinner. So JP Morgan CEO Jamie Dimon is going to be in attendance along with other finance industry executives. So will be interesting to see what sort of headlines we might get from that. But yeah, JP Morgan ticker JPM, those shares extending gains a little bit, up 1.9%. So in addition to the dinner, we also got news that they're going to be rolling out a deposit token called JPM Coin to institutional clients. And, the token represents dollar deposits at JP Morgan, will allow the users to send and receive money via the public blockchain Base, which is affiliated with Coinbase. And the idea is that eventually they'll make this token accessible to not only its clients, but also the clients of its clients, and potentially looking at different currency denominations as well beyond the dollar. So interesting move there by JP Morgan. We'll see how that plays out.
All right, Christine, thanks so much. Appreciate that. Christine Aquino, she does all stocks for Bloomberg News here. For more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. Here's just another headline that are you kidding me? I mean, the dollar Anthropic, I wouldn't know Anthropic if I tripped over it on the street. Commits $50 billion to build AI data centers in the U.S.
I just read up on it, and Anthropic was opened by former employees of OpenAI, so it's another version of OpenAI.
On the street. I mean, these are private companies.
I don't think they're physically available on the street.
Where are they getting the money? Caroline Hyde, she's the best person to talk to. B-Tech co-anchor for Bloomberg News, joining us live here. Broker studio. What a time to be covering tech like you and Ed Ludlow do, Caroline. Every day there are major news items from major companies and just amazing amounts of dollars. Today, again, Anthropic commits $50. How do you put it in context?
I mean, you become a bit numb. Yep. And then you look to some of the other whopping numbers like the $600 billion that Mark Zuckerberg expenditure on AI. Feel that. Right. But interestingly, Anthropic, what's interesting about $1 billion doesn't feel that much.
Right. Right.
But interestingly, Anthropic, what's interesting about this one is, look, they've been reliant on investment from strategics for their access to cloud. Google, massive investor in Anthropic. And with that comes to compute. So too has AWS, Amazon, and AWS has been a real provider of chips in particular. Remember, really Anthropic has been a strategic partner to these cloud companies because they've been helping them build out their chip offering, and they've been helping training models on the future generation of these vertically integrated companies. But now they're saying, look, we think the US needs to continue to build out its AI infrastructure, as you've who's already saying he's going to be spending trillions on data centers and all the capital expenditure that goes with it. Then, of course, we have the likes of Mark Zuckerberg on it as well. So it feels as though Dara Amadei, who was at OpenAI, came over and set up Anthropic to do it in a cautious, humanity-friendly way. He's now saying, look, us too, we need to put some infrastructure.
The ChatGPT as Anthropic is to Claude. That's the chatbot that they use.
Wow.
How widely used is this Claude chatbot?
So they are really nailing the enterprise space. This is where they've managed to lead, in particular when it comes to coding. So yes, they don't have 800 million weekly users in the same way that ChatGPT does, but people love it in the enterprise, and that really has been their winning formula. They've been really rather profitable thus far, more profitable at least, or seeing more revenue growth than OpenAI has been seeing, because OpenAI has been all about the reinvestment. And in many ways, Anthropic has been seen as some sort of more asset-like version of this. Now, they're kind of casting that off a little bit, but they just raised $13 billion. They are valued at $183 billion. That was back in September. And they have 300,000 business customers. So they have been managing to show that the business model works.
Is there any expectation, Caroline, that these companies may come public at some point down the line? Because I just think about the money they're spending, and I know a lot of people want to throw money at them, but maybe even the public markets. Are they talking about that at all?
Well, Sam Altman has been saying, look, it's not, I can't give you a date, but clearly they were on a path in the next couple of years to going public. And that is the idea, because many of these businesses, these founders feel that it's their duty. It's a duty to be able to allow the everyday retail investor, as well as these very deep-pocketed venture capitalists, to benefit from their businesses and be able to take a chunk in within that. So we're seeing that these companies are talking about going public. We've heard it slightly less from the Anthropics of this world, but I think certainly there's going to be a push that these companies can't remain private forever, and these boatloads of cash that they need can't keep on coming from the same group of investors.
My guess is when they do go public, the founders will have a huge swath of the voting shares, and everyone else won't. Kind of like the Metas of the world.
Yes, exactly. And what's interesting is you mentioned Meta. They accessed the bond market just a couple of weeks ago to fund some of these.
30 billion.
Yeah, just incredible.
But remember, Sam Altman doesn't actually own any significant equity in OpenAI.
Ah, okay.
So how they would structure him to have voting shares is another thing entirely. They, of course, are owned by the overall charitable, not-for-profit. Is
that
meant
complicated
to
structure.
Be in control in some ways, and has stock of OpenAI. But I don't know what the breakdown of shareholding is by the founders of Anthropic.
I'm looking at the markets overall, Caroline, and for a second day, the Dow is outperforming the NASDAQ 100. I don't know how many times you can say that over the past couple of years, but the NASDAQ under pressure. And again, it's this idea that, the AI boom is now a little bit more in doubt. There's a little bit more skepticism, and people are asking questions about, is there a clear financial model for profitable AI? There's a lot of nonstop investment, but then how do people see returns in the next year or 2 years, as opposed to 10 years down the road? How has that conversation unfolded in the tech sector?
It's unfolding by having either side of the equation come on, the Michael Burrys of this world, saying, no one's factoring in depreciation of chips. We think that this is ultimately overvalued in a bubble. But then we're going to have Threadneedle come on and really start to say, look, the proof will be in the fundamentals. The proof will be in the earnings. We've just had a cracking set of numbers from most of the Magnificent Seven. We're still waiting on NVIDIA. AMD coming out once again showing that the total addressable market for their AI accelerators and more broadly the chips is going to be $1 trillion. They're showing that they're going to guide for not just 2 years, 3 years, but up to 5 years. They think that they can be tuning to about 35% revenue increases every single year. And we're seeing CAGR numbers coming in the 80% field for an AI accelerator offering. Their MI is really selling well. So I think that every time you question it, and yes, you can look at the worry about the circular financing, the anxiety that a lot of these companies that were very asset-light, I think Meta used to be very asset-light, and to your point, now we're starting to see them laden on debt. These things do fill people with some uncertainty, but if really the revenue taps got turned on, if AMD can prove out that they're building a clear line of sight on tens of billions of dollars of revenue, people will give them the benefit of the doubt.
I think everyone's grown very accustomed to seeing the cash and short-term investments line for all these big tech companies at like hundreds of billions of dollars. And that's not going to be the case if they're going to continue investing this much and spending this much.
Yeah, and we saw Meta stock go down pretty precipitously today when Mark Zuckerberg said they're going to step up their capex by that degree. So that was interesting to see too. A little bit of caution there. Morgan Stanley out with a report recently. I just saw today saying basically, boy. A lot of things have to break right to generate returns on these investments, just writ large on the industry. A lot of things really got to break right.
And we don't know what's going to happen tomorrow with airplanes and,
So
getting to the airport.
Infrastructure and all the things that actually need to work for us to be able to get the data centers up and running.
Yep, very good. Caroline, thank you so much. We appreciate that. Caroline Hyde, BTech co-anchor for Bloomberg News, joining us live here in our Bloomberg Interactive Brokers studio. Bloomberg Intelligence today is brought to you by the Jewish Communal Fund. New tax laws take effect in 2026, reducing some charitable deduction benefits. Open your JCF donor advised fund now to maximize tax savings. Call 212-752-8277. S&P up 6 points. The Dow's up 400 points. That's 0.8%. The NASDAQ taking a break today is down 68 points. That's about 0.3%. We'll have more coming up. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Business Flash, it is brought to you by Oracle. Attention growing businesses. Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. For new U.S. customers with minimum financial commitment, see if your company qualifies at oracle.com/Bloomberg. Well, you've got a mixed look on the screen here. This says the government shutdown nears an end. House members set to vote on a spending deal in Washington today. Right now, we'll start with the NASDAQ. It's down about 0.2%, 52 points, but we go to the Dow, up 0.8%, 398 points. The S&P 500, little changed, up about 5. The 2-year yield, 3.57%. That's down 2 basis points. The yield on the 10-year, 4.08%, and that's down 4 basis points. Gold above $4,000 an ounce. We have oil falling. The IEA now says global crude demand may rise 13% by 2050. We look at Brent crude up more than 2.5% at $63 a barrel. WTI crude, $59 a barrel. Over to company news. We'll start with Chevron. They are capitalizing on the boom in artificial intelligence. The oil giant selected West Texas as a site for its first project to provide natural gas-fired power to a data center. And Anthropic, it says it plans to spend $50 billion to build a custom data center for AI work in several U.S. locations. That includes Texas and New York. And sources say Eli Lilly dropping CVS Health's drug benefit plan for its employees. It comes after CVS, they stopped covering its weight loss drug in favor of a rival medication from Novo Nordisk. And finally, Airbnb testing a new service with Instacart. It's going to let guests at some of its U.S. rental orders order groceries through Airbnb. That's ahead of and during their stay. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That is a Bloomberg Business Flash. Scarlett and Paul.
All right. Thank you so much, Lisa Mateo. This is Bloomberg Intelligence with Paul Sweeney and Scarlett Fu. We are streaming live on YouTube, and of course, we are live in our Bloomberg Interactive Broker Studio in Midtown Manhattan. There was a proposal from the Trump administration to introduce 50-year mortgages. In fact, the president posted on social media, on Truth Social, Great American Presidents. There's a picture of FDR, 30-year mortgage, President Roosevelt, and then a picture of him, 50-year mortgage. So let's talk a little bit more about this, whether it makes sense, how it would even work, with Erica Adelberg. She joins us right now in studio. She is our Chief Mortgage-Backed Securities Strategist here at Bloomberg Intelligence. The goal is understandable. They want to ease the housing affordability crisis because interest rates are high right now and housing prices are really high. So if you can spread out your loan over a longer period, the monthly payment goes down. Beyond that, Erica, how might this work?
Hi, thank you for having me on. You know, it's interesting because, of course, the 30-year mortgage itself was a great innovation, as, you know, kind of highlighted by the picture of FDR with the 30-year mortgage. And it was a product of the kind of post-recession when, you know, in order to help homeownership and because there had been a lot of people who had lost homes to foreclosures and things during the Great Depression, you know, 100 years ago, 90 years ago, I guess. This was a great American innovation, and it's really unique to the U.S. I'm not sure there's any other countries with a 30-year term, and it was really facilitated by the GSEs themselves, who are willing to guarantee something for 30 years. And so the proposal on the table right now is for the GSEs, for instance, to guarantee something for 50 years. But it's not linear, unfortunately. It's not like more is better or longer is better. You know, the problem is that this would double the amount of interest that most borrowers would have to pay for a very minimal savings in monthly payment. You know, they'd be saving, from our calculation on a median priced home, $100 to $200 a month. And they would pay, you know, like $800,000 more, I think something like that, or, you know, sort of $1,000 more over the life of the mortgage for, you know, $400,000 home. So it just doesn't make sense to us, not to mention the fact that we think the mortgage rate that these borrowers would have to take out, this is part of the problem, for a 50-year mortgage with that long of a guarantee would be kind of exorbitant, because you'd have servicers who would have to worry about default risk because these borrowers are going to be paying down almost no interest. It would take them, in 10 years, they would have only built up, I think my calculation is 10 years, they would only have paid down 4% of the equity. So, you know, in a housing market downturn, these people would really be at risk, for instance. So to guarantee that type of loan and to manage the servicing for that type of loan, you'd probably have to charge a higher rate. Plus, these are longer duration loans, so that really limits investor interest. So we just think the risks would mean that the mortgage rates that would have to be charged for these would make it a really unprofitable proposition for all involved.
So, Erica, you guys in the mortgage-backed security market, you've had a heck of a good year. I'm looking at the Bloomberg terminal, 7.8% year-to-date return. Wow, put that in context for us.
To put that in context, last I checked, that was the best we were through this time of year since something like 2002. So,
wow.
Probably in decades. And the excess returns have also been pretty amazing. They're not the best since the financial crisis, but very close, maybe in 15 years. And the reason is because, we started the year with the highest yields that we'd seen since 2007. And volatility has really come down as there's been increasing consensus around Fed direction and things. So those two things have really helped mortgage performance. So we called that at the beginning of the year. We said this was going to be the year that mortgages might finally climb out of the big rut they put themselves into in 2022 when rates rose. And in fact, we're finally back to a positive 5-year return, which is great for money managers, of course.
Yep.
So if the Fed continues to cut rates in 2026, and perhaps that is going to happen given that we'll get a new Fed chair, and Raphael Bostic of the Atlanta Fed has decided he will retire at the end of his terms, which means a new spot opens up on the FOMC, though he's not a voting member right now. What does that mean for the performance, the continued better performance of MBS? Has that been priced in already, the idea that interest rates are headed lower and therefore mortgage rates could come down as well?
Well, let's put this in the context in which you framed it. If Fed's independence is at risk, that could be a whole different scenario. Then we might see volatility pick back up, for instance. But if we think the Fed is doing what it needs to do to, move towards a neutral path, which is what we think they will do, even if they pause perhaps in December, that again speaks to volatility trending lower, rates trending lower, certainly at the short end. And even if they only trend lower at the short end, that probably increases levered buyers like banks who use funding more closely related to the front end, to the short end, to add mortgage-backed securities to get extra carry as an investment.
All right, Erica, thank you so much. Appreciate getting a few minutes of your time. Erica Edelberg, she's a chief market-backed security strategist. Bloomberg Intelligence, heck of a year so far from MBS, up close to 8% for total return. Not too bad. Let's get back to these markets here. The S&P, again, up 4 points. The Dow up 400 points, but the Nasdaq's down 58 points. So a little bit of red and green on the screen here. What do we do into year end? What do we do as we think about 2026? Let's check in with Frank Malcolm. He is head of macro trading at Buffalo Bayou, who joins us live here in our Bloomberg Interactive Broker Studio. We appreciate that. Frank, choppy year, but the risk markets, you've made some money this year. I mean, 20% moves in the NASDAQ, 15% move in the S&P 500. I know you got to own the right ones here, but boy, just on the index level, a solid year. How are you kind of positioning for the end of the year going into next year?
Yeah, pleasure to be here, guys. I think that when you think about this time of the year, typically is, I call it the 30-day closing program. Basically, you only have about 30-some days, trading days left in the year, right? And absent this shutdown fiasco that we had, typically this is when you're trying to start to set up for a center rally, right? But this year obviously it's a little bit different, right? We're coming out of the shutdown now, and I think markets are really faced with two conflicting sort of sub themes to close out the year, right? One is obviously you're seeing a bit of a relief rally in risk assets because the government is reopening, hopefully today, if not tomorrow. I think we'll get that, which essentially means there's going to be tons of liquidity returning to the market. We're going to be, you see a TGA release. That's the Treasury General Counsel. More liquidity would be coming to the markets. You can see that with crypto and all that. Sentiment's definitely turning. But on the flip side of that, what you're seeing is also worries about the return of data, right? You're going to end this blackout for economic data pretty soon here, but it's going to be very, very choppy to trade around because this data is going to be backward looking. We're going to have to trade this stuff retroactively. The data isn't super clean because there's been a lot of gaps in data collecting. So I think it's going to be tricky. I don't think the best way to put it is not going to be your typical center rally. It's going to be improvement in risk sentiment going into the year, but I don't see sort of a a huge center rally as we push through the year, just because of the chop we're likely to see here over the next couple of weeks.
All right, in the bond market, how are you thinking about trading in the bond market here? Because I can sit in a 2-year treasury at 3.55%. That's not a bad way to make a living here. But boy, there's been some better returns if I want to take some credit risk out there. How do you guys think about that?
Look, I think, I think credit spreads are, it's really hard to play credit spreads from a credit compression perspective. I mean, credit spreads now are kind of razor thin. The carry is still there, so it's pretty interesting. I actually think one has to be really cautious as to the level of volatility that we've seen in rates. I think it's painting a pretty complacent picture, because I think there's still some tail risks on both sides here. If we were to see a growth scare, or if suddenly, the bond vigilantes were to start looking at, this fiscal dominance issue that's still hovering over us, I think we could really see the tails getting activated here on both sides of the distribution. So we could, it's one of those things where we could be here at 375 on 10s, in early Q1, or we could be at 440, 450 if something were to happen. The bond market is one of those markets that really, really trades, especially when it comes to inflection points. It really needs real catalysts to break, pretty significant technical levels. I think now things are getting a little complacent because we really haven't had a major catalyst since we've seen the tariffs headlines kind of cool down a little bit. But I don't think we're out of the woods at all. I think volatility is really looking cheap to me in rate space.
What about gold? Is that big rush into gold over for now? I mean, it got to 43.56 in the spot market on October 20th, and then since then it's come back down, went below 4,000. It's above 4,000, but it feels like that moment has kind of passed for now, at least.
Yeah, I mean, look, I think the story is still very much bullish structurally for gold and even cyclically. I mean, we've talked ad nauseum about, the tailwinds that are behind gold, central banks buying, people hedging against debasement, inflation, et cetera. But I do think, though, that tactically here over the next couple of months, especially given the seasonality and risk asset tone and sentiment during this time of the year, even though, like I said, we might see a bit of chop with sort of uneven data coming in, I think the rally in gold as we get to the end of the year is probably limited here. I don't really see us taking out the recent all-time high here between now and the end of the year, simply because, if risk assets are doing fine, and and this is also the time of the year from a seasonality perspective where central banks tend to take a bit of a hiatus. They're not super active during this time of the year. So I think gold is probably cap here, and probably will trade in a bit of a range over the next couple of weeks, probably till we get to mid-January. Because obviously, no one really wants to sell gold too aggressively because of all these structural catalysts.
Yeah.
So I see a range probably around 43.50, the recent highs, to probably 3,800, where the 50-day MA is sitting right now.
All right, Frank, thanks so much for joining us. Frank Mockham, head of macro trading at Buffalo Bayou, joining us here in studio. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Matei. We've got stocks. Well, a mixed look on the screen. This is as House lawmakers get ready to vote to end a historic U.S. government shutdown. We have the NASDAQ. It's falling about 0.3%, 87 points, but the Dow up 0.7%, 368 points. The S&P 500, little changed, up just a fraction. The two-year yield, 3.56%. That's down 2 basis points. The yield on the 10-year, 4.07%, and that's down 4 basis points. The Bloomberg Dollar Spot Index, that's strengthening by about a 0.1%. We have the Japanese yen weaker by about 0.4% at 154.83 against the dollar. In company news, JP Morgan, they began rolling out its JPM coin deposit token for institutional clients representing dollar deposits at the bank. Visa, they're testing the ability of businesses to send stable coins directly to consumers. Crypto wallets for global payouts, they're using Circle Internet's USDC token. And speaking of which, shares of Circle, they're down about 8%. It did report higher than estimated revenue earnings in the third quarter, but the thing is there's concern about declining interest rates and how that will weigh on returns going forward. And finally, Kim Kardashian's apparel brand Skims raising new funds at a $5 billion valuation. Companies looking to expand its store network, add new products as well. That is your Bloomberg Business Flash. Skims? No, I don't do the Skims.
No,
I don't.
I'm not a big fan.
No,
Is that athletic leisure wear kind of thing?
No, it's like what you wear under like little tank tops, but they suck you in.
Okay.
I like the sound effect.
Thank you. You have to do it with the sound effect.
Sure. All right, Lisa, thank you so much. We appreciate that. Lisa Mateo with a break there. We got Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Head over to youtube.com and search Bloomberg Podcast, and that's where you'll find us here. So, Scarlett, I think we're getting the government open maybe as early as this evening.
Oh, my
if
gosh.
the House moves, if not, I don't know, in the next day or so.
What is it? It's day 43 of the shutdown right now? Yes,
Yeah.
we're day 43.
There you go. So, so we'll see what that means. My question is, what was it all for? Did we get anything done here? I don't know. Gautam Mukunda joins us here. He's a lecturer at the Yale School of Management and a Bloomberg opinion contributor joining us live here in our Bloomberg Interactive Broker Studio. Gautam, is it worth even saying, well, first of all, did we get anything out of this shutdown?
Well, it depends on what you mean by we.
Okay. Like the people, the peeps.
The Democratic base got evidence that the Democratic leadership will respond to their collective sort of apocalyptic rage of the Trump administration and actually fight. This is the longest shutdown in history. This is a fight. And even more so, since every single member of the United States Senate knew that this is how it was going to end, it was a fight driven entirely by the need of Democrats to sort of answer to their base.
Okay, what about for ordinary people who's not part of the Democratic base? What did we collectively get out of this? Or at least what did we learn?
Yes, well, we got an enormous amount of disruption in government services, and a lot of that stuff I always remind people is you don't know about the government. The government is like an airbag, right? It's you really, really need it when you need it, and all other times it's invisible to you. My father worked for the Department of Energy, and he did something that wasn't at all important. He managed nuclear waste. So if that goes wrong, that's a big problem. But you'll never hear about him when it goes right, and this makes it much harder. But within all that context, I think Democrats are also sort of learning that they manipulated the politics of this. I would say is not terribly well, but the Republicans sort of played the game on a board where it was essentially impossible for them to win. There was no set of moves on the part of Republicans and no set of moves on the part of Democrats that would end with anything other than a political defeat for Republicans.
How do you figure that? Because I think, I don't know anything about this stuff. And quite frankly, I tried not to pay too much attention to it.
Because it'll enrage you if you think about it too much.
Plus it's basketball season. I got the Knicks, I got Duke, I got important stuff. Are there winners and losers? Because I think the narrative is the Democrats caved and the Republicans didn't give away anything.
So in policy terms, that is exactly what happened.
Okay.
But politics and policy are sadly deeply disjoint in modern American politics, and politics is a zero-sum game right now. Two parties, one of them has to win. And so what did we see? Well, Republicans structured this, the bill and all sorts of things where Obamacare premiums were going to shoot up, and it would be their responsibility. And Democrats were able to fight this on the grounds of we're trying to save you from that.
Okay.
The political damage of that, as people are having to pay these sort of astronomical increases, they're going to be people where most of their take-home pay is going to health insurance, right? And this is actually disproportionately concentrated in red states. So this is a big political problem for Republicans. And the one thing the Democrats got out of this is they forced Republican senators to actually go on the record saying, we're not going to help solve this problem. That's the first one.
Okay.
The second is the Trump administration, as is its wont, at least the second time around, kind of acted in a way that, whatever their policy preferences are, the rhetoric and the way it appeared was kind of like mustache-twirlingly evil in ways that don't make a lot of political sense, right? So 42 million Americans depend upon SNAP funding for food, right? And it is perfectly possible for the Trump administration to pay out from emergency funds to do this. And their argument was, well, this isn't a real emergency, but of course they've been claiming emergencies left and right all the time, so that doesn't make sense. So courts go and say, you have to pay this out, and they appeal, right? They actually go to the Supreme Court saying, we don't want to pay this out. So you are litigating to the wall to stop from feeding 42 million Americans?
The optics are not good.
This is awful optics.
But I would argue the MAGA voter would still go in tomorrow and vote for President Trump. That's how strong his grip is on his base. They probably made the decision. It really isn't a political risk to us.
So I think that's right. So there's no question that the hardcore MAGA voter is going to hold on, that this is, we have never seen anything like this in American politics. So totally clear on that. But two things. One is, one of the ironies of American politics is many people who depend on government support do not somehow believe that they do, right? There's this legendary sign, which is a real sign. Keep the government's hands off my Medicare, which is right. Yeah. But I had a friend who grew up on a farm, and who would tell me, like she grew up on a corn farm, and she told me, like, we never got any support from the government. I looked up her dad on the government database and found out that he got more from the government every year than my parents made in income, right? So there's just this thing. So that's part of it. So one is the SNAP funding that comes in, like, people feel that, right? Like they feel it. But the second, of course, is elections are not won by the MAGA base. It's just not big enough. It's the 15 to 20% of Americans who are not, they're not part of MAGA, but they're open to voting for MAGA candidates. I think this looked really bad to them.
Okay.
So how does this set us up for the 2026 midterm elections? And I know that that's still a year away, so a lot can happen between now and then, but it kind of at least gives us some starting points in terms of narratives.
Yeah, so the narrative is going to be really clear, right? That these are the 40-day shutdowns only happen under Trump. This sort of thing keeps going. But the problem is we're just going to do this all over again in January. Right? The continuing resolution just runs through the middle of January. There's going to be some votes, and then it'll just happen over again. And it's actually hard for me to see, as the pressure ramps up and we get closer and closer to the midterms, how we don't have another shutdown, because all of the forces will be on Democrats to keep doing this, and Republicans don't seem to have a game plan for how to evade the political
Although
damage.
some of the agencies will be funded through the end of the fiscal year, not everything, right?
Yes, yeah. So we'll figure out some way to patch together the emergencies, and so maybe the maximum inconvenience will be there. But again, weirdly, the Trump administration chose to play the shutdown to maximize the inconvenience, not minimize it. So that's a different politics. What might happen, I think, is I'm not sure Chuck Schumer will be the Senate Minority Leader for too much longer.
He'll take the fall.
He may have to.
Okay, so we now have a couple of weeks of hindsight for us. The governor races in New Jersey and Virginia, how important were they for Democrats? Maybe how problematic are they for the Republicans in midterms?
So pretty problematic. So one is, it's not just the Democrats won. That was not surprising. The margins were surprising, right? I mean, I do this, spend all my time on this, and I did not see Cheryl winning by almost 15 points in New Jersey. That was a thing. Where it's really is the gerrymandering war that Trump set off through Texas has not played out the way really anyone, not even Republicans, it has not played out the way anyone anticipated it. Between California swinging back, they didn't do well in Utah, they didn't do well in Ohio. It looks to me like the net for those gerrymanderings is giving Republicans 2 seats. Now, we're not done yet. Maryland hasn't finished, Virginia hasn't finished, so maybe it ends up being 4 seats. But even that assumes that the Texas gerrymander, which was based on the 2024 demographics of the electorate, holds. New Jersey and Virginia, now Texas Hispanics are different so this could be different, but New Jersey and Virginia suggest that Hispanic voters are really swinging hard against Trump. If that's true, it's not impossible this gerrymander may actually cost them seats.
Interesting.
Yep. All right. We'll pay attention. As a resident of New Jersey, it was kind of interesting to see that the degree to which Mikey Sherrill did win, because the polls going into it were kind of neck and neck. So it just shows you that the polls, once again, were wrong. Gautam Mukunda, thank you so much for joining us. Gautam Mukunda, he's a lecturer at Yale School of Management. It's a great school. A lot of folks, good folks coming out of there. He's also a Bloomberg Opinion contributor. He's a Harvard dude, but he wears a
is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu, Paul Sweeney. And we are live here in our Bloomberg Interactive Brokers studio, streaming live on YouTube as well. We were talking about a name earlier, kind of a, I guess it's probably not a throwback tech name. Cisco, you know, at one point that was just the bomb, like in the 1990s and 2000s. That was one of the best performing stocks, and now it's kind of all become about the internet and now AI and all that type of stuff.
But it's making a bit of a comeback now.
It is, absolutely. It's up, you know, north of 22% this year. You know, Intel's also had a nice run this year. So if you can catch that AI wave, if you will, boom, it doesn't matter really
But I mean,
what
is it doing with AI? That's my question.
All right, let's talk to an expert here, Ryan Vlastelica, equities reporter for Bloomberg News. He's based out there in Chicago. Ryan, talk to us about Cisco. They had some good numbers approaching its dot-com peak. Talk to us about Cisco and kind of what's the narrative behind this company these days?
Sure. Well, thank you so much for having me. So yeah, like you said, this has been a record that is 25 years in the making. It was, like you said, a major winner of the dot-com era. When that bubble burst, the stock was absolutely decimated. I think it fell about 90%, and it has taken all of this time to get back to kind of close to getting back to that record. I think it's about 15% away right now. The real question is, will this company's networking equipment, all of its optical products, all of this stuff, is this going to be a major beneficiary of the build out in AI infrastructure? We're starting to see some signs of this, but this is not the kind of company that you're seeing a huge acceleration in growth the way we saw maybe with Oracle or with other companies that were sort of maybe forgotten, dismissed as yesterday's news, but managed to catch a new second wind.
Right, legacy tech or old tech. And we should mention Cisco will be reporting results, quarterly results, after the market closed today. And Ryan, what did we learn from its last quarterly earnings about whether it has any leg to stand on in terms of joining this AI boom?
Well, it does have an AI business, and they are seeing some improved sales there, some more deals. It is coming out with AI-related products. I think as the AI trade evolves, or going from just sort of, you know, the first step of the move, which was the chip makers and so forth, we are getting expanded beyond that to all other parts of the AI infrastructure trade. And networking is going to be a big part of this. And this is a place where Cisco obviously has a huge footprint. It has a, you know, ton of contacts and a huge supply chain. So it is arguably quite well positioned. The question is, are we going to start to see this translate to really accelerated growth there? This is a pretty steady grower, growing about 5% or so a year in terms of revenue. People really want to see much stronger growth than that in order to really kind of include it among the notable AI momentum winners.
Yeah, and I think, Ryan, the street's stock ratings kind of reflect that. I'm looking at the A and R function for Cisco. 16 buys, 10 holds, and 1 sell. So there's a little bit of a split out there on the street. Is this kind of a show-me stock? You know, once you guys put up some AI-related business, then I'll buy the stock?
I think that's a good way to put it. I've talked to a few investors in the company. I'm like, why do you like this company? And the first thing I hear is dividend. So the fact that it pays one of the strongest dividends in the tech sector is certainly something that is making it at least have the appearance of a more stable, mature legacy name, like you said. But of course, this is not a market that is focused on stable, mature, and legacy. It's focused on growth. It's focused on disruption. And Cisco's ability to kind of join that really hinges on whether it can show a real acceleration from AI. So far, estimates aren't really pricing that in, or it doesn't seem like there's too much explanation of that, which is why I think the analyst consensus is a little bit more muted. I think that works out to, what, 60% or so are buy ratings. That's much lower than you see at other companies, where it's typically over 90% for the mega caps.
You mentioned dividend yield for a tech stock, and I just started laughing because that's not something that people are looking for in their tech names. It's got a dividend yield of 2.3%, and you look at other companies that do pay dividends, like Microsoft or Oracle or Apple, their yields are less than 1%. Ryan, when it comes to partnerships with big, flashy companies, Cisco does have something with NVIDIA that it can kind of show investors, right?
Yeah, so designed to really sort of accelerate AI adoption, especially among large enterprises, which is, again, where Cisco really focuses. That's its main customer base right there. Now, someone I spoke to said just like NVIDIA or Cisco does not get any real credit for this. It doesn't get any real credit for the optical business it has, and we've seen very strong performance in other optical companies like Lumentum or Coherent, companies like that. So maybe this is a company where people are going to wake up to it if it does, show that it can really participate in this market, really accelerate its growth. I do kind of wonder if you will see more people kind of waking up to it, jumping on the bandwagon in the way that we saw with Oracle when after, a couple of strong quarters, people are like, oh, this is really going to be one of the big AI winners.
Yeah, I think so. It's interesting to see if they can pull that off. That would certainly be the case for them. For a name, again, it's been since, 2000. That the stock has been at even remotely close to these levels,
Yeah, I mean, I just think back for years we talked about the world's biggest maker of internet gear, and that packed a lot of punch back in the day. It doesn't anymore.
No, it doesn't.
It's a commodity.
No, it's all about AI. Ryan Vostelica, thank you so much for joining us. Ryan's the equities reporter for Bloomberg News, giving us the latest on Cisco here. Looking at the markets, kind of mixed here today. We kind of had our little, reopening rally yesterday. Maybe.
Although, to be fair, we haven't really lost that much momentum. The Dow Industrials is up by 0.75%. Interestingly, the second day of outperformance compared to the NASDAQ and the S&P 500. You've got names like Goldman Sachs and healthcare names leading the way in the Dow Industrials.
Does your stock go up if you get a dinner invitation to the White House? Is that kind of how it works? All right, we'll see about that.
That's not official, by the way. That's based on our reporting.
That's based on our reporting. All right, for our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts in just a moment. S&P down 4, the Dow up 372, and the NASDAQ down 125 points. This is Bloomberg. Good morning.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Wednesday morning. This is Bloomberg Intelligence with Paul Sweeney and Scarlett Fu. We've got a lot coming up on the second hour of Bloomberg Intelligence as we are in day 43 of the government shutdown, but perhaps that will end soon as well. All right, Emily Mason will be joining us. She's the Bloomberg FinTech and Crypto reporter. She'll talk to us about Circle, which issues the second biggest stablecoin. Those shares are falling on concern that lower interest rates will slow its profits. We'll also check in with George Ferguson. He is Bloomberg Intelligence's senior aerospace, defense, and airlines analyst on the latest in terms of the congestion at the airports, the delays, the cancellations. Things are looking a little bit better here. Anna Rathbun is CEO and founder at Granadilla Advisory, and she'll join us to give us her take on the markets, what she thinks about whether this AI bubble is a bubble or whether this is just a pause. And Shaheen Contractor, she covers ETFs, or I should say ESG ETFs for us here at Bloomberg Intelligence, and she'll give us the latest on ESG. Is it still a thing? I'm not sure that it is. All right, first let's go now to Alexis Christophorus for our Bloomberg Business Flash.
Thanks, Scarlett. And stocks are mixed right now. There's still optimism that the U.S. government shutdown is nearing an end. The Dow Jones Industrial Average rallying ahead about 390 points now, further into record territory. The S&P 500 down about 5, and the NASDAQ under pressure for the second straight day, down now about 132 points. Yields are slightly lower with the 10-year yield at 4.06%, two-year yield at 3.55%. Checking commodities, gold rallying 1.3% right now to 41.84 the ounce, but We have oil sliding. West Texas Intermediate down 3.5%. Brent crude also off about 3%. And Bitcoin down for a second straight day, off about 0.5%. Traders are betting that once the shutdown's over, the resumption of data releases could bolster the case for interest rate cuts from the Fed. And if history is any guide, the S&P 500 has gained after all 4 government shutdowns since 1995, with the exception of early 2018. NVIDIA, which led those big tech names lower yesterday, just adding to those losses today. NVIDIA down 0.2%, but AMD, boy oh boy, extending yesterday's gains, now up more than 9% after the chipmaker's CEO projected accelerating sales growth over the next 5 years. And Russian President Vladimir Putin signing an order allowing Citigroup to sell its bank inside the country to Renaissance Capital. This deal is still subject to regulatory approval. It's just the latest in a string of recent deals that have been greenlit by the Kremlin. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous. That's a Bloomberg Business Flash. Back to Paul and Scarlett.
All right, Alexis, thank you so much for that. We appreciate it. As Alexis was reporting, we got some red and green on the screen here. Let's take a look at some of the stocks that are on the move today. I'm Paul Sweeney alongside Scarlett Fu, and we're joined by Bloomberg's Nora Melinda. Nora, what are you looking at?
Well, Paul, let's take a look at On Holdings. This is a stock that's really been in focus a lot of today. That's ticker ONON. Of course, we know this is a company that's backed by tennis player Roger Federer. We're seeing shares climbing as much as 28% in today's trade. This is the best day that we've seen for performance since 2023, and this is after it boosted its sales forecast for the year. We did get some better than expected third quarter results as well. That's really buoying the stock higher. But we are thinking about a lot of sales that are happening both in Asia and Europe. It seems as though this sneaker is clearly a hit, especially as you pair it up to a lot of the competitors that it's really been rivaling during this time period. Nike, Under Armour. It seems like it might be the new shoe that everybody cares about right now.
Yeah, for a while, that's all I saw on people's feed, On Holding sneakers.
Yeah, I didn't know it was a thing until recently.
Me either. I was behind the curve, apparently.
Nora, the second stock you're looking at?
AMD, this is ticker AMD. Shares rising as much as 11%. This is the biggest intraday jump that we've seen since October. The company projected accelerating sales growth over the next 5 years. We did get some analysts on Wall Street saying that they're positive here in the forecast, and they do see material upside to current estimates here. But if you look at share performance on the year, I'm seeing shares of AMD up about 115% year to date. So this has definitely been a positive year for shareholders of AMD.
Yeah, that is a nice move there. And there's another name that's been out there for a while, but boy, they've certainly caught the AI wave there. Black Rock Coffee Bar, again, didn't know it was a thing. So let me know what's going on
Today's my first day hearing of it, so I might be out of the loop here. This is ticker BRCB. It actually went public back on September 12th here. We are seeing shares sliding, though, dropping as much as 5% today. This is after it announced its first earnings report since going public just in September, and it did give an outlook for the year, but it did disappoint. I mean, Morgan Stanley is saying that if the aspiration of the new IPOs is to handily beat at least the first few quarters, that didn't really happen this time across the P&L for the company.
See how this, like when I took like 1 million companies public as a research analyst and as a banker, I knew what the first probably 2 quarters numbers were going to be to the penny. There's no risk of disappointment there. What are you guys going to earn first quarter out of the box? You know, and I'll come in there at a little bit of a discount. And you can beat my number. Everybody's happy. I don't think they play the game anymore. I don't get it.
It's a bit different.
All right. Go figure. All right. Very good, Nora Melinda. There you go. And that's kind of what we got here. That's our Stock Movers Report. For more conversations like this, subscribe to our Stock Movers Report. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. Where do we want to go from here?
Well, there's another stock that's on the move, and that is Circle Internet Group. It's the issuer of the second biggest stablecoin, USDC, and the shares are tumbling today, down about 8%. And this is on kind of what feels like a pretty pedestrian reason, concern that lower interest rates will slow profits. I mean, that's kind of unusual if you think, you know, cryptocurrency or crypto-linked company with lower interest rates. Let's bring in Emily Mason. She is a Bloomberg News fintech and crypto reporter, and she joins us now. So, Emily, just explain to us the dynamic here, why lower interest rates from the Federal Reserve would be a concern for a company like Circle.
Yeah, so Circle issues USDC, and that's a stablecoin pegged to the US dollar, and they maintain that peg by holding reserves in cash and short-term treasuries. They keep the yield from the treasuries, and that's kind of how they make money, and that's where most of their revenue comes from. So if interest rates go down, that shows up in earnings, and that causes some concern for investors and analysts.
So what have their recent results been like?
I mean, this is their second time reporting since going public. They benefited heavily from all the hype around stablecoin, especially before the Genius Act was passed, and their stock performed really well. It's kind of been down since their summer highs, and that's kind of because of the concern from the interest revenue, but also because of some of the distribution partners that they have. They have revenue sharing agreements with Coinbase, for example, who helps distribute their coin.
So if this company for now is kind of a proxy for a money market fund because its earnings track short-term treasury yields, it must need to do more to diversify its revenue streams. What is it looking at?
Yeah, that's what they're doing. And then if you talk to Jeremy Allaire, who's the CEO, he'll kind of say that lower interest rates are actually good for the company because it means that there's higher velocity of money, there's more investment, and then people want faster moving money like stablecoins, and they also might want to use products like their Circle Payments Network, which recently is experimenting with like a stablecoin payouts product, which like helps people to pay out globally with USDC. And they're trying to move more USDC volume onto their own platform instead of working with distribution partners like Coinbase, and that kind of could help them as well. But they see the lower interest rates as a positive thing. And also the USD circulating supply is increasing very heavily as they add new partners. So that also kind of could potentially offset the lower interest rates.
Emily, your beat is FinTech and Crypto Reporter. Two things that didn't exist even just a handful of years ago. Talk to us about broadly the kind of the intersection of the growing crypto market and applications like FinTech.
Yeah, I mean, I think what's kind of the most interesting right now is like FinTech, when it came onto the scene, was sort of like building very sleek interfaces on top of his existing financial infrastructure. And then crypto's pitch is much more sort of like rebuilding the financial infrastructure with things like blockchains. And now the conversation is kind of about bringing the traditional world and the traditional financial infrastructure together with crypto rails. And Circle's really kind of sitting at the center of that and trying to bring stablecoin and like integrate that with how traditional markets work. And that's involves a coming together on both sides. Like traditional firms kind of have to upgrade and make their systems interoperable with crypto technology, and then crypto firms also have to kind of move into a regulated environment. And that's been something that Jeremy Allaire has talked about for a long time. Like he really thinks that crypto needs to be regulated, and Circle, that's been a big part of their narrative, is like we are kind of like the suits in the room and we're going to be regulated, and that's how we're going to go about doing business.
They're kind of the most TradFi of the DeFi world, in other words, if we want to get technical. This is going to be a dumb question, Emily, but we've seen how Bitcoin and the rest of the cryptocurrencies had a pretty rough October. They're struggling to regain momentum. All these digital coins are not the same as stable coins, but is that shift in sentiment and conviction on Bitcoin and altcoins, especially from institutions, affecting demand at all for stable coins? Or are those two just not linked?
I mean, stablecoin is used a lot of the times, like anytime there's a lot of trading happening in crypto, like and in crypto tokens, like stablecoins kind of benefit because they're used to like move in and out of those markets. The stablecoin, the whole point is that it's like a stable currency. It's pegged to the dollar. It's one for one. So the price of it really shouldn't be impacted at all by like crypto market movements.
But does demand affect it? Or does the spillover involve like demand waning for stablecoin or increasing for stablecoin?
I think where like the demand growth for stablecoin is going to come from is like it moving out of a tool for crypto trading. It's going to be like people in countries where the local currency is volatile wanting to hold stablecoin, or people wanting to actually use it for payments, or like stablecoin payouts. Like if you're a US-based company and you're employing a bunch of people around the world who want to hold a stable currency like the dollar, the stablecoin is the best way to access it, then you can pay them that way. Like that's where demand for stablecoin is going to come from. I don't think it's like super tied to the trading necessarily. Like people use stablecoin to get in and out of crypto markets. So, they might see more volume if trading activity is high. But their journeys are kind of becoming less linked.
Got it. Thank you so much, Emily. Really appreciate your joining us. Emily Mason, Bloomberg FinTech and crypto reporter, making her debut on Bloomberg Radio.
Oh, awesome. She did a great job.
All
Awesome.
right, well, we'll get her back on again.
But a crypto and fintech reporter, that beat didn't even exist 15 minutes ago.
That was a great point.
Yeah, I mean, but that's why you have to somebody young and smart who can learn that stuff.
Just like Emily.
Yep.
All right, let's go to someone who is smart, George
Yeah, we're not
Ferguson.
going to young part. Let's be honest. Let's be honest.
If you're watching us on YouTube, you'll see what Paul means. All right, George Ferguson, Bloomberg Intelligence, Senior Aerospace Defense and Airlines Analyst, and I'm joking, George. There's a headline here from the U.S. government that it aims to start lifting flight cuts in a week once the government opens. And of course, we're still waiting for that to happen. So if it happens today, maybe the flight restrictions will be lifted next Wednesday.
That would be good because we're coming into the Thanksgiving.
All right, so there you go. George, great to speak with you. What does that mean in the meantime? I mean, apparently the disruptions today are a little bit better than they were yesterday.
Yeah, I think they're not getting the full 10% cuts. They're, in flights. I think, what we're hearing is 4, 5, 6%-ish kind of levels. These are the smaller airplanes, less lucrative, routes. So if you looked at it, total seat counts wouldn't be as interrupted as 5%. So I feel bad for you if you're flying to one of those tertiary markets, into a hub or something like that. But I think if you're on a major route, on an important money-making route for most U.S. carriers, you're probably just going to do fine. Maybe you got a little bit of a delay. I think hopefully something gets passed today, and I think you'll be sort of all clear to get back to the normal challenges of air travel in a week.
Yeah, I mean, it's hard enough as is, and I've got clear, I'm pre-checked, I got everything you can have, and sometimes you still get...
Still painful.
You still snagged, I don't know. George, talk to us about just supply and demand out there in the airline industry today in terms of capacity for these airlines. Are you happy with where it is? Do you feel like there needs to be some more supply, or maybe less capacity in the market?
Yeah, I think there needs to be a little bit less capacity. We're actually starting to cut the numbers into 1Q and 2Q, starting to think about sort of the first half of next year. Actually, domestic is starting, some of the numbers we're seeing are coming down to a little bit below 2% growth in seats for the U.S. market. I think that's pretty good. I think we probably want to be sub-GDP growth because I think there's still maybe just too much supply. Interestingly, and maybe no surprise to your listeners, we're still seeing the big full-service carriers growing the fastest. Delta and United really growing the fastest. My concern is going to be for premium seats here. I do think there's a bit of a market share game going on where, in the back of every United jet, there's a little Spirit Airlines living. And so they want to take over that basic economy business, right? They'd like to keep you in that tube, fill out that tube as full as they can, 85% kind of full. That helps with their profitability as well. So there's a bit of a market share grab. And again, we're kind of still seeing full service growing stronger than that sort of 2-ish% growth in seats we're seeing in the first half. So I think there may be a bit of a premium challenge as we go into the new year.
I mean, from where we sit, and I haven't been traveling during this period of disruption, things are about as good as it can be, given that we have all these shortages of air traffic controllers. Are airlines going to look at what has happened over this past week and say, you know what, we can cut a lot more flights and, yeah, maybe it'll inconvenience some people, but financially makes much more sense? Kind of to your point about capacity, there's just too much capacity, but the government shutdown kind of proving that they can do more with less.
I don't think so, right? So I think really what you have is carriers like United are filling out their domestic route network. They're taking delivery of bigger airplanes, A321s is why they were upset they couldn't get the 737-10 out of Boeing, which are both the bigger versions of those narrow-body aircraft, put more people in there, make sort of lower cost per seat. And so they're kind of filling out their fleets with these larger aircraft. Meanwhile, the low-cost carriers are also taking some of those bigger aircraft. Even Southwest, which is sort of migrating from low cost to a sort of a full-service carrier, they're taking 737-8s. So everybody's got sort of this cadence of larger airplanes coming to their fleet. They'll retire some But they want those larger aircraft again to drive down costs, which means I think that you've got sort of a baked-in amount of capacity build in the U.S. market that's
Right.
hard to avoid, and you need that capacity build to lower costs. Like I said, pilots are making a really nice wage right now, so I don't see them sort of deciding that less is more. I think they think more is more, and they want share.
All right, George, thanks so much for joining us. Appreciate it. George Ferguson, Senior Aerospace, Defense, and Airlines Analyst for Bloomberg Intelligence. He's also a U.S. Army veteran, so a day late. We will wish him happy Veterans Day. Appreciate your service, as always, Captain Ferguson. Good stuff there. Surprisingly, he was in intelligence, which was the last thing I would have thought, but there you go.
Well, then it makes sense. Intelligence of Bloomberg Intelligence.
Yeah, exactly. And I hired him, so it's okay. He does a great job, one of the best on the street. We appreciate getting some of his time. S&P down 7 points. The Dow's up 350. The Nasdaq's down 145. So there you go. No direction whatsoever. WTI crude oil, I take note of that. Below $59 a barrel. And I know from watching Landman, that is not good. They need $75 a barrel. This is what.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
7:21 on Wall Street. I'm Alexis Christoforous, and this Bloomberg Business Flash is brought to you by Oracle. Attention growing businesses. Oracle's offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. For new U.S. customers with a minimum financial commitment, see if your company qualifies at oracle.com/Bloomberg. We have got a mixed picture on Wall Street today on hopes that the longest government shutdown in U.S. history will soon be over. The Dow Jones Industrial Average powering ahead, up 336 points at an intraday record of 48,265. The S&P 500 down about 7 points, and the NASDAQ Composite lower by 144. We've also got the Russell 2000 down just fractionally, and bond yields slightly lower with the 10-year yield at 4.06%, the 2-year yield at 3.56%, and oil is slipping with West Texas Intermediate now down nearly 3.5%. In stock news, Kava and Sweetgreen in the spotlight. The fast casual chains have been put on Citi's 90-day positive catalyst watch. Both chains have a big presence in the Washington, D.C. area, and analysts at Citi believe Kava and Sweetgreen will see improved sales once the government reopens. The stocks, though, are split right now. Kava down 1.8%. We've got Sweetgreen up more than 4.5%. And shares of Coinbase down about 0.5% right now. The company has filed with the SEC to leave Delaware and reincorporate in Texas, where they say the regulatory environment is more friendly to crypto. Coinbase also tapping former Goldman Sachs partner Liz Martin as VP of Product to oversee markets and derivatives. Once again, we've got a mixed market. The Dow Industrial's up 336. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Alexis Christoforous, and that's a Bloomberg Business Flash.
All right, Alexis, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Head over to youtube.com, search Bloomberg Podcast, and that's where you'll find us. The word I've heard more frequently over the last 4, 5, 6 weeks is bubble. Do we have an AI bubble? Do we have a private credit market bubble? Do we have just a bubble in the market in general sitting here at 23 times earnings? I don't know. I'm just throwing money in a 401k. I'm telling my kids to do the same and hope for the best long term. Anna Rathbun, CEO and founder at Grenadilli Advisory, joins us here. So, Anna, how do you think about that when you talk to your clients? Is there a bubble out there in some of these asset classes? Are you concerned about that at all?
Good morning. I'm happy to be back. I think there are bubble-like characteristics for AI as well as some other parts of the investing landscape. But I think the word bubble scares a lot of people. What I usually say to clients is, if the bubble were to burst, what would you find in it? Would you find nothing in it, which would scare everybody? And that's not the case with AI. So I think we have to find some nuance in talking about bubbles within AI, or frankly, private credit, since we have been talking about cockroaches for a while now.
Yeah, I mean, even if we are in a bubble, we won't know it until months after the fact. So when you look inside AI, where do you see the value? Where do you see the opportunity, given how extended some of the price gains have been?
Yeah, the price from a stock market perspective, yes. I mean, if you have something like, 300, 500x PE ratios, yeah, that is very, very high. And it does scare a lot of people. It makes people nervous. But if we were to take a long-term view, and not only forward, but also backward, we actually didn't build enough data centers for a long time. There was a stage where we didn't have enough money going into business investment after 08, 09 for a really long time. So I think some of this is actually catch up. We're trying to do AI and finding ourselves with not enough capacity. But the other thing we're finding out, and I think the reason why the markets are reacting the way it is, in addition to taking some gains, is that we're finding that we're not demand constrained, because we're hearing that there's a lot of demand out there. We're supply constrained. And so we heard from CoreWeave yesterday, and we're also hearing from a lot of friends in the energy industry, this is going to be a supply constrained issue. So I think what the market is doing is actually discounting in terms of time value of money when they're going to see some of those returns. And you see those names going down actually for the last week or so.
Anna, I know in your new firm here, you're focusing on alternative investments. Give us your thoughts on how do you define what is alternative, and kind of where do you see opportunities these days?
Yeah, so I do alternatives and public market investing. So I'm looking at the markets at large, everything that private clients can go into. As far as alternatives are concerned, I mean, we're looking at real assets, infrastructure, and real estate. And that's where you can really play the real asset picks and shovels of the AI game, and not necessarily in the public markets where valuations can go really, really high. And then there's, of course, private equity and private credit. I'm a little bit more careful on the credit side, just in terms of selection and the level of discernment that is really required to pick on the private credit side, and to a certain degree, private equity as well, because a lot of these, companies are interrelated because of direct lending and more specifically, sponsored direct lending. So right now, my favorite might be infrastructure and real estate.
And how would you get exposure to that? Would you do it through publicly traded companies? Would you do it through business development companies? What's the preferred vehicle?
So this is where alternatives and really private investing comes into play. So, we partner with certain investment companies that are out there that actually the portfolio companies underneath are the data centers, not the companies that are managing the data centers. So we're kind of removing that middle section. And data centers, but not only that, but also cooling companies. We have on our list, our watch list or select list, companies that are doing, or private equity partners that are actually buying and owning natural gas. I would call it a factory, but they're involved in natural gas as well as ethanol. And there's a lot of demand for energy, and there are a lot of private equity players that are poised to really benefit from it. And not only that, but actually supply some of the energy that is required to run these data centers and ultimately to develop AI software. So
in the alternatives space here, for most clients, Anna, what do you think is a reasonable allocation of alternative investments versus maybe public markets?
Yeah, and that is very client specific. The number I'm hearing out there is about 20%, but that's not for everybody. And the biggest question in my mind is, what kind of liquidity do you need? When do you need it? Because a lot of these alternatives, you're going to have to lock up your liquidity. And that's where some of that premium for higher returns, potential higher returns comes from. So for me, liquidity, there's nothing like cash. Cash is king, right? And being able to take your money out is a huge value. So I would put liquidity front and center at looking at client situations and determining what allocation is really appropriate for the client.
All right, good stuff. Thank you so much, Anita Rathbun, joining us. She is CEO, Anna Rathbun, she's the CEO of Grenadilla Advisory, joining us from Independence, Ohio. We want to shift our attention now to something that's happening in Brazil. COP30, the 2025 United Nations Climate Change Conference, kicked off this week in Brazil. And I feel like we don't talk about it here in the U.S. because the U.S. has pretty much decided that it doesn't exist.
Right. And we heard President Trump at the United Nations, basically
say as much.
Yes, exactly.
So let's bring in Shaheen Contractor. She is, of course, she's our senior ESG strategist, works a lot with our ETF crew here at Bloomberg Intelligence to talk to us a little bit about what's going on in the world of ESG outside the United States. And Shaheen, you, in your research, talk a lot about ESG versus ESG plus. What does ESG plus mean?
So ESG plus is funds that include ESG plus impact, sustainable. It's almost like the word ESG has become confusing, and I need a short way to say it in research. So it's ESG plus. It's everything responsible investing.
Talk to us about COP20. Because we were recently at a Bloomberg Philanthropies conference at the Plaza Hotel, which focused on climate change and so on. And what I think Scarlett and I kind of learned is the rest of the world's moving forward with a lot of these new technologies. And if the U.S. wants to participate, great. If not, okay, we'll see you guys. Is that kind of the tone coming out of Brazil, Rio?
That seems to be the case, yes. I think the one piece that people are watching that, kind of depends on the U.S. is this fossil fuel phase down that countries committed to last year. Yet, that's not being reflected in countries' climate plans. Mm-hmm. So I think that's one of the hot conversation topics. How will that materialize going forward?
if you're an investor and you wanted to still be very much exposed to all this ESG and the efforts to reduce carbon emissions, how do you do that? Do you look to European companies? Do you look to Chinese companies? What's the best way to think about how to pursue that?
Sure. I think the best way right now to think about it is by theme. So what clean or climate theme do you want to have exposure to? And I'll give you an interesting disconnect. So I don't know if this is surprising, but clean energy is one of the best performing themes of the year.
In terms of investment performance?
Yes.
Okay.
50% year-to-date performance, 30% outperforming the market.
Wow.
Okay.
Correct. So if you look within that, there are certain themes like decentralized energy, for example, that are showing this correlation with AI because data center decentralized energy. So I would look at it from a thematic angle at this point.
Talk to us about how unique is the U.S. in our view of climate change and investing in maybe different types of energy sources versus rest of world?
So I'll touch on the policy aspect. The U.S. is an outlier. I don't think that's a surprise to anyone. I think from the technological standpoint, the business standpoint, there is quite a bit of momentum. A lot of these companies, these climate funds that I mentioned, they are domiciled in the U.S., and that outperformance is still seen. And a driver for that is really this AI-driven power demand, right? Power demand is expected to double by 2028, and that really favors these faster deployed technologies, solar, batteries, etc. So I would say, that is the focus everywhere, regardless of policy.
We started on this idea that this COP30 conference is taking place in Brazil. Do you think anything will come out of it that, I know, I didn't even finish my sentence yet, that changes the way investors need to think about how they're deploying their money when it comes to ESG?
We'll have to wait and see. I think this COP is dubbed the COP of implementation and adaptation. So the focus is not on headline, this is this much money going towards XYZ, but on implementing things from the past. And I think that's going to be key. And seeing what actually materializes will be key in deciding that going forward.
30 seconds left. Are U.S. companies investing in cleaner energy type things?
Given this power demand, yes, there's a race for anything that produces electricity right now.
See, that's my take.
love that
My
answer.
simple energy policy is, I think we need everything.
We need
Until
everything.
somebody tells me we don't, I'm going to be investing in everything, including nuclear, including...
correct.
Now, maybe the dirtiest coal plants I don't need to deal with, but there's some cleaner coal plants. I don't know. It just feels like if people are telling me this demand is going to be
You
crazy.
can't afford to say no to things.
Exactly. So that's
Correct.
That's
But then
my
the
policy.
fast deploy technologies are favored, right? Renewables is a faster time frame than nuclear, which is multiple years.
Exactly. We need everything. So I'm throwing money at everything. Shaheen Contractor, Senior ESG Strategist, Bloomberg Intelligence, joining us live here in our Bloomberg Interactive Brokers studio. S&P down 3 points. The Dow up 330 points. That's 0.7%. The Nasdaq's off about 110 points. That's 0.4%. Maybe getting this government open as soon as this evening. We'll keep it right
That'd
here.
be something.
Yep.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
11:40 on Wall Street. I'm Alexis Christoforous. This Bloomberg Business Flash is brought to you by Van Eck, celebrating 70 years of helping investors stay ahead in a world that never stands still. Visit vaneck.com. And for a second straight day, it looks like investors are rotating some money out of the big tech names and into areas of the market with relatively lower valuations. We've got the Dow Jones Industrial Average again in record territory, up 334 points. Broader market pulling back. The S&P down just about 3, but the NASDAQ composite is off 116 points. We've also got oil prices lower. WTI crude is now down more than 4%. We've got Brent crude, the benchmark, global benchmark for oil, down 3.7%. This is as OPEC said global oil supply will match demand next year, and this marks a further shift from its earlier projections of a supply deficit. In stock news, Airbnb is testing a new service with Instacart that will let guests at some U.S. rentals order groceries through the home sharing app ahead of and during their stay. This pilot program's open to select hosts with available listings in Phoenix, Orlando, and L.A. Guests will be allowed to place an Instacart order within the Airbnb app up to 3 weeks before their stay. We've got shares of Airbnb down about 1% right now, and shares of Instacart up 1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Alexis Christoforous. That's a Bloomberg Business Flash. Back over to Scarlett and Paul.
All right, thank you so much, Alexis Christoforous, with our Bloomberg Business Flash. This is Bloomberg Intelligence with Paul Sweeney and Scarlett Fu. And, the past week has really been kind of a reality check for a lot of investors who are betting big on the AI trade. It's been kind of wobbly. A lot of people asking whether there's a bubble. So, of course, we need to bring in Dan Ives, who's insisted all along that we are only at, I think, 9 p.m. and a party that lasts all night.
Right.
Maybe the time has ticked over a little bit. Dan Ives is Global Head of Technology Research at Wedbush Securities. Dan, did everyone just kind of take a pause in the partying, in the AI party that runs all night?
Yeah, and look, in that party, it's 10:30 p.m. It was 9 p.m., but that party goes to 4 a.m. But look, Scar, we've talked about it. The DJ is gonna stop playing music sometimes. There could be glass on the dance floor. Maybe cops come to the party, but the party's going to 4 a.m. These are just white knuckle moments. What I view is this tech bull market has 2 more years ahead of it in terms of the AI super cycle of CapEx.
Dan, I know you travel. You spend a lot of your time traveling around the world, visiting your institutional investor clients, meeting with the companies you cover. I'm sure question number 1 or 2, or maybe 1 and 2, is about the AI bubble here. How do you put that into context in terms of some of the spending?
Yeah, Paul, I put in context, as someone like myself who covered tech stocks in the 90s, the average tech company was 30 times revenues. Now the average tech company is 27 times earnings. Big tech, trillion on the balance sheet, 300 to 400 billion a year of free cash flow. CapEx next year is probably going to be 580 to 600 billion. It all comes down to demand and supply that we're seeing. And I mean, just come back from Asia, demand and supply for NVIDIA chips is what, 12 to 1, 15 to 1. So I get the concerns, but it's my view investors are underestimating the scale and scope of what this is going to ultimately look like.
Maybe part of it is because investors are focused on earnings 12 months out, revenue 12 months out, and this is a story that needs a longer runway beyond 12 months. How many years are we talking about?
I mean, I think if you're Meta is a good example, right? Like that stock, phenomenal earnings, CapEx ramps up, earnings, free cash flow goes down next year. But when it comes to Meta, right now Zuckerberg's wartime CEO, focused on the future, next 2, 3, 4, 5 years. That's the right move for them to make. And that's why I just view this as you have to have a longer perspective. Just like Palantir, you're never going to ultimately look at Palantir over the next 1, 2 years. I think Palantir is $1 trillion market cap in the next 2 or 3 years.
Dan, how about Apple here? It's a name that one could argue is not quite fully benefiting or even partially benefiting from the AI tailwinds here. What's your call on Apple as it relates to that?
Get the popcorn out, Paul. I mean, I think this is one when it comes to Google Gemini. That's going to be the AI deal that ultimately is going to monetize the biggest install base in the world. I think that could add $75 to $100 to Apple stock. And that's why I think Apple here, I think could ultimately be one of the biggest surprises in 2026 as this all plays out. And also, look, iPhone 17 ahead from everything we see from our checks in terms of almost a surprise upgrade cycle. And the New York City cab drivers embarrassing Apple the last 6 months.
So just to be clear, Dan, you think that Apple will strike a deal with Google and its AI engine?
It's a matter of when, not if.
Okay.
I think that is going to be the future. That's going to be their partner. And when it comes to the AI party, right now, Apple, they're behind the velvet ropes being like, okay, they're looking through the party, through the window. Could you let us in? Now they will be in that AI party. And it speaks to the multiple, right? That's not reflected right now in the stock.
Well, Apple certainly has the cash to flash everyone.
Yep.
What about Cisco? We were talking earlier with Ryan Vlastelica of Bloomberg News about how the stock has made this round trip and is almost approaching its dot-com peak. And part of it depends on whether it can get in on this whole AI thing. And, you know, that's a big question mark. But is this something where it's an AI arms race? Can legacy tech companies make up some lost ground and get a little bit of benefit from here?
Yeah, look, ask Arvind at IBM. Look in Nadella and Microsoft. I mean, and it continues, right? Because I think Cisco's one. Like, they've made acquisitions, they have a massive install base, and they potentially commoditize the AI revolution. But that will continue to be the next phase for them. They have to prove it out from an execution perspective. And I'd be shocked if they don't do more acquisitions over the next 12 to 18 months.
And Dan, before we let you go here, just your call on Tesla here. It's off a little bit today, off about 6% year to date, but obviously so many crosswinds for investors to navigate.
They are going into the best and biggest chapter of growth ever. Autonomous and robotics is the future. Musk, now wartime CEO, the $1 trillion pay package. He's going to be the leader of this, you know, what I view as really the best physical AI play in the world besides NVIDIA. And I think this is one we're going to be talking about $2 trillion. $3 trillion over the coming years as this goes into what I view as really the AI chapter for Tesla. That's why it's, to me, 600 base case, 800 bull case.
So you see Elon Musk earning that $1 trillion over 10 years.
Look, I think it's one where it's like if he brings 4 or 5 trillion of value, then what, he gets 700 billion. I mean, the point is you're paying him because it's no different than Nadella's importance in Microsoft. Karp's importance, Palantir, the godfather of AI gens in NVIDIA. There's only one Musk. And I think when I look at the future, autonomous robotics, that's the future. It's going to be less about selling cars. That is ultimately where Tesla's going to shine. That's why it's so important.
Before we let you go, and I know we keep saying that, but you know, we want to make sure we get as much coverage with you as possible. NVIDIA, in 1 week's time, will be reporting earnings. And, you know, it feels like it's been a while since there were NVIDIA watch parties because, you know, that was when the AI boom was in full swing. What are we likely to hear from Jensen that we haven't heard already? Because every time he goes somewhere, we're tracking his comments. He was in Asia and talking to folks in Taiwan and South Korea, and we covered all of that. What's going to be new in the latest earnings report from NVIDIA?
And I think there will be watch parties. I'll have a party. The invite will be in your email for you and Paul.
Excellent.
Yeah, so get ready for that. Look, the reality is that investors right now underestimate where numbers go. I think numbers, even without China, go up 10 to 15% next 12 to 18 months. And then when China reopens, even partially for NVIDIA, that's going to be an extra incremental 15, 20 billion. Then you go from Blackwell to Rubin. There's one chip in the world fueling the AI revolution, and it's led by godfather of AI gens in NVIDIA. That's what I ultimately see. $6 trillion market cap 2026.
Dan, thanks so much for joining us. Always appreciate getting some of your time there. Dan Ives, he's Global Head of Technology Research at Wedbush Securities, checking in with us. We appreciate that. Continues to keep his, here's the title of his most recent note. Tech stocks will navigate this white knuckle period to rip higher into year end. Now, if you gave a quiz, said who wrote that? I mean, everybody would know who wrote that.
Yeah.
Right? I mean,
10:30 p.m. in a party that lasts until 4:30 a.m.
Yep, there you go. So he gets your attention, if nothing else. And you know what? Generally been right to be bullish on tech. Yeah, 2022 is tough, but nobody made money in 22. But if you're bullish, long-term bullish on tech, like Dan has been, you have been right. You have been rewarded, and that's kind of how he plays the game. We'll have more coming up. This is Bloomberg. Good morning.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, whether we like it or not, the holidays are upon us. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. And with the holidays upon us, that means shopping. And for retailers, it is obviously the most important time of the year, kind of right now through year end. So we want to get a sense of how that's shaping up for the retailers out there. Mary Ross Gilbert, Senior Equity Analyst. She covers the retail space for Bloomberg Intelligence. She's based in our Los Angeles office. Mary, thanks so much for joining us here. We're, kind of right into November, getting into the thick of it here. How's the holiday shopping season shaping up? What are your companies saying?
Thank you, Paul. So if you look at how the holiday shopping is shaping up, I think it looks very positive. So I think we are going to see an increase, and particularly for apparel retailers, that's usually like the largest category that consumers, if you look at those that have been pulled by all the holiday surveys that have been conducted, including the National Retail Federation, and they have over 8,200 respondents in their surveys, and the other ones are pretty sizable, relatively speaking, around 5,000. So they're showing that there's definitely a higher percentage of shoppers wanting apparel and accessories for gifts. So that should be good news for apparel. But Gen Z is planning to cut back on their overall holiday spending by 23%. Millennials just 1%.
Wow. So the Gen Z, these are the younger folks, maybe tougher time finding a job, maybe student debt. Is that kind of the driver there?
Yeah, I think that could be part of it. Yeah, it could be the job market situation that might be happening there, because these are really like the 17 to 28-year-olds. So we have been hearing some, talk about some of these latest graduates, having a difficulty finding a job. I think it's just probably going to take longer, because generally unemployment is still very low, and soon we'll be getting, more data on that. But we're seeing resilience. If you look at the data so far with Bloomberg's second measure for apparel retailers and department stores and off-price, we're seeing good sales coming in for the third quarter, and they'll start reporting their numbers in the next few weeks. So I think we're off to a good start, and I think Black Friday sales are already happening. Macy's is out today with 50% off on their private label brand product, and they expect to have other drops every week.
Wow.
So everyone's focused on starting now.
Yep.
With the promotions.
So Mary, economists talk about a K-shaped economy out there. Some consumers, maybe the ones that own assets like stocks and bonds and real estate, doing more than good, and kind of everybody else struggling a little bit, particularly with inflation. How does that get reflected in retail sales? Does it mean you just kind of, if you're an investor, look at, I don't know, the Amazon, Target, where I can get some deals?
Yeah, and that's actually what's happening, and that's why you see, let's say, pretty robust sales overall coming out of off-price. So think of TJ Maxx, Ross stores, and Burlington stores, and Burlington's at the very low end. If you look at credit card delinquencies, or those rates, and a lot of these companies that we're tracking represent the credit card holders for like department stores and for some select apparel brands such as Gap, et cetera. And when you look at that data, delinquencies are actually lower this year versus a year ago, but not for the very low income, which it kind of speaks to what you're talking about, and inflation. Actually, those are up in the teens, for the very low income consumer. So think like under 50K.
Yep. How about e-commerce, Mary? I know the pandemic, folks are saying, kind of pulled forward maybe 4 or 5 years of share shift from bricks and mortar to digital. What's the e-commerce growth story look like these days?
E-com growth is looking strong. When we look at the data, like I said, for the third quarter that we're seeing from Bloomberg's second measure, it's showing actually online sales were stronger at the department stores, except for Kohl's. Kohl's online businesses, not their online business, but actually their credit customer is shopping less, like in the double digits less. So that's kind of an issue for them. But generally, we're seeing stronger pull with online sales there. Now, there is also a delineation between the type of consumer. If it's Gen Z, they tend to prefer shopping more in store.
Really?
And we see that with Abercrombie and Fitch's Hollister brand. So they are about 70% of their sales are generated online. And then it's the inverse when you look at their namesake brand, Abercrombie, because that consumer those are millennials, and millennials prefer to shop online. So 60% of their sales are being generated online versus in store.
Interesting. All right, Mary. Thanks for that brief. Really appreciate it. Mary Ross Gilbert, Senior Equity Analyst covering the retail space for Bloomberg Intelligence. She's based out there in Los Angeles. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. Top stories coming up in just moments. We've got a red headline crossing the Bloomberg terminal. The EU preps new probe into Google over news publisher rankings. That's according to the Financial Times. We'll have more reporting on that. So yet another European regulator looking at some of these big U.S. tech companies, which seems to be status quo. S&P down 9 points, the Dow up 300, NASDAQ down 150. So red and green on the screen. Yields come in pretty sharply here, in 6 basis points on the 10-year Treasury, now at 4.05%. The top stories and global business headlines are coming up right now.
CBS News on the Hour, sponsored by Progressive Insurance. I'm Steve Kathan. Newly released emails by House Democrats from the Jeffrey Epstein estate. Epstein wrote in 2011 that Donald Trump had, quote, spent hours at Epstein's house with a victim of sex trafficking, and said in a separate message years later that Trump, quote, knew about the girls. CBS's Aaron Navarro.
White House Press Secretary Caroline Leavitt said, quote, that House Democrats selectively leaked emails to liberal media to create a fake narrative to smear President Trump. She said that the unnamed victim in the emails released this morning, whose name was redacted, is the late Virginia Giuffre, who had worked in the spa at Trump's resort in South Florida, Mar-a-Lago, and per Leavitt's statement, repeatedly said President Trump was not involved in any wrongdoing.
House Speaker Mike Johnson swipes at Democrats hours before a vote on the Senate-passed measure to end the government shutdown.
I just want to apologize to any Americans who are out there who still have flight cancellations or delays today. I want to apologize to the many American families who were made to go hungry over the last several weeks, our troops and other federal employees who are wondering where their next paycheck would come from. All of that's on the Democrats.
Well, CBS's Chris Van Cleve is on airport duty.
It remains a question mark for what happens throughout the day today as the government remains closed and those controllers remain working without pay. But with a potential end in sight and a promise from the Transportation Secretary of a lump sum payment being rushed out to controllers within 24 to 48 hours of the government reopening, there is hope that the staffing crunch that we have been talking about for weeks may be behind flyers.
Correspondent Ed O'Keefe reports President Trump sent a letter to Israel's president asking him to pardon Prime Minister Netanyahu.
The president called the charges against Netanyahu, quote, a political unjustified prosecution, and said, quote, it is time to let Bibi unite Israel by pardoning him and ending that lawfare once and for all. The prime minister has been facing a years-long corruption investigation and trial, but describes it as a left-wing witch hunt.
Well, CBS's Michael Wallace tells us about jobs for the holidays.
The job site Indeed says the number of retail holiday job postings is down 15% from last year. Companies that usually hire thousands of holiday workers like UPS, Macy's, and Target haven't made any announcements this year. Many companies have been cutting jobs. Indeed senior economist Corey Staley.
So we're seeing a lot of the broader trends in the labor market being reflected in this year's holiday hiring.
A Deloitte survey found Americans plan to cut their holiday spending by an average of almost $200 this year.
Wall Street, the Dow is up 328 points. This is CBS News. If you're considering a move, consider this.
A new report from MRI Software crowns Nashua, New Hampshire, the best city in the U.S. to move to. It hits all the key quality of life metrics with plenty of job opportunities, a decent cost of living, and safety. Just an hour from Boston and 4 from New York City, Nashua has a little more than 91,000 residents. Second on the best city to move to list, the Chicago suburb of Aurora, Illinois, with a glut of jobs and a low cost of living. Number 3, Cleveland, cited for a steady job market, a growing downtown scene, and its lakefront location. Dover, Delaware, and Salt Lake City round out the top 5. Deborah Rodriguez, CBS News.
3 paintings by the late Bob Ross sold for more than $600,000 on day 1 of an auction. 27 others will be sold to benefit public TV stations hurt by federal funding cuts. Steve Kathan, CBS News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
Last day of the shutdown, or so they tell us. Welcome to the Wednesday edition as we count down to votes in the House later on today, and they're going to be important. Expected to fund the government on a plan that runs through January to end the longest government shutdown in American history, assuming the president's there to sign this. We're going to bring you live to Capitol Hill for an update from Bloomberg's Caitlin Riley on, yes, this last day of the closure. The economic impact, however, of the shutdown is very real and will continue to be for the nation's most vulnerable. We're going to consider the way it's exaggerating a K-shaped economy when we spend some time with economist Peter Atwater. And later this hour, a special conversation with Kevin Hassett, director of the White House National Economic Council. He's going to sit down with David Rubenstein at the Economic Club here in Washington. We'll have that for you live and unfiltered. And we start, as always, with a look at Wall Street. Let's get to the markets first. Alexis Christoforous has the read on the markets live from New York. Hey, Alexis.
Hey, Joe. Stocks are mixed in the Dow in record territory on optimism that this U.S. government shutdown will soon be over. The Dow Jones Industrial Average up 363 points. The S&P 500 is off 4. The NASDAQ Composite slipping 133. Traders are betting that once this shutdown is over, the resumption of key economic reports could boost the case for another interest rate cut from the Federal Reserve. High grocery prices, especially for things like coffee, continue to take a bite out of household budgets. But in an interview with Fox News today, Treasury Secretary Scott Bessent said relief is coming soon.
You're going to see some substantial announcements over the next couple of days in terms of things we don't grow here in the United States. Coffee being one of them, bananas, other fruits, things like that. So that will bring the prices down very quickly.
Futures for Arabica coffee down nearly 5% on that news. Tariffs, including those on top coffee grower Brazil, have constricted the flow of coffee beans to the U.S., and that helped send prices to record highs last month. And airline stocks are bouncing back after their recent sell-off. The U.S. is on track to have fewer flights canceled today than on any other day since the Trump administration restricted air travel. The FAA says if the government reopens this week, air travel could be back to normal by the Thanksgiving rush. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Alexis Christoforous. That's a Bloomberg Business Flash. Back to Balance of Power and Joe Matthew.
Alexis, thanks so much, and thank you for being with us here on the Wednesday edition of Balance of Power. It's going to be a big day. By the time we're done, they tell us the government might be up and running again. And first, of course, everybody needs to get back to town, which is easier said than done. So thanks for being with us today on Bloomberg Radio. Streaming live on YouTube, search Bloomberg Business News Live. You can always get us on your satellite radio at channel 121 and on Bloomberg Originals. Last stop for gas, Frederick, Maryland. Congressman Derek Van Orden says he had a great talk with Tony and took a selfie with him at the gas station there, having taken a motorcycle all the way from Wisconsin so he could vote today. Is it that hard to get on an airplane that we must submit to 951 miles on a motorcycle? Others found their way onto planes, from what we understand. Not always easy. Greg Stanton, Eli Crane, Andy Biggs, Paul Gosar, all on the same flight. That's a party. Had to divert, apparently, make a pit stop in Kansas City to remove a disruptor on the plane. This is what it takes to get a quorum in the House of Representatives in the middle of a government shutdown when air capacity is being pinched. Is that true? Producer James says, great Waffle House up there, Frederick, Maryland. Maybe the congressman stopped by. Of course, you know, a lot of lawmakers have already been here. The leadership is here, and we're going to take a minute. We'll walk you through the whole TikTok and the timeline of what's going to happen today when we talk to Caitlin Riley, who was up way before we were, combing the halls of Congress. The leadership already spoken. We heard from the Speaker of the House, Mike Johnson. We heard from Democratic leader Hakeem Jeffries, all here to say, welcome back.
House Republicans, welcome back. From your taxpayer-funded 7-week vacation, you now have an opportunity to actually take some action in an area of this healthcare crisis by working with Democrats before the Rules Committee this evening to extend the Affordable Care Act tax credits.
I just want to say that we're very optimistic about the vote tally tonight. We think this is going to happen, and we're sorry that it took this long. So Republicans are going to deliver for the people. We're ready to get back to our legislative agenda. We have a very aggressive calendar for the remainder of this year. There'll be some long days and nights here, some long working weeks, but we will get this thing back on track.
Take him at his word. I'm just wondering how long it goes tonight. What we understand here, Caitlin can correct me, 4 p.m. they're going to swear in, they're going to swear in Adelita Grijalva, the Congresswoman-elect from Arizona. And I haven't mentioned the name Jeffrey Epstein yet, so just let me get it out right there. Of course, won the special election to replace her dad. She's number 218 on the discharge petition. Epstein files. There's a lot more on that. We'll get to that later. Then the leadership gets busy here. They're going to start debate on the funding package, and we're told there could be a vote, like the big vote, by, say, 7 p.m. Let's see how this tracks with what Caitlin is hearing. Bloomberg's congressional reporter with us now live from Capitol Hill. Caitlin Riley, it's great to see you. How late of a night do we have in store?
Well, the plan from House leadership is to have members be done and walk off the floor by 8 p.m. We know that could always change. It's Congress, and so plans can go off the rails. We have heard from aides in Minority Leader Hakeem Jeffries' camp that he is not planning to go late into the night with his magic minute that allows him to talk for as much time as he would like before they call a vote. We know that over the summer when Republicans pushed through the One Big Beautiful Bill, Jeffries went for hours and hours and hours and delayed the vote until the early hours of the next morning.
Sure did.
What we're hearing is he's not anticipated to do that this time, which would, point to a relatively early evening here in the House, but we will see.
All right, I sense some optimism there. See, did you hear that, James? They get everybody off the floor by 8. We can make dinner reservations right now for when this is done, because, Caitlin, we're coming up there for special coverage, and we're going to do the show from that same spot you're standing in right now as lawmakers are preparing to vote or maybe have just voted. So tell me how difficult this whip count is for Tom Emmer and for Mike Johnson. Assuming everybody gets back into town, do they have the votes to pass it?
Yeah, absolutely. So we know the margins are thin. They can afford to lose 2 votes. Republicans are projecting optimism. Majority Leader Steve Scalise was on TV this morning saying that he expected to see some Democrats defect and vote to reopen the government. We know one did back in September. We'll see if they add more to that tally. But, it's the House. Margins are very thin, and there's always the possibility that things could go sideways.
Wow. Well, that keeps things interesting. We did hear the Freedom Caucus is good, right? They're all coming in to vote yes. Who are the troublemakers, Caitlin, or have they not yet been identified?
Well, someone to always watch is Congressman Thomas Massey from Kentucky. He has repeatedly voted against bills Republican leadership has put on the floor, particularly this Congress, and notably on the Big Beautiful Bill that passed earlier this year. But you're correct. Many of the right flank of the party, who can sometimes be a thorn in leadership's side, have come out in support of it. Congressman Andy Harris, who chairs the conservative House Freedom Caucus and is also an appropriator, has said he'll back the measure. I believe Congressman Chip Roy has also spoken positively about it, and so we're not anticipating, a lot of defections from the Republican side, but there are always members that are worth keeping an eye on.
All 219 members are expected to be in town. I mentioned Adelita Grijalva. She will be sworn in, just to be clear, Caitlin, before these votes take place?
Correct. She's supposed to be sworn in at 4 p.m. today. The vote margin at that point will be 2 for Republicans can afford to lose 2 votes at that point.
Yeah.
And she will crucially, as you mentioned, be the last signature needed to force a vote on the floor about releasing the Epstein files.
Well, yeah, since you went there, I got to ask you about it, and I don't want to get into this whole New York Times piece right now, but let's stick with what's actually happening in Congress, because the revelations in the New York Times story today actually came from documents that were given to the Oversight Committee, correct? And the Oversight Committee, according to the ranking member, says there are more emails to follow. That's a separate path than this discharge petition, which would also have to be passed in the Senate for it to work, right? So is Oversight actually the conduit for us to get all this material?
Correct. We know the Oversight Committee has been going through these files. There have been releases over the last few months by Democrats on that committee as well as Republicans, and that has been Speaker Mike Johnson's main counter argument to allowing this discharge petition on the floor. His argument is that Oversight is going through these and are releasing these documents in tranches, and that there's no need for this floor vote to push for the sort of wholesale release of the files.
It's quite the reader here that Jeffrey Epstein suggested in an email that Donald Trump knew about his activities. Do you have any sense, Caitlin, about what the disclosure might be later, or how much information Oversight is sitting on that has not been released yet?
I'm not sure of that. I know that about 20,000 other documents were released on the heels of the 3 emails that Democrats released this morning, where you saw Epstein in email suggest that Trump was aware of his activities. I'm not entirely sure how many more documents there are to come, but we have been getting these in these rather large tranches.
Just said it. Caitlin, thank you as always, and good luck with your coverage today. Maybe I'll bump into you up there. Caitlin Riley, part of Bloomberg News presence on Capitol Hill today, which is a pretty big footprint as we try to cover what's happening in a reopening. How about it? House of Representatives, after 7 weeks of recess. The New York Times definitely shaking up things here today with an email from Jeffrey Epstein himself in 2011. Quote, "I want you to realize that dog hasn't barked is Trump." Without specifying he was referring to the future president, he went on to say that a victim spent hours at my house with him and that he has never once been mentioned, without directly identifying whom he was referring to. The dog that hasn't yet barked. We'll have more on this throughout the day as we learn more. We'll be joined tonight, by the way, by a member of the Oversight Committee, Tim Burchett, and later on this program in our second hour, we're going to spend some time with Congressman Ro Khanna, the Democrat who was on that discharge petition along with Tom Massey, and I'm sure he's got a lot to say about the release of these files. We'll stick with the economy next. Looking forward to this conversation with Peter Atwater, the K-shaped economy, straight ahead on Bloomberg.
12:21 on Wall Street. I'm Alexis Christoforous. We have a mixed market with the Dow plowing further into record territory, up 390 points now at 48,319. The S&P 500 is down just 3, but the Nasdaq Composite sharply lower for a second straight day, off now 135 points. Nvidia losing for a second day in a row, now down about 0.5%. Nvidia will reportedly invest $1 billion to build a so-called green data center focusing on AI in northern Mexico. And Toyota says it will invest as much as $10 billion in the U.S. over the next 5 years to support future mobility efforts. The announcement comes as the Trump administration pressures the global auto industry to shift more production to the U.S. And Anthropic is launching a $50 billion nationwide artificial intelligence infrastructure build-out. This is starting with custom data centers in Texas and New York. Anthropic says the new sites will start coming online next year and will create 800 permanent jobs and 2,400 construction jobs. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous. That's a Bloomberg Business Flash. Back to Joe Matthew and Balance of Power.
All right, Alexis, thank you so much, and welcome to the Wednesday edition of Balance of Power. By the time this day is out in Washington, the government should be open again, which is quite a thought. And partly why the greatest story of the day has been overshadowed here. Because also on this Wednesday will not only be the end of the longest shutdown in American history, the final penny will be minted in Philadelphia. The last penny. Remember, President Trump ordered the end of the penny because it costs 4 cents to make a 1 cent token, which is a little bit ridiculous. And it'll take place in Philadelphia. Been making pennies since 1793. Producer James put this story in front of me this morning, a year after Congress passed the Coinage Act. Now, if you're like me and you don't even carry cash around anymore, this may not mean a lot to you. For some Americans, they're counting their pennies right now because they haven't been receiving food assistance or maybe a paycheck at all because of the government shutdown. And it's been interesting the last couple of days here, ever since maybe a couple weeks even, Peter Atwater put his post on LinkedIn. Everybody's talking about the K-shaped economy again. Just flip around. It's like the subject of every show and article that you can find over the past couple of weeks. And so we thought we would invest ourselves in this today, knowing that this shutdown has exacerbated the gap between the haves and the have-nots. It's worse than that when you talk to Peter and read what he's writing. Our K-shaped economy is worse than you think is the headline, remembering President Trump speaking to the economy just in the last 24 hours as he sat for an interview, as he delivered remarks at the White House, telling people that it's not exactly what you feel, it's something different. Here's the president.
We must get the government back open soon, and really immediately. We have to get it up. We have the hottest economy we've ever had, and it's affecting the stock market now a little bit. But the stock market has hit many record highs during the last 9 months, many. And it will again. This is just the beginning, because when these plants that are being built right now start opening up, we've never had anything like this as a boom.
Enter economist Peter Atwater. The K-shape to our economy is no longer just a story about the divergence between those at the very top and the very bottom of the economy. It is a statement on the widening gap between those at the top and everyone else. He's the president of Financial Insights, author of The Confidence Map. Peter Atwater, it's great to see you. Welcome back to Bloomberg.
Thank you very much, Joe.
We've been way overdue and looking forward to doing this for some time, and this is the time to have this conversation. Because, you know, it's going to take weeks, they say, to start fulfilling all these SNAP benefits and the rest. So we're looking at a moment in which we kind of tear the covers off the bed to see the state of our economy. How would you describe it?
We have two economies today. We have one that is intensely market-driven for those at the top, which is extraordinary. They are spending like there's no tomorrow. Meanwhile, for those at the bottom, they're not sure how they're going to make it through the day. And so that disparity shows up in all sorts of data, in corporate anecdotes, in earnings reports. And it's troubling to me, not solely from an economic perspective, but what it says in terms of sentiment. Because we have a small group of Americans who feel invulnerable. At the same time, we have this sea of mounting despair. And we talk, and I know you talk a lot left and right as being the biggest divisions in America. It's not. Our biggest division is up and down, and no more so than measured in terms of the confidence people feel.
How about that? It's not left and right, it's up and down. And you have an administration that's largely populated with people who are up.
Yes.
Does that matter?
Yes, it does. Because one of the I think unappreciated elements that happened during COVID is the top stopped interacting with those at the bottom. People started to work from home. In fact, it was that work from home divergence that first drew my attention, because I saw white collar workers immediately feeling better while blue collar workers continued to struggle. Hospital workers, factory workers, supermarket clerks. And those at the top don't see those at the bottom. We don't go to church together. We aren't involved in civic organizations together. We barely ride the subway together. And so those at the bottom have an intense awareness of what's going on above. But I don't think those above really appreciate the despair at the bottom.
Used the word despair a couple of times as the president describes this as the greatest economy in history. And we don't have a lot of data to put to this right now because the government is closed. And there are questions about what we're going to learn when the government reopens, BLS starts cranking out data again. So let's stick with the anecdotal, because this new poll from Bloomberg Harris is striking, to think that this many people are worried about losing their jobs. What's prompting the fear?
So if you go back to April, one consistent message we heard from CEOs when the tariff tantrum hit was they were going to control the controllables. I think it was the CEO of Norfolk Southern who said that. So you think about, if I'm a CEO of a business, what do I control? I control corporate investment and I control hiring. And so they immediately pulled back on the hiring front, looking for certainty. And here we are 6 months later, and the tariff question still remains. So the all clear sign hasn't come into the full economy other than at the very top with AI.
With AI, which is eliminating jobs.
Which is eliminating jobs.
And adding to the agita at the bottom.
Sure. And you see that not just at the bottom, but you see that with entry-level workers coming right out of college. You know, I teach at William & Mary, and so you hear from students, AI has gone from being this big opportunity to being a threat.
How about that? To college students.
To college students.
Who are studying economics.
And studying data science.
Yeah.
They now appreciate that employers are holding back on job offers because they believe that AI will fill the void.
Well, so the job market and the weakness that we're seeing is supposed to justify at least another interest rate cut. Do you support that view?
No.
You don't?
I don't, because we have two economies today. The bottom economy, yes, it supports a cut, but appreciate that the consumer is unlikely to see that in their credit card loan rates or even their car loan rates. Meanwhile, if we lower the cost of funding for those at the top, all we do is to make it cheaper to speculate. And we already see an explosion in option volume and leverage in the market to begin with. And so I think we have to realize that the K-shaped economy puts monetary policymakers in a real box.
So it increases speculation at the top. It doesn't loosen the housing market, for instance, or have any positive impact at the bottom.
It does, but appreciate that if you look at the inventory data, so Connor Sen, who's a reporter for Bloomberg, and I were exchanging data. If you look at lower income neighborhoods, they're awash in inventory for sale. And so it's questionable if you don't have a job, a lower interest rate isn't going to help you on a mortgage you're not going to qualify for.
How about that? That is an underreported story.
I think it is too.
And it speaks to the K-shaped economy. Nobody even knows that this inventory is available in a neighborhood like that because they're not shopping there. Kevin Hassett's going to be speaking in about 10 minutes. This is partly why we wanted you to join us, to help us walk into this conversation. You sit down with David Rubenstein, you never know what's going to come up. But I suspect they're going to get to inflation. And this idea that tariffs are not inflationary, which the administration has spoken to at length, and we've heard from everybody from Kevin Hassett to Joe Lavorgna on this program, Scott Besson, have diligently made that case. And they say, well, it's a one-time shift in pricing, and we need tariffs on a national security level. What does that mean if you're on the wrong side of the K?
Economists spend an awful lot of time talking about annual changes in inflation, and it drives me nuts because the consumer eats the cumulative effect. And if you look at the cumulative effect, particularly on food prices since COVID, it's a staggering number, particularly for those at the bottom. And inflation is not just an economic experience for those at the bottom, it's a psychological one, and it is on top of other ways they already feel vulnerable. So as much, I don't pay a lot of attention to whether tariffs will be inflationary or not. I see the impact already in the data on how people feel.
Got it. There's an argument, however, between hard data and anecdotal data that this White House has used to make its argument. When do we start seeing CPI jumping off the charts the way so many predicted?
You know, I'm not sure when that will be.
So this is the frog in the boiling pot.
It's the frog in the boiling pot, but I would argue that the cumulative impact since COVID hit already has the water boiling for those at the bottom.
Yeah, sure, right.
And they don't have the discretionary income. They don't have the savings to be able to afford that. And I think you really saw that with all of the SNAP benefit anxiety. I mean, the searches for food bank open near me have just skyrocketed. And that says the bottom is not good.
Yeah. What happens if the president sends $2,000 checks to everybody, the pocket dividend he's talking about?
You know, on the surface, that looks great. But let's look at the COVID experience with what happened.
We know about getting checks.
They flow through the lower consumer to the lower consumer's lender. It helps them to become more current on their auto loan. It helps them to become current on their credit card loan.
And people at the top just save it?
And people at the top just save it.
And that's not growth.
No, and for the bottom, they're a conduit. They're not in a position to create savings out of this. And we've hollowed out enough of the middle class that it becomes really concentrated savings among those at the top.
This is really instructive because when the consumer gives up, that's when the economy gives up. Do you see a recession in the next year?
No, what's so interesting is I refer to our current economy as a Jenga tower. It's top heavy.
Yeah.
And so the bottom economy is already in recession. Those blocks are being pulled out left and right. At the top, it's booming. And so I care less about what happens to economic growth at the bottom today than I do at the top. We like to joke that the markets are not the economy, but we've reached a point where the economy now is the markets. And so what happens to the financial markets is likely to have a supersized experience on what we see in terms of economic growth.
Well, now I'm starting to get scared because you look at that column about the so-called NVIDIA state in the Atlantic recently, or you consider what happened yesterday is just CoreWeave had a little sniffle and the market had a very nervous reaction. This idea of circular investing or a house of cards that is the AI race, and I'm not calling it that, by the way, but a lot of people are growing concerned that there's very little propping up this economy.
But the circularity is bigger than that because it flows all through those at the top. You know, when you have the head of Delta announcing that for the first time in its history, it will earn more revenue from the front of the plane than the back of the plane.
How about that?
That's saying that we have an economy that is unknowingly very dependent on a very few wealthy individuals.
The essence of a services-based economy with a small pocket of extreme wealth.
Yes.
So what happens to the rest of the economy if the K keeps going in both directions?
Well,
at some point, this is unsustainable, right?
It is, and you're starting to see the consequences politically. Affordability has jump to the headlines just like the K-shaped economy, and that's, to me, isn't surprising. But what it says is there is a potential, and I think we saw this with the election in New York City, that voters move not left or right, but move down. That progressivism is what begins to appeal. And we saw this if you looked at the relationship between confidence, consumer confidence, and Bernie Sanders' popularity in 2016. You saw that as mood fell, he became more popular, and so did Donald Trump.
I was going to say, this is the Trump effect as well.
It is the Trump effect. So you end up with anti-establishment, populist, potentially progressive, and I think politicians on both sides of the aisle underappreciate the consequences when you get somebody named Bob or Joe or Ann from Kentucky who can coalesce those at the bottom, left and right. The bottom is purple. And I think both parties like to suggest it's one or the other. No, it's purple. And increasingly, it's even more purple because of the rage that is felt.
Wow. So you could extend that to believe or suggest that Zoran Mamdani's base has more in common with the MAGA base than it realizes.
Absolutely. And
is that how we reconcile this gap?
Yeah, I saw him as a symbol of a move down. And it's not alone. We see this across Europe. We see this in other states. Those who are young and unemployed are excited by this. At the same time, it will have appeal to those at the bottom, left and right, because in many ways, they now feel betrayed by our two establishment parties. One of the most disheartening things for me as somebody who's been writing about this for 5 years is that those who are best in a position to do something about this seem disinterested and unwilling. And that hasn't gone unnoticed, particularly in the last couple of weeks, given the ping pong ball that was SNAP benefits.
Well, you know, so we're going to be hearing, I guess, momentarily from Kevin Hassett and David Rubenstein. What do you make of this? Everyone's calling you right now. You didn't put out a news release or hire an agent. Everyone realized that this K-shaped economy was something that we need to address once again.
Yes, I think this is a tipping point. This is like Tom Hanks getting COVID, where suddenly the crowd went from not being concerned to being extremely concerned.
Wow.
That this is so ubiquitous, so easily explained to anyone, cautions to me that the gap has become too great. And now the question is, how does it close? And I would encourage those in policy making to think thoughtfully about that, because if they fail to do that, we know that shared despair leads people to come together across history.
This is fantastic. I can't thank you enough for coming in.
No, I appreciate it.
It's great to see you and great to meet you, and I'm flattered that you listen to Balance of Power. Let's keep this talk going. If we can ever wrest him away from all the other programs, this man's in high demand. Peter Atwater, thank you so much for being with us here on Bloomberg. I'm Joe Matthew in Washington. Let's go across town, as I mentioned, to the Economic Club. Our own David Rubenstein in conversation with Kevin Hassett, live on Bloomberg.
Going to have an impact on this quarter GDP. That our estimate of the White House is that each week that we were shut down is worth about $15 billion off of GDP. I think the Goldman guys have added all that up and guessed that it's between 1 and 1.5% reduction in the growth rate of GDP this quarter. So I was kind of feeling good about a 3% quarter before the shutdown. So I guess that means that you think we'd be shooting in the sort of 1.5 to 2 range now because of the shutdown.
So GDP growth for the year, you think will be between 1.5 and 2?
Oh no, I'm talking about the fourth quarter.
For the fourth quarter. What about for the year?
Yeah, then we just have to average basically 10. Yeah, so it'll be 2 something.
2 something. Okay. Yeah. Now the inflation rate has been around 3%, 3.1% or something like that. Do you see any chance that the Federal Reserve will get it down to its target rate of 2% in the near future, or is that unrealistic?
If you look at a chart of inflation, that it's a time series that has quite a bit of momentum. And, you know, my friend I used to work with at the Fed, Alan Greenspan, used to say that, like, dealing with inflation is like steering the Queen Mary. They don't even have a Queen Mary anymore. I think they have a Queen Mary, too. Kind of dates poor Alan. But the fact is that that if you look at it, then what happened is that in the Biden administration, it got very high, averaged 5%, was still in the high 3s when we came in, and now, like, if you look at the latest CPI, it surprised, 48 of Bloomberg's people who forecast these things on the downside. If you adjust for a refinery that shut down, then you're kind of looking in the 0.2 range. And so I think that inflation isn't all the way to where you want it to be, but that the momentum is pretty directional. And so I think that if you add to that the basic idea that the policies that we're pursuing right now are increasing supply, their supply side policies, then you should expect that we could have growth like we're seeing without picking up Phillips curve effects in inflation.
So you may have noticed the president was calling on the chairman of the Federal Reserve to lower interest rates. And
really? He did?
Yes, he did. Oh. And and interest rates have been lowered. The last time the Federal Reserve FOMC committee met, they lowered by 25 basis points. There's a wide expectation that the Federal Reserve Board might lower again in December. Do you have a view on whether, if the Fed does lower it, should be 25 basis points or 50 basis points as the president, or do you have a view on what might be better for the economy?
Well, I first want to say that I have high regard for Jay Powell. I've known him for a long time, have had economic conversations with him many, many times during the last administration and this time too. And, I think at times he and I have had policy disagreements, but that's where it is. And I think that an example of a policy disagreement that Jay and I might have is that, I sort of agreed with the previous two meetings that it was the right time to cut rates. Then after the last meeting, the sort of two things that happened that surprised me looking at the macroeconomy is that we had the shutdown that happened and then was longer than expected, which is a negative for GDP. And then we had an inflation report, which was much better than everybody expected, why 48 people at Bloomberg missed it on the high side. And so I'm thinking, if I'm sitting at the FOMC thinking about how that affects my decision at the next meeting, then I'd say I'm more likely to move, because we got like two things that say, oh, well, the only news we have is more likely to move. And then somehow, Jay decided that the news between the two meetings made him less likely to move. And that's an example of a policy disagreement I have. And so I would guess that the fact that he came in signaling less likely to move makes the likelihood of them deciding to go 50 basis points lower.
You think it's more likely to do 50 than 25?
No, I think they're not likely to do 50.
50? More likely to do 25?
I think that's probably what. I mean, I'm reading the tea leaves that they're showing us.
Would that satisfy the president, do you think?
I think that the president thinks rates could be a lot lower, and I agree with him on that.
Okay, so obviously you were one of 5 people that the Secretary of Treasury has on a short list to be the next chairman of the Fed. Why would you want to be chairman of the Fed? Right now, you get to work with the president every day, and he's not criticizing you at all. So, are you sure you want that job?
It's a thing that, first of all, I have to say that I, as you know, feel like I'm the luckiest economist alive, because I have the best job I think an economist could possibly have if you spent your life doing, economic policy, unless you're a monetary theorist. And so I think, when Ben Bernanke was chairman of the Council of Economic Advisors, he probably thought, oh, there's a better job for me out there, because Ben Bernanke was one of the leading monetary theorists and historians of all time. And so for me, I think that being director of the National Economic Council is my dream job. And if the president asks me to be Fed chair, then I'll do it. But if I'm not Fed chair, don't be disappointed for me, because I love the job that I have right now. And I'm so honored to be able to work with the president every day.
Well, 2 of the people on the list have the first name Kevin. Is that a prerequisite to be on the list? I think, does that help a lot?
I guess time will tell.
Okay. All right. So you would take the job if you were offered it, if the president offered it?
Yes, we've had that discussion.
Do you have any view on when the president might make the decision or make it public? Would it be this year or next year?
I think that I don't have a view on when the optimal time for that is, and I've not discussed that with the president. I think that people in Washington will understand that a confirmation struggle for a position that's that significant can be quite difficult. And then if it goes on for a really long time, which, we think Jay probably isn't leaving until May, then that just creates like a long period of, confirmation struggles that can be pretty ugly. And so I don't know what the optimal time is, but I would guess that as soon as you do it, then the sort of confirmation turmoil will begin.
Most presidents in the last 25 years or so have supported, and secretaries of Treasury have supported what's called a strong dollar policy, which is to have the dollar be really strong and never support anything that would lower it. This administration has not seemed to be upset with the idea that the dollar has gone down against European currencies by about 10% since the beginning of the year. So is it fair to say you do not have a strong dollar policy, or are you happy where the dollar is now?
Well, this is a group that, like, everybody here probably can go to their computer and put up the dollar chart, and probably has already done it this morning. But if you look at the dollar chart, then it's stronger now than it was when Trump left office, but it's down a little bit from its peak. And I think that the strong dollar policy is a sound policy, and I think that basically, I'd almost say that if I were running any country anywhere, I would want the currency to be sound, because we know what happens to countries when the currency isn't sound. And so I think if you want to have an inflation take care of your deficit, then you're on the road to financial crisis. And so I think that one of the ways that we can maintain fiscal discipline is to be really committed to a strong dollar.
But you're happy with where the dollar is now, relatively speaking, the adjustments that have occurred?
Well, I think that, again, if you look at where the dollar is now, it's stronger than it's been. The charts kind of went like this. And so I think that if you were to look at historically, is the dollar strong right now, you would say yes.
So in his career in public policy, President Trump has always been not a big fan of a trade deficit. We've had trade deficits for quite some time. Do you see any progress in the trade deficit as a result of the tariff policy? And do you expect trade deficits to be going down in the course of his administration, or to be happy to just keep them more or less where they are now?
Yeah, the trade deficit is definitely going down, and the fiscal deficit is going down as well. And I just got a readout from people at OMB on this, and the deficit this year is down almost $400 billion from what it was last year, and extrapolating for the rest of the calendar year, then it could drop by about $600 billion in this year alone.
You're talking about the budget deficit.
The budget deficit, and then, but it's interesting that $600 billion reduction in the budget deficit for the fiscal year, for the calendar year, is obscured by the fiscal year, because you might recall that President Biden's team was shoveling money out the window in the last quarter of last year, and so the fiscal year numbers didn't look quite so good, but about 40% of the deficit was in the first or the last Biden quarter. But in the calendar year, it's about a $600 billion a reduction in the deficit relative to 2024. And then the question is, where did the $600 billion reduction come from? And it's about 1/3 of tariff revenue, about 1/3 increased tax revenue, because growth is higher than we expected. We've got these 4% growth quarters, and then the rest is spending reduction relative to last year.
Okay, so right now, the budget deficit has generally been, for the last couple years, about $2 trillion a year, more or less. More or less, we spend roughly $7 trillion a year. We take in roughly $5 trillion a year, and we generally have about $2 trillion deficit. Maybe it's coming down now. But we have about $38 trillion overall of debt. Do you see any way that to reduce that indebtedness in the next couple years or so, or realistically, we're stuck with $38 trillion or rising a little bit over the next couple years?
Right, well, to reduce the debt, right, then you have to run a surplus. And so the question is, do you reduce the debt relative to the target or not? And we clearly are doing that with the big reductions in the deficit right now. And so I think that those will continue. And I'm also extremely bullish about growth. We haven't talked about the growth outlook much, but let's talk about AI and growth when you're ready. But I'm very bullish about growth. And I think that that will help a lot. But it's not just growth that's doing it. It's the fact that we have tariff revenue and we've got a lot more spending restraint than was here in the past.
Now, the big, beautiful bill the president got through did have everything the president pretty much wanted in the legislative arena. Is there any legislative bill that the president wants the remainder of this term? In other words, is there anything you really are trying to get out of Congress other than appropriation bills the remainder of the term, or pretty much everything you wanted was in the big, beautiful bill?
For sure, we're going to be using future reconciliations to improve the American economy with better policy. We got a lot of the things we wanted done then, but there are a lot of other things to do. I could say that right now, for example, one of the things that we're spending a lot of time on is thinking about the state of housing in America and the fact that first-time home buyers have seen their age go up over the last 5 years from like 30 to 40. And so you've got to be 40 years old before you can buy your first house now because, mortgage rates went up so much over the last few years that the typical monthly payment about doubled. And nobody can buy a house, or it's much harder to buy a house, and it's hard for people to move who want to move. And then, since we're the economics club, I could talk about this, that when you're stuck in a house because there's been a big swing in mortgage rates, that there's something we call the flypaper effect. It makes people sort of be stuck where the fly landed on the paper. And the flypaper effect is something, there's two authors, Blanche Flower and Oswald, that have a famous paper that when we have a flypaper effect like this, it can increase unemployment. Because people can't move to where the jobs are and so on. And so I think that one of the things that we've got a huge amount of our effort with, the Treasury and other corners of the government is thinking about what we can do HUD. I, in fact, was meeting with Scott Turner this morning on this to try to address housing policy, to sort of recapture some of the ground we lost in the last 4 years.
On housing, the president the other day said maybe he would support a 50-year mortgage. Is that going to be the policy of the administration, or where does that stand, the 50-year mortgage?
I don't know if the president's decided that he wants to do that. I do know that we've been having meetings with principals in the White House to talk about what we can do about housing, and there's a whole list of possible things that haven't been fully vetted and haven't been decided on yet. Okay. But a 50-year mortgage, you could argue in favor of it that it wouldn't necessarily, but could reduce the monthly payment, which would make it easier for people to get into a home. And then the flip side is that the equity that people would acquire over time would be spread out over a longer time period. And when I was last digging into the housing market, just doing my work at the Hoover Institute at Stanford, one of the things that sort of struck me was that the typical person moves their house like about every 7 years. And in a 30-year mortgage, you almost get no equity in the first 7 years because it's all interest up front. And so there is, you have to weigh all those things when you decide what to do.
Well, the concern about a 50-year mortgage by some people is that what it will do is maybe encourage more people to buy houses, inflating housing prices. Is that a worry that you have?
I think the too many people buying houses right now is not what the problem is. The problem is that the home ownership of people sort of 40 and under is at a historic low.
Right. Now, on the tariffs, in the president's tariff policy, it's really an important part of his economic revenue because a lot of the revenue coming into the Treasury, the president said, is from tariffs. Mm-hmm. And if the Supreme Court were to rule that the president's policy using the 1977 emergency tariff or trade legislation were not to be appropriate to raise this kind of revenue, what would the administration do? In other words, you've got all this revenue coming in. If the Supreme Court rules against what you've done, is there a fallback to use some other statute to get that revenue in, or what would you do?
Right. Well, first of all, I think that if you're going to think about the logic of, we have repeated over and over, you see any of us on TV, that we're confident that we're going to win the case. And the thing is that if you want to think about the logic of it, if we were in an economic seminar, we're kind of almost in an economic seminar, is that so what we're using is emergency authority. And so the first thing you want to say is, well, is it an emergency? And it's an emergency I could think of for two reasons. One is fentanyl and the hundreds of thousands of deaths from fentanyl. And two is, my friend Angus Deaton wrote this book with his wife Ann Case about deaths of despair, about how the massive trade deficits that we've had because China's dumping stuff everywhere and wiping out towns and shutting down factories. The deaths of despair, there's like a whole best-selling book by a Nobel Prize winner about that. And so I think that the case that both the sustained trade deficit because China and other countries have a policy to create jobs in their own country by selling stuff as cheap as possible into the U.S., that I think that the emergency case is really, really solid. And so then the question is, when the law says that we have the authority to regulate trade, then does that mean tariffs, since it says regulate trade, but it doesn't say the word tariff? And I think that that's a pretty cut and dry case too, because if you're going to regulate tariff, for example, this came up in the oral arguments, well, one thing you could do to regulate tariffs would be an embargo, and a tariff is less significant than an embargo. So if you could do an embargo, then surely you could do a tariff. Or to make the economist argument that you could definitely do a quota, no one would challenge that. And if you did quotas, you could auction off the quotas. And if you auctioned off the quotas, it'd be mathematically the same as a tariff. And so I think that the case is really, really strong, logically. And so I think we're confident that we'll win the case. But I want to respond to your question now, which I sort of was, but I want to understand the Jameson Greer and the people at USTR and Howard Lutnick at Commerce and all the trade people at Commerce have been looking at our options should the Supreme Court ruling go the other way, and there are a lot of options on the table. There are a lot of alternative authorities for trade people here, 301s, 122s. There are a lot of things that we could do so that we could reproduce the policies that we have right now with alternative authorities.
Now, most people in your profession, economics profession, would say that a tariff is a tax and it's somewhat inflationary. Is that your view, that tariffs are inflationary? I know the administration has argued that it's not necessarily inflationary, and there's no evidence yet that inflation is going up because of the tariffs, but generally, do you think tariffs have an inflationary impact on the economy? And if they do, why have it not happened yet?
Yeah, so this is something that we've talked a lot about going back, on the economic team, going back to January. And the first thing is that if there is a price effect, it's not inflationary, it's a level adjust effect. So you have a tariff, and then if it has a price effect, it changes the price, and whatever that price changes, that causes the inflation or deflation, whatever that happens because of the price effect of the tariff. And then the tariff, unless it changes, doesn't do that again. And so it's not an inflationary thing, it's a level adjust thing. And my intuition from the beginning has been that it wouldn't be inflationary, because the reason we have the emergency that we're talking about is that we have inelastic supply of Chinese goods and other goods from all the countries that are dumping stuff into the U.S. And so by definition, if you put a tariff or a tax on inelastic supply, then the inelastic supplier bears the thing. And so the way that would work is, the simple example that I've used on TV before is, the way it would work is that suppose that we had an economy, let's just do it with an economy, that had one apple tree, 100 apples, and it cost $1 an apple, and the market clears. And then the government decides to put a 10% tax on apples. And then, so then if the person with the apple tree raises the price to $1.10, then the demand for apples will go down, and maybe they only want 90 apples. And then the question is, what happens to the other 10 apples? And the answer is, what, they're going to just let them rot? No. And so eventually the market's going to clear, where the guy with the apple tree is charging 90 cents and paying the 10-cent tax, and the dollar clears the market for 100 apples again. And so my expectation all along, and you would have seen it in TV hits starting January 20th, is that we're going to see a big reduction in the price of imported goods from China and other places. And that's exactly what we've seen. Because they don't want to just let the apples sit and rot on the ground.
Now, in pushing the big, beautiful bill, the famous Laffer curve was used as support for the bill, that the theory was if taxes go down, growth goes up. Do you support the idea that the Laffer curve is is working here, if it ever worked at all? Is it working here? And you think that growth is going up because taxes have gone down?
Yeah, I mean, growth is going up because taxes go down. That doesn't necessarily require a Laffer curve effect. The way to think about Laffer curve is that if the elasticity of something is bigger than 1, then you can have Laffer curve effects, and if it's lower than 1, then you can't, or it's harder, or over time maybe. But as an example, if we cut the corporate rate, then I have a new paper out that I published right before I came in again at the National Bureau of Economic Research with my colleague Josh Rao, where we showed that with the latest data that the elasticity of capital spending with respect to the corporate rate was well above 1. And so that means that in the corporate tax space, there would be like Laffer curve effects. But you could imagine other quarters of the tax code where you wouldn't. So for example, if you expand the child credit, there might be a lot of good reasons to do that. But unless you think that there's going to be a big fertility response, you're not going to see a Laffer curve effect.
Now, you've argued in papers in previous years that for economic growth to occur in an economy like ours, we need to have immigration, getting workers to come in to take jobs. Now we don't have as much immigration as we did before. Do you worry that we're not going to be able to fill all the jobs that might be available? And are you worried about the lack of our ability to get a lot of skilled workers to come in because of immigration policies?
One of the things that people forget about President Trump's immigration policy in the first term is that he had us, and I worked very closely with Stephen Miller on this, come up with a immigration reform that could significantly increase legal immigration. And I can remember we went and presented it at the Washington Post editorial board, and I remember they were very favorably inclined towards that policy. And so I think that you have to sort of think about legal versus illegal, and that I think that we've already were on the record for the previous administration as supporting, sound immigration reforms that copy the kind of immigration policies they have in Canada and Australia. And so that's not happened yet. And so then the question is, how does that feed through to the labor market? And I think that one of the stories that people have said is that it's probably going to cause a sort of real disruption in the labor market, because the illegals or undocumented folks who did get Social Security numbers and so on when they were released into the country ahead of their hearing down the road, they did get a lot of jobs. If you look at, it's kind of hard to tease this out from the BLS's data, but if you look at the job creation this year, I just got an update on it yesterday, that basically of the jobs created this year, 129% of them were people who are native born. And then there was a reduction in people who are non-native born. So that's where you get down to 100 of minus 29. And so the idea that the reduction in non-native born workers would cause a disruption could be true if native born workers didn't jump in and take the vacancies, but it looks like so far they have.
Let's talk about how economic policy is made in this administration. So does the president want to have his advisors come together and you hash out things in the Oval Office? How do you actually make policy? Is it by memos, conversations? Do you go in and whisper in his ear what you should do? How does it work?
Yeah, so it depends on the gravity of the policy. That there are things that happen every day that get resolved by cabinet secretaries, and every now and then the cabinet secretary will want to know, well, what do you think the president would think about this? And then maybe I'll say, oh, I'm pretty sure he already talked to me about this 6 months ago. He's fine if you do it this way. And so there's a lot of smaller things that, because they have a ginormous government, that have to be resolved by the cabinet secretaries, often in consultation with the chief of staff's office and us in the domestic policy council and so on. The bigger things that require presidential decisions, very often what happens is we'll have a meeting, often in the Roosevelt Room, where the principals will say, well, here are the options we think we should give the president. And then we will sort of usually draft the people who are for and against each of the things, and then go into the Oval and discuss them with him. But he always wants to have the people who support the thing that he's being advised to do and the people who don't, unless, obviously there's some things that everybody supports so much that you just can't do that. But he really likes to have lively debate in the Oval, and if you're not giving him enough debate, he'll work it out and make sure you get
when you
debating.
go in there, and when you debate with him, does he ever say, let me think about it overnight, or does he say he makes a decision right then and there?
Yeah, he does say that. He definitely says, I need to think about it. That happens, yeah.
And then afterwards, the people go whisper in his ear after everybody else is gone, here's what you should do. Does that ever happen?
It's a thing that that really, I commend Susie Wiles especially, that there is a risk that the most convincing person in any administration is the person who talked to the president last. And then that creates, kind of like a competition to like check his, sleeping schedule and decide that, who's the one who's going to call him right before he goes to sleep. And that's something that every president has to deal with, and that I think that, this administration has dealt really well with compared to previous administrations.
You're one of the few people working in the White House now who worked in the first term as well. So
when people asked me if I was going to come back, I had a joke about it. I said that I was Trump season 1, and I think I'll probably be the Christmas special for season 2.
How is he different than in Trump 1? In other words, he's more experienced. He understands economic policy making more than maybe he did the first time around. But how is he different? Is he easier to deal with, harder to deal with, more dogmatic than before, or any change at all you can talk about?
Yeah, he's much more experienced. He has already been involved in a million policy debates about just about everything you could imagine in the first term, so that he hits the ground running more. I think that that within the White House, that he has had a good idea of how to build a White House that would be functional. And it's again, if you're thinking about it as season 2, you want like some new faces and some old faces, so the old faces kind of know how to make sure the trains run on time and so on. And so I think that it's a much more efficient White House, that there's been way less turnover, and that people are really focused. I could also say that because he didn't win or didn't take the office last time, that there was a gap where he and all of us got to think about, well, if we ever did win again, what would we do? And so I think that if you've seen like the rapid pace of change that President Trump and his team have been able to accomplish, that in part it's due to the fact that there was 4 years of downtime where people could get policies ready in case they could ever have a chance to enact them again. And so I think that the rate at which successful new policy has been pushed is completely unprecedented in my career living in Washington for 30 years by any administration. And I think that it's because we've got experienced people, but also experienced people who had some downtime to think about it. And I was almost joking if I were giving a graduate seminar about this, I might even say that presidents should be allowed to have 2 terms, but they have to take one off in between.
So what would you say the president would say, or you would say, is his greatest economic accomplishment to date, and what would you say is their greatest economic challenge for the remainder of the term?
Listing great accomplishments is, I would say that he cares most about like how well Americans are doing. And in the first term, like we've only been here for half a year or a little more, but in the first term, that I can remember when we were talking about the Tax Cuts and Jobs Act, that I went in and I had a simulation of what I thought it would do for the economy, how much GDP would go up, and we had a simulation that GDP growth could get back up around 3, which was controversial at the time because everybody believed in the new normal and we were only stuck in the ones. And then he kind of looked at me and he said, I don't want to talk about GDP. Come back and tell me what it means for ordinary people. And so then the next day we came in and I had reviewed a large labor literature on what happens to wages when we have big corporate tax reductions. And I told him that, well, if we pass the bill, then people's wages will go up between $4,000 and $8,000 was the range of estimates in the literature. And then he said, well, I'm going to promise 4. I want to under-promise, but that's going to be our message. If you go back and look, $4,000 increase in wages was the main storyline of TICJA as we were trying to get it passed. And then right up against COVID, it had already gone up to $6,500, which was about the midpoint of my range. I actually like the $6,500 better. But I would say that if you asked him, I haven't asked him this, the thing one he would say is that I was able to deliver for the American people wage increases that hadn't really happened for the previous 20 years. The second thing that I think he would want to say, I know you said pick one, but I do think that he has believed in tariffs his whole life. And a lot of people thought that the tariffs would come in and cause a recession and cause inflation, and his intuition was that they wouldn't, and they haven't. And I think that we've learned a lot about like how tariffs fit into an optimal fiscal policy because of him, and I would say that that would be a great accomplishment as well.
Now, the tariff policy, is it complete now? In other words, has he finished negotiating the major deals with the countries he wants to negotiate with, or is it still an ongoing process?
It's an ongoing process. It's an ongoing process. I think that one of the things that people have been talking about just the last few days is, thinking about changing tariffs for foodstuffs and things. And so I think that there are going to be more changes, and there have been really big changes. And then one of the things that people forget about, like prudent policy making, I'm sure that President Carter would have agreed with this point, is that you do what you think is right, and then you watch what happens, and then when you see things that you need to adjust, you adjust them. And so I would guess that we've made really big changes and that we'll have to make adjustments now.
Now, the theory behind tariffs, I thought, was to even out the trade balance to some extent and maybe raise revenue. But the president has imposed tariffs on countries with which we have a surplus, like Brazil. What's the theory behind imposing a surplus or a tariff on something like Brazil?
The point is that it's really easy to transship, and that if you're going to actually have tariffs have an effect on the U.S. economy, then you need to have kind of a tariff wall around the country. And I could say that that tariff policy is very complicated, and there are a lot of things that we're studying carefully right now in this kind of space. But for example, if you're a foreign importer that traditionally has sent stuff into the U.S., sold into the U.S., then one of the ways you can get around the tariff potentially is you set up a U.S. subsidiary, and then you have your widget and you sell it to the U.S. subsidiary for, say, $100. And then the U.S. subsidiary will pay the tariff or you'll pay the tariff, but either way on $100. But then the subsidiary sells the product in the U.S. for $1,000, and you avoid $900 worth of tariff. And so tariffs, if you want them to have an effect on the economy, you have to really, really look at like how are we really collecting the tariff, and how are we making sure that people aren't transshipping, people aren't funneling things through subsidiaries, and so on. And so I think that that's part of the overall calculus.
Now, one of the issues that's risen in the last couple of days is the issue of affordability. Obviously, some of the Democrats say that the president isn't worried about the affordability of things that people need to buy, and the prices have risen. What is your response to the concern that some people have that either the president's not as worried about affordability, or prices are going up beyond what the average person can afford to buy?
Well, I think that he, of course, is focused on affordability, and I think that the way I think about it is that why people feel the way they do right now on affordability is that because of the really high inflation from the previous term, then over the entire 4 years of President Biden, then real wages dropped by about $3,400, which means the purchasing power dropped by, say, $3,400. And that doesn't include actually the mortgage part of it, which would make it even worse. This year, real wages have gone up by $1,200. And so some of the ground that was lost last time has been made up, but you're still down $2,000. And so people are like, when you go to the grocery store, I'm the grocery store shopper in my family because I love to look at the price of everything, the value of nothing, I guess. But it is the case that people are still short, and I asked the team to give me like actually some real-world examples of the things people buy. And just yesterday, got this factoid from the Consumer Expenditure Survey that the typical monthly expenditure on groceries when President Trump left office was about $400 a month. The typical monthly expenditure on groceries when President Biden left office was about $510. And so it went from 400 to 510. And so far this year, it's gone to like 512. And so the rate of increase of food prices has gone down to almost nothing. But the ground that we have to make up is still a significant challenge for us, which we take very seriously. And if you think about it, we've closed about a third of the gap in our first 8 months.
So the president has you as a National Economic Council director, and he's got a Council of Economic Advisors director, and he's got a Secretary of Treasury, Secretary of Commerce. But does he listen to people on the outside as much as he listens to people on the inside? Tonight he's having a dinner with a lot of prominent Wall Street people, I think. Are they the principal advisors that he has on the outside, Wall Street CEO types, or the other business people he knows? Where does he get his economic advice from outside of the people working for him directly in the administration?
He has an enormous social network of really talented people, and if an issue comes up, any issue that comes up, he'll probably know somebody that's been working on that their whole life, and after his staff goes into the Oval and says, here's what we think we ought to do, then you had asked earlier, sometimes does he say, well, I want to think about it? I want to think about it very often is he'll call up, maybe call you or your colleagues.
You're not calling me too much.
Yeah. Well, we'll see how it goes.
I'm always waiting, but
so, I guess I could understand.
Let's
that.
let's talk about your own background for a moment. You grew up in a blue state, right? Massachusetts, is that fair?
Mitt Romney was governor of Massachusetts.
So how did the president know that you worked for Mitt Romney, John McCain, and George W. Bush earlier in your career? Does he ever?
He's seen my whole resume, yeah, for sure.
So he didn't hold that against you, obviously.
Yeah, I guess that there have been a lot of people that have come into government with worse backgrounds than that.
You grew up in Massachusetts. You went to Swarthmore. How did you pick Swarthmore?
I grew up in a really small town. Actually, you talk about blue state for Massachusetts. I kind of reject that view, even though it is a blue state. But the thing is that our part of Massachusetts was actually pretty red, Western Massachusetts.
Okay.
And but I grew up in a small town, and I didn't want to go to a big university.
Were you always conservative as a youth, or were you a liberal then? Or?
My mom was a kindergarten teacher in my hometown who was on the Republican State Committee in Massachusetts. And so she was like the little old lady that made apple pies that everybody knew in Massachusetts. And so and my dad was very much a Democrat who disagreed with my mom on everything. And so the dinner table was really fun, and I tended to side with my mom.
But did they ever say what happened when you turned out this way, or they never said?
No.
No, they didn't say that. So you went to Swarthmore. Swarthmore is, I would say, maybe left of center compared to some other schools. So were you did you stand out there as a conservative?
The rumor is Nixon called it the Kremlin on the crumb. I think that actually is true. But Swarthmore, especially then, was a place that had legitimate diversity of thought. Okay. And I was one of the conservatives there, but I didn't feel like I was attacked for it.
All right. Were you a track star there?
I wouldn't say star, but yes, I was on the track team, and played basketball.
What was your event?
So I did almost every event from 400 meters down, but the sort of conference medals that I ever won were in high hurdles and the long jump.
Okay. And then you went to get your PhD at University of Pennsylvania, and what did you know then, that you wanted to be an academic PhD economist your whole life? Is that what you wanted to do when you went to Penn?
Yeah, I thought that's what I was really enjoying doing research. And then my first job was at Columbia University, and I did a lot of research. When I was at the Fed, I did a lot of research. I'm still doing research.
No attraction to business, private equity, hedge funds, nothing like that? You weren't interested?
Yeah, the problem with private equity guys is they buy something, then they got to wait 5 years and just watch it until they get their carry, right? I mean,
well, we can sell it sooner, but okay. Okay, so you haven't been tempted to go to Wall Street, right?
No.
Okay, so if the president does not select you, are you going to stay in the administration in your current position?
Yes.
Okay, and if he does...
I mean, if he decides that that's the right choice for me.
Okay, if he wants you to stay, but
Yeah,
if he
wants me to
if he does select you, then you have to get ready for confirmation, and you expect that would be political a bit?
It probably would be political. I've been through it before. Not that I'm counting. I think I had 83 votes last time. So I've been through the process. The process is, basically you get very carefully scrutinized, of course.
Right.
But once you've done it once, there's kind of not a lot of news left for them to find.
Well, I'm sure the president will get recommendations, but if you were to recommend a person for the job, how would you say you would be the best person for the job? In other words, if the president was watching right now, he might be, and you were to say, well, here's why you would be qualified to be chairman of the Fed, what would you say?
I think that, first of all, that there are a lot of qualified people that have...
But you're the most qualified. If you were to say the most qualified.
If I want to say the most qualified person, I don't want to compare to others, but I would say that the reason why I could be ready to get to work right away is that I spent 5 years working at the Fed. I know a lot of the economists that are leading the divisions there now. I work closely with Alan Greenspan at times and have seen what's good and bad about the way the Fed people think, and there's a lot of bad. And I think that somebody who can go in and basically my view is that the staff has a big effect on the decisions of the Fed, and this staff historically has been excessively influenced by two thoughts. One thought is that Keynes was right. Keynes had value, but you don't have to be a Keynesian, like a religious Keynesian. But the second thing is that there's been a lack of willingness that really started with Greenspan to show deference and respect to the corner of the macro literature that I think is really important, which is conditional expectations, time series analysis, the Stock and Watson type stuff for the economists here. And so if you're running the Fed, then having the best forecasters of the world who are really building nonlinear time series models and so on would be a good investment. And I think that having someone who understands that would help the Fed be better in the future.
If you were nominated, no doubt Democratic senators would say, well, you're close to the president, you worked with him or for him for a couple of years. How would you resist his entreaty to do something if you're the chairman of the Fed? How would you resist that because you have such a close relationship with him?
I had this wonderful experience in the Trump White House is such a fun place to be. And we were meeting, the president and I were meeting with a few economic advisors on one thing. And then somebody stuck their head in and said, oh, the next meeting is coming in. And the next meeting was the Sports Council. And he said, well, bring them all in. And so now we're having a meeting, and there's Lawrence Taylor and Triple H and all these guys on the Sports Council. And one of the things that I noticed was I'd never seen anyone razz the president as much as Lawrence Taylor was. And I think that there's basically, once you trust someone, then you basically have the authority to be independent because you're trusted. And I can say that the behavior, the decisions of the Fed, policy decisions of the Fed, have been uncomfortably correlated with what a partisan might do for the president and for all of us. And I think that he knows that I wouldn't do that.
Suppose I'm a business person who wants to lobby the president on a particular issue. What is the best way to succeed in doing that? Is it to call him up, get on his own calendar, go have lunch with him, talk to you? What's the best way to influence the president if I want to do something? Of course, it would be in the nation's interest, but... Yeah.
Well, I mean, if it's you, there's no chance in the world. I mean.
All right. So, but does he? I mean, what do people do wrong when they're business people that want to lobby him, or anybody in Washington or anybody anywhere wants to lobby him? What's the wrong thing to do? Is it to tell him why he? What's the best way to lobby him or not lobby him? Based on your experience,
I'm not engaged in.
You don't business people come. People come to you sometimes and say, "Can you get the president to do this?" Do they ever do that?
They could try, but it doesn't work.
Doesn't usually work?
No. So I don't know. Whoever does try to do that and be successful, I think they have a low success rate. I don't mean to take business away from lobbyists in town, but the president really cares about doing what the right thing is, and For sure, if we're doing something in an industry that you know a lot about, we care what you think, but that's what we do.
Are you worried that there's a bubble in the AI valuations of certain companies and that this could come down to haunt us, or you think there's no bubble and the AI valuations of companies are consistent with what they should be?
So if you think about what AI is doing right now, is that it's increasing the productivity of workers and firms, or capital and labor, and it's doing so at a remarkable rate. And the firms that are helping other firms use AI are making a lot of money because they're helping ordinary businesses make lots of money. And so if you looked at the earnings season, it was the earnings season with the most positive surprises ever. Right? And so what that means, I think, is that the AI revolution is creating a huge amount of value. And now who captures the value and so on, it's, markets will work it out. But if you compare this to the computer revolution, started in 94, 95, maybe when Navigator came out was the place you really start the clock, then economists were all like, oh, well, the computer is everywhere but in the statistics. And the thing about AI is that it's so powerful that it's already in the statistics. And so I think that the valuation, I'm not saying that I know what the price of something should be, the market knows better than me, but that the valuation could be really, really high because it is increasing productivity and profitability so much. And that the fact that it's visible already, that's quite a bit different than the computer situation of the 90s.
Okay, so if the president asked you to serve in a third Trump term, would you do that?
I don't think there's going to be a season 3.
Oh, okay. You don't think he'd ask you? Okay. So final question for you. On the whole, are you pleased with where the administration's economic policy is right now? And do you think it's been adequately communicated to people out the country, or do you think you could communicate the policy better, or you can make the policy better? You're happy with the policy, happy with the communications. How would you make it better or do something different?
I think that we're going to have more policy proposals that will improve policy. I think that we're focused on communicating better. So we want policy to be better and communication to be better. But I think that in the end, what matters, and this goes back to a great literature started by Ray Fair at Yale University, is that in the end, you can communicate all you want. People are going to look at their wallets. People are going to go to the grocery store. Right. And in the end, I think that means that we got to get policy right and focus on communication, but communication is more of a political thing. In the end, if we put more money in people's pockets, then they'll celebrate our policies, and if we fail to do that, then they'll rightly condemn them.
I can't help but notice you have these very colorful socks.
I was feeling stripy today.
Yours,
no, it's not actually. It was just like a random choice this morning.
Random?
Yeah.
You don't make economic policy in a random way, right? Yeah, consistent. All right. Kevin, I want to thank you very much for being here today.
Thank you so much.
Appreciate it. Thank you very much. Thank you.
All right, there you have it. Almost a full hour with Kevin Hassett, chair of the NEC, with none other than David Rubenstein, live from the Economic Club of Washington. And you can see more of where that came from. Now that this is in the bag, you can watch more of David's interview with Hassett on the David Rubenstein Show. Peer-to-peer conversations, that's December 3rd. If you want to lock it in at 9 p.m. Eastern Time. I'm Joe Matthew in Washington. Thanks for being with us on Balance of Power alongside Tyler Kendall here in the nation's capital on what is expected to be the last day of the longest government shutdown in American history. The votes are teed up for a few hours from now, and we're going to have a special edition of Balance of Power for you starting at 5 p.m. Eastern as all of this is set to get going. But Tyler, as we kind of unpack everything that we just heard from Kevin Hassett, really interesting, beginning with the shutdown itself, he says it will have an impact on GDP, which could come in quarterly between 1.5–2% for the year. He's targeting about 2%. Said inflation is not all the way down to where you want it to be, was the quote. But he agrees with the president's that rates can be a lot lower.
Right. I was actually pretty struck by the laughter in the room when he was asked why he would want to be the next Fed chair. Of course, he's on the short list for that. He also said if he's reading the tea leaves, he's looking at a likely 25 basis point cut when the FOMC meets in December. But of course, the backdrop here, the fact that we haven't gotten as much economic data as there should be as we try to weed through the forecast.
We're learning a little more about that, by the way. I guess within 48 hours of the government reopening, we'll get a new calendar from BLS, and then it's off to the races at that point. Liz Pancati is with us, I'm glad to say, Managing Director, Policy Advocacy at the Groundwork Collaborative, having listened to that conversation and sort of noting broadly what's happening here against the backdrop of a government shutdown. Liz, welcome back. It's great to see you. This is going to have an impact on data. The question is, when do we start seeing data? BLS is going to take some time, and we're never going to fill these gaps that we have for the month of October, are we?
No, I mean, there was some data collection that was already in process prior to the government shutdown for what was to be released in October. The government shut down on September 30th.
So we get a stale September jobs report.
We'll get a stale September jobs report. We may get some CPI indications, kind of a mini release, and then we will hopefully start to get back to collecting data. Some of the data that goes into, especially the jobs report, is reported on a pretty continual basis. It is not a survey that, phone calls or online surveys have to go out to households. It's kind of incoming data. So it's sifting through that, analyzing it, and then getting the surveys back on track. That will probably take a couple weeks to get those stale reports, and then hopefully by the beginning of the year, we'll have an accurate picture. But of course, the Fed will have to meet once again before that without that full picture.
So let's talk about where we currently stand from what we do know. What are the indicators that you've been watching for as we try to piece together a picture, particularly related to the labor market? Because of course, we're talking about 2 missed monthly jobs reports.
Yeah, unfortunately, the private sector data, as you both know, is not always the most high quality or the most sensitive. We've seen ADP kind of all over the place, but what we have seen is record numbers of layoffs. When we look at, the Challenger report, that to me is a little bit concerning. We had started to see layoffs tick up, but they were still within a normal range. And we got information from Challenger last week that they were really at historic highs. The other thing I have been watching is among small businesses, how hiring has been faring. And we've seen both in Gusto, another private payroll processor, and ADP, those small business numbers not look great. Small businesses obviously employ about half of workers in the United States. They have been hit the hardest by tariffs, just unable to kind of increase inventories and keep cash on the books as interest rates are very high. So those are the couple of things I am looking out for. And then we've gotten some indications that seasonal temporary hiring will be down through the holiday season, which is typically a big kind of push in many areas. We saw Spirit Halloween really slow their openings, and we are seeing for the retail spending ahead of the holiday season that not to look so great given where consumers are. And so a lot of retailers are holding back on hiring.
Caroline Leavitt was just asked about the lack of data. She's holding forth in the White House briefing room now, the press secretary at the White House. Check this out, Liz. October CPI and jobs data likely never to be released for October. I guess you can't go back in time and get that snapshot. Will it be more difficult for the Federal Reserve to understand the impact of this government shutdown if we start putting numbers on data like this, between 1.5% to 2% growth this quarter, according to Kevin Hassett? What happens, though, when you cut off 42 million Americans from SNAP benefits for a month? When do you know what the impact of that is?
The SNAP benefits, even knowing when they'll be turned back on is something we don't know right now. A lot of states were able to send out at least partial benefits, either because governors stepped in or we had a couple of late-breaking court rulings forcing some of that money to go out. The administration has not committed to a specific schedule for when those benefits will resume going out. I think, there's a tension in wanting to know what the effects of the shutdown were after the shutdown is over, and for the Fed especially and other policymakers to know what the current state of the economy is. I would put those in the opposite order of we need to know exactly what our economy looks like right now so we can make decisions about interest rates, about fiscal policy. It would be nice to have that historical look back, but missing 1 month is not catastrophic. I think the bigger issue is that we are unlikely to have that data by the Fed meeting in a couple of weeks here for the current snapshot, which is the more concerning thing to me than missing those data points. But, we saw the president a couple times in the last week say inaccurate things about how prices are down. We saw that Walmart report report about a Thanksgiving meal costing less when, in fact, they were just moving around all of the items that go into that. I think the more and more that the administration tries to rely on fuzzy private market data as they, withhold that information about the typical reliable government reports, that to me is more concerning.
I did want to ask you also about the broader backdrop of the economy here when it comes to tariffs. You brought up tariffs. It was also part of this conversation that we just heard with Kevin Hassett, and he said that the administration is considering some of these other tariff authorities as the Supreme Court looks at the big one, IEEPA, those broad-based tariffs based on emergency powers. We heard President Trump earlier this week suggest that there could be $2,000 refund checks. How do these headlines jive when you have the administration looking at dispersing money from tariff revenue, but also preparing a backstop if those tariffs get struck down?
In the Supreme Court arguments last week, we really saw the solicitors struggle with how to respond to questions from the justices about these revenue effects of the tariffs. They say they're minor. The president tweets out that they're going to be $4 trillion. The president tweets again that they're going to be $3 trillion and they're going to fund stimulus checks. I mean, it's really all over the place and quite incoherent. I'd say on the checks, I am not running out to put $2,000 on my credit card because I think the government will be sending me a check in the next 30 days, and I would not suggest that anyone else do so. And then, I think we're likely, even if the Supreme Court does weigh in on those emergency IEEPA tariffs, the Trump administration has signaled, and they have even started, over a dozen investigations using those other authorities on specific inputs. So that could be, copper, aluminum, semiconductors, but we could see those spread to other industries using other authorities, some of which, could allow him to enact time-limited across-the-board tariffs of 10 to 15%. Others would require 6-month, typically, investigations before they could put higher rates on them.
So there would be an interruption then, been waiting for the next round of tariffs to come in that world. Would the money need to be paid back during that period of time? I guess the court needs to decide that, Liz, and I won't make you decide that now. I guess the question I have is, what would happen? The president says it will ruin the country, it'll destroy the country, to pay back what he says is $3 trillion. It seems to be in the billions, not the trillions. But what would be the impact of writing checks like that?
There's kind of two separate things happening right here. So one is if the IEEPA tariffs that have been somewhat collected over the last 6 months by customs, there are lots of delays and lots of kind of mixed implementation of those. If the Supreme Court strikes down those tariffs, there are already companies lining up as part of class action lawsuits trying to get those refunds from the Treasury Department for the tariffs that they've paid. I think it's very unlikely those would then be passed on to consumers, though some consumers did directly pay those tariffs on, shipments to their doorstep.
So then you get the class action lawsuit going.
Correct, which is a whole other disaster in and of itself. And I think you have both seen how long it takes for lawsuits to work through our court system. So that's one aspect. The president is separately suggesting that these magical dividend checks will be sent out to consumers that are completely separate. So those would be funded by the revenue from the tariffs coming in, the tariffs which could, of course, be interrupted by the Supreme Court's ruling. But as you said, there are not $3 to $4 trillion worth of revenue. We have at most seen, $200 to $300 billion taken in revenue. And the administration has drawn on that pot of money to pay for this, that, and the other over the course of the last 6 months, trying to pay troops or trying to pay SNAP benefits or, paying for the ballroom. I mean, he seems to view this as kind of an unlimited slush fund. Whether he spends it or tweets it out, this is really not a thing I think the American people can rely on.
We actually have a great story on the Bloomberg terminal about how there's already a case forming for a class action so that we could see those tariff refunds paid out more broadly, because we know that the issue of universal injunctions has come up before with this administration on it. Sticking on tariffs, we heard from the Treasury Secretary Scott Bessent earlier today, who said that we could see some potential planned reductions when it comes to things like coffee, bananas, other food that we don't grow here in the U.S. How would targeted reductions work, and does that make a dent when we're talking about potential pass-throughs and prices for consumers?
The targeted carve-outs are, very complicated to implement, as are the broad sweeping tariffs that the president has put into place. They also seem to, the administration has historically not stuck with the thing that they announced. So do I think that it will be smooth sailing for exempted coffee, bananas, et cetera? No, because none of these tariffs have been smooth sailing. I think this is a really fascinating press tour that, both Bessent and Hassett are doing right now, where they realize that American people are very frustrated with higher prices. The president campaigned on lowering prices on day one. Last week, he walked this back saying that's a 2026 priority for them. So I guess this is kicking off that tour. But, a couple of months ago, the president said groceries. What a fascinating word. I wonder where that word came from. And I guess now he has figured out that, in fact, the American people do care about their grocery prices. We, of course, do not grow coffee or bananas here in the United States. It's not so much about onshoring supply chains. It's just genuinely impossible. And so now they are exploring these, limited carve-outs. We have seen the president look at other limited carve-outs. There was a deal struck with Apple where they would be able to get out of semiconductor tariffs. These have been, implemented in different ways, and in many cases, tariffs are not being collected anyway because there's so much confusion at the border. So do I expect, bananas to magically become cheaper at the grocery store in the next couple of weeks? No. I mean, coffee's up 20-30% over the past year. And there are a number of other grocery costs that are not so impacted by the tariffs. Ground beef is up double digits over the past year, given other issues in the economy that tariffs will not really affect, though I guess the president is looking at increasing imports from Argentina to fix that problem.
Well, he does cite beef pretty frequently. That is, the whole grocery store is cheaper, but beef is the cost that we need to deal with. And of course, he's running afoul of our ranchers here in the United States, the cattlemen, who have been not terribly happy about that idea. What is his obsession with grocery? You brought this up. He says it's an old word, a beautiful word, a strange word, grocery. And then he started using BLT as a descriptor of what grocery is: bacon, lettuce, tomato. Has he ever been in a grocery store?
That's a great question.
Being serious about that.
I would love to have, a Bloomberg reporter ask that the next time that they get a press briefing question. It's a good one.
You remember the gallon of milk with George Bush? This used to be like treacherous ground for a politician. It's not anymore, is it?
Yes, I mean, I remember President Joe Biden opening up a bag of chips and saying there's not too many Doritos in here. Right. I think, maybe we'll see as part of this press tour, Donald Trump go into Kroger and take a couple things off the shelf. I would be curious.
That's typically when this stuff happens.
How long it's been since he went into a Kroger and pulled a couple things off the shelf. But, we saw in elections last week in Virginia, New York City, and New Jersey, and even in Georgia, where, power bills were on the ballot, that Americans are really frustrated by the prices they're paying, whether it's at the grocery store, the gas pump, for rent. And I think the president hates to be an unpopular guy. His approval ratings on the economy and inflation are in the tank. And he realizes that he's going to have to get acquainted with the beautiful word groceries if he wants to turn it around.
It's an old-fashioned word, Tyler.
Yes, okay. Well, this has been great insight after that conversation between Kevin Hassett and
I'm glad we could spend some time. This is a great dive. We should keep this going, actually, as long as the press tour is on the road.
Yes, all right. Liz Pancotti, Managing Director of Policy and Advocacy at the Groundwork Collaborative. Thanks so much for joining us here in D.C. Right now, we're going to take a check on the markets because, of course, they've been watching all of this, particularly as we head closer, it seems, to reopening the government. For that, we go to Alexis Christoforous in World Headquarters in New York. Hey, Alexis.
Hey, guys, we have got a mixed market at the moment with the Dow now at its best level of the session and in record territory. The Dow Jones Industrial Average up now about 400 points, led higher by shares of United Healthcare, Goldman Sachs, Cisco, and Nike. The S&P 500 on the plus side by 11, and the NASDAQ well off its lows of the session, now down just 50 points. Big winner today was also a big winner yesterday. Shares of Advanced Micro Devices racing ahead more than 8%. That's after CEO Lisa Su told a company event that the AI chip maker will see more than 35% year-over-year revenue growth for the next 3 to 5 years. Elsewhere in stock news, BlackRock Coffee Bar recorded higher sales and a narrower loss in the third quarter in its first quarterly report as a public company. Still, shares of BlackRock Coffee Bar down 1.2%. And we've got shares of the Swiss sneaker brand On Holding up now 17% after the company boosted its sales forecast for the year. That follows better than expected third quarter results. And more Americans than ever are falling behind on their car payments. Fitch Ratings says the share of subprime borrowers at least 60 days past due on their auto loans is now at the highest level on record dating back 30 years. With ongoing inflation pressures and the return of student loan bills, millions of car owners are struggling to afford their monthly payments. To recap, stocks are mixed. The Dow up 393 points at a record high. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous. That's your Bloomberg Business Flash.
Alexis, thank you so much. You'll be back with more on the markets coming up at the top of the hour for Bloomberg Business Week Daily. I'm Joe Matthew alongside Tyler Kendall in Washington, where we're counting down to some important votes in the House of Representatives on what is expected to be the last day of the longest government shutdown in American history. And it's a pleasure to bring in a voice from the House of Representatives now that the chamber is back in session. Democratic Congressman Ro Khanna of California is with us live from Capitol Hill. And Congressman, it's good to see you back in the Capitol here. Welcome back to Bloomberg TV and radio. We've missed our conversations. I know that a lot of Democrats are pretty unhappy about the way this has gone in the Senate, and you're not terribly happy with the way Senator Chuck Schumer has handled things. Now that the bill is coming into your chamber, are you a no vote?
I'm a no vote because I don't believe we can sit idly by while 20 million Americans face astronomical spikes in their health care. We have a moral responsibility to make sure people have food assistance, to make sure they have health care, and we're not meeting that moment.
But Congressman, President Trump has said that he's willing to negotiate on health care. Isn't it better to negotiate with the government reopened, alleviate the stress on our air travel system, get food benefits to Americans, and pay our federal workers?
Well, we could have done all of that. I mean, the president held this country hostage. He refused to release aid, food aid for Americans, which would have cost $9 billion, while he's giving $40 billion to a corrupt libertarian in Argentina. My question for the president is, why aren't you putting Americans first? Why are you withholding aid from American kids and giving money to Argentina instead? We should have been funding the food. We should have been funding our federal workers and paying our troops, and then we could be negotiating on health care to make sure that 20 million people under Donald Trump's watch are not going to have the largest increase in health care since Barack Obama.
We understand that you will have a new colleague in the House as of a couple of hours from now, Congressman, as Adelita Grijalva is at last sworn in, having been elected on September 23rd. This means only a 2-vote margin, if you will, for Speaker Johnson in passing this CR minibus package. It also means you have the vote that you need to bring the Jeffrey Epstein discharge petition to the floor of the House. How quickly do you expect that will happen, and does it need to pass the Senate?
I expect that Adelita Grijalva will sign today. That gives us 218, and early December we will have a vote. But look, the Epstein class in American politics needs to go. These are rich and powerful people who either covered up for Jeffrey Epstein or who themselves abused young girls. And the American people are tired of it. They're tired of one set of rules for rich people who have friends who are politicians and another set of rules for ordinary Americans. So I believe the House will pass this, and it's going to send a message for the full release of the Epstein files and for the Senate to pass it.
I know that you want to bring, obviously, all members to account on this and have them take a vote, which will take place in the House. But to be clear, it does need to pass the upper chamber to force the release of these files, Congressman?
It does, and I believe that the vote margin in the House
coincide with your new colleague coming in and momentum behind the discharge petition?
Well, we had subpoenaed the Epstein estate. I had written a letter to the Epstein estate with Mr. Comer, and we had gotten these files. And one of the things we got today were emails where Jeffrey Epstein is talking to Ghislaine Maxwell, saying that Donald Trump is aware that they're underage girls at the Epstein estate. And so it implicates...
Not get and release these. Do you have an answer?
I don't. I mean, here they were claiming they're doing a thorough investigation. They're going to do everything. And then you have a congressman who's more focused on economic issues than anything on Lawrence O'Donnell, and a lawyer for the survivors basically says, hey, tell the congressman he should write a letter to the estate. They have the documents. And so I write a letter to the estate and get the documents. And you're telling me that the FBI and the Justice Department couldn't do that? Of course they could. They haven't taken this investigation seriously. That's why Congress has gotten involved. We need a full release of the Epstein files.
In the final minute that we have you, Congressman, I know that you have been working on a ban crypto corruption legislation. Now that the House is back in session, can you give an update to us on this? And I'm also curious about the link here to your perch as the ranking member on the Armed Services Committee. What's the national security angle to this legislation?
Well, members of Congress and the president and their families should not be trading cryptocurrencies, and they should not be trading stock. But look, the president's family has made millions of dollars on cryptocurrency. They sold World Liberty as a stable coin, and they have this guy who's gotten now a pardon, a foreign billionaire who's basically accepting payments of World Liberty. This should not be going on. It makes us vulnerable to foreign countries, to foreign interests, and so my bill is simple. No trading of cryptocurrency by any elected official, whether it's in Congress, whether it's the presidency, whether it's the Supreme Court as an appointed person.
All right, Congressman Ro Khanna, Democrat representing California's 17th District. Thanks so much for joining us here on Bloomberg Television and Radio. And the California congressman isn't the only Democrat who is upset about this deal that was struck in the Senate to reopen the government. We heard earlier today from New York Congresswoman Alexandria Ocasio-Cortez catching up with reporters in the halls of Congress who laid out the stakes that Democrats are facing like this.
Federal workers across the country that have been missing paychecks. We have SNAP recipients, millions of SNAP recipients across the country that, whose access to food stability was imperiled. And we have to figure out what that was for, because you had both the capitulation in the Senate and you have the refusal and the outright cruelty among House Republicans and the White House, who went to court to try to sue for their ability to deny people's access to food. This is the reality that we're in right now, and we need to act like it.
From earlier today, Alexandria Ocasio-Cortez, this is obviously the rhetoric that we're hearing from the Democratic side of the aisle, having heard from Ro Khanna just now as well. We're going to be talking in a special edition of Balance of Power starting at 5 p.m. Eastern. We'll be live on Capitol Hill with members of both sides of the aisle. But we want to get a read right down the middle right now with Caitlin Riley, Bloomberg congressional reporter who's been up there all day and looking ahead to votes that could start in the 4 o'clock hour. Caitlin, now that we've heard positioning from the elected officials, talk process with us. When could this be done tonight?
Yeah, absolutely. At 4, the House will come back to vote on a rule. Before that, we'll see the swearing in of Congresswoman-elect Adelita Grijalva. From the vote on the rule, which is a procedural vote, we'll see time devoted to a debate, and then Republican leadership would like to kick off the final vote on this sometime after 7 p.m. And the hope is to be off the floor at 8 p.m. That could always change as we know Minority Leader Hakeem Jeffries has what's called a magic minute, which allows him to talk for however long he would like. We're hearing that he doesn't plan to go late into the night, but that is what we're looking at now.
I don't mean to rain on the parade, but the next deadline that I'm looking at already, once the government reopens, is going to be the end of the year when we see those Affordable Care Act premium tax subsidies expire. Caitlin, what's the conversation like right now on the Hill when you are talking to Democrats who are upset about how this compromise shook out?
Yeah, absolutely. House Democrats are very skeptical of Senate Majority Leader John Thune's promise of a vote on this in the coming weeks. They've pointed out that a vote is not an outcome. There's a lot of disagreement between Democrats and Republicans on these subsidies, which, as you said, will expire at the end of this year, and we'll see premium costs spike for those enrolled on Obamacare exchanges. There is maybe some bipartisan agreement around extending the subsidies with some additional guardrails, but it's really not clear that that will come to fruition. We're having some Republicans in the Senate pitch completely alternative ideas, and so it's just not clear that this will come together.
All right, Caitlin Riley, Bloomberg congressional reporter, joining us live from Capitol Hill. Thanks so much. And Joe, there's a lot to look out for tonight as we kick ahead to our special coverage at 5 p.m. Eastern. I'll tell you, I went back to look what we were covering on September 19th, which was the last time the House was in session. President Trump had just announced he was going to meet with Chinese President Xi Jinping. That's how long ago this has been.
It's been a minute, month and a half we haven't seen some of these members in town, and we'll be talking to them tonight when we make our way up to Capitol Hill. Hope you'll join us. As Tyler mentioned, starts 5 p.m. Eastern Time, the late edition of Balance of Power. By the time we all end this day, the government should be open again, which is saying a lot.
That's the hope. The bill's going next to President Trump's desk. Once they get this through, stick with us for coverage. This is Bloomberg.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody, across Bloomberg platforms. I'm Carol Master along with Tim Stenivek. This is Bloomberg Business Week Daily. Let's get to the setup because we've got what? The Dow at a record intraday. House lawmakers poised to end this historic shutdown here in the United States, government shutdown. And maybe it would unlock some access to economic data that would be key in shaping the Fed outlook. However,
However, yes.
Didn't we get a headline on some of that data?
Oh, yeah. The October numbers, we're not going to perhaps ever get them.
Yeah, okay. So that's kind of a bit of a bummer. All right, so
perhaps. Maybe we'll get them.
Perhaps. Welcome to the environment in 2025. We're going to get into that. There's so much going on. We've got an incredible lineup over the next 60 minutes. Bob Michael, Chief Investment Officer, head of the Global Fixed Income Currency and Commodities Group over at JP Morgan Asset Management, tying all the micro and macro together. And then we get reads on the U.S. consumer, Tim.
Yeah, that from Delta Airlines CEO Ed Bastian. Also, Tricia Tolliver, the CFO over at Kava. She'll be joining us a little later in the hour.
And we're going to talk a little bit about global energy with the CEO of Vista Energy, about Argentina's push to replicate the U.S. shale boom. So there's a lot going on. Let's get you going, though. On the trade, here is Alexis Christoforous in for Charlie Pellet.
Thanks, guys. It's another record day for the Dow Jones Industrial Average, which is now up nearly 400 points at 48,317, being led higher here by shares of United Healthcare and Nike. In the broader market, the S&P 500 is up 8. The NASDAQ trying to climb into the green. So far, no dice. It's down about 65 points. And the Russell 2000 up just fractionally at the moment. We've got Treasury yields slightly lower with the 10-year yield at 4.06%, the 2-year at 3.5%. Gold rallying about 2% now at 42.08 the ounce, but we've got oil slipping, WTI crude down more than 4%, Brent crude off nearly 4%. That's on concerns about oversupply. OPEC says global oil supply will match demand next year, marking a further shift from its earlier projections of a supply deficit. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Alexis Christoforous, and that's your Bloomberg Business Flash.
All right, Alexis, thanks so much. We did see treasuries with yields dropping across the curve on bets that the Fed will have room to cut rates next month, that last meeting of 2025, maybe to help prop up the U.S. jobs market. Traders might get some clues. We've got a lot of central bankers out there speaking. We are curious to see what Bob Michael has to say. He's Chief Investment Officer, head of the Global Fixed Income Currency and Commodities Group over at JP Morgan Asset Management, a certainly well-known voice here across Bloomberg platforms. Joining us in studio, welcome, welcome.
Happy to be here.
Well, it's great to have you here. I feel like there's some different views out there, like the tariff angst maybe not completely done. We've got a growing U.S. budget deficit. Bob, we've got a slowing U.S. labor market. How do you see today, let me throw this in, more Americans falling behind on their car payments. How is the U.S. economy right now? How do you see it?
I think the U.S. economy is just okay. It's not great. I think recession is remote, but it's a little bit squishy. So it feels as though businesses and households are still struggling a little bit with tariffs and the ultimate impact to cost of goods. I think that's a headwind. Certainly, the government shutdown hasn't helped with sentiment. And of course, the Fed has highlighted for a while that interest rates are a bit on the restrictive side. And I think all of those things are conspiring to take a little steam out of the economy right now.
The labor market part is what I'm really interested in hearing from you. Absent government data for a couple of months, what's an accurate view of the strength of the labor market right now?
So the government data is one thing, but you and I both work in franchises which have ungodly amounts of data. We use that. We look at the Chase data. We look how the consumer is performing. The consumer looks okay. Deposit balances look okay. We're seeing big ticket purchases starting to tick up a little bit. But of course, all of that is concentrated in the top quintiles of earners. From businesses, our equity and credit analysts talk to literally hundreds of businesses a day. And what we're hearing there is they don't feel an urgency to do any hiring. They're in pause mode headed into year end. And of course, that would weigh on the labor market.
I want to bring into something that, and forgive me if I mispronounce it, Gregory Dacko, he's chief economist at EY Parthenon Daco. And he says the economy remains resilient on the surface, but it's increasingly dependent on three narrow interconnected A pillars: affluent consumers, artificial intelligence-fueled investment, and asset price gains, and talks about how they're connected, right? We know the wealthier consumer has been out there spending. They're responsible for really a big bulk of consumer spending that goes on in the U.S. But if the AI spending boom, Bob, is not if there ends up being a little bit of a bust, a big bust or something, or we start to talk about, right now we're talking about the spending and on balance sheets and, you know, whether or not we're going to have to kind of replace these items. They're not going to last forever, whether it's chips or what have you. But what if we see those asset prices come down? The affluent consumer doesn't feel so affluent. They stop spending. Does all of this start to come undone?
It could, but I think we have to remember we're a month and a half away from the One Big Beautiful Bill Act hitting. And when you look at the One Big Beautiful Bill Act and think about the tax refunds on tips and overtime and Social Security payments, where are most of those? Those are in the bottom couple quintiles of earners. So you're going to get some relief there. You think about the Genius Act and a lot of things that are happening there, you're going to see some spending there. And the one thing nobody's really talking about right now, which we see on the horizon, is deregulation. It's certainly going to come to financial services. It will likely come to other industries as well.
Well, that makes me think about, and we weren't going to talk about this till a little bit later on, but we do know that President Trump is hosting a little soiree with a bunch of financial executives. Jamie Dimon's going to be there, at least according to reporting or people who have been briefed on the event. Is that what they're going to talk about, the regulatory environment? Have you talked to Jamie about this? But if you were sitting down with the...
When I looked at some of the attendees, I suddenly thought, boy, there's going to be one outspoken bank CEO there.
Rhymes with...
I'm sure they're going to do a lot of listening. I think they're going to be a sounding board for a lot of things, the things that have been mooted in the market recently, $2,000 payments that go out, checks get cut, 50-year mortgages, maybe not, maybe you just take your mortgage with you. I think this is going to be an administration that will bounce things off of them.
Yeah.
I think it will be one that will ask them, what do we need to do to unleash big banking, big business? Are there other things that can be done? And I think there's going to be a group there that will be pretty free-flowing with the information.
For what it's worth, Caroline Leavitt at the White House was asked earlier this afternoon about the 50-year mortgages. She said the administration is seriously looking into 50-year mortgages. I do want to go back to the
Would
AI
you buy? Would you recommend investors buy
a 50-year mortgage?
Wait, which side, Carol, are you talking about? Like someone buying a home?
I got taught very early there's no such thing as a bad bond, just a bad price. So it depends on where it gets priced and the features in it.
I do want to go back to AI because
You didn't answer the question.
Carol asked about,
Depends on
hey,
price.
no
Well, it
bad
depends
bond,
on
just
price,
bad price,
right?
okay?
It's
Carol asked
secured.
about
It's secured by a home. I would buy it.
Okay.
I absolutely would buy it.
We were talking about one side of what ends up happening with AI and if there is potentially some sort of unraveling given or bust. What about the other side? What about the side where everything actually exceeds expectations, where productivity increases as a result of this technology, and then potentially we see widespread job losses? Are we looking at the right parts of this right now? Are we understanding where we could see productivity gains?
I think you have to look at it all. And I think you have to realize that unlike the dot-com bubble where nobody envisioned the iPhone 10 years later or whatever, and there are companies without revenue, without even really business models that were worth billions of dollars, you actually have deep-pocketed companies that are either developing or investing in it. And it is everywhere. We see it in JP Morgan, how it's being used everywhere to create efficiencies. You talk to any company now, and they talk about how they operate in real time. They can shift their supply chain. So think about the logistics and shipping. All of that can have some sort of AI overlay to it. How they manage their pricing, that could have an AI overlay to it. And those are two big things that have come out of tariff policy, and already we're seeing AI introduced there.
So what could possibly go wrong here in all that's coming at us?
I always go back to William McChesney Martin, whose comment was,
I kind of wish Tom was here because he would love that.
our job is to take away the punch bowl. And the reality is there's a lot of money sloshing around in the system. Policymakers on the monetary side and the fiscal side are working hand in hand. You may even see the regulatory side as part of that accommodation coming from everywhere. But we're not looking at the next Paul Volcker being appointed to the Federal Reserve. We're looking at people who fundamentally believe that lower interest rates create a level of economic activity which will generate higher productivity. So for me, as long as that's in place, I'm not really worried. I would get worried when you have to take the punch bowl away. Growth and inflation pressures are so high, you have to start draining liquidity from the system.
But you don't think we're there?
No, I don't think we're going to be there anytime next year.
Well, that brings us to one last question. We got the news today that Fed Bank of Atlanta President Raphael Bostic announced plans to retire at the end of his current term in February. We are seeing a changing composition, Bob, of the Fed, new names, more to come. Kevin Hassan telling Carlyle Groups and host of peer-to-peer conversations, David Rubenstein, that if President Trump asks, Hassett will do it. He also said he had high regard for Fed Chair Jay Powell. This changing, though, composition of the Fed, good, bad? How does that help hurt in getting policy?
I think it's reality. I think you have to accept that these are political appointees. And believe me, I know that they go into rooms, they work with their staffs, they try to make the very best decisions. But they come with different core fundamental views. And one could be the William McChesney Martin, Paul Volcker kind of view, which is there's too much money sloshing around the system. Get it out of here before we have an inflation problem. A Hans Tietmeyer kind of central banker. And others come thinking, no, we need to be able to create liquidity, make mortgages and housing affordable. That will create economic activity, which gets taxed. There will be productivity that comes out of AI, which will offset that headwind. It's an exciting time to be in the markets, and it's an exciting time to see the way policy makers are shifting around.
Come back soon?
Always happy to be invited.
Okay, we will definitely invite you. Bob Michael, thank you so much. Really appreciate it. Chief Investment Officer, Head of the Global Fixed Income Currency and Commodities Group over at JP Morgan Asset Management. All right, now we're going to talk a little bit about the global energy economy, Tim.
Yeah, this on a day when the International Energy Agency further tempered its stance on an imminent peak in oil demand, reinstating a scenario in which global consumption keeps growing to the middle of the century. We head on to the Bloomberg News Bureau in Buenos Aires, Argentina, and to the founder, chairman, and CEO of the close to $5.2 billion market cap exploration and production company, Vista Energy. Miguel Galuccio joins us. The company's ADRs trade in the U.S. under the ticker VIST, down about 8% so far this year. Welcome. Good to have you on the program today. I'm curious about this company being one of the few options for investors wanting a piece of the world's next shale boom in Argentina. Today, you told them about your plans for the next 5 years. Walk us through some of the highlights here and what the exposure for investors would be.
Hi, team. Thank you very much for having me. Yes, let me give you a context about Vista. Vista was a company that was listed in 2018 in the New York Stock Exchange at $9 per share. We're producing around $200 million EBITDA and producing 20,000 barrels per day. Today, we announced a plan where we're going to take the company to $2.8 billion in 2028 and producing 180,000 barrels of oil per day. So we are super excited about the next phase of growth of Vista.
One of the things I want to ask you, Miguel, is President Milei. He is somewhat of a global star, a Wall Street darling. He's already helped Argentina's shale industry. They've done deregulation, like getting rid of some price caps on crude there. So resounding, election for him, or I should say endorsement of him, what we saw in the midterm. What else would you like he and his administration to do?
Yeah, Carol. So yes, as you pointed out, stabilizing the macroeconomy, having access to the capital market is good news for Argentina. More of a country that have a lot of resources to be produced and where capital is one of the main elements that are important to continue accelerating the growth of Vaca Muerta. What else we can do? I think there's one thing that we can do is to become more competitive. We are today, we have a rock that is fantastic. We have super productivities. You have seen the numbers of Vista. We have margin of EBITDA around 65%. Nevertheless, the cost of a well in Argentina is still around 30 to 35% higher than the cost of a well in US. So being more competitive, that means deregulating the market, having less tax, better law, more flexibility, definitely could help for us to be more competitive. For Argentina, more competitive means more investment, more production, more export, more proceed for the country, more job for our people.
On the capital side of this, could the company now come to market with more global bonds or maybe even a follow-on equity offering? How are you thinking about financing?
Well, we just released a plan that is fully funded. We are in a cycle. We are cash flow positive. We have the inventory of wells to drill. We have the equipment. We have 4 drilling rigs and 2 frac sets. We have the capacity to evacuate. We export around 60% of our production today. In 28, we will export in 75% of the production. Vista is the main exporter of Argentina and the main independent producer for Argentina. So we don't really need to come to the market. But there are several companies from the industry that have come to the market last week due to the result of the election. And it's very positive for the industry that the rest of the industry had access to the market today. It clearly will accelerate the development of Vaca Muerta in Argentina.
So I am also curious, okay, so that would help Vaca Muerta. President Trump, as you know, is certainly an ally of President Milei. Helped him through a bad patch just a few weeks ago with the financial lifeline, right? We've reported that out. Everybody did. I am curious, in what ways do you think Argentina's close diplomatic ties with the United States, really President Trump, will help or impact the shale industry in your country?
Now look at Carol. I mean, everything that helped to stabilize the macroeconomy of Argentina, and as I said before, to gain competitiveness is good for the industry. So if Trump did that, it's good for the industry, it's good for the country.